Been deemed to be illegal by a court. The defence stocks in focus, as you say, Guy, that big defence spending plan coming next week from the Germans. They're set to approve military procurement contracts worth a record 52 billion euros. And ThyssenKrupp also in focus, as this business says it's going to swing to a loss in the current financial year. Weakness in the auto sector and restructuring charges to blame, Guy.
Okay, here we go. Big drum roll moment. I'm joking, of course. It's a small drum roll moment. We are waiting for markets to open here in Europe. Top down, nothing to see. Bottom up, I think there's going to be some interesting stories. I do actually genuinely think the wind story is interesting. What continues to happen in defence obviously is fascinating from a European point of view. Will it be reflected in the top-down market? No, the market is looking broadly for some clues as to where policy goes next. And I think until we get that, we may not sort of go very far. Volatility, remember, has come down over the last few days, though bond markets obviously remain reasonably elevated in terms of the yield. FTSE 100 is negative, the CAC 40 is mildly positive, the Stock 600 is mildly positive, and I'm using mildly really kind of quite buoyantly here. IBEX is up by 0.1%. I'm not entirely sure that the German market is going to play ball this morning and open early, so we're going to have to wait for that to happen. But while we wait for that to happen, there's some single stocks and maybe some sectors that are worth focusing on. Anna, over to you.
Yeah, absolutely. Let's go to where the sector movement is in the first part of the trading day. Financial services actually the best performing sector, up by 0.6%. We actually see Man Group as one of the stocks that's on the rise within that. We're around 50-50, gaining sectors, losing sectors. At the bottom of the basket, if you like, we've got basic resources, and we have seen some weakness coming through in steel prices and other basic metals overnight, so maybe that's having a negative impact there. We've also had some news flow surrounding some M&A in that space. We'll watch that. But one of the sectors that we mentioned in the run-up to the open is showing some signs of life, and that is the wind sector. We've got Vestas up by just shy of 3%. We've got Ørsted up by 3.4%. And, of course, this all in connection with President Trump's executive order being declared by a federal judge to be illegal, saying that, and this was seen as something that could be positive for these businesses that had great plans, particularly around the eastern seaboard, that had to be either mothballed or cancelled entirely. So that's where we are. In terms of the individual movers, we've got Novo Nordisk moving higher, Relics moving higher this morning, HSBC providing some downside movement. But, yeah, still waiting for Germany, to answer your earlier question.
I'm actually struggling to see any kind of clear narrative in terms of the stocks that are moving this morning. Oil stocks maybe a little softer. We have seen, obviously, a big move lower in the oil price. Maybe that acts as a bit of a drag. So you are seeing names like Shell under a little bit of pressure, but not a lot of pressure. It's British American Tobacco, HSBC, EssilorLuxottica, Swiss Re, Richemont. Some of the luxury names are actually a bit soft. So LVMH is also a little bit soft this morning. But again, not by much.
We do have those defence names just coming into action over in Germany now. So we've got Renk Group up by 4.3%. Some of the others within that space, industrial goods and services, of course, it forms part of that. So Hensoldt is up by just shy of 3%, Rheinmetall. And it's the confluence of the German spending. I mean, maybe we knew this was coming, but it's another tick in the box for the process of delivering huge uplift in German defence spending, plus the fact that we've got just more talks on Ukraine overnight as the message, and some progress, but no sort of resolution. Maybe that also leaves some space for these German defence names to go
Even
higher.
with this, the DAX is up a staggering 0.2%.
Yeah.
Which kind of speaks to the idea that we are maybe kind of waiting for the Fed. And it's also interesting that actually it's some of the pharma names that are doing the kind of the most heavy lifting across Europe. So you've got Astra, Allianz, Novo Nordisk, Rheinmetall in the mix at the top end of the market this morning. There's plenty of politics that we need to focus on as well. Look at what is happening in Germany, look at what's happening in France. There's things that are worth paying attention to. But how are we now thinking about what 2026 is going to deliver? And is the Fed going to give us any clues today as to what the story is going to look like? Madison Fowler, JP Morgan Private Bank Global Investment Strategist, joining us this morning. Good morning. You excited about the Fed?
Always excited about the Fed.
Is the Fed going to tell us anything useful today? Why are we excited about the Fed? Obviously, it's a Fed meeting. We need to pay attention. The Fed doesn't have much data going into this meeting, and we're about to have a Fed chair shift. We're going to get a lot of dissent. So I'm just kind of, which bit should I be excited about? Because in some ways you shouldn't be excited, but in some ways, with this level of dissent and this level of uncertainty, there's a lot to play for.
Well, I think there's reason to be excited for the fact that we will receive, incremental clarity on the path of future interest rates. So when we think about the fact that there might be a high bar for future Fed rate cuts after this one,
yep.
I think that does signal to us what the path of 2026 could look like. And so if we do see more pronounced dissents, for instance, in this meeting, that could signal to us that the Fed might be more cautious heading into 2026. But nonetheless, I think it is still clear that even with that, the Fed is maintaining its easing bias. But I'm very interested to hear not just about the short term, but also the long term as well, and how it perceives the neutral rate and the trade-off between, for instance, AI productivity-linked gains, but also some of the challenges related to fiscal activism and how that really shakes out, I think will be important as well.
What would you ask if you had a question to the Fed, Madison, today? And everyone will be focused on, obviously, the dissent question will be front and center. But you raised the AI story and productivity. And if we are focused on the longer term and what that can really deliver for the US economy and the global economy, I mean, what is it that we want to understand about the Fed's thinking on AI? Because we had lots of interesting conversations last week about the way that AI and inflation are going to interact, and maybe there'll be a mismatch in timing there. Maybe you get inflation first, then deflation, or maybe the reverse. I mean, what kind of questions would you be asking around that?
I think when it comes to the long term, and when we're trying to think through the balance of both AI and inflation, I think the biggest thing to try to understand is what does that ultimately mean for growth in the U.S. and also more broadly globally. So is there the belief that AI can lead to genuine productivity gains? And I think from our perspective, that answer is certainly yes. We are believers in the AI revolution. I think that doesn't mean that there aren't going to be pockets of froth and some consternation underneath the surface, and there will be winners and losers within that. But I do think understanding the strength of the potential productivity that could bring is quite important. And then, of course, what the path of inflation looks like as a result. So we do think that AI can have a deflationary impact, but at the same time, we know that there are more structural inflationary drivers as it relates to persistent capacity gaps, immigration controls, and all of that leads to higher structural inflation as well.
And what's the AI trade of 2026 going to look like then, with all of that in mind? Is it going to be, maybe it's not going to be about the early gainers, the companies that did really well in the first couple of years of the AI revolution. Is it going to be something different? We talk a lot about other sectors getting involved. Energy is the obvious one, other infrastructure. What's it going to look like, AI 2026?
I do think that we start to talk about that trade broadening out from here. So, and we're already starting to see more market discernment when it comes to even the big AI names. So, for instance, when we're just thinking about the trading of some of the hyperscalers, we are seeing markets start to, try to price in real time which of those names are going to see real revenue gains as a result of all of the CapEx spending that they've employed. So, I think that we want to be discerning around the hyperscalers, but we do expect that to broaden out, one, into the data infrastructure providers, two, into the power space. So we can think utilities there, those that expect to benefit from productivity enhancements, and there you can think like sectors like financials, even healthcare. But then I would also say that a lot of the value creation that we're seeing today is actually happening in private markets. Actually, some of the largest companies, both in the U.S. and Europe, call it between 85 to 95% of those are private today. And so when we think about that next wave of value creation, I do think we need a barbell, both public and private markets.
A lot of people are making asset allocation decisions for next year right now go to meetings, and what I'm hearing is that a lot of people are going to continue to allocate to private credit, private markets. Is that the right decision?
For private markets broadly, I do think it's important, especially if you are concerned about some of the rising concentration risks that we are seeing within the public market space. And again, when we think about the growth drivers of the future, I do think that allocating to private equity is important. When it comes to private credit, I think it's just another reminder of why very careful manager selection is so important. I do think when we're looking at the space broadly, there are some more reasons to be more mindful, I think, into the years ahead. But from a broad perspective, we are still seeing quite low default rates.
So some managers are, you think, maybe being a little too gung-ho in that space?
I think that ultimately it's really important to ensure that you are investing alongside managers that are being mindful of the underwriting standards, the underlying fundamentals, and when we allocate to any market, but especially within private markets, we do see that the dispersion between top and bottom performing managers is quite wide. And so I think that thoughtful manager selection is really important.
Okay, and thinking about, you mentioned in your notes, Madison, about fragmentation and how that throws up opportunities. I mean, that we had a conversation about European fragmentation earlier on in the program, which felt like that feels like a negative, that actually the answer is more pooling of interest, more capital markets union, savings and investment union around Europe. But you think about fragmentation as an opportunity because we live in a less globalized world, so that means more countries doing things for themselves, I suppose.
Ultimately, yes, and I think that's true across the board. So whether we are talking about AI inflation or fragmentation, there is a sense of the challenges bringing pressure, but also the promise of opportunities that are opening themselves up. So when we think about a more fragmented, more fractured global landscape that is, moving through more difficult supply chain issues, that's also led to, I think, increased fiscal activism. So governments spending more, corporates investing more heavily in CapEx, and we're certainly seeing that in Europe specifically as it relates to infrastructure and defense. And then, I think, again, bringing it back to the AI story, that's even becoming more of a matter of national security as well. So I think as countries are turning more insular, that opens up the conversation, I think, of global diversification and why that's so important because of that domestic story, I think, really burgeoning and that narrowing of the differential between the U.S. and the rest of the world into the years ahead.
Yeah, no, that takes us to the defence theme and that and the reshoring theme, plenty of ways in which that fragmentation, the less globalised nature of the world.
Emmanuel Macron was talking just about this when he was referencing China yesterday, talking about the idea that unless China figures out how to make the relationship more balanced, then maybe they have to go down a similar road to what we've seen in the United States. Madison, thank you very much indeed. Nice to see you. Madison Fowler, JP Morgan Private Bank, Global Investment Strategist. Looking ahead to 2026, let's look ahead to what we are seeing in the markets right now. Defence stocks catching a bid. You can see that with Rheinmetall, but you can see it across the entire sector. Luxury under a little bit of pressure. It's interesting that ASML's not doing very much, despite we've got that good news, apparently, from an NVIDIA point of view on the H200s. Anyway, let's focus on the defence story because that is the standout theme in Europe this morning. Louise Moon with more.
It is indeed the standout theme. So looking at Rheinmetall, BAE Systems, Saab, Leonardo, all of them across the board ticking up into the green in early trading. That's, of course, after Germany investing a record amount into their defence contracts. So we're seeing this across the board, all across, straight into the green for them, extending gains that we've already seen this year. Moving on from that, we're also looking at ThyssenKrupp, taking a look at their stock down over 13%. That's as analysts are focusing on their guidance rather than the beat in their results. Their guidance for the following year wasn't so strong, and that's what investors are really looking at this morning. Moving back to the UK, also looking at British American Tobacco, the tobacco giant. Their stock down over 4% into the red. They had their results this morning, and they cut their revenue guidance just slightly. They were seeing it at the high end, now seeing it slightly lower for the following year. So stock is reacting on the back of that for BAT. Now, moving into wind, obviously this is a big story after a US judge ruled that Trump's banning of new wind projects was illegal. So this is benefiting Ørsted, Vestas, both ticking up high into the green. Ørsted up over 2% this morning on the back of that. So positive news for them. Potentially some new projects could go ahead in the US. And then finally, looking at HelloFresh, down over 6% this morning. That's after there was cut by Morgan Stanley, saying that there's a lot of competition in the US in the market, and so the prospects for future growth are not a bit more shaky than potentially previously thought. So weighing on their stock today.
Louise, thank you. Louise Moon from our equities team with those stocks that are moving this morning. Up next, we'll continue to focus on the European defence space, including Rheinmetall, after Germany approves, or is set to approve, next week, a record 52 billion euros in military orders. That's next. This is Bloomberg.
Asia is at the forefront of some of the world's biggest stories. I'm Sherrian in Tokyo.
And I'm Heidi Stroud-Watts here in Sydney, where the trading day begins. We're here in the center of all the action to get you set up with the numbers, news, and knowledge you need for the day ahead.
The demand is indeed recovering. We've been waiting for this moment.
The opportunity of a century.
Join us on Bloomberg The Asia Trade. Weekdays only on Bloomberg TV. Context changes everything.
Bringing you up-to-the-minute geoeconomic news whenever and wherever it happens. I'm Vonnie Quinn in Sao Paulo, Brazil, and this is Bloomberg.
The countdown is on. Everything you need to get the edge at the end of the market day. Get ahead of tomorrow's trading with The Close. Weekdays on Bloomberg. Context changes everything. It's the world's second largest economy with a growing influence in global affairs. Bloomberg The China Show brings you the unmatched expertise you need to keep track of breaking news, in-depth market analysis, and the most influential newsmakers in and around China.
We need to do more to engage the market more.
We're risk on. I think we caught a little sweet spot.
Massive savings right now.
It's already a different game.
Bloomberg The China Show. Weekdays around the world, right here on Bloomberg. Context changes everything. From the world of politics to the world of business, Joe Matthew and Kaylee Lines deliver news, insight, and analysis live 2 times a day, every trading day. Balance of Power at 1 and 5 Eastern, only on Bloomberg.
The Middle East and Africa regions are home to some of the biggest deals and fastest growth in the world. Vibrant resources and high-yield investment opportunities abound. I'm Jumana Versace. Join me on Bloomberg Horizon's Middle East and Africa for the stories, newsmakers, and insights shaping the decisions of traders across this exciting region.
You had heightened levels of volatility.
There's still room to maneuver.
We do see opportunities.
It allows you to increase significantly your net income.
Every trading day, only on Bloomberg.
Bringing you up-to-the-minute geopolitical news whenever and wherever it happens. I'm Stephen Engel at Japan's Akasaka Palace in Tokyo, and this is Bloomberg.
Good morning. How are you feeling? Welcome back. You're watching the opening trade. We are 17 minutes into the equity market session, and you are actually seeing some outperformance coming through from Germany this morning. The defence story is front and centre. It is driving that market, and it is causing the DAX to be up by, let's call it 0.5%. I'm being slightly generous, but let's call it 0.5%. Elsewhere in Europe, nothing to see here. Very quiet markets. Quick look at the defence stocks that are doing all of this heavy lifting this morning. Remember, many of them are in Germany, but not all of them are in Germany. Rheinmetall, Hensoldt, Renk, Leonardo across Europe, all moving higher, but BAE Systems is also on the upside. Some of the adjacent names are also moving to the upside as well. But this is German military spending that is likely, we think, to be announced next week. 29 military procurement contracts. We think the number is, let's call it circa 52 billion euros. We were anticipating this was going to come through at some point. It's just that it's interesting on the timing and kind of the size and scope of what we are seeing here. So let's get the details of what we know, what we're expecting. Let's go to Oliver Crook, our Chief Europe correspondent, who joins us today from Brussels. What do we know? What are we going to get next week? We've got a big procurement drive coming through from the Germans. They are accelerating military spending. What do we know about that military spending?
This is the Germans really putting their money where their mouth is. This is part of the sort of Zeitenwende. This was the famous speech given by Olaf Scholz after the invasion of Ukraine, the turning point for the German military and their view of their own military and the military capacities really being brought into life by Friedrich Merz now with this latest procurement, which is 52 billion euros worth of military orders. And just to put that into context, Guy, the German military budget in 2021, the year before the Ukrainian invasion, was 47 billion euros. That was the entire military budget for the entire year. So we're talking about a single order that goes beyond that. As you can see there, it's going to be, a lot of it's going to be on basic military gear, about 22 billion, 4 billion on infantry and vehicles, 3 billion on interceptor missiles, and also that Arrow program that we'd heard from the getting from the Israelis, and about 2 billion there on surveillance and satellites. We should say that this obviously is one of the sort of most biggest drivers within all of European defense spending. This is super important for companies like Rheinmetall, which is up about 2.5% this morning, because it gave them the confidence to make the kinds of investments that Rheinmetall needed to make. 13 different factories, doubling, tripling capacity at a number of these plants. That's what the CEO told me last week, and that has been one of the major issues, actually getting these contracts in. And in order to get these sort of upgrading in terms of capacities and building out this actual stuff, the German companies need that kind of confidence, and it's very clear that the German government is giving that confidence. That is one thing. We have one side of this equation, which is the materiel. There's a difficult other side of it, which is the personnel. This is the question of the number of people within the German military. The German military stands at only about 180,000 active military troops at the moment. When we think about Russia, that's over 1 million. For the Ukrainians, that's approaching 1 million. So that is going to be the next step and potentially the choke point for the German military. But as it stands, this is really the Germans executing on those ambitions, those big ambitions of military buildup.
And Oliver, sticking with the defence theme, we've also seen, yes, some conversations, many conversations taking place around Ukraine at very high level in Europe over the last 24 hours, but not a huge amount of progress. But there has been an indication that maybe more unity has been found around security, around the frozen Russia assets and the use of those in backing a loan to Ukraine for the rebuilding of Ukraine. But is Belgium on board? I mean, that's been the stumbling block for some time, as hundreds of billions of dollars are in Euroclear.
Yeah, so that's the big question. We haven't heard anything particularly positive from the Belgians over the last weekend or the last couple of days. You know, the last thing we've heard publicly from them is saying that they basically had great misgivings about it. They were not yet on board with the plan. That being said, what we heard from European leaders with that degree of confidence came yesterday after that meeting between Keir Starmer, Zelensky, Friedrich Merz, and Emmanuel Macron. And Friedrich Merz had been in Brussels having dinner with the Prime Minister of Belgium just on Friday, right before going to those meetings on Monday. So it's quite possible that he had a bit more insight, a bit more success in lobbying the Belgians in terms of making forward progress on that. And really what the Belgians are asking for, I think, is fairly reasonable, that they share the burden of potential litigation or having to repay the loan if that were to have to materialize across the EU 27 or the EU 25. The other sticking point is, of course, Hungary and Slovakia, who have sort of raised objections about this. The Europeans will be able potentially to get around them by a qualified majority, so that's potentially is going to be put to rest. But really, this is the crunch time. Over the next 10 days, they need to come to a consensus on this. This is what we'll be talking to finance ministers about later this week. And really, the big event is next week for the European leaders meeting that will be taking place in Brussels. And we should say that in my conversation with Volodymyr Zelensky a couple of weeks ago, he was very unequivocal about the importance of these Russian assets. He says for the Ukrainians, this is a matter of survival, and that 90 billion euros will go basically 2/3 of the way of funding not only the Ukraine military, but their own other budgetary issues for the next 2 years. So absolutely critical. Even if you're really concerned with getting a peace deal across the line, it's the difference between sitting across the table from the Russians with $100 billion in your bank account and not having it.
Okay, Oliver, thank you very much. Bloomberg's Oliver Crook in Brussels with the latest on the German defence push and the Ukraine news. Let's pivot to the tech sector, where NVIDIA is making gains in after-hours trade after winning President Trump's approval to ship its H200 AI chips to China in exchange for a 25% surcharge. It paves the way for the chipmaker to potentially regain billions of dollars in lost business from a key global market. Bloomberg's Jill Desis joins us now from Hong Kong. So, Jill, we saw NVIDIA trade higher in after-hours on the back of this. I mean, this could be quite significant, I suppose. It's not the top-end chips, but it is a market that NVIDIA counts on no revenue from right now.
Yes, that's right, Anna. And as you said, I mean, we're talking potentially billions of dollars in revenue that could be on the cards here. Just look at what Jensen Huang said a month ago, talking about China is a $50 billion market. So you're looking at absolutely massive potential here, even if you're accounting for that 25% surcharge. I mean, the fact that NVIDIA has been unable to sell any chips to China over this past year as these tensions have persisted, I think does tell you that, you know, if all sort of just goes ahead as planned, if they're able to sell these chips there, if China ends up buying these chips, I think that you're looking at a really, really significant opportunity for NVIDIA.
Okay. Persuading Trump might be the easy bit. Persuading Xi could be the hard bit. Is China actually going to want to buy these things?
Well, Guy, I think there's a couple of things to keep in mind here. So these H200 chips, they're actually quite a bit more powerful than the H20 chips that were originally in question earlier this year that NVIDIA was trying to sell to China. In actuality, the H200 chips are about a generation ahead of anything that the local Chinese chip makers like Cambricon or Huawei are able to produce right now. So you've got that as one factor, is that these are just more advanced chips. The other factor is that at present, China actually needs more chips than any of those local producers are able to supply. So when you take that into consideration, I mean, yes, it is true that the Chinese government has been trying to convince China to wean itself off of American chips, has been dissuading the purchase of American chips, but at the same time, I think, you know, the actuality there of being able to purchase an advanced chip that those local chip makers can't produce yet, I think is a pretty big draw here.
And I suppose we think then about what it is that President Trump is going to want from China in return for allowing them access to these H200 chips. We know what he wants from the US businesses exporting, and that's money, because that's what NVIDIA and AMD and anybody else is going to have to pay to the US. But what does he want from China? Do we have any sense?
Well, Trump just said that, you know, after talking, he said he was talking with Xi recently, that he's under the understanding that China could potentially be buying more U.S. soybeans. You know, that entire agricultural sector, that's been something that's really been at the center of a lot of these U.S.-China tensions this year, and China, you know, going through, you know, the prolonged period of not purchasing any U.S. soybeans before agreeing then. So Trump is saying that, like, that's maybe one thing that he can get from the Chinese side of things here. Maybe, you know, ultimately agriculture is where he sees his big win.
Yeah, you wonder how much this could all change and how quickly it could change and how volatile it could all be. It's going to be an interesting 2026. Jill, great stuff. Thank you very much indeed. Jill Desis on what is the latest with NVIDIA. Let's talk about some of the stocks that we're watching here in Europe in a bit more detail. ThyssenKrupp is under a little bit of pressure this morning. The numbers actually this time around aren't that bad. It's the outlook that I think is causing most concern right now, and what is happening in terms of the cash position of this business going forward. Costs are a huge factor, and that is being reflected this morning in terms of the weak guidance that maybe we are seeing being delivered. So the stock is down by, what, 6.25%?
Yeah, absolutely. So the stock responding, as you say, to that negativity around the guidance. It's interesting, it's the steel unit's doing okay if you're looking at the year-on-year performance here. But there's a lot of concern around autos. It's auto technology that's down 24% year-on-year. Materials services also down 35% year-on-year. So those are the areas, those are the parts of the business where they're having this weakness. I mean, the weakness of the auto story is a well-known one.
It certainly is. And are we going to see that converted into maybe a military story going forward? There'll certainly be some suggestion around that. Up next, we're going to talk about what is happening in Abu Dhabi. It's Finance Week there. We're done with the Formula One. We're on to Finance Week. We're going to check in on the private credit landscape. Direct lending is a big story. Golub Capital CEO Lawrence Golub is going to be joining us next. This is Bloomberg.
crises, two essential crises, and for both it's now or never: democracy and climate, and they are absolutely interlinked. And we have to solve them together. We're losing the democratic infrastructure and norms to deal with the climate, and we're losing the climate stability that is essential for a democracy. We have to solve them together. We've never faced a threat like this to our democracy at a time when it's a perfect storm, at a time when we're being told by climate scientists, some of you may be in this room, that we have to cut our emissions, fossil fuel emissions, in half in 5 years now. You know, when I started to realize what was happening, it was 12 years, and we haven't done it.
Technology is embedded in every aspect of our lives.
And laying the foundation for the future.
From finance to defense, AI to entertainment.
And from the road to the stars. Bloomberg brings you the latest stories of the people and companies pushing the tech sector to new frontiers.
And the politics that shape global tech markets.
I'm Caroline Hyde in New York.
And I'm Ed Ludlow in San Francisco.
Watch Bloomberg Tech every weekday.
Only on Bloomberg Television.
From our studios in New York and San Francisco, our expert hosts have the data and analysis from the companies you know and the startups to watch, plus the interviews you don't want to miss. Watch Caroline Hyde and Ed Ludlow on Bloomberg Technology, the only daily business show dedicated to tech, right in the middle of the trading action. Live every weekday, only on Bloomberg Television. Context changes everything.
What is going to be the consequence for U.S. markets? We are basically deep in the European earnings season.
Take a look at how we're faring when it comes to Asian markets.
This is the opening trade, 30 minutes into today's session. Tuesday morning, this is what we have for you across European equity markets. Then up by 0.2%, not much, but better than we'd anticipated maybe an hour ago on a Fed day. We're waiting, of course, for the Federal Reserve, or day one of the Fed, I should say. Of course, they give us the results of their deliberations tomorrow. The DAX is up by 0.4%, and some of that is around the government spending, in particular around defense. We've seen defense names pretty strong this week, in part due to Ukraine news flow and also due to these defense lines coming through from Germany and the spending commitments that we're expecting to see nailed down there next week. The French market up by 0.2% ahead of a crucial budget vote, and the FTSE 100 underperforms this morning. Guy, what have you got?
Okay, 3 is bigger than 2. That's what I've got. Markets are a little bit higher. I know that doesn't take into account weightings, but basically we've just got a few more stocks that are higher than lower. Defence names are certainly helping. London may be a little bit of a laggard with some of the oil names a little softer. Volume is down. It's Fed day one. Let's park that and move on from that. Let's talk a little bit about some of the leaders and see what has happened there. Defence names are on the front foot after the Bloomberg story. Rheinmetall is up by 3.4% on the back of the spending plans we're expected to be announcing next week. BNP Paribas is climbing quite nicely as well, 1.7% to the upside. Orsted, the wind story in the United States. A judge may be pushing back against the Trump administration's ban on East Coast wind farms. That certainly is helping out Orsted this morning. So that's kind of the positive story. Let's turn to what is happening on the negative story. There seem to be outlooks for next year that is causing a few problems at the moment this morning. British American Tobacco outlook. Market doesn't like it. Stocks down by nearly 5%. ThyssenKrupp outlook. Market doesn't like it. Stocks down by 7.72%. HelloFresh is actually a downgrade, I think, by Morgan Stanley. Its outlook for next year is that we're going to see more competition in the United States, and as a result of which that stock is down by 7%. So it's looking forward into next year that seems to be causing a few problems at the bottom end of the market this morning. BAT, Thyssen and HelloFresh all weaker on the back of that, Anna.
Guy, here are some of the other stories we're watching this morning. The French Prime Minister, Sébastien Lecornu, faces a key vote on the social security budget today. The risks fueling political turbulence in Paris. The National Assembly will vote on a bill which covers spending on welfare, health and pensions for next year. Google is being investigated by the European Union over whether it has abused its dominance by using its own artificial intelligence tools to squeeze out competition. The Commission said today it will look at whether the firm has distorted competition by imposing unfair terms on content creators and giving its own AI model an advantage over its rivals. And President Trump's son-in-law, Jared Kushner, has emerged as a player in Paramount's fight for Warner Brothers Discovery just days after Netflix agreed to a deal. Paramount is making a hostile $30 a share cash takeover bid for all of Warner Brothers. Financing terms unveiled yesterday show that Kushner is participating in the Paramount bid through his investment firm Affinity Partners. Guy?
Okay, let's turn our attention to what is happening in Abu Dhabi. Finance Week is on. The Formula One is over. Bloomberg's Abir Abu Omar joins us now from there. Over to you.
So this is the second day of Abu Dhabi Finance Week, where we have been over the past couple of days speaking to a lot of the executives that have come to the region. And joining me now is Lawrence Golub of Golub Capital. Lawrence, lovely to have you with me today.
Great to be here. Thank you.
Let me start with a quick question about your company's philosophy. Now, you brand yourself as good boring, which is in fact a good thing when it comes to your line of business. But in the light of the geopolitical tensions that are happening across the world, whether it is in the US or Europe or even here where we are in the Middle East, does that philosophy shift a little bit? How does that factor into how you think about what you do?
In our core business, which is acquisition finance, direct lending, it doesn't shift. It's good boring. We want to have partners who are equity holders, usually private equity firms, who are very skilled, careful, have a lot of money junior to us. We want a lot of resiliency in terms of things that can go wrong. But we do have to pay attention to what geopolitical issues or international issues or local economic issues might bring to bear big risks. And that brings in our second part of our philosophy, which is really to be specialists in credit, specialists in acquisition finance. So we specialize to be able to be boring.
So let me talk a little bit about what is happening when it comes to the monetary policy. Now, with higher for longer rates, where are, do you think, the best returns when it comes to risk-adjusted investments?
Well, I think I would urge investors not to look at the very short term. Don't worry about whether this 25 basis point cut is going to be followed by another one immediately or not. Forward curves show SOFR coming down to about 3% by this time next year. That rate is sustainable, good, attractive if we, on a dollar basis, have inflation under control. So a 3% SOFR rate, if we've got 2% inflation, maybe even 2.25% as we have some short-term adjustments from tariffs, that's all a real indicator of stability. And you know, we really like being floating rate investors because we don't have to guess about longer rates. But I think you'll be able to see, we'll all be able to see what the impact on longer-term rates are from this lower for longer or however it ends up. If long rates, for example, the 10-year Treasury is slightly over 4%, if that ticks up, that could have an adverse impact on growth rates in the U.S. We are very satisfied with the growth that's going on in the U.S. economy right now. It's not booming growth, but it's better growth than we expected when we understood the tariff implications. We do a quarterly report looking at our monthly financials all through the portfolio, and we don't see any indication of a base level of growth slowing down.
Right. Let me turn a little bit towards this part of the world. We are in Abu Dhabi at ADGM. You just recently got your license to operate here. And I've been asking this question to a lot of the people that we have been meeting with over the past couple of days. Why Abu Dhabi? You know, there's a lot of capital, a lot of people, a lot of operations that are moving to this part of the world. But where do you see the pockets of opportunity when it comes to the Middle East or the Gulf in general?
We've had investors from the Gulf and from Abu Dhabi and the Emirates for more than 10 years. We decided a couple of years ago we wanted to open an office locally to be closer to our clients, to demonstrate our long-term commitment because we're being asked to. And I think that connectivity with people in government, people in the business community has really accelerated our growth in the region, not just in Abu Dhabi, but in the Emirates generally, and even in Kuwait and Saudi. I think that we're going to expand our office very significantly next year. Interestingly, nobody ever comes to the office. It's about having an office and having local people and being engaged in the community, philanthropic work like we do with NYU Abu Dhabi Stern, And it's not easy to just pinpoint, okay, because we opened an office, we got this investor or that investor. It's really about being part of the community. And we are also developing over time strategies to invest, not just invest back like philanthropy, but actually create investment strategies that take advantage of the growth of the economies here.
So we were talking about this before, earlier before this interview, and we were talking about direct lending and private credit growth in the region. And I asked you a question about, again, the pockets of opportunity that you're finding in the region when it comes to private credit. In Saudi in particular, we were talking about how private credit notions are on the rise. Do you see that the market is in the Middle East ripe for this kind of sophisticated vehicle?
I think it is becoming very ripe, but not in the way we might have anticipated 2 years ago. 2 years ago, I would have talked about how we would by now be doing acquisition financing for middle market companies, and there are opportunities here and there for that, but it's not really a scaled business based on the private equity industry having not developed as much. We do a lot in some of our other strategies of partnerships with banks, whether that's through CLOs or SRTs, which are synthetic risk transfer. These products are perfect to help Saudi banks expand their lending capability, and we're actively exploring, in parallel with changes in the regulatory environment to enable this, to be partners with some of the financial institutions in Saudi and hopefully also in the Emirates. So that's going to be, I think, a real opportunity for us and investors of ours.
Let me turn a little bit inward, and as an independent credit manager, will you, do you think, at any point be open to negotiations with larger players on consolidation efforts?
Well, we have a number of minority passive investors, and we've used that to build our balance sheet. You know, it's public that KIC, one of the Korean sovereign funds, and Mizuho, the large Japanese bank, are minority investors with ours, and we have important joint ventures with both of them. We're pretty dedicated to staying as an independent, boring specialist in credit. We don't want to be spread all over the place. We're best in sponsor finance. We want to be best in the adjacencies to sponsor finance, like working with banks on these structured products, and we're very happy with that.
And just finally on private credit again, and as it becomes something that is talked about a little bit more often, we've been hearing a lot about private credit, especially over the past few months, and how it's on the rise if it replaces traditional funding, traditional banking. Do you see, and going back to your point about regulation, do you think that regulators will eventually have to step in, and would that be healthy for the macro markets?
Direct lending and our relationships as an industry with banks actually reduce risk, don't increase risk. Banks have just as much money invested indirectly in acquisition finance and private equity finance through their loans to BDCs, through their loans to other private credit managers, but they're at the top of the capital stack. So just like we, as part of our culture of being boring, want to have the private equity firms own the bottom half, we are responsible for the first risks and the second risks and the third risks. So banks are really a lot more secure, and they make a lot of money on a capital-adjusted Basel III, Basel IV basis. It's very profitable to lend to firms like ours and BDCs.
Lawrence, thank you so much for joining me today.
Thank you.
Lawrence Golub of Golub Capital. Anna, Guy, back to you.
Abir, thank you very much. Bloomberg's Abir Abu Omar in conversation there about credit markets, private credit markets, part of that conversation, and thinking about risks and where they might lie. Now, staying with the credit markets, hosts of the Bloomberg Odd Lots podcast spoke with Dan Iverson, the CIO of PIMCO, who is warning of dangerous assumptions where inflated credit ratings may be giving investors a false sense of security.
It is very, very dangerous to assume something has an investment grade rating just because the rating agencies assign a rating to it. It's critically important that you do your own credit work.
Those are the views then, Guy, of Dan Iverson, saying that you shouldn't just believe what you get on the tin from the credit rating agencies. And he's drawing the parallels with the GFC and saying, you know, at that point, you really shouldn't have trusted. Everything that was sliced and diced was AAA.
We've seen this movie before.
Yes.
2008. We've seen this movie. Are we about to see a rerun? And the point he's making, actually, is that regulators don't like to bail out businesses that have already had one bailout twice. So maybe the protection that has existed in the past for kind of expanding certain areas of the financial markets maybe don't exist for this particular area of the financial markets going forward. So watch out. So if you're not going to do your due diligence, don't expect the regulator to be there and help you out.
Yeah, that is interesting. And the links you have into the real economy and the rest of the economy could be material in the thinking of those regulators and whether they do get involved.
So what should we be worrying about more? Is it an AI bubble, which is kind of 2000, or is it 2008, which is the private credit bubble? There's two choices going into 2026. Up next, we're going to talk about what is happening maybe over in France today. The French Prime Minister, Sébastien Lecornu, faces a key vote on the social security budget today. It doesn't completely kill the finance package, but it could hold it below the waterline were this not to go through. We'll deal with the details and find out why it's important next. This is Bloomberg.
Nobu-san, would you say, when you look at your career, that the pivotal moment was actually that meeting with Robert De Niro? It took him 4 years to convince you to open a restaurant near him. You eventually did, and that started a partnership that has lasted through the decade.
You know, I met him 1988 after my first restaurants opened. He asked me to come to open the restaurant in New York. And beginning, I didn't know what he did.
You didn't know he was an actor?
No, I don't know what he doing. Because I never watched the movies, you know, I was traveling, the business. But of course, after, you know, people, hey, Nobu, so you must know him. And then I understand.
How is he as a partner?
He's, for me, and a great partner. He understands to my concept. He supports me 100%. But he's a very smart people. Sometimes, so strange idea, but it's good idea. So, example, Nobu Hotels, idea come from him. He said, hey, Nobu, so we have a lot of new restaurants coming in somebody's hotel. For him, doesn't make any sense. Then we start Nobu Hotel in Las Vegas 11 years ago. Now it's a big success. So next step is the residence.
Why do the biggest names in business choose Bloomberg Television?
That's a great question.
It's a very good question.
Interesting question. Good question.
Great question.
I so appreciate that question.
You certainly ask interesting questions.
Bloomberg Television. Top experts, great questions. Get your fixed income fix. Watch Bloomberg Real Yield around the world right here on Bloomberg. Context changes everything.
Welcome back to the opening trade. 8:46 in London, 9:46 if you are in Paris. We are seeing modest gains across European equity markets, waiting for the Fed, digesting a lot of news out of Germany. We also look ahead, though, to a crucial vote taking place in Paris today. The French Prime Minister, Sébastien Lecornu, faces a key test later today. The National Assembly will vote on the social security budget, which covers spending on welfare, health and pensions for 2026. We're joined now by Bloomberg's Caroline Conan, who's now back in Paris and can give us some information here. So how significant is this vote then, Caroline? I have lost count of the number of crucial votes that this Prime Minister has had to take to the Assembly.
you're not the only one to have lost count, really. And this is, again, perhaps another moment of truth for Sébastien Lecornu. We had the very, very tight adoption of the revenue chapter of that social security bill on a Friday night. And today we get the spending part and the overall social security bill voted at the National Assembly after being back and forth between the Senate and the National Assembly several times. That includes, again, the suspension of the pension reform that the socialists wanted to include. Remember, that was a precondition for them to support this bill. So the socialists, fortunately for Sébastien Lecornu, have called to vote in favor of this bill. However, we are seeing cracks within Macron's camp. The centrist party horizons of former Prime Minister Edouard Philippe, himself a candidate for the next presidential elections in 2027, is saying he can't vote in favor of this bill now, and he is calling for his 34 MPs to abstain. The Republicans were also supporting Lecornu before, remember, may also abstain. So even if you get some of Macron's camp and some of the socialists, it might be really, really tight. The National Rally and the far left will vote against this bill. So we may see either a very, very tight vote or a rejection of that bill. Another back and forth between the Senate and the National Assembly with really no compromise in sight.
OATs are 72 basis points over Bunds right now. I just point out the BTPs are 70. We'll park that thought for the moment and talk about what happens next. Should the market be worried? It was only a few months ago we were trading 85 over Germany. Is there a danger that we go back to those kinds of levels? What are you hearing from the market?
In the very short term, you know that Lecornu is not using this constitutional article 49.3 to put his responsibility on the line. So there is not going to be any government collapse today. There is not going to be any Lecornu resigning over the next few days. So the level of risks that we are seeing is not the same as we saw in early October when Lecornu resigned and was reappointed a few days later. However, of course, there is the subject of having no budget for France. What does it mean? For example, for the social security budget, it means increasing the social security deficit from 20 billion to 30 billion euros. It means possibly some special laws in order to roll over the 2025 budget into 2026. So this process is going to take a long time. The risk level clearly could still increase. The deadline for the vote on the overall state budget is December 23. And with all these back and forth between the two chambers, we're clearly dangerously approaching this deadline. Last year, remember what happened? We had the Barnier government collapsing because he had put his vote of his responsibility on the line. This time, it's not going to be the case, but we may have no budget in France until March or April next year, according to the budget minister. That means no reforms, deficit that keeps increasing, debt levels of France that may, in the longer term, become unsustainable.
Okay. That feels like a familiar theme. We'll see exactly how it's going to play out this time. Caroline, thank you very much indeed, Caroline Conan, on what is happening with the French budget debate. Let's talk about what we're going to be seeing from the rest of today. 2 p.m. we got the vote in France. Later in the session, the Energy Information Administration is due to release its short-term energy outlook. Oil prices have been coming under a little bit of pressure. Gas exports are a big theme in the United States. There's a lot of exports, which is potentially driving up gas prices over in the United States. JOLTS data from the United States a little bit later on, always backward-looking, worth paying attention to. I think it's a tiny bit more backward-looking than normal. Anglo shareholder vote, Tech Resources shareholder vote coming up a little bit later on. But it's Fed Day 1. I think that's kind of the main thing.
Yes, it is. And the thing about Fed Day 1 is it never delivers anything because you have to wait for Fed Day 2.
Actually, to be fair, we have to wait for Fed Day 3. Because basically...
We do in Europe, yes.
It's basically a 3-day process.
It is a 3-day process, so get ready. Right, let's bring in Bloomberg's Valerie Teitel. She's with us for this 3-day process that is the Fed. Val, yields have been on the rise. We talked about this a little while ago. Europe yesterday, Japan last week. US Treasuries have been catching a little bit of that. The RBA overnight. What does this tell us?
Yeah, no, it's been an interesting thing that Treasuries are being dragged around by global factors instead of normally what we see is the other way around. Treasuries leading the rest of global fixed income markets. But it has been a confluence of factors that have seen U.S. 10-year Treasury yields rise around 25 basis points, just in the month of December alone. So the market is getting a bit worried that we could be breaking out of these recent levels that we've been really stuck in for the last 3 months when it comes to Treasuries, and that could be higher. This is all on the back of the market pricing in, a higher terminal rate next year, which is surprising given the last 3 months we haven't really gotten a lot of new data. We're still waiting on this backlog of data. We're still waiting for some clarity for the Fed. I don't think we're going to get that tomorrow, given how contentious and divided this Fed is and how much they're still waiting on the November backlog as well. But interesting to see that it's really also been the belly that's been leading this sell-off. So not necessarily what people are thinking immediately about central bank policy, but what we could get next year, be it a more hawkish Bank of Japan, a more hawkish ECB, as we heard from comments from Isabella Schnabel yesterday. So the belly's really leading this, and we're seeing a repricing globally of the neutral rate, essentially.
I'm not sure I want to think about 2026 yet. There seems to be a fair few things to think about in 2025. Is it safe to put my Christmas tree up yet?
I would say that this year is different because normally after the second week of December, everything quiets down. But now that we have this backlog of data, the November CPI and the November payrolls are going to be released in the third week of December. So honestly, we could get some pretty decent volatility right up until year end. We know this is a very illiquid point for markets. You have, various portfolio managers really not wanting to take a lot of risk, and whenever they see even just a shred of losses in some positions, they want to cut them and crystallize their gains for a year. So I really think that headed into Christmas season, that last week of December, we could see some real volatility. I think a huge curveball could be the Supreme Court ruling on tariffs. We're hearing from the street that really this ruling can come any day now.
And Trump's clearly worried about it.
He's promising these stimulus checks in the back of tariff rebates. He's really trying to position himself for what he's going to do if he loses the Supreme Court ruling. But this could have a bad effect on the Treasury market. We saw last time around when there was worries about the Supreme Court ruling that essentially we had a big sell-off in the Treasury market because they have to pay back this tariff revenue. That's something that's been sitting in the U.S. government coffers. So it's negative for the deficit, again, which has really made little progress since Trump's been elected.
If that happens, though, we will go straight into that conversation about how President Trump is going to get this revenue anyway through some other measure. I'm just predicting that will be the conversation, won't it, Val, about whether there are other levers he's going to pull, other tools he can use. Interesting on a stocks perspective, the MLive team had a pulse survey of investors that showed there are expectations that US stocks go quite a bit higher on the back of that kind of Supreme Court ruling. So what might worry the end of the bond market might pop stocks higher.
I think that would depend on whether you think that now that Trump is not allowed to use these emergency powers for tariffs, if we're less likely to see tariff-induced inflation next year. And that's a thing that, is continually being discussed, whether tariff-induced inflation is something that already happened or whether it's something that's yet to hit the market. And that kind of discussion, I think is likely to really rock the market next year. As soon as we decide whether tariff-induced inflation is in the rearview mirror, we've already seen it. There's nothing more coming. We could see a big revision lower in people's CPI forecasts. I know you're raising an eyebrow to that because you doubt that kind of optimism about progress on inflation. But again, obviously we have November CPI to wait for. Then we have the December.
We had one guest today who was not worried at all about inflation.
He did then go and highlight the risk. Yeah, it was the same. If it was Chris Watling.
Yes.
So my question is, if the Supreme Court throws it out, do we get another moment where you have another sort of board and he stands in front of it?
So more theatre.
Yeah, does that happen again?
Well, look, the administration has been very clear that they have plenty of tools to use in order to replace this kind of tariff revenue. It's whether it actually happens, just how long it does take them to replace the IEPA, the Emergency Powers Act that they have been using.
I'm assuming, so I'm going with no, not safe to put Christmas tree up yet.
Yeah, I think that's the conclusion of many of my conversations with Valerie Totel towards the end of this year.
It'll go up.
Bank of Japan, we could also get a surprise
Bank
there.
of Japan, that's going just before
Don't
Christmas.
close it up yet.
No, absolutely. Valerie, thank you very much indeed. I'm going to catch up on the conversations around the aviation sector with Willie Walsh out with IATA's big report of the year. We'll have that on the brief a little bit later on, around 10:40. That wraps things up for the opening trade. The Pulse is coming up next. This is Bloomberg.
Coming to you live from Kuala Lumpur. The whole world is here.
The APEC Leaders Summit bringing together heads of states of 21 APEC economies.
The White House is trying to use the stops to gain additional leverage.
This big deal with a number of the biggest companies in South Korea.
That's a big number.
Deals can be done.
Trust Bloomberg for on-the-ground coverage.
Korea is not Japan.
Up-to-the-minute reporting.
In this latest salvo of this trade war.
What a visual.
And the analysis you need.
China's not going anywhere, nor are we.
Bringing you the world's business and financial news whenever and wherever it happens. I'm Michael McKee at Mount Everest, and this is Bloomberg.
Key investors, top executives, global innovators. Join me for in-depth conversations with the biggest newsmakers on the day's top stories.
Insight with Haslinda Ahmed, only on Bloomberg.
Morning, this is Bloomberg Daybreak Europe. I'm Tom McKenzie in London. These are the stories that set your agenda.
Taking you from the U.S. market's close to the overnight session in Asia, we'll walk you through what you need to know to kickstart Europe's trading day. Live from our European headquarters, we bring you the day's top market-moving stories, unmatched expert analysis, and on-the-ground reporting from across the continent. Tune in to Daybreak Europe, only on Bloomberg Television. Context changes everything.
At a time when policy in Washington is driving Wall Street, we draw a distinction between the rhetoric and the action, bringing you market-moving guests and original reporting. This is Bloomberg Surveillance.
Tune in to Bloomberg Business Week Daily.
We got to talk crypto.
From the magazine that helps global leaders stay ahead.
What's the conversation around your company?
Bringing you insight on the people, companies, and trends shaping today's complex economy.
Planning very big things.
A new level of premium.
Plus global business, finance, and tech news as it happens.
The floodgates of innovation are going to open up.
You can't fake passion. You either are or you aren't.
Bloomberg Business Week Daily, only on Bloomberg.
Germany seeks to transform its military with a record 52 billion euro defense spending package. This, as Ukraine's president said there's still no deal to end the war. NVIDIA wins President Trump's approval to sell more powerful H200 chips to China, despite concerns that it could undermine U.S. national security. Plus, family drama, Paramount enlists the help of President Trump's son-in-law as it launches a hostile bid for Warner Brothers just days after it agreed a deal with Netflix. So, good morning, everyone. There's stocks posting small gains across the board. Again, bond yields hovering near Monday's high. Traders actually refraining from making big bets ahead of the Federal Reserve. S&P futures gaining some 0.1%. We always look at the U.S. 10-year yield, a great benchmark, 4.1722. Euro dollar. Now, this is an interesting conversation on the appetite for investors looking at euro, given also the White House's position on Europe when it comes to defense spending, 116.45. We'll get on to defense spending, especially coming from Germany a little bit later on, and then Brent down some 0.3%. Look, the European markets map, I know yesterday Friday was pretty much flat. Today, if you look at the difference between, for example, a DAX that's gaining some 0.4%, really boosted by some of the defense spending hope that's supporting this index, and the FTSE down some 0.1%. For the conversations that matter and the insights you need, let's get started.
Newsmakers and market movers. This is The Pulse with Francine Lacqua.
Well, good morning, everyone, and welcome to The Pulse. I'm Francine Lacqua here in London. Now, Bloomberg has learned that Germany is set to approve 29 military procurement contracts worth a record 52 billion euros. Now, it's part of the government's push to transform its military into Europe's strongest conventional army. Let's bring in Bloomberg's chief Europe correspondent, Oliver Crook. Ollie, good morning. So what more do we know about these contracts, and what message is it trying to send?
The message that it sends is that the Germans are putting their money where their mouth is. This is part of the initial program that was launched by the former Chancellor Olaf Scholz, the so-called Zeitenwende, turning point speech that he gave after the Russian invasion of Ukraine. And this is Friedrich Merz really picking up the mantle and really executing on some of those ambitions. We should say $52 billion is the number of orders that have been approved now, or were likely going to be approved for the German military. To put that into context, Francine, in 2021, the year before the Russian invasion of Ukraine, the Germans spent only 47 billion euros on their entire military budget for the whole year. So this is one sort of procurement a go-ahead by the Bundestag, dwarfing all of the spending formerly of the military before the war and the invasion. What we get in terms of the actual money for the gear is 22 billion on basic gear, about 4 billion on infantry vehicles. You can see there 3 billion on interceptor missiles, and almost 2 billion euros on surveillance satellites. I think this comes, Francine, at a time when we are seeing the American foreign diplomacy. We had that national security document that came out on Friday, really wanting to see the Europeans take more responsibility for their own defense. And this is part of the reason that the Germans have been called repeatedly by U.S. officials a model ally, because they're really executing on those ambitions and really what the United States would like to see. Now, one of the issues that the Germans are going to have, yes, the money is there and they're spending it, and we should say that that is really being represented on the Stock 600 right now. Most of the biggest gainers on the Stock 600 this morning are arms manufacturers, many of them German, is how are they going to get the number of personnel that they need in the military. The German military only has 180,000 active duty personnel. The Russians have, for example, over 1 million, the Ukrainians almost 1 million. That is going to be the next step for the military build-out for the Germans.
Yeah, and Ollie, I mean, this comes as Europe nears a deal on using frozen Russian assets to fund Ukraine. European leaders seem increasingly confident that they'll be able to do so, before the end of the year following the talks in London.
Absolutely, and those are talks that were held by President Zelensky, Emmanuel Macron, Keir Starmer, and Friedrich Merz. And we should say that the sort of biggest impediment to grasping those assets and the reparations laws has been Belgium. And we've not really heard anything from the Belgian Prime Minister over the last couple of days that suggests that his position has changed. That being said, those statements were made after that meeting that included Friedrich Merz. Friedrich Merz had met with the Belgian Prime Minister here in Brussels on Friday, potentially had some success in lobbying him. And really, this is going to be for the European leaders to discuss over the next 2 weeks. They will be meeting here in Brussels in about 10 days' time, and that really is seen for many as the last moment for the Europeans to make consensus and to get moving on this reparations laws. And we should say, Francine, the sort of importance of getting that 90 billion euros to Ukraine is absolutely fundamental. When I spoke to Zelensky a couple of weeks ago, he said for them, this is a matter of survival, and for the Europeans, it may be a way to get them back at the negotiating table in these conversations with the United States on Russia and Ukraine.
Ollie, thank you so much. Bloomberg's chief Europe correspondent, Oliver Crook. Now, President Donald Trump says that NVIDIA has permission to ship its H200 AI chips to China in exchange for a 25% surcharge. The chip maker could now potentially regain billions of dollars in lost business from a key global market. Well, Bloomberg's Tom McKenzie is here with the very latest. Tom, so great to see you. So first of all, how significant is this for NVIDIA?
It is very significant. It's the first time we've seen in the last few years, and you saw it under the Biden administration, administration and then into the second Trump administration, a continuing ratcheting up of export controls on the hardware and software that is available and can be shipped into the Chinese market. So this is the first time we've taken a step back in terms of those restrictions, with the H200 being an AI chip that has significant capability and is very different to the H20. The H20 was specifically designed for the Chinese market and was therefore allowed to be shipped in to China. It never really got there because the Chinese, or at least in recent times, because the Chinese authorities themselves discouraged their own companies from buying the H20. The H200 is a far more powerful chip. It was just the last generation prior to the Blackwell, which is the AI accelerator that the likes of OpenAI and other hyperscalers currently use. So we would give China capabilities it currently doesn't have at a time when China's own chip producers not only are a generation behind, but also are not able to produce the number of chips that China's own company needs. The key question is, will China accept these H200s? And also, what's the Treasury going to do with that 25% take?
So, Tom, do we have any idea of what demand will look like in China?
Well, potentially the demand is really significant, again, because China's own chip makers are behind in the technology and also can't produce as many chips as they need. So you've got companies like Cambricon, you've got companies like Moore's Threads, and you've got companies like HiSilicon, which sits within Huawei, that are the key leaders in terms of turning out and designing AI chips that can on some levels compete with their US counterparts. But again, they are behind on the technology and they are not producing as many chips as they need. So really, we have to watch for Beijing's response. Do they adjust their rhetoric, their jawboning of Chinese companies and suggest that they are able to take shipments of these much more powerful chips to allow them to build and continue to innovate? And that is really where we're watching now, I think, is how Beijing responds to this. But it's a clear, from President Trump's side, it's a clear concession from the US as he thinks about his trip to Beijing in around April of next year.
Yeah, and he's possibly, thinking of a deal. Tom, thank you so much. Tom McKenzie there with the very latest on NVIDIA. Now, U.S. Treasury yields edging higher, traders growing anxious over the pace of easing by the Fed. With us now, Alexandra Wilson Elizondon, the co-chief investment officer of multi-asset solutions at Goldman Sachs Asset Management. Alexandra, thank you so much for joining us. I mean, what a day to have you on. What will the Fed do next?
So, we're expecting a hawkish cut from the Fed. That's, nothing new in that. In fact, that's what the market's expecting. I think what's more important is to focus on the dots for next year, and then any comments as it relates to the balance sheet, anything that's interpreted by the market as a liquidity injection in the system. Yeah. So you could, even with them being hawkish, you could still see risk asset continue to perform on the back of any announcement like that.
Do you see, Alexandra, just the economy deteriorating, especially the labor market, into 2026?
I mean, we expect to see pockets of weakness, and we have. And in fact, we're expecting Chair Powell to keep maximum optionality in front of next week's job data, which will be critical because they are still very data dependent. But holistically for the year, we're still expecting to see above trend growth, mainly driven by fiscal stimulus, as well as, continued CapEx spend from the AI trade. But in terms of markets, we're not expecting a linear upward trajectory as it relates to risk assets. In fact, we expect to see some volatility. Definitely
across equities?
Across equities. So definitely not calling, a top. We still see, room for continued performance, but the margin of error is a lot tighter given where valuations are. And then, previous guests were speaking to the global duration trade and how much rates are moving upwards. And we just think that there's more room for, macro to be repriced, a higher dispersion of macro across the board.
Do you worry about AI valuations? So when you're intimating they're priced to perfection, so is it going to be pockets of air being let out, but then they increase again, or could we actually see a fundamental correction?
I think there's going to be continued dispersion amongst names. This is a really important week as well for earnings. We see a lot of the CapEx ecosystem announcing this week, and some of the things we're really focused on are actually CapEx plans. In particular, you've seen in credit markets a response to the $1.5 trillion that's being expected to be issued over the next 5 years. And so we're really closely watching some CDS markets, actually not for underperformance, but actually for some outperformance this week, just given if you get any announcements as it relates to GPU-backed issuance, some more transparency and clarity, but it'll be a key focus point for us.
How do you invest across the world? When you look at U.S. exceptionalism, we talk about it, waning a little bit, but actually equities are still performing very well.
Yeah, they are performing very well, and we don't see a stop to the U.S. exceptionalism trade, but we do have more diversification in our portfolios, and whether that's across the U.S., Europe, but increasingly towards EM. In fact, we're very bullish on India, just given a lot of the, government focus, the GDP trajectory, but also, just more of a productivity gain and better performance from equities over the next year.
Is this because of the EM discount?
Definitely, yeah. So in some cases, you're seeing the EM discount being, up to 2 standard deviations cheaper than normal. But, we still see not just the pricing, but there's a lot of fundamental tailwinds in some of the areas. And some spaces you've seen tremendous bid from retail, in particular areas like Korea, that can continue. And we expect that to, expand more across the globe.
Alexandra, as we look into a little bit backward looking at 2025, you had these geopolitical tensions that are coming back at the forefront. They haven't really played out in markets. I guess at the margins you could see a little bit of an impact on oil. Do you expect more of the same in 2026?
I mean, from a geopolitical angle, we're actually focused on most announcements have been positive on the margin. And so increasingly it's about, what concessions are made, what negotiations are taking place. In fact, you were talking about some of the NVIDIA announcement this morning. So we see a lot of room for positive trajectory and just knowing where that specifically might play out in sectors.
I mean, we're trying to figure out with Tom exactly how, the NVIDIA chips sale to China was going to play out. Any thoughts on China overall? A lot of it is deflationary, but then we're also, potentially expecting quite a lot of stimulus in 2026.
Yeah, I mean, we've re-upped our forecast for GDP growth, especially on, how much the export announcements have increased. And we're on our, third 5-year plan. It seems to be quite pragmatic. It obviously puts a little bit of a hindrance on European outperformance, just given it could slow down growth. But more holistically, we're pretty bullish, but we're also, cautious. We know that there's a lot of capital that can be put to work, especially because people have been underweight China for some time. But again, it's still, there's, the geopolitics haven't been completely resolved, and there's, some pockets of volatility to be expected on a go forward.
Do you like, equities in Europe? And is it very either sector dependent or actually country dependent?
A little bit of both, to be fair. We're expecting some stealth performance, so nothing aggressive, nothing like we saw in the first quarter of this year. In fact, we've seen less retail buying in Europe, more of an institutional focus. But we do still expect, Germany and the fiscal plans that you're continuing to see momentum behind to continue to put some thrust behind European equities. It just doesn't have the same momentum in terms of technicals as other markets do.
Does the consumer hold up both in Europe and the U.S.?
Yeah, in fact, we expect the consumer to be better in the U.S. given some of the tax stimulus. And that is a big driver of our GDP forecast.
I mean, another, the big theme for 2025 is, of course, Liberation Day, trade and tariffs, and it feels like the market's kind of largely overlooked some of the concerns into 2026. Do they continue to just look through it?
So it's interesting. If you look at most of the macro calls, they're pretty consistent. And from our perspective, just given some of the valuations, some later cycle dynamics, this is the exact kind of market that you put some tail hedges into your portfolio. We do like, for risk, owning the front end of the yield curve. And in fact, most of the commentary recently has been how auctions aren't performing and duration is trading off. But you saw, yesterday, the 3-year Treasury auction was pretty incredible. In fact, I think it was, the second best in terms of, non-bank takedown. So we continue to think that there's a lot of different pockets of opportunity, especially just given where options and vol are priced, to, put some hedges into the portfolio.
Alexandra, thank you so much for joining us. Alexandra
Thanks for having me.
Elizondo, there, Co-Chief Investment Officer at Multi-Asset Solutions for Goldman Sachs Asset Management. Now, coming up, the French Prime Minister faces a key budget vote. We'll discuss all of that with an economist from Jefferies. This is Bloomberg.
U.S. jobs numbers are released. Bloomberg has the report under surveillance with crucial data and expert analysis at terminal speed. Nobody covers Jobs Day like Bloomberg.
Asia is at the forefront of some of the world's biggest stories. I'm Sherrian in Tokyo.
And I'm Heidi Stroud-Watts here in Sydney, where the trading day begins. We're here in the center of all the action to get you set up with the numbers, news, and knowledge you need for the day ahead.
The demand is indeed recovering. We've been waiting for this moment.
The opportunity of a century.
Join us on Bloomberg The Asia Trade. Weekdays only on Bloomberg TV. Context changes everything.
It's the world's second largest economy with a growing influence in global affairs. Bloomberg The China Show brings you the unmatched expertise you need to keep track of breaking news, in-depth market analysis, and the most influential newsmakers in and around China.
We need to do more to engage the market more.
We're risk on. I think we caught a little sweet spot.
Massive savings right now.
It's already a different game.
Bloomberg The China Show. Weekdays around the world, right here on Bloomberg. Context changes everything.
Good morning. This is Bloomberg Surveillance.
Welcome back to the opening trade. Watch Bloomberg Tech. This is the Asia Trade.
This is Wall Street Week. Welcome to Balance of Power.
This is Bloomberg Television. Tomorrow, the Fed decides.
There are credible arguments to cut interest rates. Equally, there are credible arguments to do absolutely nothing.
I think the Fed believes that this is a risk management exercise.
Trust Bloomberg to bring you the fastest coverage and exclusive analysis, including Powell's press conference.
You wonder at this point how much the Fed is between a rock and a hard place.
There's going to be a lot of hyperventilation about this.
Tune in to Bloomberg Surveillance. The Fed decides, starting at 1:30 p.m. Eastern.
If inflation continues to be persistent and looks like it is not coming back down towards the board's target, then I think that does raise questions about how tight financial conditions are, and the board might have to consider whether or not it's appropriate to keep interest rates where they are, or in fact at some point raise them. But I wouldn't put a timing on that. It's going to be a meeting-by-meeting decision.
The Australian Central Bank Governor there, Michelle Bullock. Now, the French Prime Minister faces a crucial vote on the Social Security budget today, with risks reigniting political turbulence. The outcome is highly uncertain, as previous votes passed by narrow margins. Rejection would be a serious blow for Sébastien Lecornu. Well, let's bring in Modupe Adebembo, economist at Jefferies. Modupe, thank you for joining us. I mean, it feels like this is a story that's going on and on and on, and it's unclear what needs to happen for a budget to be able to pass.
Yeah, no, exactly. It feels like Groundhog Day. We've seen this many, many times. And what I think is quite interesting is we've already seen the Socialist Party leader tell his party to back the Social Security bill. So, look, I think we could have a narrow kind of, once again, a narrow approval of this bill. But it means that going forward, we still have this uncertainty. And that's why we remain negative on the French outlook. Because even if we limp forward, these underlying structural issues remain there. And also it means that the kind of fiscal consolidation that France needs to deliver is becoming a lot more challenging.
Is it just difficult in general for most European countries? I know there was a lot of concerns about Chancellor Merz in Germany. Then today we have, they're actually going for contracts and quite a lot of defense spending. But what looks good in Europe right now from an economic point of view?
So I think the challenge for Europe at the moment has been that growth just overall has been lower. And of course, we still have the lingering hit from the kind of European gas crisis. But what we're seeing in Europe is that, particularly in Germany, there is some kind of bright sparks when you think about the level of government spending that Germany are set to embark on and have already started. That is really big. And I think that can have a significant impact on the German economy, but also spill over as well to other areas of Europe, which can help to build this kind of revival. But as you say there, the kind of political uncertainties make it really, really challenging to deliver on that.
Especially after the White House got this white paper or this paper out on Friday, which says Europe is a little bit of a mess. I don't know whether it changes the perspective of politicians of what they need to do economically to make sure that they are resilient, deal with the debt, but also spend enough on defense and budget.
I think it's challenging because we're slowly seeing the kind of transatlantic relationship shift, and I think that paper kind of sets it out quite clearly. But if you think about it maybe from a positive perspective, I think it could push European leaders to do more and to understand that they need to do more to kind of support their own economies. So that's one thing that we think could be positive. And if you think about what Germany have done with the infrastructure spending, that's taken a long-standing issue and trying to deal with some solutions. The next challenge will be on delivery, of course, and I think markets and investors will be really, really focused on next year. Do we actually see the fruits of those sorts of investments? But at least the kind of plan, I think, is a really, really good start.
But when you look at some of the central banks that have been supporting a lot of equities through this year, what happens in 2026? Are we going to see more of a divergence with, for example, between the ECB, the Fed, and the BOE?
So I think it's interesting because, at least starting from the ECB, we've had some interesting comments, at least from Schnabel, suggesting that, the next move from the ECB might be a hike. And actually, I would say we don't agree with that view. I actually think that the ECB is likely to remain on hold throughout all of 2026. But if anything, I see the risks skewed to the downside. When you look at the inflation outlook in the Eurozone, we see it below target for 2026 and 2027 as well. So kind of lower inflationary pressures there. But then you also think about some of the things around kind of trade diversion, demographic trends, and potentially AI as well. But all of these things weigh on inflation to the downside. So I think we're less hawkish in that sense. But when we look at other central banks as well, I think in the Bank of England, or for the Bank of England, rates are already high. So I think we would all agree that rates remain restrictive in the UK. And there's a lot more for the Bank of England to do in terms of bringing rates down towards neutral, maybe even slightly below, because ultimately I think that growth in the UK could disappoint, and that could push the Bank of England to cut more than markets are currently pricing.
And this would be, has the Bank of England just been a little bit too slow to cutting, or is it because there's, also, I guess, domestic dynamics that complicate an extra layer for the Bank of England?
I think you have to at least see it within that context that there are slightly different domestic dynamics in the UK. Even when you look at spot inflation in the UK, it is still high, well above the Bank of England's target if you compare to the Eurozone, where inflation is essentially at target. So it is a slightly different kind of picture. And so I think the Bank of England has been responding to that difference. But what I think we'll see next year is that inflation will take quite a significant step down lower, and especially some of the policies that we saw the government implement in the budget that actually helps the near-term inflation trajectory. So that is helpful. And then when I think you take that alongside some of the weakness in growth that we're seeing on the UK side, if you look at some of the smaller pieces of data that came out last week, so the Bank of England's decision maker panel was quite weak, at least on the employment side, and the construction PMI. All of those things, and they're not great indicators, for growth and inflation dynamics going forward, but it just does mean that the Bank of England can do a bit more, I think, on the monetary policy side.
Are we going to see a lot more volatility into 2026? 2025, actually, we ended almost where we started, but it has been a bit of a roller coaster, right?
Yes, indeed. No, it has been a very, very volatile year. And I do think that at least the way I see it, at least, some of the macro drivers also do support some more volatility, particularly on the fiscal side. I think we've talked about some of the politics in France, haven't necessarily touched on some of the politics in the UK, but I think those kind of factors will continue across Europe and in the US as well. And those are some of the things that I think could really, really drive volatility in markets. But I would say that overall we are positive on kind of risky assets, and we think that the economic backdrop, even though in some ways it is deteriorating, I don't think it's a significant deterioration in a way that would put any issue. So I think that is supportive.
What did you see dollar doing? Will it weaken further?
So I think it's interesting. I think we could continue to see a weakening in dollar, and that's actually one of the things that we think could also induce the European Central Bank to cut rates, actually, because if you think about seeing a further weakening in the dollar, we haven't yet heard about the confirmation of who the next Fed chair will be. I think some of those challenges around whether it will be someone who maybe will cut rates faster than markets feel is necessary, or potentially the economic dynamics suggest would be necessary. If we have someone who's extremely dovish, that would be negative for the dollar. And I think that's also would have impacts on other countries as well, other countries' central banks.
Thank you so much, Modupe Adebembo, their economist at Jefferies. Now, we have a couple of things we need to watch out for. First of all, the markets, all eyes on the Fed this week. There's also a couple of other things that we're watching out for, which is exactly what's happening in Europe. So first of all, stocks rising modestly. Stocks posting some of these small gains. I don't know whether we have a market market board. We'll get to that in a second. Small gains while bond yields hovering near Monday's highs. Again, traders actually refraining from making big bets ahead of a Federal Reserve decision. Then we have BMW naming Milan Nedeljkovic as CEO from May 14th, 2026. We found out today that Oliver Zipse will step down at the end of May 2026. So again, quite a lot going on. We'll spend a bit of time also talking about Ukraine. When it comes to Ukraine, Europe seems to be nearing a deal on the Russian assets after these talks that we had in London. Ukraine's allies are under growing pressure to find fresh sources of financing after U.S. President Donald Trump's administration last Friday largely stopped aid to the war-ravaged country. Coming up, our stress test, the way forward to alleviate concerns in the private credit sector. We'll discuss all of this with the CEO of Arkmont Asset Management, Anthony Fobel. That's next, and this is Bloomberg.
Rodriguez.
And I'm Jason Kelly.
And we're back with another season of The Deal.
With athletes and entrepreneurs who are changing the game on and off the field. Jerry Jones.
Some good-looking trophies.
1 and 1 is 3 in sports, not 2. And it's because that 3 is imagination. That 3 is putting yourself in a way, having yourself hit the home run.
Erica Ayers-Badon.
I'm a high-energy board member. I'm very passionate. I have a lot of opinions.
Robin Arzón.
I want to light fires in people's lives, and that is still one of my core mandates for all of my businesses.
Justin Tuck.
I tell all of my friends that play in leagues now, make these relationships now while you're hot. Don't wait till you're like your 12th year in and you're just hanging on.
Stay tuned. You won't want to miss it.
The Middle East and Africa regions are home to some of the biggest deals and fastest growth in the world. Vibrant resources and high-yield investment opportunities abound. I'm Jumana Versace. Join me on Bloomberg Horizon's Middle East and Africa for the stories, newsmakers, and insights shaping the decisions of traders across this exciting region.
You had heightened levels of volatility.
There's still room to maneuver.
Reduce the opportunities.
It allows you to increase significantly your net income.
Every trading day, only on Bloomberg.
Astonishing day for U.S. technology.
It's shaping the region's technology ecosystem.
Asia's biggest tech news and innovation.
It's a multi-trillion-dollar industry. We'll show you what's happening in ETFs like no one else. ETF IQ, only on Bloomberg.
Good morning, everyone, and welcome to The Pulse. I'm Francine Lacqua here in London, and these are your top stories. Germany seeks to transform its military with a record €52 billion defense spending package. This comes as Ukraine's president says there's still no deal to end the war. NVIDIA wins President Trump's approval to sell more powerful H200 chips to China, despite concerns that it could undermine U.S. national security. Plus, family drama. Paramount enlists the help of President Trump's son-in-law as it launches a hostile bid for Warner Brothers just days after it agreed a deal with Netflix. Now, regulators in the U.S. are being urged to conduct stress tests on the private credit market, warning the bankruptcies of companies such as Tricolor and First Brands Group are just the tip of the iceberg. The Bank of England is already evaluating how the private credit industry would respond to financial stress. Well, joining us now is Anthony Fogel, the Chief Executive of Arkmont Asset Management. Anthony, thank you so much for joining us. So first of all, I mean, this was quite a big development, actually. What do you think about the Bank of England's plans for a stress test of private markets?
Yes, I mean, I think we think it's a very good thing. Clearly, it's a review of the broader financial markets, so liquid markets and private markets. And really, as one of the founders of the private credit industry in Europe, we actually volunteered to participate in this exercise. And really, I suppose it gives us an opportunity to demonstrate what we think has been an extremely resilient asset class over really the last 15 years.
But I guess as a private credit becomes even more established as an asset class, what are the, I guess, pitfalls or the things that you worry about for your industry?
Yes, I mean, ironically, regulation is not one of them, because generally I think private credit has been seen as a force for good. If you cast your mind back to the financial crisis, really all financing was either provided by banks or the liquid markets, and the regulators have very much moved away from that and encouraged private markets and private credit to come in and provide necessary financing, perhaps at times when either banks or the liquid markets are not able to respond.
Is it resilient enough? Or, again, it's really impossible to know what's in some of these black boxes.
Yes, I mean, I would like to think it is. I mean, clearly, if you think about the investors of private credit, they are the leading pension funds and insurance companies globally, and they certainly put us through pretty rigorous tests before they choose to invest in us. And I think one of the trends we're seeing, as you alluded to, is a growth in private credit. And I don't think insurance companies and pension funds and sovereign wealth funds would be doing that if they weren't very happy with the returns that we've generated and the resilience we've demonstrated through some pretty interesting economic and political times.
Anthony, has the rise of AI made you more cautious about lending, for example, to software firms or in the software space?
Yes, I mean, that's clearly a theme that we look at very intensively. I think over the last 15, 20 years, there are always themes that might cause a disruption in the market. We are actually, as a sector, quite heavily focused on software and IT services. But we do think that actually most of the businesses we invest in should be pretty robust. I mean, interestingly enough, it's just an exercise that we and a lot of our peers have been carrying out, really bringing in experts just to not only look at our current portfolios to make sure that they will be robust in those circumstances, but also to help us educate us, to the extent anyone is an expert, on some of the investment themes that we need to be mindful of as we think about future investments.
Do you see a danger of AI being in a bubble, full stop, and so anything also that's private will be touched if it suddenly drops?
I don't necessarily think so. I think if you get a significant public market correction, inevitably that will have some impact on the equity valuations in the private markets. But we are very much at the debt end of the spectrum. We are boring lenders, and really what we focus on is, does the business has sufficient cash flow to service our interest and ultimately repay the debt? So it's a lower threshold.
I don't believe that for one second. Otherwise, we wouldn't have you on TV. What do you worry about how, if you look at the algorithm or actually mathematics that you use to market things, is there anything that could change significantly in the next 12 months?
Certainly, I wouldn't say in the next 12 months. The two things that always concern us are very heavy recessions. I mean, actually, one of the reasons why we welcome this Bank of England exercise is most of us, when we do our investment theses, always look at the loans having to survive a normal type recession. Generally, you're making 7-year loans, so it's a pretty sensible thing to do to assume that you will go through a recession. I think GFC-type recessions obviously put additional stress, so that would be a concern, but I don't think that's in anyone's immediate forecasts in the next 12 months.
No, but there has been a slowdown in private equity activity overall. So what does this mean for leverage buyouts, but also financing bolt-in acquisitions?
Yes, there clearly has been a slowdown over the last 2 to 3 years, although interestingly enough, we've seen a significant, probably a 30 to 40% pickup in private equity deals during the course of 2025. And as we look at our pipeline going into 2026, we're seeing a very active private equity market. And I think a lot of that is driven by the fact that financing costs have come down, but also public market valuations make it a better time for private equity firms to exit deals and do new deals. So actually, we've seen a significant pickup in private equity activity, and we've seen a corresponding pickup in our own activity as well.
Blue Owl had to cancel its plan to merge a public-private credit fund. What does it tell us more broadly about individual and retail investor interest in private credit?
Yes, I don't think that was quite specific to those particular circumstances. I think your point is a good one, which is generally we are seeing more appetite from retail for private credit. I think that's very much driven by the US, where investors typically are more active than Europe. But I would emphasize at the moment this market is very much open to professional investors rather than mass retail. But we support that. I mean, just as we've seen a significant growth by institutions coming into the asset class, we think that appropriately qualified retail investors should also have access to the asset class, and I think that will continue to grow.
Anthony, thank you so much for joining us. Anthony Fobel, their chief executive of Arkmont Asset Management. Now, President Trump's son-in-law has emerged as a player in the fight for Warner Brothers Discovery after Paramount launched a hostile $30 a share cash takeover bid. It comes days after the company agreed to a deal with Netflix, while Bloomberg's deals reporter Manuel Baigori joins us from Hong Kong. So, Manuel, what can you tell us about Jared Kushner's involvement in this hostile bid?
Francine, another day, another twist on this fascinating saga, the potential acquisition of Warner Brothers. Yes, Jared Kushner seems to be one of the parties, one of the backers involved in Paramount's hostile bid. Was disclosed, as we've seen yesterday, and has unfolded into a potential bidding war between Netflix and Paramount. Kushner's involvement is definitely remarkable. He was also, through his firm Affinity, was also involved in the previous mega deal of Electronic Arts, the take private as well, in the tech space earlier in the year. So this is another high-profile deal in which we see his name as one of the key potential backers. And it's not only him and his firm. We are seeing other high-profile investors in there, including some sovereign wealth funds from the Middle East, also Apollo, the alternative asset manager, lots of banks providing financing. Definitely a fascinating saga here that remains to be seen how it's going to unfold, because now everybody obviously expect what Warner Brothers will say in response to this offer being made public, and also potentially what Netflix next move might be as well.
So, Manuel, where does this leave the bidding war?
Yes, Francine. So as in any bidding war, everybody is going to be very tactical about the next move. I think the next few days will be key. Obviously, now Warner Brothers has 10 days to respond to Paramount's offer after being made public. Obviously, two offers, two different proposals on the table. Netflix, obviously, there is cash and shares for some of the assets. Obviously, then we've got Paramount, which is $30 all in cash for the whole company. What their response for Warner Brothers and the shareholders will be critical here, right? Whether they prefer one bid versus the other, and what the pressures might be for each of the company on their next moves. Remains to be seen. Also, the political backdrop. Donald Trump has been quite vocal about the idea that a potential deal by Netflix could also raise antitrust issues or concerns given the big market share that the combined entity might have. So the next few days, next few weeks will be very, very important, and each company obviously will keep the cards close to their chest as they try to analyze the next moves.
All right, Manuel, thank you. Bloomberg's deals reporter Manuel Baigori. Now, the European Union has begun an antitrust investigation into whether Google has abused its dominance by using its own AI tools to squeeze out competition. Now, the Commission is also looking into how much AI overviews are based on web publishers' content and whether they're being paid appropriately for it. Google has not yet responded to our request for a comment. A U.S. judge has ruled that President Trump's executive order banning new wind projects is illegal. The ruling says the president's January order was arbitrary and capricious and contrary to law, siding with more than a dozen U.S. states and a clean energy group. Now, the order froze dozens of projects, including large-scale installations planned off the eastern seaboard. And the U.S. Supreme Court has signaled its willingness to give the president more control over a traditionally independent federal agency. In a hearing on Monday, justices suggested they will let Trump permanently remove Rebecca Kelly Slaughter from the Federal Reserve Commission or Federal Trade Commission, despite a law saying commissioners can be fired only for specified reasons. Now, the ruling could undercut the independence of the Federal Reserve, but conservative Justice Brett Kavanaugh has indicated he would reinforce a carve-out the court created for the central bank back in May. Coming up, we get an insight into the lives and investment activities of the billionaire class. That's next. This is Bloomberg.
Technology is embedded in every aspect of our lives.
And laying the foundation for the future.
From finance to defense, AI to entertainment.
And from the road to the stars. Bloomberg brings you the latest stories of the people and companies pushing the tech sector to new frontiers.
And the politics that shape global tech markets.
I'm Caroline Hyde in New York.
And I'm Ed Ludlow in San Francisco.
Watch Bloomberg Tech every weekday.
Only on Bloomberg Television.
The countdown is on. Everything you need to get the edge at the end of the market day. Get ahead of tomorrow's trading with The Close. Weekdays on Bloomberg. Context changes everything. From our studios in New York and San Francisco, our expert hosts have the data and analysis from the companies you know and the startups to watch, plus the interviews you don't want to miss. Watch Caroline Hyde and Ed Ludlow on Bloomberg Technology, the only daily business show dedicated to tech, right in the middle of the trading action. Live every weekday, only on Bloomberg Television. Context changes everything. Tomorrow, the Fed decides.
There are credible arguments to cut interest rates. Equally, there are credible arguments to do absolutely nothing.
I think the Fed believes that this is a risk management exercise.
Trust Bloomberg to bring you the fastest coverage and exclusive analysis, including Powell's press conference.
You wonder at this point how much the Fed is between a rock and a hard place.
There's going to be a lot of hyperventilation about this.
Tune in to Bloomberg Surveillance. The Fed decides, starting at 1:30 p.m. Eastern.
I'm a little bit worried now, to be honest, what the next days and weeks will bring, in the sense that, of course, we, just like the Ukrainians, want to have peace as soon as possible, but not at any cost. Because certainly if this war isn't Trump's war, which it totally isn't, the peace will be Trump's peace. And I'm sure President Trump is interested in having a lasting peace.
The Finnish foreign minister there speaking to Bloomberg. Now we're in the middle of the world's biggest wealth transfer as multi-generational billionaires inherit the largest amount in history. Now, meanwhile, a new generation of self-made billionaires is steadily emerging, fueled by success in sectors such as tech and financial services. That's according to a UBS report on the investment habits and concerns of ultra-high net worth individuals. Joining us now is Maximilian Kunkel, the Chief Investment Officer for Global Family and Institutional Wealth at UBS Global Wealth Management. Thank you, Maximilian, for joining us. Look, this is an extremely interesting and important survey that you've put out. What do market participants most misunderstand about how billionaires want to use their money today?
So I think in terms of what they want to do with their money, first of all, they do not see equities being in a bubble that you want to sell out of. In terms of their intentions for the next 12 months, only 3% of the billionaires that we surveyed say they want to reduce developed market equity exposure. In fact, actually, they believe that this is a bull market that you want to embrace. More than 40% want to add to equities. We'd agree, because ultimately what we are seeing is we're still seeing a very powerful rate-cutting cycle globally and earnings growth that is accelerating. The second thing I would say that's noteworthy is exposure to gold. Last year, for example, 40% said they wanted to increase gold, and of course we've had that very significant rally. Now only 3% of them say they want to reduce it. So again, this is something that's quite remarkable about this cohort, because typically it's not that interested in having metals in its portfolio, but rather companies. And there is this continuation of wanting to add to this space.
Maximilian, how are the younger generations actually investing differently? So do you have to advise them differently compared to like 10, 15 years ago? And does it mean more diversification, more into sectors that do no evil, or has that changed in the last 2 years?
So there's obviously a lot of focus on disruption. But I think importantly, this is not just about tech per se and AI per se, but also what is associated with it. And really there's 3 areas of great interest. The first one is, of course, AI, but here not only focusing on infrastructure, but also increasingly on the application side, as we're moving away from CapEx more towards a focus on cash flow. The second one is, what are the areas where you are seeing significant disruption and growth as a result also of greater needs for electricity, in part driven by AI? Think the whole electrification. And this really starts from the beginning of the value chain with commodities, aluminium and copper, down to, of course, the data centers. And then the last thing continues to be a focus on healthcare. And I think specifically right now, next to the more structural issues, people are finding a lot more interest here because you have this powerful mix of 3 things. Policy uncertainty that is coming down, valuations that are still depressed, and of course, the use of technology that can significantly enhance efficiency when it comes to diagnostics and drug development.
Yeah.
And that's an opportunity both in private and public markets.
I mean, how much, I think in some of your latest, actually, surveys, almost a third of 87 individuals commanding 10-figure fortunes surveyed by yourselves are actually looking to cut contribution to private equity vehicles over the next 12 months. How significant a shift is this?
Well, what we are seeing is there's mixed opinions around private equity in terms of funds. We have, on the one hand, as you just noted, close to 30% that say we want to reduce a little bit of exposure. At the same time, we have 37% that say they want to add to private equity funds. What I would generally say is there's a huge focus on the 3 Ds: due diligence, diversification, and differentiation. The other thing I would note with regards to private equity, finally, we're starting to see an increase again when it comes to private equity direct investments. Close to 50% have said that they want to add to this space over the course of the next 12 months, which is interesting because over the last 2 years, interest was a little bit more subdued due to high interest rates and political uncertainty.
What does that mean, Maximilian, going forward? Do they worry also about AI and AI investing, or does that change in terms of how much they want to allocate in specific private equity funds?
No, I think it's very much about how do private equity funds generate value, and that is in part also through AI rather than financial gearing. So I would rather say it's a mix of what do I actually invest in terms of where does the fund add value or the fund managers add value, and on the other hand, of course, do I already have exposure to this theme potentially through public markets? Remember, if you're focusing on certain areas within AI, you can almost play them better through public markets, and you don't necessarily need to add exposure on top in private. On the other hand, of course, you might have some areas that are better played through private rather than public. So there's a big focus on the complementarity between the two, because ultimately for many of these clients and investors, it's public equity and private equity, it's equity. So you really want to make sure that this is complementary.
Yeah. Maximilian, have you seen a lot of your clients actually leave the UK for other places? Are you also seeing, because of taxes and changing regimes across the world, more clients deciding to uproot and move, and what impact does that have on where they want to be invested in?
So what we are seeing is that wealth is mobile. For example, with regards to the billionaires that we interviewed, 36% said they have already moved funds, and 9% are currently considering relocating. Now, this is normally a mix of things that plays in here. The first one is education for the next generation. The second one is a top-notch healthcare system. The third area is the rule of law. And fourth, of course, which in part was very significantly increased as a consideration post-COVID, given the substantial increase in government debt levels, is what are we seeing with regards to taxation. But it's not the only reason out there. The places that are benefiting from this, from what we've seen, and is Switzerland, it's Monaco, in the European area, it is places like Dubai and Singapore in particular.
Maximilian, give me a sense of, so again, looking at the figures, right, of the amount of money that's being given from one generation to the other, their total assets of around $4.7 trillion compared to $4.2 trillion last year. Does that change the psyche on what some of these billionaires ask you?
Yeah, so what we are seeing, first and foremost, is that a lot of this is not necessarily given to the next generation, but often to spouses. So you're seeing a significant rise in the number of billionaire women. And what is interesting, and it might sound a little bit stereotypical, but we often do see it, is that when it comes to investing, women often tend to be more disciplined and a tad more risk-averse. And this is something that we have to take into consideration. So there is more of a focus on building up a strategic asset allocation for a long-term portfolio and then sticking to a strategy once you've built it up, rather than focusing very much on the next best trade idea, which you sometimes may have.
Yeah. Maximilian, thanks so much. Maximilian Kunkel, their Chief Investment Officer for Global Family and Institutional Wealth at UBS Global Wealth Management. Now, the German car maker Volkswagen has been struggling to cope with U.S. tariffs, shrinking sales in China, and muted demand and high costs in Europe. The chief executive, Oliver Blume, has taken steps to find solutions, but the deeper changes needed to make VW more competitive could be slowed down by a family interest in maintaining dividends. Well, joining us now is Bloomberg's Monica Raymond. Monica, so first of all, explain to us exactly what's going on here.
Right. So Volkswagen and Porsche, like much of the German car industry, are really struggling right now. And Volkswagen is in a unique situation because its family owners have an outsized amount of control, and through their holding company, they get a lot of dividends from Volkswagen usually. And the family's interest in continuing to see those dividends and to see those payouts means that they're more interested in sort of maintaining the status quo and maybe more risk-averse to making the big changes that are necessary to get VW in a better place.
So will the Porsche Peach family's push for high dividends actually slow Volkswagen's recovery?
So that's the risk that Volkswagen is facing right now. VW has several big challenges to tackle. As you mentioned, they've seen their sales really decline in China. They're facing massive U.S. tariffs on their main Audi and Porsche premium brands. And then they have high costs in Europe and a lot of uncertainty about how the EV market is going to develop. With all of these challenges, we sort of see the potential that the family's insistence on these dividends could stall the bigger changes that they need to make in order to combat those challenges.
So is there a risk that the family's dividends could fall to zero?
No. So it's clear that the Porsche and the PH families are not facing a liquidity crisis. Most analysts and investors that I speak with take the view that the company is going to continue to pay out dividends in some way, shape, or form because the family really insists upon it. It's just that these dividends are really coming under pressure now because of the cash crunch that VW is under right now. They're facing a lot of write-offs and a lot of additional charges, in large part because Porsche has had to make a big strategy reset when it comes to electric vehicles, and they're incurring a lot of charges to make this pivot back into combustion engines, to redo and refit their battery business and investments. So all of that takes money, and that means that the cash flow situation at VW and at Porsche are sort of on edge. What we do know is that the family's stake in their holding company is now worth about $7 billion, and that means it's down by more than $3 billion since Porsche was listed. So we see that the value of the family's holdings is shrinking, is slowly sort of coming under pressure, and the situation in the car industry is making it pretty tough.
All right, thank you so much for joining us. Monica Raymond there with the very latest on Porsche. Now, recapping a breaking story earlier this hour, BMW's chief executive stepping down next May. The new chief executive has a task of steering the car maker as the industry experiences an uneven move towards electrification. Up next, it's Bloomberg Brief with a full roundup of the markets, of the Fed this week, and of course of geopolitics. This is Bloomberg.
From the world of politics to the world of business, Joe Matthew and Kaylee Lines deliver news, insight, and analysis live 2 times a day, every trading day. Balance of Power at 1 and 5 Eastern, only on Bloomberg.
The game here is understanding. These digital assets have the ability to change the payment landscape of the world, and we need to be ready. We, the regulators, the world needs to be ready for a new wave of technology.
Stablecoins are almost entirely used in the mechanisms of trading cryptocurrencies. What we saw is the opportunity for digital assets broadly, stablecoins in particular, to be used as a medium of exchange outside of the crypto world, what is today the fiat currency world. At some point, I think these digital asset wallets will be big enough and people will be comfortable enough using them. I think we'll have a flip from conventional payment mechanisms into stablecoin-based mechanisms.
Does that mean banks such as yourselves issuing stablecoins?
We could. We are issuing Hong Kong dollar stablecoins today. We're in a sandbox for tokenized bank deposits in Hong Kong. We're effectively issuing tokens related to trade finance in Singapore. So it's all on the table, but we're always going to tie it back to what our clients want and need. Because if we don't get that one right, the rest doesn't matter.
The market capitalization of both type of instruments, crypto and digital assets, are both very low. Stablecoins today have $20 billion of flows a day. It's less than 1% of the flows of the payment system in the world. But because they have the ability to be very helpful in use cases, particularly in retail to begin with, but then potentially on the wholesale side, I think we will see a lot more of them.
Coming to you live from Kuala Lumpur. The whole world is here.
The APEC Leaders Summit bringing together heads of states of 21 APEC economies.
The White House is trying to use the stops to gain additional leverage.
This big deal with a number of the biggest companies in South Korea.
That's a big number.
Deals can't be done.
Trust Bloomberg for on-the-ground coverage.
Korea is not Japan.
Up-to-the-minute reporting.
In this latest salvo of this trade war.
What a visual.
And the analysis you need.
China's not going anywhere, nor are we.
What
is going to be the consequence for U.S. markets?
We are basically deep in the European earnings season.
Take a look at how we're faring when it comes to Asian markets.
It's 5 a.m. in New York City. Good morning. I'm Bonnie Quinn with your Bloomberg Brief. Here's what you need to know. Hot pursuit. Paramount Skydance makes a hostile takeover bid for Warner Brothers to torpedo Netflix's deal. China-bound, NVIDIA wins President Trump's approval to sell H200 chips in China. And markets look to JOLTS data as the FOMC begins its two-day meeting in Washington. So let's take a look at those markets on this first of those 2 days. John Authers pointing out that it's really not the rate cut, which we're very, very likely to get this time round. Traders will be focused on. It will be the descents and also the SEP, the dot plot, and how much dispersion will we actually see and how are we going to interpret that, or more importantly, how are markets going to interpret that? So as you can see, not moving too much on futures. We were down slightly yesterday, about 1/3% or a little more apiece for the S&P and the NASDAQ. But let's take a look at bonds, because yields now on the 2-year in particular are at 10-week highs. We're up to 4.16 here on the 2-year. We hit 4.17, in fact, yesterday. This hawkish tilt from central banks around the world, including what's likely to be a hawkish cut this week from the Fed. But of course, we know the BOJ. We were talking to Isabel Schnabel of the ECB yesterday, talking about the next move being a hike. Well, it's all putting upward pressure on those yields. We'll keep an eye on all of that. We're going to be speaking with Amy Silverman about volatility too in just a little while. But first, let's get to some individual movers. And for that, we'll go across to London and Valerie Teitel. Val.
Good morning, Bonnie. Let's start with a check on the drama in the entertainment space. This hostile bid launched by Paramount, and we're still seeing the positivity in Paramount shares continue in the pre-market session. Paramount shares jumped 9% yesterday on the back of that news of the hostile bid. They're up another 1.3% today. Netflix on a back foot, but only just slightly down 0.3%. And the real winner of the bidding war is what they're bidding on. Warner Brothers Discovery in the green again today, up 1.5%. Let's move on to NVIDIA. As you mentioned, they've got the approval from the Trump administration to sell a H200 AI chip into the China market. NVIDIA shares are feeling some positivity this morning, up some 1.6%. This is largely seen as a win for the CEO, Jensen Huang, who's been largely lobbying in Washington against these export restrictions, and NVIDIA gaining some of that market share back in China. Lastly, let's head over to Germany and talk about the defense trade. Now, while defense stocks have really been outperforming this morning off the back of a German spending pledge for defense, we are seeing ThyssenKrupp really on a back foot, down nearly 10% after they gave some weak guidance and also said they will be turning into a loss in the next fiscal year. This comes amid a broadness in the auto sector, which this German defense company is exposed to. Shares have risen around 200% so far this year, Vonnie, but it does seem like there are still some winners and losers in the German defense story.
Absolutely. Val, thank you so much for that roundup. Much appreciated. And coming up in this hour, we'll bring you my interview with the Deputy Prime Minister of Greece as well. Plus, we speak with IATA Director General Willie Walsh, and Amy Silverman of RBC Capital Markets joins. But first, Paramount makes a hostile bid now for Warner Brothers.
I have to see what percentage of market they have. We have to see the Netflix percentage of market, Paramount, the percentage of market.
Joining us now is Bloomberg's Manuel Baigori. I guess a hostile bid can be sometimes more dramatic than just a regular bidding process. Manuel, what can we expect? What comes next in a situation like this?
Yes, Bonnie, definitely dramatic and super interesting, fascinating for us to watch and to continue to monitor and try break news on this ongoing saga. It is really a very, very transformative, important, critical deal, and Paramount now going hostile makes it even more interesting, isn't it? The next steps remains to be seen. The next few days will be critical. All the players here are going to keep the cards close to their chest as they try to analyze and bring to the table different types of sweeteners to make a more compelling offer. Obviously, we have two offers on the table, Netflix Netflix, and that is the agreed deal with Warner Brothers. But obviously now Paramount's cash offer, $30 a share, could also raise questions, especially with shareholders, that may potentially increase pressure on the board to reconsider, given that it's an all-cash proposal from Paramount. So we'll see now what happens. Warner Bros. Has 10 days to respond to that bid from Paramount, and then the next steps either from Warner Brothers in their response and also potentially from Netflix if they consider any sweeteners for their agreed deal. I think it remains to be seen also what happens with the regulatory landscape. Donald Trump has been pretty vocal about the potential questions around antitrust and the market share of the combined Netflix Warner Brothers entity. That may also give a little bit more leeway, a little bit of an advantage for Paramount, given that the combination of those may be a little bit easier for regulators. But it's still too early to tell, and definitely want to watch closely. There is so many twists and turns on this one, Bonnie, that just makes it fascinating for us.
A real soap opera, a real streamer, if you like. Manuel, there had been reporting that John Malone in particular, but also obviously David Zaslav, wanted that $30 per share, and that, you know, they had been told they wouldn't get it and so on, but they are getting it now. And there are also very good arguments being made on the part of David Ellison for why it should be Paramount and not Netflix. I mean, will they hold water with regulators?
Yeah, I mean, it depends. It comes down to the market share and also the proposals, the business plans from both companies, and ultimately what the impact for the consumer might be. Obviously, regulators will take a very close look at this. It's not necessarily going to be a smooth path to getting the deal completed with either of the parties, given the tremendous, scale of these transaction. But obviously with Netflix, there is being already some concerns being raised. It remains to be seen what the impact might be with Paramount, even though the combination in theory may present less of a hurdle. But obviously two different proposals. Also super interesting, Bonnie, to see Paramount's backers, right? We see Jared Kushner in there, also the likes of Apollo and some Middle Eastern sovereign wealth funds, as well as some U.S. banks. So definitely kind of like a fascinating proposal that Warner Bros. Has on the table as well.
All right, well, we have 10 days. Manuel, thank you so much. Manuel Baigori there. NVIDIA gaining in pre-market trading as President Trump grants the company permission to ship its H200, in fact, AI chip to China in exchange for a 25% surcharge. The president posting on Truth Social, quote, "This policy will support American jobs, strengthen U.S. manufacturing, and benefit American taxpayers." Joining us now from Washington is Mika Solner of Bloomberg Government. So Mika, as Javier Blas of Bloomberg Opinion just tweeted out, chips for soybeans. I mean, is that what this is? Is this a deal?
Yeah, essentially, President Trump is making this a national security argument. The president has been very adamant on improving his relationship, the U.S.'s relationship with China. He's poised to meet Chinese President Xi Jinping in the spring even, which will be a huge monumental step for the U.S. But the president is really trying to, improve that relationship when it comes to trade. And because the posturing of China when it comes to buying U.S. soybean products and easing down on some of the tariffs that the president has imposed initially, it seems like that Trump is making nice here.
Yeah, it remains to be seen how many of these chips China would actually buy in the event that this all goes through and China wants them. Now, Trump is also threatening new tariffs on Mexico over water, on Canada over fertilizer, and on India over rice. What are these targeted single-item tariffs?
Yeah, absolutely. I mean, I think tariffs have always been a way that the president has to try to, his argument is to create a fair relationship with a lot of these countries. But I do think that is one of the ways that the president has really utilized his bully pulpit and bring U.S. Into these markets. He's saying that this is going to have really good impact in return rate on the U.S. But obviously, the administration is also closely monitoring that Supreme Court case when it comes to tariffs. And this is going to be a huge deal as well in terms of what is actually decided there when it comes to the IEEPA tariffs.
Yeah, let's actually show everybody what Trump has been posting on Truth Social about the importance to national security of this SCOTUS decision. I mean, it proves that he's angsty about it, right? I mean, does he can't have any sway over SCOTUS, but certainly posting on Truth Social would make it seem like he's thinking about this.
Yeah, absolutely. The president actually discussed this yesterday during a meeting at the White House, where he said that, if the Supreme Court does decide to strike down his tariffs, they can find other ways to try and impose this, but it's not going to be as strong and it's going to be slower. So they're really, really closely monitoring the decisions that are made here. And I think that Trump is trying to put some pressure on what he believes is to be friendly justice. But as we know, the Supreme Court is its own entity and it's going to decide what it is. And right now, I think that, there's people that are optimistic within the White House, but there's a lot of skepticism as well.
Exactly. I love the way he puts it, that we would be financially defenseless if SCOTUS were to decide against his tariffs. Mika, thank you so much. Mika Solner of Bloomberg Government there in Washington. And European defence stocks rallying for the most part as Germany is set to approve 29 military procurement contracts worth a record $61 billion next week as part of the government's push to build Europe's strongest conventional army. Joining us with the latest is Bloomberg's chief Europe correspondent, Oliver Cook. So Germany building up its Bundeswehr once again, Ollie, but in fact, Germany's army is absolutely not the strongest even in Europe, right?
Well, I mean, it depends how you look at it. Certainly in terms of number of personnel, in terms of historic spending, the Germans have, underinvested in their military for many, many, many years under Angela Merkel. That peace dividend that they were getting from no war in Europe, getting cheap gas from Russia. And that was a policy that really changed under the former Chancellor Olaf Scholz during this sort of famous speech he gave after the invasion of Ukraine, the Zeitenwende, meaning the turning point in sort of historical Germany to really reinvest in their military. And this is an example, Vani, of the Germans really putting their money where their mouth is. We're talking about orders of about 52 billion euros being approved by the Bundestag possibly next week. We should say in 2021, the year before the invasion of Ukraine, the German military only spent in the entire year 47 billion. So that just gives you the size and the scale and the speed at which the Germans are now deploying this. We have some information on where they're actually going to spend it. 22 billion of it is going to go on basic military gear and clothing, 4 billion on Puma infantry fighting vehicles, 3 billion on aero defense system from the Israelis, and about 2 billion for surveillance satellites. And we should say, Vani, this is very important, obviously, for the Germans, but it's also won them a lot of praise from the United States. We've heard a number of officials, I've spoken to a number as well, saying that basically Germany is now a model ally. And that is something that you don't hear a whole lot from the Trump administration, from many people in Europe. So for the Germans really sort of hitting the ground running, and we should say that this gives a huge amount of confidence for German industry and for many of these defense companies within Germany. I spoke to the CEO of Rheinmetall last week, and unlike a number of other of these sort of defense companies within Europe, he's really putting his money where his mouth is. 13 new factories, doubling, sometimes tripling output, and that's all down to confidence that Germany will spend the money, as we see they're doing today.
Yeah, as Chancellor Merz said, we want to be able to defend ourselves so that we never have to defend ourselves. Let's move to the European question over Ukraine and funds that will be appropriated in order to help Ukraine with reconstruction. Leaders increasingly confident they will reach that deal to use those frozen assets. How are they going to reach a consensus, Ollie?
Yeah, so listen, this is after a conversation that we had in London yesterday between Zelensky, Macron, Starmer, and Friedrich Merz critically. And that comes after Friedrich Merz came to Brussels, came here, and met with the Belgian Prime Minister, who, remember, has been the big hurdle in terms of blocking access to these assets, because the Belgians, where many of these assets are held, want basically assurances that they won't be on the hook for all of the money in case something happens, in case there's a legal proceeding and they need to pay some of that money back to Russia. There has been basically zero progress on that for a long period of time. time. It seems now, according to these leaders, that there has been a breakthrough. That being said, Vonnie, a couple footnotes. We have not heard from the Belgians yet, so we don't know that that is 100% across the line. But we should say, when I spoke to Zelensky a couple of weeks ago, he talked about the Russian assets and the funding from those assets as a matter of survival for Ukraine. 90 billion euros goes a massive distance in terms of funding the war effort. But Vonnie, even if you are close to a peace deal from the United States brokered by the Trump administration, the difference between sitting across the table from the Russians with $100 billion in your bank account and zero is massive in terms of your negotiating position.
For sure, particularly now that he has absolutely drawn a red line. They are not ceding territory. Ollie, thank you so much. Oliver Crook, Chief Europe correspondent for us. Now to all the top stories trending on the terminal this morning. The European Union investigating Google over concerns it has abused its dominance by using its AI tools to squeeze out competition. The Commission said it will look at whether the firm has distorted competition by imposing unfair terms on content creators. The investigation will also look at whether Google pays web publishers appropriately for using their content to generate AI overviews and AI mode. Nomura Asset Management is planning to relocate dozens of staff from its Tokyo headquarters to cities such as London and New York. The move is part of a push to develop homegrown talent for investment and sales operations. And military tensions between China and Japan have reached their highest level in more than a decade. Japan is quickly putting in place missile batteries, radar towers, and other combat facilities on an island chain near Taiwan. Coming up, Greece seeking to become a gas transportation hub as Europe works towards a complete ban on Russian supplies. We'll bring you my conversation with the Greek Deputy Prime Minister next. This is Bloomberg.
Okay, ready?
David, what initially sparked your interest in this topic of longevity?
15 years ago, I turned 60, and I began to wonder how much longer I'm likely to live and what I could do to extend my life. On longevity, I talk with the leading experts in science and medicine to educate people about how they might be able to change their conduct so that they can live a happier and healthier life. I'm David Rubenstein. Join me on a 4-part journey as I explore the great quest for longevity. Only on Bloomberg.
From the world of politics to the world of business, Joe Matthew and Kaylee Lines deliver news, insight, and analysis live 2 times a day, every trading day. Balance of Power at 1 and 5 Eastern, only on Bloomberg.
Join me each week on Wall Street Week for stories of capitalism from business, markets, economics, tech, and climate. More than what you need to know, it's what you need to think about.
It's the world's second-largest economy with a growing influence in global affairs. Bloomberg The China Show brings you the unmatched expertise you need to keep track of breaking news, in-depth market analysis, and the most influential newsmakers in and around China.
We need to do more to engage the market more. We're risk on. I think we caught a little sweet spot.
Massive savings right now.
It's already a different game.
Bloomberg The China Show. Weekdays around the world, right here on Bloomberg. Context changes everything. Tomorrow, the Fed decides.
There are credible arguments to cut interest rates. Equally, there are credible arguments to do absolutely nothing.
I think the Fed believes that this is a risk management exercise.
Trust Bloomberg to bring you the fastest coverage and exclusive analysis, including Powell's press conference.
You wonder at this point how much the Fed is between a rock and a hard place.
There's going to be a lot of hyperventilation about this.
Tune in to Bloomberg Surveillance. The Fed decides, starting at 1:30 p.m. Eastern.
Bloomberg Brief. I'm Bonnie Quinn in New York. Greece looking to bolster its position as a gas transportation hub in Europe, signing deals with the US and American companies. I spoke with the nation's Deputy Prime Minister, Kostas Hatzidakis. Have a listen.
First of all, I have to underline that
all these agreements, both as regards hydrocarbon exploration, but also as regards LNG, American LNG through Greece to Eastern and Central Europe are extremely important politically, geostrategically for Greece, but also in economic terms. They strengthen the geopolitical importance of Greece. These agreements also contribute to further enhancing the Greek-American relations, but also to some extent, I would say, they reshape the energy future of Europe because they change the energy map to a significant extent.
For sure. Now, should we expect other deals in other areas, maybe defense or some other areas?
Greece has been a credible ally of the United States for many years. That has to do with foreign policy, of course, and with defense policy. We are already cooperating in a very productive manner. The Greek government and the American government are examining ways to further enhance our relations, including in the energy sector. Recently, the Greek energy minister visited the United States. He had a meeting with his counterparts in the Trump administration, and there are some ideas to further enhance our energy relations, but I would like to stop here and not to elaborate on this issue.
That was the Deputy Prime Minister of Greece, Kostas Hatzidakis. Coming up, Jamie Dimon forming a group of national titans to protect the US from foreign adversaries. That and what else is making headlines in your front page news. This is Bloomberg.
In case you missed it, on Bloomberg Crypto.
There's a debate going on right now in DC that I think folks need to start paying more attention to, and that is the yield. And the question really is, who is going to keep the yield? Who makes money off stablecoins? Well, right now, in the case of some of the large stablecoin issuers, there's a yield on those deposits. So when there's a dollar, for example, deposited in a bank account, there's interest paid on that dollar. And so who's capturing that yield? And I think one of the really interesting things about the Genius Act is that it bans so-called yield-bearing stablecoins from giving that yield directly back to consumers. Now, that's not true everywhere. And I think if consumers have a choice, why would a consumer want an institution to keep that yield? Or would there be sharing of that yield? So right now, one of the debates going on is, will rewards be allowed? And I think these are really important questions.
Don't miss Bloomberg Crypto live Tuesdays.
Making money isn't about drowning in emotions. It's about understanding what's actually happening. Markets are the best way to glean signal from noise, and that is what we try to do every morning. This is Bloomberg Surveillance.
Technology is embedded in every aspect of our lives.
And laying the foundation for the future.
From finance to defense, AI to entertainment.
And from the road to the stars. Bloomberg brings you the latest stories of the people and companies pushing the tech sector to new frontiers.
And the politics that shape global tech markets.
I'm Caroline Hyde in New York.
And I'm Ed Ludlow in San Francisco.
Watch Bloomberg Tech every weekday.
Only on Bloomberg Television.
Bloomberg Brief. I'm Bonnie Quinn in New York. Time now for your front page news. First up on the Washington Post, Ukraine's President Volodymyr Zelensky ruling out surrendering land to Russia. The Post says the unequivocal declaration could mark the collapse of Trump's peace plan. Critics had condemned the plan as fulfilling a wish list of Russian President Vladimir Putin. Now, Zelensky did say that the current proposal has been stripped of, quote, explicitly anti-Ukrainian provisions. Next up, the Wall Street Journal is reporting Jamie Dimon is assembling a group of national titans and close friends to protect America from foreign adversaries. The group includes Jeff Bezos, Condoleezza Rice, and Michael Dell. Dimon announced a $1.5 trillion initiative focused on national security back in October. The Journal says the CEO has long looked to play the role of a corporate statesman, and the ultimate impact of this whole plan will be unclear for years. And finally, the FT reporting that two of Boaz Weinstein's key funds extending a run of lackluster returns. His $1.9 billion flagship fund down about 6.5% this year as of November 21st. That fund bets on dislocations in the credit market. Another fund that aims to shield investors from market downturns is, of course, down this year as the market rises. Saba has had greater success in activist campaigns against closed-end funds. Saba declined to comment. Coming up, the Federal Reserve is set to kick off its two-day meeting. We'll push ahead to that meeting with Amy Wu-Silverman of RBC. This is Bloomberg.
Such an incredibly exciting moment with AI. It is really the most profound technology of our lifetimes, and I think it has the potential to help us rethink literally everything. The potential for economic impact, societal benefit is honestly boundless. When we think about the economic impact for Europe in particular, it's around a 1.2 trillion euro estimate of the productivity growth that can be unlocked. This platform shift that we are living through, I think, is going to create untold amounts of value for the world, but also for the businesses and for economies, which is why I'm incredibly optimistic in this moment for Europe, but also for the whole world.
How do you think about job losses or safety for some of the AI tools?
You know, I hear the anxiety, and I understand the anxiety about jobs. I think that we are certainly going to live through a massive transition about how people learn to work alongside these tools. I mean, the reality is I do think there'll be some number of jobs that are displaced. I think it is a smaller number maybe than some anticipate. We estimate it's around 7%. And I think what's important is that we have programs that help those 7% transition into new fields of work. I think what is more likely is that most of us are going to learn to work alongside these tools. So we estimate about 2/3 of us. If you think about the tasks you do in your daily life, when you look at every industry, there are administrative tasks that are happening everywhere, and that's what AI is most helpful in improving.
Asia is at the forefront of some of the world's biggest stories.
And we're here, where the action starts in Sydney.
And in Tokyo, get ahead as the global trading day begins.
The Asia Trade, weekdays only on Bloomberg.
Get your fixed income fix. Watch Bloomberg Real Yield around the world right here on Bloomberg. Context changes everything.
It's 5:30 a.m. in New York City. Good morning, I'm Bonnie Quinn with your Bloomberg Brief. Here's what you need to know. Hot pursuit. Paramount Skydance makes a hostile takeover bid now for Warner Brothers to torpedo Netflix's deal. China bound. NVIDIA wins President Trump's approval to sell H200 chips in China. And markets look to JOLTS data as the FOMC begins its two-day meeting in Washington. So let's check those markets. Typically not much happens the first day of an FOMC meeting, but there's lots of catalysts, including Oracle earnings tomorrow after the bell, as well as that FOMC meeting. As John Authors points today, the focus will be on so much more, not on the cuts, which we do assume we'll get, but the descents and the dot plot. Now, we do have futures pointing higher after the S&P and the NASDAQ 100 started the week with small declines, about 1/3% for the S&P and 1/4% for the NASDAQ 100. Russell 2000 futures not really going anywhere. Let's take a look at the bond universe. I think TD Securities has the best note today, calling it talky-talky. That's the environment we're in right now, with the 2-year yield close to a 10-week high there. We got to 417 earlier in the day. Yields rising, and it's not just in the US, it's across the globe as we see a hawkish tilt from central banks. Isabel Schnabel telling Bloomberg yesterday that, the next move will be a hike at the ECB, and of course we know the BOJ is all but ready to hike. So let's get to some individual movers now. Over to London and to Valerie Teitel. Valerie.
Good morning, Vonnie. Let's start with a check on the media sector. The fight over Warner Brothers has now reached a new level with this hostile bid from Paramount Skydance. We're continuing to see shares of Paramount Skydance trade very well. They were up 9% yesterday, up just shy of 2% in pre-market. A lot of this has to do with the fact that these new equity backers that they have found are foregoing their governance and not asking for any board seats. So it's looking fairly positive for Paramount Skydance. They do, in fact, clinch this deal with Warner Brothers, but a lot still is be worked out. We are all seeing all three of these contenders in the green so far to start this morning's pre-market session. Let's move over to the tech trade, especially Mag 7. NVIDIA is leading the gains for the Mag 7. Shares up 1.9% off the back of the Trump administration's plan now to allow them to sell their H200 AI chip into China. The access to the Chinese market has been largely shut out for NVIDIA this year, so that positivity around potential market share, gaining that market share back, is leading NVIDIA shares higher in the pre-market. Lastly, let's head to Germany. German defense, always a big focus, but one of them is on a back foot, really underperforming the market today, and that's ThyssenKrupp. Shares are down nearly 9%. Some weak guidance in their results this morning. They are forecasting a contraction in sales in next year, and this weak guidance comes alongside more softness in the automotive sector that ThyssenKrupp is exposed to. It goes to show that there are still some winners and losers as we have this next stage of the European defense story. Bonnie?
All right, Valerie, that is for sure Valerie Teitel there in London. Let's get back now to NVIDIA. President Trump approving the chipmaker to sell its H200 chips in China, but in exchange for a 25% surcharge. He posted on Truth Social, quote, "This policy will support American jobs, strengthen U.S. manufacturing, and benefit American taxpayers." Back with us from Washington now is Mika Solner of Bloomberg Government. It's so interesting to see a president getting involved in pricing, essentially, Mika. I mean, does he even know what NVIDIA charges for these chips, and can NVIDIA discount them if it really wants to sell into China so that the 25% surcharge doesn't hurt?
Yeah, I mean, I think that a lot of those details are still a little bit unclear and still being worked out. But while this is a big win for China, this is also, somewhat of a win for the U.S. when it comes to taking a large cut of those profits and those sales, like you mentioned there. But I know AI is a topic that's really, deep to the president. The president is very interested in the future of this kind of technology. He's actually going to have an executive order this week separate on AI. But it's really interesting to see his posture posturing towards China and letting them into the AI race.
Javier Blas of Bloomberg Opinion posting on X actually this morning after this news that this is really chips for soybeans. Is that what this is, that China can have the chips, assuming it wants them now, in exchange for more purchases of soybeans potentially? That's the understanding at least.
Yeah, I think the president really celebrated some of the wins when it comes to trade agreements that he's made with the Chinese president Xi Jinping, and soybeans is a big part of that. Trump touted it as a win for American farmers, and so I think that he really wants to have a good relationship with China. The two leaders are poised to meet in the spring, and this is really a step in that direction. And I think that this is just all part of the administration's plan to improve U.S.-China relations.
If this works and if everybody's happy with this agreement about 8 to 200 chips, does this give the president more clout when it comes to what he's trying to do, which is apparently individual tariffs on things like rice out of India, water for Canada, Mexico, fertilizer for Canada, I should say. These individual small tariffs, 5% for Mexico, for example.
Yeah, I think it's very possible. I think the president has fostered his own unique relationships with world leaders, and he's been really trying to make compromises and listen to other leaders when it comes to trade and tariffs. So, I think we're going to have to see what happens there.
Mika, thank you so much for all the context. Mika Solner there of Bloomberg Government in Washington. Turning back to these markets, as we look ahead to the Fed decision tomorrow, RBC's Amy Silverman says Fed Day may be crucial for these markets, but even a cut only brings us a Santa grind at best. She's head of derivative strategy at RBC, and she joins us now. So, Amy, why just a Santa grind? Is it because we have a cut priced in at this point?
Look, that's a big part of it, and something that always amuses me to look at is just the volatility of how quickly we went, from no rate cut to a cut to no rate cut. So to some degree, the market already had the taper tantrum. Now, the toddler is getting what it wants, if you will, but it's unclear if there's going to be further upside from here, even if obviously what is priced in does play out. On the other hand, you've seen implied volatility levels really come in. You've seen skew melt. And so we're essentially priced for this to not go wrong. And so if something does come as a surprise, maybe more hawkish language, the options market certainly hasn't prepared for that aspect, Bonnie.
Yeah, I mean, you talk frequently about volatility potholes. We've definitely had some, Amy. Are there more to come, or are the big ones behind us, assuming we get the cut and, as you say, nothing surprises?
Look, I think this is a big week because not only is it going to be a week full of Fed speak, it's going to be Oracle earnings. I think those are, possible potential potholes if they do not go well for a lot of folks who have been looking to Oracle almost as a proxy for this angst around the credit issues. You really have seen this disparity in the credit spreads for Oracle versus the equity volatility. So that should be interesting too. But outside of that, this is seasonally a time where volatility declines as we get into the holidays and just look forward to 2026.
Yeah, and at the same time, even if there is a tantrum in the works this week or something, I mean, we will get real signals about what the market thinks and the direction. I mean, you say CDS has become the proxy for its AI, trust us, angstiness. So if we do get Oracle tomorrow, we'll know a little bit in terms of credit quality implications and volatility, what's to come in 2026, no?
Yeah, exactly. So look, again, it has the potential for being a pothole, but if these things come through, I don't necessarily see that we're going to get a rip up because of it, because that is the expectations that are priced in. So, that's where the Santa grind comes. But it will go far to alleviate some of the fears that are in the market. And I think that's one reason why you've seen a lot of the option metrics come in. Now, that said, as we get into 2026 and there's just more dispersion, there's going to be more AI winners and losers, the market is going to, kind of dig in and start doing more homework, then I do think, you continue with this paddling duck market where there are winners and losers underneath, and then that headline volatility might still look relatively complacent.
So how do options markets look now into year-end, Amy? Because we only have something like, 12 sessions between now and Christmas Day, and then just a few more after that with very low, participation.
Yeah, exactly. To give you kind of really how staggering these stats have come in. So if you just think about the cost of protection against a one standard deviation drawdown on the market, a few weeks ago when You know, you think back to that day when you had that inflection point post NVIDIA earnings and how the market really switched a flip on sentiment. You were probably in year-to-date highs from a percentile perspective on that cost of protection, and now we're back in kind of the 30th, 40th percentile. So that really gives you a sense of how much metrics have eased, how much the market is just expecting what it's expecting. And, you know, as we get into year-end, some of that is unsurprising, Bonnie, because it is seasonally a time where volatility moves less when there's just more folks in there, when there's less folks in their seats during the holidays.
You know, after NVIDIA earnings, obviously NVIDIA blew things away and it looked like we were all in the clear, and then suddenly we had this reversal in sentiment, and it was pretty crazy actually, and a lot of things were blamed, right? From, you know, one day to expiry options to, I mean, I looked immediately at rates. There was a little bit of a tantrum going on rates too, but not as much as you might think. And then crypto was also blamed. Amy, is crypto a signal of anything these days?
I have to tell you, this is something that comes up more and more in client conversation. So, you know, our joke is, it doesn't matter what part of the market you started in, all roads at some point during meetings will lead to AI or will lead back to crypto. And I'll tell you, a few investors did point out to me that when you look at some of the moves that were surprising, again, if you want to go back to that NVIDIA day to dissect that move, crypto was leading that move in terms of risk-off sentiment. You know, it really hasn't been this inversely correlated digital gold the way actual gold has been. It's been more of a sentiment marker, and it has been leading a lot of the sell-offs that we then have. And what I think is interesting that I've heard as part of the explanation is when you think about both retail sentiment and crypto, it tends to be the same cohort that is playing it, that is going long these assets and maybe, you know, assets in the prediction markets or zero DTE. And so that might explain some of why you're seeing those code movements.
Amy, we have to leave it there, but thank you so much. Always love chatting with you. That's Amy Wu-Silverman of RBC Capital Markets. Now to other top stories trending on the terminal this morning. First up, Brookfield Asset Management and Qatar Investment Authority are teaming up on a $20 billion venture to invest in AI infrastructure in Qatar and select international markets. Brookfield will invest through its newly launched AI fund, which aims to mobilize as much as $100 billion in investments globally. Michael Burry, bullish on Fannie and Freddie. The money manager made famous in The Big Short, predicting the collapse of the U.S. housing market, says he holds sizable positions of common stock of both government-sponsored entities. In a blog post, he said a relisting is, quote, nearly upon us. PepsiCo reached an agreement with activist investor Elliott Investment Management that includes a 20% reduction in its U.S. product lineup. The company also planning layoffs to cut costs. Coming up, the International Air Transport Association says airline profitability is expected to stabilize next year. More on their latest outlook for the industry with IATA Director General Willie Walsh next. This is Bloomberg.
Know how the market day started.
Find out how it finishes.
Public markets to private markets.
From the micro to the macro.
Covering retail, entertainment, the business of sports.
The supply chains, trade policy, how it all is impacting the U.S. equity market as we drive to the closing bell at 4 p.m.
A holistic approach to covering financial markets.
If it matters to your life, we're covering it. I'm Katie Greifeld.
And I'm Romaine Bostic, and this is The Close.
Live every weekday.
Only on Bloomberg. Context changes everything.
We have two crises, two essential crises, and for both it's now or never: democracy and climate, and they are absolutely interlinked. And we have to solve them together. We're losing the democratic infrastructure and norms to deal with the climate, and we're losing the climate stability that is essential for a democracy. We have to solve them together. We've never faced a threat like this to our democracy at a time when it's a perfect storm, at a time when we're being told by climate scientists, some of you may be in this room, that we have to cut our emissions, fossil fuel emissions, in half in 5 years now. You know, when I started to realize what was happening, it was 12 years, and we haven't done it.
It's the countdown to the market open as we bring you the first trades across Europe.
We'll debate the most important stories and what will drive the big investment decisions throughout the morning. I'm Guy Johnson.
I'm Kriti Gupta.
And I'm Anna Edwards. Join us every weekday morning for the opening trade, live at 7 a.m. here in London.
Only on Bloomberg. Context changes everything.
This is Bloomberg Brief. I'm Bonnie Quinn in New York. The just released by the International Air Transportation Association report, global airlines expected to earn record profit next year, even as supply chain issues persist. Bloomberg's Guy Johnson is with the IATA Director General for more. Guy.
Bonnie, thank you very much indeed. Yes, the Director General is Willie Walsh. He's in Geneva, and he joins us now after IATA published its latest financial outlook. Willie, good morning. Thank you very much indeed for the time. Willie, for the last few years, this report has been dominated by the Americans. They've led the financial league tables since, I think, probably COVID. Yet this year, it's the Europeans that have taken over. And next year, it looks like it's going to be the same story. Willie, what's changed?
Yeah, good morning, Guy. I think a couple of things. Obviously, growth in the US, in North America, has been relatively low compared to other parts of the world. Europe continues to do well. I think a weakening US dollar obviously benefits airlines who are not US dollar denominated. 50% of an airline's cost base is typically in the US dollar. So if you see a weakening dollar, it typically would benefit airlines in Europe. And, generally the demand for aviation in Europe is stronger than the US. So we see Europe in absolute terms overtaking the US. Still in margin terms, both are doing pretty well. And the airline industry looking at another good year in 2026.
Let's stay in the United States for a moment. The Federal Reserve is meeting in Washington, D.C. today. The Trump administration would like to see rates coming sharply lower, Willie. Let's talk about cost of capital. Say the Fed cut rates aggressively in 2026. How significant an impact would that have on the outlook for U.S. airlines?
I don't think it'd have a major impact. Obviously, the debt levels in all airlines increased during the COVID crisis, coming out of the COVID crisis. I think most airlines have done well to strengthen their balance sheets, but, obviously the impact that it would have on consumer would clearly be beneficial. And I think one of the things we are seeing in the US is the weakening consumer demand as a result of the cost of living issues that have been highlighted there. So, it would have to have a benefit for the industry. I think it would accelerate some growth. But in reality, though, capacity has been constrained by other issues in the US.
Let's come on to those capacity issues in just a second, but just stay with the consumer for a moment. You got a K-shaped recovery in America. The upper end of the income bracket is doing very, very well. The stock market is certainly helping, as a result of which they've been taking lots of trips abroad. The strong dollar has helped out with that. You referenced the fact that the dollar's beginning to weaken now. Do you think that kind of phase of Americans traveling abroad is going to peter out from here? We've seen certainly loads of them in Europe over the last few years. Is that about to change?
I don't think it is going to change quickly, and you're absolutely right. You look anywhere in Europe now, there's quite a lot of US travelers, and I think they've come to appreciate the value on offer in Europe. So the weakening dollar may discourage some people, but quite genuinely, if you look at, here I am in Geneva, the ski market we're seeing being really dominated by US travelers because the cost of vacationing in Europe is significantly lower than doing so in the US.
You mentioned a moment ago some of the capacity constraints that have been hitting the industry. Boeing and Airbus, obviously, are names that instantly spring to mind, but the engine manufacturers as well. What's been happening at Rolls-Royce, Pratt & Whitney, and General Electric to a certain extent, but less so, have been impacting this industry. Do you think these are businesses that command huge margins, Willie? And I'm just wondering whether or not you think the airline industry is getting the kind of the wrong end of the stick on this one, and whether things are going to improve from here.
Well, I couldn't put it better myself, Guy. You know, you look at GE commercial engines margins for the first 9 months of this year, 27.6% at an operating level. The airline industry looking at less than 7%. So there's a big disconnect between suppliers and the people doing all the work. And that just is not sustainable. So, you know, we're going to have to look more detailed at this, because we've seen these margins increase in terms of GE, while, as I say, airline margins are pretty much stagnant. You know, net margins for us is about 3.9% this year, 3.9%.
Do you see some of the supply chain issues that have been hitting this industry over the last few years, just the availability of aircraft? Do you think that's going to improve in 2020?
No, I don't see any significant improvement. We're still seeing constrained delivery issues there. We've estimated that the cost of the supply chain disruption for the industry this year has been $11 billion as a result of the delayed delivery of new aircraft, increasing fuel burn, increasing maintenance costs. So that will continue into 2026 and probably 2027 as well.
Willie, the Trump administration has just rolled back some of the Biden-era auto fuel regulations for the car industry. Do you think that would be a good idea for the aviation industry as well? Do you think regulation on fuel is too tight? Do you think both Europe and the United States should re-examine that? And if so, how?
Yeah, mandating fuel, the use of sustainable aviation fuel, I believe, is wrong. What we need to do is to continue to encourage production. We've got a big disconnect between the levels of sustainable fuel being produced for the airline industry and the mandates that are in place. And all it's leading to is fuel suppliers making even greater profits on the back of the airline industry. In Europe, what we see happening is they're adding to the price of conventional jet to cover what they call compliance fees. In other words, the penalties that they may face if they don't meet the mandates that they're required to meet. So I think regulators do need to look at this again. You know, the industry remains committed to using sustainable fuel as the key element to reduce our environmental impact, but we're just not seeing supply being made available at the levels that we require.
Willie, put it all together. Fares, what are they going to do next year? Is it going to be more expensive to fly or cheaper to fly in 2026?
No, we think yields will actually be flat in 26 versus 25. Demand will continue to be relatively strong, about 4.9% up on this year. That's slightly less than we've seen before, but still reasonably healthy.
Okay, final quick question. Asia, that's the bright spot. That's where the growth is coming through. But we've started to see problems. We've seen what's been happening in India over the last few days. Do you think we can expect turbulence as these Asian airlines grow as quickly as they do? Do you think what is happening in India, the issues that have happened with Indigo, do you think we can see those replicated elsewhere? Are these guys growing too quickly?
No, I don't think they're growing too quickly, but what we did see was, you know, a change in the regulatory environment, which imposed additional restrictions on how they operate. And I think that issue, you know, has caused a shock, particularly in the low-cost segment, which is much more impacted by some of the regulatory changes that has happened. So I think things will stabilize, Guy. I think growth is going to continue to be particularly strong in that region as they see the value of aviation driving their economies.
Willie Walsh, the Director General of IATA in Geneva. Sir, thank you very much indeed. Bonnie. Thanks.
Guy, some lovely optimism there. Thank you so much. Wonderful interview. That is Guy Johnson there in London. Coming up here, jobs data and earnings on deck. We'll get you set up for your trading day next. This is Bloomberg.
I'm David Weston. Join me each week on Wall Street Week for stories of capitalism from business, markets, economics, tech, and climate. We go on the road for a look at what lies behind the headlines of today and what will likely be the headlines tomorrow.
We need more transparency.
Oil and gas is still important.
They said every citizen should be investing in the market.
Accelerate progress in all fields of science.
Watch Wall Street Week right here on Bloomberg.
More than what you need to know, it's what you need to think about.
Bringing you up-to-the-minute geopolitical news whenever and wherever it happens. I'm Lizzie Burden outside Windsor Castle, England, and this is Bloomberg.
Middle East and Africa. Vibrant resources and high-yield investment opportunities abound. Join me on Horizons Middle East and Africa for the stories, newsmakers, and insight from this exciting region. Now weekdays, only on Bloomberg.
Tune in to Bloomberg Business Week Daily.
We got to talk crypto.
From the magazine that helps global leaders stay ahead.
What's the conversation around your company?
Bringing you insight on the people, companies, and trends shaping today's complex economy.
Planning very big things.
A new level of premium.
Plus global business, finance, and tech news as it happens.
The floodgates of innovation are going to open up.
You can't fake passion. You either are or you aren't.
Bloomberg Business Week Daily, only on Bloomberg.
Bringing you up-to-the-minute geoeconomic news whenever and wherever it happens. I'm Bonnie Quinn in Sao Paulo, Brazil, and this is Bloomberg. Now look at what's ahead for your Tuesday trading session. In just less than 5 minutes, we get the NFIB Small Business Optimism data. That's at 6 a.m. Eastern. Plus, Campbell's and AutoZone earnings out before the bell. And Jolt's jobs numbers, about a third of people respond, but nevertheless, we will be watching that at 10 a.m. Eastern. All right, let's get to some individual pre-market movers. NVIDIA winning approval to sell those H200 chips to China. It's putting on about 0.7% right now in the pre-market. Paramount extending gains after that 9% gain yesterday. It launched a hostile takeover bid for Warner Brothers Discovery, $30 a share in cash. Bear in mind, though, it had dropped 10% on Friday, so a lot of volatility there. And then Norwegian Cruise Line cut to neutral at Goldman, down about 2.5%. Analyst Lizzie Dove cites less favorable risk-reward profiles for 2026, driven mainly by the supply-demand setup in the Caribbean and the firm's outsized exposure to that market. Now let's take a look at the macro environment as we head into day one of the Fed. Look at that two-year yield up to 3.57. That's it for Bloomberg Brief.
When I visited Fernandez at IMAX's headquarters outside Toronto, we went to the facility where IMAX designs and maintains its cameras. The latest next-gen equipment was out with directors on filmed for IMAX sets, but there was still plenty of cool gear on view.
As the head of the finance department, do you look at all the things in this room and think, this costs that amount of money, this costs that amount of money?
Thankfully, no, I don't. When I think about cameras in general and what we, when we first, I'll give you a really prime example, the film cameras. When you thought about it, okay, are we building 2? Are we building 4? Are you building 8, right? And that's where I start to think about, well, what makes the most sense from a return perspective? Because yes, Nolan wants the cameras, but how many other filmmakers out there use the film cameras? The lens that I look at it through is essentially, how many do we build and in what way? Because the one thing is we are going to invest to build it right and to build it for longevity. But do you need 10 of them? No. Building 4 that was the right number. And do we potentially want to build a couple more? Maybe a couple more, but I don't think we need 10 because they won't always be in use all the time.
I imagine that at different points you need to tell people no. What's that process like for you?
Oh yeah, it's a key role in the CFO position. It is a word that most people are used to, and yet they still think you're not going to say it.
Key investors, top executives, global innovators. Join me for in-depth conversations with the biggest newsmakers on the day's top stories. Insight with Haslinda Anand, only on Bloomberg.
Bringing you up to them in the news whenever and wherever it happens. I'm Shevrian in Seoul, and this is Bloomberg.
The direction of travel, things look great right now.
We're entering this phase of AI application.
AI is not a bubble. I think it's still a boom and a structural change, and that's why we are constructive for next year.
AI is certainly going to change the world, but who are going to be the winners in that?
You can look at either side of the coin on so much of the data that's out here, and you could either be bullish or bearish.
This is Bloomberg Surveillance with Jonathan Farrow, Lisa Abramowitz, and Anne-Marie Hordern.
Good morning. Welcome to Bloomberg Surveillance. Stocks range-bound as traders curb their enthusiasm about Fed rate cuts, with U.S. yields rising to the highest levels in almost 3 months. Macro analysis giving way to boardroom drama with Paramount's hostile takeover bid for Warner Brothers, setting the stage for a new chapter in the media landscape. And NVIDIA notching a win with President Trump signing off on sales of H200 chips to China. If we sell it, will they buy? I think, Anne-Marie, that is the ultimate question.
That's a great question, because over the summer, remember, when the administration gave the green light for the H20 chips, China told their firms, do not buy these chips. We are shrugging them off. This morning, just moments ago, the Financial Times is reporting about how Chinese regulators are discussing ways to limit permits for the access to the H200 chips. Buyers need to go through an approval process. So basically, maybe some Chinese companies can buy them, but not all of them. Because remember, China wants to make sure that they have their own national champion.
You know, this really is notable because you saw AMD shares rally in tandem with NVIDIA last night as this was announced. And it raised this question, is the concept of national security changing at a time where this administration is taking a greater clutch over corporate America than ever before? Is there a sense that there is more of a risk for U.S. tech companies not to have a presence internationally than to potentially sequester some of the high-tech technology away from China?
This is a live, active debate right now at the White House. Individuals who think you need to get the world addicted to U.S. technology, and others who think you cannot give China an inch when it comes to the most advanced chips, when it comes to national security, because it's not just iPhones that these chips go in. These are used for the military. This debate is active, and at the moment, it looks like the tech sector, especially Jensen Huang, who was just in Washington, D.C., is winning this debate. And I think for a lot of people, especially China hawks in Washington, who really backed the president in 2016 because they liked his rhetoric on China, are thinking this is a huge pivot.
Well, right now, a huge pivot also for the media landscape, and this is something that we keep watching. It will be the Game of Thrones that everyone is looking for the next season. The idea that Paramount coming out with a hostile bid to take over Warner Brothers after Netflix's offer. Some of the characters behind this are just pretty impressive. The idea of Jared Kushner, of Abu Dhabi, of Saudi Arabia, all lining up to get behind David Ellison, who is saying to shareholders, look, vote for us because we have the sign-off from President Trump. How much is this ultimately? Who gets the blessing of the president in order to carry this through the antitrust?
The president is being quite coy. Yesterday he said none of these individuals are really my friends, which you'd have to think for his son-in-law, Jared Kushner, that one potentially was a dagger in the heart. But when it comes to Affinity Partners, his private equity firm, and some of these sovereign wealth funds, yes, they're there showing up with the backing and the capital, but they will not get a seat on the board, which is why the Ellison family thinks in the end they can get regulatory approval for this. But this doesn't look like it's going to be ending. Of course, Warner Brothers, now valued with this Paramount deal, $108 billion, they're going to have 10 days, I believe it is, and then Netflix will have another 4 days. This can potentially become a fight, and I think this is classic Trump. The same way we see him pick, say, a Treasury Secretary in the Game of Thrones, War of Roses, Bachelor, however you want to call it, he's almost in putting himself in the middle of this, and he thinks that it should be the best deal for Warner Brothers. Let's see.
Yeah, the other drama is barbarians at the gate. Right now, the drama is also heading into the Fed meeting that starts today, ends tomorrow with a rate decision. Taking a look at the drumbeat to that, we get the JOLTS job openings data coming out at 10 a.m. Eastern. Then later today, we do get some auctions, as well as heading into tomorrow, we get ECI, we get Oracle earnings, and that Fed rate decision, and then jobless claims coming on Thursday. Right now, futures little changed after breaking their 4-day winning streak yesterday. Really, it is all predicated on the yield space, the idea that yields are rising. Today, we're seeing a little bit of a reversal after another 2 basis point sell-off increase in yields. Given the fact that we're looking at yields that are hovering near the highest levels going back to September, is this because of the Fed, or is this despite the Fed, given the geopolitics and the global landscape? Coming up this hour, John Stoltzfus of Oppenheimer, with stocks looking for direction ahead of a key Fed rate decision. Wendy Schiller of Brown University as President Trump ramps up his affordability message. And Port of Los Angeles Executive Director Gene Soroka on how tariffs are impacting global trade. We begin this hour with stocks holding steady as investors look ahead to that 2-day Fed meeting. John Stoltzfus of Oppenheimer raising his year-end price target on the S&P 500 for 2026 to a street high of 8,100. Once again, the biggest bull on Wall Street, writing monetary policy, fiscal policy, and the continuing progress of innovation and corporate earnings growth are key to growing earnings and revenues in the year ahead. John joins us now. John, you have been the biggest bull and you have been right. Why do you think this time people are getting it wrong about how accommodative both monetary and fiscal policymakers are going to be?
Well, I think, Lisa, the big thing is, we're in a process of normalization of interest rates coming out of a hike cycle, and a remarkable hike cycle, because the Fed raised rates 11 times, on pause 14, with only 5 cuts in this whole process, but no recession. Brought inflation growth down from 9.7 to, based on the PCE last week, sometime between 2.8 and 3. So, it looks pretty good. It shows sensitivity for the dual mandate, a balance. There's a bit of a walking the tightrope for Jerome Powell, but I think he loves it. He's a real pro. And I think, he's got to walk the tightrope here to give you a little bit of balance so we get enough stimulus for the economy, essentially, for sustainable growth without upsetting the job cart terribly. And we move forward. And around the world, we've seen interest rate cuts, and now the thought that maybe it's gone too far. I think this is a lot like different that it's got the override of the Bernanke legacy, high transparency, communications in its policy, the way the Fed operates. But we're looking for that normalization, and inflation tends to be stickier for longer after you've had a period of untoward levels of inflation. It takes a while to work out in the system, and it's a drama that traders and investors need to work out and play to their benefit.
Right now, the drama is playing out. You are seeing people ratchet back their expectations for rate cuts next week to now next year to now 2 rate cuts from 3 just a couple of weeks ago. I am wondering, though, how much that matters versus the AI trade. I mean, there was a recent Goldman Sachs survey of investors, and they agree with you on the basis that you will get Fed rate cuts, but they disagree that you're going to get that kind of screaming return because the AI trade is hitting some roadblocks and isn't in hyper-growth mode. How much do you buy into that?
It's some of that sounds to me like the trading establishment in a way, because it's the action where can you add bips to the bucket, in trading, working with the spread on the daily basis. I'd have to say this is not uncommon. I mean, there's always questions. You have to invest a lot of money to do what this proposes to do, whether it's the data centers, whether it's all the ancillary software and the design changes to be made. But the companies that are doing it are very well positioned in terms of their balance sheet. And when they borrow money, it's probably because they rather keep the cash on the balance sheet and just use other people's money, OPM, other people's money, the old thing from the old days, right? And so I look at it, it looks, to me, AI is for real. I think whenever I talk to people who are institutional users, and I don't mean just in finance, but if it's healthcare, consumer discretionary, insurance, what have you, people are using AI, and the consumers are using it either for fun or just to shock each other what they can do with GPT or whatever the heck it's called. You know what I mean? Where they put your face on somebody else, you know, and you're running down the street crazy.
What you look like is a 130-year-old.
You know, there you go. And the whole thing is, it's just not uncommon. It just looks to me like, and haven't I been here before? But the wonderful thing about this, in a digitalized environment, the market tends to discount both good news and bad news fairly quickly. And that what gives us this effect of one day the traders own the market, the next day it's intermediate and long-term investors as they buy up the babies that got thrown out with the bathwater the next day. Then they visit mids and smalls, then it's a rotating market. But it discounts good news and bad news more quickly because the digital news travels faster, it's quicker to analyze, determine, and the play is on.
John, we got, in terms of the play is on, NVIDIA is getting the green light to sell the H200s in China. When you look at that decision by the administration, does it say to you that in 2026 trade tensions are going to be a little bit more quiet than they were this year?
You know, that's a tough one to say because when it comes to trade tension, it seems to be just part of the way things work with the current administration, but likely would also continue on with any other administration because that's the way President Xi operates. Also, there's a balance between fig leaf and the axe. You know, it's a constant. This is a game of chess, and it's not a friendly one. But ultimately, both sides want trade because peace is more profitable than building war machines and battling each other. Look what's happened to Russia financially, really, when you look at what the cost of doing what they've done to Ukraine has been. And on the other hand, if you play with your financial partners nicely, you know, and you compete, you produce better results for your own people, and you also improve for China, it would be the Silk Road and the success of that, the competition that's occurring then, and what is felt by other emerging markets. It's just, you know, this is the way things work. But the tension, it's like they often say the market doesn't like uncertainty. It loves it. The traders love uncertainty. Both sides can benefit. Intermediate to long-term investors, again, babies that get thrown out with the bathwater. The traders looking for the bips, a new vanity plate for the trophy car.
Yeah, and maybe bonfire of the vanity play. I am curious going forward about how much you see this rotation as durable, given the fact that you still see the AI stalwarts as really having a lot of the strength. Are they going to keep leading, or do you think that there is this durable shift?
That's a great question, and I think what we have seen since 23, and many people deny it, has been a broadening of the rally, with other sectors sharing the stage with information technology and communication services, which is where the streamers and the social media and the search engines are, as well as the old phone codes. But when you look at it, you're in a situation where other sectors like financials, industrials, healthcare, utilities are beginning to find interest by investors. Greater diversification in portfolios, to benefit from the other 9 sectors that can benefit from technology. Any company that wants to keep a competitive edge needs AI. Any company that wants to gain a competitive edge needs AI. Any company that just wants to maintain a good premise is a value company to attract and maintain investor loyalty needs AI.
Yeah.
It looks like into the future. It's you know, here we go. What is it? Back to the future.
Yeah.
Here we go.
I'm going to have that soundtrack in my head all morning. John Solsmith of Oppenheimer, thank you so much with Into the Future. All right, right now let's get you an update on sales stories elsewhere this morning. No one has to listen to me sing. Here is your Bloomberg Booth with Yahaira Anand. Yahaira.
Hi, Lisa. President Donald Trump granted NVIDIA permission to ship its H200 AI chip to China in exchange for a 25% cut of the sales. The move means the world's most valuable company could regain billions of dollars in lost business. President Trump says the sales would only go to, quote, approved customers, and that chip makers such as Intel and AMD would also be eligible. Meanwhile, Paramount Skydance launching a hostile takeover bid for Warner Brothers, the move coming just days after the company agreed to a deal with Netflix. The offer stands at $30 a share in cash, compared with Netflix's cash and stock bid of just under $28 per share. President Donald Trump, whose son-in-law Jared Kushner is participating in the Paramount bid, saying he's not close to Paramount nor Netflix. And PepsiCo announcing a series of operational changes backed by an activist investor, Elliott Management. The moves include cutting nearly 20% of its U.S. product lineup, investing in more affordable products, and layoffs in North America. Elliott says the plans will drive greater revenue and profit growth. That's your Bloomberg Brief. Lisa?
Thank you so much, Yahaira. Yeah, the activist influence over Pepsi going to affordability. Everyone seems to be looking for that. Value, affordability. We hear that from every company. We're hearing that increasingly from the administration.
Because the consumer is demanding it. They're demanding it in polls, and they're demanding it when they go and they're shopping.
Yeah, up next, we're going to talk about that, all about affordability.
My administration and our partners in Congress will continue our work to lower the cost of living and make America affordable again.
Affordability, they call it, was a con job by the Democrats. We did a great job on groceries and affordability. The only problem is the fake news.
Wendy Schiller of Brown University joins us next to talk about that. Right now, future is fluctuating as that meeting does start to take place in Washington, D.C. with the FOMC. This is Bloomberg Surveillance.
At a time when policy in Washington is driving Wall Street, we draw a distinction between the rhetoric and the action, bringing you market-moving guests and original reporting. This is Bloomberg Surveillance.
Good morning, this is Bloomberg Daybreak Europe. I'm Tom McKenzie in London. These are the stories that set your agenda.
Taking you from the U.S. market's close to the overnight session in Asia, we'll walk you through what you need to know to kickstart Europe's trading day. Live from our European headquarters, we bring you the day's top market-moving stories, unmatched expert analysis, and on-the-ground reporting from across the continent. Tune in to Daybreak Europe, only on Bloomberg Television. Context changes everything. Why do the biggest names in business choose Bloomberg Television?
That's a great question.
It's a very good question.
Interesting question. Good question. Great question. I so appreciate that question. You certainly ask interesting questions.
Bloomberg Television. Top experts, great questions.
Looking for direction ahead of a Federal Reserve meeting where people broadly expect there to be a rate cut. But the real question is, what will the signal be going forward? Right now, you're seeing just a fluctuation in futures. After yesterday, we saw a four-day winning streak snapped. Meanwhile, yields inflected downward just a little bit after a losing streak in terms of yields higher that has sent yields close to the highest levels going back to the end of September. A real question of how much more the Fed can actually cut rates. Very much front and focus for all of Wall Street is this boardroom drama that is going to turn out to be the blockbuster of the year. A question of Paramount's hostile bid for Warner Brothers after Netflix came out with a $27.75 share in cash and stock bid for Warner Brothers. Paramount came out for $30 a share in cash. Some of the players behind this just really eyebrow raising when it comes to trying to curry favor with the White House.
Oh, absolutely, especially Affinity Partners, which is part of the Paramount bid. Of course, this is led by the president's son-in-law, Jared Kushner. He did tell reporters yesterday he hasn't spoken to him about it. There's also the sovereign wealth funds of Saudi Arabia, the United Arab Emirates. Qataris are involved in this. What's going to be critical for whoever gets the green light is the regulators. What are they going to say about, as you say, the characters that are involved, but also the market share and what this means? Paramount thinks that because Netflix has already such a stronghold in the streaming sphere, that they're going to be able to get that green light. remains to be seen. Whoever buys it needs to make a movie about this deal.
Well, I think that would be probably the next blockbuster. Right now we're looking at breakup fees of $5.8 billion for Netflix and $5 billion by Paramount. So someone's going to get paid quite a bit of money. Getting paid is key and front and focus for a lot of Americans as affordability concerns come front and center. Under surveillance this morning, all about affordability.
My administration and our partners in Congress will continue our work to lower the cost of living and make America affordable again.
Affordability, they call it, was a con job by the Democrats. We did a great job on groceries and affordability. The only problem is the fake news. There's this fake narrative that the Democrats talk about, affordability. They just say the word. It doesn't mean anything to anybody. Just about everything is down. You know, this whole thing is, they use the word affordability. It's a Democrat hoax.
Here's the latest. President Trump traveling to Pennsylvania later today to promote his economic agenda. As more polls show, affordability is the dominant concern for Americans. Bloomberg's Tyler Kendall joins us now for more. Tyler, great to see you. What are we expecting to hear from President Trump today?
Yeah, hey Lisa, good morning. Well, we have to keep in mind this really marks the first big domestic policy speech for the president that's going to be focused on the cost of living after Republicans suffered a slew of election losses last month that really put the issue front and center. And it's important context here. We have to keep in mind that President Trump really campaigned on the issue of the economy. It's what helped propel him to the White House. But as you mentioned, recent polling and data, including consumer sentiment, while improving, is still around record lows. And I'll even point you to our own Harris poll conducted from Bloomberg News in October, which showed that 55% of Americans that are currently employed are concerned about losing their job in the next year. Now, President Trump is going to tout those policies that we've seen him roll out in really the last month since Election Day. That includes that investigation that was launched over the weekend when it comes into the food supply chain. President Trump signing that executive order directing the Department of Justice and FTC to look into alleged price gouging and unfair trade practices. He also yesterday, of course, rolled out that aid for farmers, and we're also expecting him to talk about some of the policies that he's put forth but have yet to be implemented, such as his tariff rebate checks, though, of course, we know that that does face some pushback in Congress. And Lisa, there's another issue from Congress that could complicate matters for President Trump. That's the current debate over the path forward when it comes to health care. Of course, we're coming up on the end of the year when those Affordable Care Act premium tax subsidies are set to expire. And right now there is still big debate, but not really action on Capitol Hill on exactly how they could address what could be a steep hike in prices for Americans if we go over that cliff. Now, Lisa, I'll also quickly add, expect more of this from President Trump. It's our understanding from the White House that he's about to go on a big domestic policy push around the country.
Tyler Kendall, thank you so much for that. And one of those big domestic pushes might be some reporting from Politico this morning where President Trump may make tariff changes to lower some prices. Wendy Schiller for Brown University joins us now with more. Wendy, thank you so much for being with us. I just want your take on some of the focus on affordability and whether you think it will resonate given some of the proposals that are on deck.
Well, I mean, I think President Trump realizes that he is losing a little bit of his grip on the House of Representatives in terms of his power over the GOP. He's still a player in primaries, so we've got another 7-month window, give or take, for the Republicans to face primary challenges, and that's where he gets his leverage. But you can sense that the House, is, particularly GOP, really worried that this affordability or economy or inflation or prices will cost them control in the House and even possibly the Senate now. So I think that's the real overlaying issue here is what do you do symbolically as the President of the United States? Because, we all know all presidents have a tough time getting a handle on prices and inflation. But what do you do that reassures Congress? Because if, in fact, he loses his grip on the House of Representatives this early, then he really enters uncharted territory in terms of his power to get anything done.
Symbolic, of course, is going on a tour domestically. They're also floating $2,000 tariff dividend checks. Wendy, do you think we're going to see that?
Well, Anne-Marie, it just immediately brought to mind the stimulus checks during COVID. And of course, we had multiple checks, Trump and Biden. And much of that, in terms of commentary, was thought to increase inflation. In other words, not good for the economy and making things more expensive. So I'm not sure that's going to fly with consumers who remember that, but also the base of the Republican Party that voted for Trump that thinks government gives away too much money to begin with. Do you get these deficit hawk conservatives in the House to give away more money? and, you know, making the connection between the revenues gained by the tariffs, our very large deficit, our national debt, and then giving away government money, it just seems like it's a package that will be difficult to sell to conservative Republicans in the House, but also to their constituents.
There's a lot of talk as well that there's going to be a number of Republicans that retire from Congress. How difficult is that going to be as the president tries to tout this affordability, the economy is working ahead of the midterm elections, but a lot of Republicans seem to be wanting to get off the ship?
Right. So there's a record number of Republicans who are retiring going into this midterm at the moment. It's not a record number overall of members of Congress. I'm watching the next couple of weeks to figure out really if there's going to be even more Republicans that walk out the door. If they can't get any kind of compromise on extending these subsidies, and the president has basically indicated, even though, you know, it depends on the day, he'll sign it. If they give him an extension, he'll probably sign it. So if they don't do that, then these Republicans have to go home, and they're in fact going to face constituents who are paying a lot more money for health care. And do they really want to face that onslaught? So if they fail to get a deal, my instinct would be that more Republicans would walk out the door. It makes it much harder for Speaker Johnson. And then you've got people like Marjorie Taylor Greene, who are, you know, who's leaving, who's then on the outside and who can do nothing but criticize the inside. So the pressure ramps up on the Republicans in the House, and that, I think, makes it harder for President Trump. The farm subsidies remind me of the first term, $16 billion, I believe, in the first term to farmers because of tariffs. Now we're looking at $12 billion that you can argue is an unnecessary expense due to Trump's tariff policy.
And there's a question of whether the tariff policy will actually remain in place altogether, given some of the recent proposals. Wendy Schiller of Brown University, thank you so much. Picking up on that Politico interview with President Trump, a lot of information there in terms of just his agenda going forward, what he thinks about affordability, about Ukraine, as well as the Federal Reserve and the potential pick that he already seems to, Emery, have selected.
Oh, he says he has it in his mind, but then he did call the front runner, Kevin Hassett, a potential Fed pick. In this interview, he says he thinks Jay Powell is not a smart person, doesn't like Trump. And the reason he doesn't like Trump is because I hit him hard because he's doing a bad job on interest rates. But he didn't give a name. He just kept talking about we're fighting these interest rates. It's interesting because obviously the Fed is meeting today, but he didn't give a name on who that person is in his mind that he's already made that decision on.
Meanwhile, Wall Street has a short attention span and it's shifting very quickly to the AI story away from the Fed chair drama. A real question of what national security means in the case of some of the high-tech chips coming out of the likes of NVIDIA. Coming up, we'll speak with Bloomberg's Mark Bergen as NVIDIA gets the green light to sell those H200 chips in China. Plus, Danny Berger with your morning movers. We'll be taking a look at NVIDIA shares, which are rising after that approval. Right now, they're basically unchanged. This is Bloomberg Surveillance.
The key issue right now for us in the diamond space is the declared divestment of Anglo from GBS. And as you know, Anglo holds 85% stake in GBS. Botswana, the government of the Republic of Botswana holds 15. We are resolute now, and we've communicated a firm intention to increase our stake in GBS to a controlling stake. We have lined up a number of potential collaborators with us, if I may put it that way. We have targeted funders, we have parties, we have the Oman Sovereign Wealth Fund, we have others who are willing and ready.
Right, okay, ready?
David, what initially sparked your interest in this topic of longevity?
15 years ago, I turned 60, and I began to wonder how much longer I'm likely to live and what I could do to extend my life. On longevity, I talked with the leading experts in science and medicine to educate people about how they might be able to change their conduct so that they can live a happier and healthier life. I'm David Rubenstein. Join me on a 4-part journey as I explore the great quest for longevity, only on Bloomberg.
Looking for direction after snapping a 4-day winning streak, we're looking right now at markets that are grappling with the concept that maybe yes, the Fed will cut rates in the 2-day meeting that begins today, but no, they will not continue cutting rates aggressively next year. Now just 2 rate cuts priced in for the entirety of 2026 are basically range-bound across the board, except for the Russell 2000, once again eking out an outperformance with a 0.2% gain. When you take a look at 2s, 10s, and 30s, a bit of a reprieve after a pretty violent sell-off. What we are seeing at the front end is just meandering. It really has been hovering around that 360 point, 358 right now on that 2-year. 10-year yields near the highs since they've been going back to September after a pretty vicious sell-off, 415 on that 10-year, and 30-year yields also getting a little bit of a bid down from the 4.8%. Take a look at Home Depot shares, pre-market trading right now. Those are lower by about 1.4%. It is investor day for the home goods retailer, offering some cautious preliminary guidance for next year without really seeing a revival in the housing market.
Right, so there's 2 things. Even though some mortgage rates are lower, they're seeing that less and less families are able to get on the housing ladder. And then even if families have a home and they want to refurbish and do work on construction, they're not able to do it right now just because of the state of the economy. And it comes back to what we were just talking about, Wendy Schiller and Tyler Kendall, about this idea of affordability. So right now they just expect comparable sales growth to be in the range of flat to up to 2% for the year. It is their investor day, so they do have a very rosy picture, but we would need to see the housing market turn for that.
Which is the reason why after about 10% losses so far this year, you're seeing additional losses in pre-market trading. 3 hours away from the cash open, here are your morning movers with Danny Berger. Danny.
Hey, Lisa. Starting with NVIDIA, after President Trump posting on Truth Social that he will allow the sale of H200 chips to China, those shares now little change. They were up as much as 1%, so maybe some questions now being asked in just how this will work. The Commerce Department telling Bloomberg that it would work via the form of a 25% tariff. That's what the revenue share that the U.S. wants with NVIDIA when the chips get shipped from Taiwan to the U.S. for inspection. So again, NVIDIA, little change this morning after moving significantly higher. One share that is moving to the upside is Ares this morning. This is about the time of year when we get a reconstitution of the S&P 500. We learn who's being added and subtracted. Ares is being added, so shares up 8.2%. It gets a lot of passive flows with that new addition. And Kellanova is being booted out for the sake of Ares. Just shows the growth of these private capital players entering the sphere. Finally, you mentioned Home Depot giving their cautious outlook. We also had a cautious outlook from Toll Brothers. This one's significant because Toll Brothers is one of the rare home builders that has outperformed. It has a more luxury customer base. Its homes on average are about $1 million, but its outlook disappointed. The CEO saying that they're confident, but did so cite that they have softness basically in many, many markets, so shares off by 4.5%. 5% in the pre-market, Lisa.
Thank you so much, Danny. Really notable given the fact that they tend to be the most resilient amid sort of a K-shaped economy. On our radar this morning, Paramount Skydance launching a stunning hostile takeover for Warner Brothers Discovery. Paramount's bid of $30 a share all-cash offer comes days after Netflix agreed to buy Warner Brothers in a cash and stock deal just under $28 per share. So not exactly apples to apples in terms of comparing the price, given the fact that, yes, it's a little bit less than $28 a share, but it doesn't include some of the properties that include sort of the news and sports versus the $30 all-cash offer.
Right. Netflix is just going for the studio and the catalog. And then what Paramount wants is everything. They want to include CNN, TNT, and some of that live audience. So it's a little bit hard to decipher exactly what deal. It's difficult because, as you say, it's not apples to apples. I think part of this comes down to how Warner Brothers decides, do they want to spin off the news before they sell the remaining entities, or would they rather sell it as a whole? And it seems like, based off all the reporting, the Wall Street Journal has a ton of reporting about this, about the text messages, the visits to David Zaslav's Beverly Hills house. It does seem like they felt like they were getting ghosted. That's the word that the Wall Street Journal used. Larry Ellison, David Ellison, the Ellison family felt like they were getting ghosted, and it seems like the Warner Brothers C-suite already decided they were going to Netflix.
Yeah, well, David Ellison doesn't like being ghosted. Now he's bringing in some of the big guns when it comes to the White House and saying, look, we're going to get regulatory approval. It is all about regulatory approval. The EU launching a new antitrust investigation against Google, the probe centering on the company's alleged favoring its own AI tools, as well as failing to compensate content creators for materials used in its AI results. This might be the key between issues between the U.S. and Europe. It has to do with regulating the U.S. tech sphere. How much is this going to be sort of sticking a finger in the eye of some U.S. negotiators?
When we saw a similar probe in September, the president came out and he said it was discriminatory. Obviously, there has been a lot of sharp rhetoric from this administration when it comes to the European Union, their regulation of a lot of these tech companies, which is why the second that Trump won, you saw all the tech companies going down to Mar-a-Lago and talking to him about we're going to need help when it comes to Europe, whether it's regulation or the digital services tax. We are just getting news as well from the EU Commission saying they did give the U.S. administration about the Google antitrust probe. So trying to get ahead of it, but this is going to be another big point of friction between Brussels and Washington.
Yeah, which is an ongoing negotiation. Meanwhile, talking about negotiations, President Donald Trump granting NVIDIA permission to ship its H200 AI chip to China in exchange for a 25% profit cut. The policy will limit sales to approved customers and is applicable to other chip makers, including Intel and AMD. Joining us now for more is Bloomberg's Mark Bergen. Mark, thank you so much for being with us. So how big of a surprise was this, given that it is a reversal and it comes over some of the pushback from even people within President Trump's administration?
Yeah, it's a reversal. I mean, it's definitely something that Jensen Huang, the CEO of NVIDIA, has been arguing for a long time, making the argument here that this restriction basically gives Chinese companies, particularly Huawei, a big edge. And there are people, as you mentioned, in the Trump administration that have argued against this. There are those that have argued for this, using terms like they want to get China addicted to American chips and American AI, something that the U.S. can have control over.
Do we have a sense, Mark, if we sell it, will they buy? Do we have a sense of whether China is going to sign off on some of their big tech companies using NVIDIA chips?
That's a big question. I think an outstanding one. There's some reporting in the FT this morning that Beijing is going to restrict that. We've seen restrictions on the H20, which is sort of an earlier version, less powerful version that has been sold, permission to sold into China. I think that's the ultimate question, right? The concern here from Chinese side is that they also want to build up their own industry. You mentioned Huawei. There's also several other chip competitors trying to catch up to NVIDIA. And one way to do that is to have these large Chinese tech companies and startups buying their stuff.
Mark, can you talk to us about actually how this will work? Because in its exchange for basically a 25% tariff.
Yeah, I mean, I imagine that's also the response inside NVIDIA right now, is I think trying to make sense of the actual details in here. The devil's in them, of course. I mean, the prior agreement had a 15%, and now we have 25%. I imagine there's a lot of back and forth. I imagine there's a lot of lawyers involved. But this is something where the company has clearly, China is a really big market, and certainly the signaling and the messaging from Wang and his executives there is it's a place that they want to be in.
So even if they play a 25% surcharge, what you're saying is for NVIDIA, it still makes sense. What kind of money and access will they get in China with the H200 if, to Lisa's point, China gives the green light for firms to buy?
That's a good question. I mean, there's certainly... These are, over a year old right now, but they are, from our reporting, about 10 times more powerful than the NVIDIA chips that China has access to now. I think there's an expectation. There are a lot of really, there's obviously the major AI tech companies, there's Alibaba and Tencent, and then there's DeepSeek and a wave of these companies that have kind of come out of nowhere and developing these models, many of them open source, that are as competitive as those coming out of Silicon Valley. I think the argument from the hawks in DC is that you're basically handing them these incredibly powerful tools to let China continue to go ahead. I think it's, there's lots of questions around the sales channel, but the big one is, what Beijing is going to allow.
Mark Bergen of Bloomberg, thank you so much for being with us. There also is a question, Emery, of just how much already has gotten out of the bag. The idea that there have been chips that already have been smuggled to China anyway. There's a story this morning about the Justice Department detaining 2 individuals for allegedly smuggling H200 chips out of the United States to China in the prior year, which really underpins some of the questions around DeepSeek.
So there's 2 stories at the same time. One, the Justice Department is going after these individuals. At the same time, the president is recalibrating his policy on what should be acceptable to China. It feels like they are putting economic concerns, they are putting trade concerns, and making sure they have a good trading relationship with Xi Jinping ahead of national security concerns. And with Financial Times, I think the biggest question this morning, as you've been saying, will China even allow it? And it does seem like China may allow some of it, but it's not going to be carte blanche allowance of NVIDIA back into China.
Which is the reason why you're not seeing an even bigger share pop, right? Given the fact that they did not include any sales to China in some of their forecasts. I'm talking about NVIDIA in particular. NVIDIA and AMD seeing the biggest gains. Intel, not so much, because they're not going to be quite as affected. Today, we are getting a host of investor days, and I think it is important to mention this. We did get Home Depot with a real tepid outlook for next year, a question on the revival of the housing market. CVS also holding its investor day, talking about how its 2026 revenue is going to be short of some Wall Street estimates, highlighting the concern around the consumer. I mean, just want to point to this one more time. CVS coming out and seeing the low end of an adjusted EPS range from 7 to 7.20 versus the estimate of 7.17. You are seeing a little pop, but a real question here, a lack of certainty when it comes to the state of the consumer at a time where we're talking about affordability, and we're talking about really how much acceleration there is with consumers that are kind of running out of steam.
We continuously hear this from the retailers. Yes, they're showing up and buying, but it's much harder. And what you hear from a lot of retailers is that, especially when you see the likes, as we talked about extensively, Dollar General, Dollar Tree, they're seeing more consumers come and try to find deals from the top end. This idea of choiceful, I know it's like the C-suite word. The Wall Street Journal is using cranky. It's a fickle consumer right now, and they are making these decisions and looking for bargains, which paints the picture why people are really unsure of what 2026 will be. And I know everyone wants to talk about these tax rebates. Potentially, there's going to be that fiscal impulse. But as some analysts have said, consumers are spending that money today when you look at the Black Friday and Cyber Monday sales.
Yeah, so right now we're focusing on just how that's affecting the different sectors. So right now, let's get you an update on stories elsewhere. Here is your Bloomberg Brief with Yahira Anand. Yahira.
Hi, Lisa. President Donald Trump is warning he could impose new tariffs on Canadian fertilizer and Indian rice. He issued the threat at a White House event where he announced billions of dollars in assistance for farmers. The president says the U.S. doesn't need Canadian fertilizer, but Canada is America's biggest supplier of potash. As for rice, India is the world's biggest exporter, but the U.S. buys most of its rice from Thailand. Meanwhile, the U.S. Supreme Court appears poised to allow President Trump to fire a leader of the Federal Trade Commission, the decision that could limit or overturn a 90-year-old precedent that curbs executive power to dismiss the heads of agencies that Congress set up to be independent. Many of the High Court's conservative justices expressing support for an idea which holds that the Constitution gives the president broad authority to fire officials. And as you all were just discussing, Home Depot providing a cautious preliminary outlook for the next year. The home improvement retailer forecasting comparable sales growth below analyst estimates, citing the challenging U.S. housing market. Home Depot is, however, ready for a potential rebound, stating it could see 4 to 5% growth in a market recovery scenario. That's your Bloomberg Brief. Lisa.
Thank you so much, Yahaira. Up next, the Supreme Court weighing President Trump's tariffs.
We are making a lot of money from countries that took advantage of us for years. Our deficits are way down because of tariffs. The decision of the Supreme Court's a very important thing.
Port of LA Executive Director Gene Soroka joins us next as we do see some trade fall off, but China really continuing to be strong. This is Bloomberg Surveillance.
Rodriguez. And I'm Jason Kelly. And we're back with another season of The Deal. With athletes and entrepreneurs who are changing the game on and off the field. Jerry Jones.
Some good-looking trophies. 1 and 1 is 3 in sports, not 2. And it's because that 3 is imagination. That 3 is putting yourself in a way, having yourself hit the home run.
Erica Ayers-Badon.
I'm a high-energy board member. I'm very passionate. I have a lot of opinions.
Robin Arzón.
I want to light fires in people's lives, and that is still one of my core mandates for all of my businesses.
Justin Tuck.
I tell all of my friends that play in leagues now, make these relationships now while you're hot. Don't wait till you're your 12th year in and you're just hanging on.
Stay tuned. You won't want to miss it.
It's the world's second largest economy with a growing influence in global affairs. Bloomberg The China Show brings you the unmatched expertise you need to keep track of breaking news, in-depth market analysis, and the most influential newsmakers in and around China.
We need to do more to engage the market more. We're risk on. I think we caught a little sweet spot.
Massive savings right now.
It's already a different game.
Bloomberg The China Show. Weekdays around the world, right here on Bloomberg. Context changes everything.
Astonishing day for U.S. technology.
It's shaping the region's technology ecosystem.
Asia's biggest tech news and innovation.
It's a multi-trillion-dollar industry. We'll show you what's happening in ETFs like no one else. ETF IQ, only on Bloomberg.
Going to be about the Fed starting today, heading into tomorrow. The Fed does meet in Washington, D.C. The expectation, a 95% chance they will cut rates. Probably more interesting, how do they message going forward, especially given the fact that Jay Powell is a lame duck Fed chair right now. S&P futures trying to claw out of yesterday's losses, up about 0.1%. You are seeing a bid into bonds as well. After a 2 basis point rise yesterday, down less than a basis point, 415.85. Under surveillance this morning, the Supreme Court weighing President Trump's tariffs.
We are making a lot of money from countries that took advantage of us for years. Our deficits are way down because of tariffs. And, we have a big decision. Hopefully we're going to get the right decision. such a big thing in the Supreme Court right now. The decision of the Supreme Court's a very important thing.
Here's the latest. President Trump signaling Canada, India, and Mexico could get hit with a fresh round of levies, with the Supreme Court expected to rule on his sweeping global tariffs before the end of the year. Gene Soroka, executive director of the Port of Los Angeles, writing, if there's less tariff and trade uncertainty, that will stabilize the supply chain. We're all waiting on the Supreme Court ruling on tariffs. Gene Soroka joins us here in New York. Wonderful to see you. I do want to start on just how much of an impact you already have seen to trade based on some of the tariff uncertainty year to date.
Oh, it's been an unbelievable roller coaster of a year. When hard tariff policy went in, importers slammed on the brakes. Then when that policy was softened and deadlines extended, we saw a real surge in cargo, up and down all year. But we wind up with about our third best performance on the container side in our history. Yet exports have really lagged behind because of retaliatory tariffs, and Asia countries, our normal trading partners, cutting deals with other countries.
So you're saying that the U.S. can't kick its importing habit, but its exports have suffered as a result of retaliation more so. Has the importing mix changed for the United States in terms of where the countries are that are providing some of those imports?
It certainly has, Lisa. Starting back in 2018 with the first round of tariffs, 60% of our business was with China. Today it's 40% and dropping. Yet we've still grown because we've picked up a lot of trade from Southeast Asia.
So isn't China just using those countries to then send the goods to the United States, transshipment?
Anne-Marie, I was in China twice in the last month, and in the announcement of the 15th five-year plan by the China central government, they said specifically they're not just exporting products, they're now exporting manufacturing expertise to other countries. They're investing in Southeast Asia factories and supply chains. But as far as transshipment goes, the shirt I'm wearing, the button plackets go from China to Vietnam to make the full shirt and then ship it here to New York to the retail store. So it's nuanced, it's a little bit wonky when it comes to our business, but it's not necessarily transshipping to avoid tariffs in one country.
You talked about 2025 being a roller coaster. What do you expect for 2026? How much really hinges on what the Supreme Court decides on IEEPA?
That's a big deal. But then what happens? Do we see a refund of all this money from the Treasury Department? We know Costco has stepped into the litigation arena, only one so far, but let's see what happens. There are a couple of other companies that they followed in different sectors outside of traditional big box retail. If we see a relatively calm future over the next first 2 quarters, because maybe some are focused on midterm elections, that could give some certainty to the supply chain. Okay, I know the ground rules, I know the prices, let's get back to work instead of all this simulation and speculation of what could be.
How much does the uncertainty favor some of the largest companies over and above some of the smaller companies that are having a harder time navigating through it?
Lisa, I think there was a distinct advantage for those who decided to front load inventory and try to mitigate the presumption of tariffs, and then when they actually went in place with all the ups and downs of different announcements. More than half of our 125,000 importers at the Port of Los Angeles are small to middle-sized businesses. They tell me directly in conversations that they struggle to pass on those increased costs for fear of not being able to compete with the larger companies. Auto parts companies trying to absorb those costs as they send product to the big 3 manufacturing facilities, because the alternative is potentially shutting down a manufacturing line, which could be $2 to $4 million per hour.
So is something else going on when you look at small business confidence and the fact that it hasn't recovered to the same degree that, say, the stock market has? Is there something else going on here that isn't just with respect to a consumer that's flagging, but that has to do with an uncompetitive landscape in a way for some of the companies that don't have the supply chain heft and the data that some of the largest ones do?
You're right, and I'll give you another example. In Los Angeles, a number of small companies in our Chamber of Commerce, led by Maria Salinas, tell me that I buy a lot of small parcels from Asia, from China specifically, to put in my storefront, to put in my boutique shop. Now, with the de minimis exemption removed, their prices have skyrocketed, and those folks, family businesses, are in real trouble when it comes to keeping inventory at decent prices.
So you're seeing not so much a struggling consumer, but a struggling small business sector?
I do. And folks are trying to make ends meet. They're trying to dance around all of this policy change as best they can. They're resilient. They're working hard. but it's a distinct area of concern for a lot of small businesses.
Do you think it's enough for small businesses to actually go out of business, to close shop?
Haven't seen that yet, but again, folks are worried about what they do. You've got toy importers right now who take these 6 weeks before the holidays to make payroll for all of 26. And everything that cuts into their margin, if they're dipping into cash just to pay for those products because of the elevated tariffs, that's going to put a squeeze on a lot.
Ahead of 2026, what kind of front loading are you seeing right now?
Cargo is moderate. It's not falling off a cliff. It's not saying the consumer is going to stop. We've got Lunar New Year on the 17th of February, so we'll see a little bit of a bump before then, and then an early springtime for fashion here, especially in the U.S. But also for the month of December, we're anticipating about 800,000 container units. That's a really good number, but it's off just a bit compared to the comps of an elevated 2024.
You started by saying that the total volume of shipments from China has dropped from 60% back in 2018 to now 40%. At the same time, yesterday we read a story saying that China just crossed the $1 trillion surplus mark when it comes to total exports. How much is the United States getting cut out of the global supply chains right now?
Now, two pieces here. Even though imports from China are down, exports from China to the rest of the world are up by double-digit fashion. They're finding other customers in Europe, Africa, and Asia countries. Second, because our exports have been really waning this year due to those tariffs and different countries stepping in, like Argentina and Brazil on soybeans, Australia with almonds, we're seeing a really depressed export market. And we only consume about a third of the ag products that we harvest in the United States. Balance 2/3 go to renewable energy and overseas markets. That's not there.
Do you feel like people are pretty optimistic when you talk to them that there is going to be some sort of calibration of some of these policies, or do you feel like there is a sort of a gut check and sea change in the mentality of the businesses that you work with that have traditionally imported a lot?
The want is to get to a more stabilized environment. The actual on-the-ground work is still simulation. If I have to take another 10 percentage points of my sourcing from Vietnam, what does that mean? Do I have the services? Can I get the product to my regional DC in time for sales items, fulfillment centers, et cetera? So it's still a lot of extra work beyond the day-to-day execution of the supply chain.
Gene Soroka, wonderful to see you. Thank you so much for being with us here in New York. Port of LA Executive Director Gene Soroka here. And talking about small businesses, we actually got the small business survey from NFIB earlier this morning, and it came out at 99 from the expected 98.3. So actually inflecting a little higher, although far below where it had been. A real question here, though, about the disproportionate influence, whether it's a big company that has more resilience or whether it's a small company that's having to eat a lot of the prices.
If you're a Walmart, you're a Target, you're able to stockpile and you're able to really front load a lot of this, and you have a lot more flexibility. Also, great point by Gene, the de minimis tax. That is huge because you didn't have to pay a tax on any of these little trinkets that were under a certain amount, $800. Now you are paying that level of tariff and tax. And for a lot of these small businesses, the price and the cost of doing business has just gone up.
Yeah, which is the reason why you're getting investor days from a lot of different companies, potentially even the first investor day in years. And the clarity you're getting is not much because they don't have much clarity either. So the range of estimates is incredibly wide. We're going to continue with that conversation, especially as it becomes a very heavy deals environment. Coming up next, Sarah Hunt of Alpine Saxon Woods, Eswar Prasad of Cornell University, and Sam Zeef of JP Morgan Private Bank as we count ahead to that Fed meeting, that rate decision largely expected to end in a rate decrease. This is Bloomberg Surveillance.
Technology is embedded in every aspect of our lives.
And laying the foundation for the future.
From finance to defense, AI to entertainment.
And from the road to the stars. Bloomberg brings you the latest stories of the people and companies pushing the tech sector to new frontiers.
And the politics that shape global tech markets.
I'm Caroline Hyde in New York.
And I'm Ed Ludlow in San Francisco.
Watch Bloomberg Tech every weekday.
Only on Bloomberg Television.
What some of these generative AI models look like they're going to do is they're going to reduce the cost of producing content to basically zero. So that will be a multiplier effect on the things that we're already seeing, which is that there's more people producing more content and reaching more people. And there's a lot of good and bad that comes downstream from that.
I don't know if you can break down what the average person is seeing right now in terms of stuff that's AI generated versus, maybe more traditional human generated, but what's that going to look like in a year or in 5 years?
There's actually a lot of hybrid content, and too often we talk about synthetic content and organic content, and never the two shall meet. But there's a lot of content where AI is part of the workflow, right? Like you might not even know it. It might be whatever app you're using to do color correction, might be using models to do so. Stamp tool in Photoshop in the old days to get rid of a pimple, those types of things. But that line is going to be more and more blurred. So it's going to be a little bit less like what is organic content and what is AI synthetic content and what the percentages are. I think there's going to be actually more in the middle than pure synthetic content for a while. But you will also see experiences that are purely AI, right? You see this in the last 2 weeks with Vibes in the Meta AI app and with Sora 2 from OpenAI. So I think you're going to see both.
Know how the market day started.
Find out how it finishes.
Public markets to private markets.
From the micro to the macro.
Covering retail, entertainment, the business of sports.
The supply chains, trade policy, how it all is impacting the U.S. equity market as we drive to the closing bell at 4 p.m.
A holistic approach to covering financial markets.
If it matters to your life, we're covering it. I'm Katie Greifeld.
And I'm Romaine Bostic, and this is The Close.
Live every weekday.
Only on Bloomberg. Context changes everything.
From the world of politics to the world of business, Joe Matthew and Kaylee Lines deliver news, insight, and analysis live 2 times a day, every trading day. Balance of Power at 1 and 5 Eastern, only on Bloomberg.
It's the countdown to the market open as we bring you the first trades across Europe.
We'll debate the most important stories and what will drive the big investment decisions throughout the morning. I'm Guy Johnson.
I'm Kriti Gupta.
And I'm Anna Edwards. Join us every weekday morning for the opening trade, live at 7 a.m. here in London.
Only on Bloomberg. Context changes everything.
Markets are looking sort of short term, right? They think that there's going to be another Fed rate cut.
There's a question of how much is appropriate to cut.
I probably wouldn't cut at this meeting this week because inflation is a concern for me.
The Fed rate cut is the right thing, and I think we'll get it.
There's so much at stake going forward with the Fed.
This is Bloomberg Surveillance with Jonathan Farrow, Lisa Abramowitz, and Anne-Marie Hordern.
Good morning. Welcome back to Bloomberg Surveillance. Stocks range-bound as traders curb their enthusiasm about Fed rate cuts, with U.S. yields rising to the highest levels in almost 3 months. Hollywood drama meets boardroom drama, with Paramount's hostile takeover bid for Warner Brothers setting the stage for a new chapter in the media landscape. And NVIDIA getting a win as President Trump signs off on the sales of H200 chips to China. A real question about what this entails with a 25% tariff, as well as potentially a real question about the new landscape for national security.
New landscape for national security because this was seen as a chip that potentially was too advanced to go to China. But when China was given the offer to have the H20 chip, they told their firms, please shrug them off. We only want the best of the best. And actually, we also want to support our national champions. The most important question, I think, as you rightfully pointed out earlier, maybe this is why NVIDIA's stock is not rising as much, is whether or not China is even going to buy these chips. And the Financial Times has reporting this morning about Chinese regulators discussing ways to limit the permits. So buyers will need to go through a lengthy approval process. No final decision has been made, but it seems like China is going to be incredibly choosy on what chips they allow into which firms.
Yeah, which is the reason why I think people are not bidding up the shares even more of the likes of NVIDIA and AMD. Meanwhile, when we talk about the boardroom drama, some of the details coming out about the financing behind the Paramount bid for Warner Brothers, as well as Netflix's bid. Netflix's bid is really interesting. It features a $59 billion line of credit from Wells Fargo, BNP, and HSBC. For Paramount, their bid features money from the Ellison family, from Qatar, from Saudi Arabia, from Abu Dhabi, and of course, Jared Kushner, the son-in-law of President Trump.
And actually, this is the second time this year that we see the PIF, the Saudi Sovereign Wealth Fund, partner with Affinity Partners, Jared Kushner's firm, when it comes to doing a massive deal. This is why this is incredibly so interesting. It's not just who has the better deal for shareholders, it's what kind of makeup is the company. They're different, selling different parts or going after different parts when you look at these two deals. Some want Warner, Netflix wants the catalog and the studio. Paramount wants the whole thing, including the news division. Which one actually can get regulatory approval, I think, is really important. The president was asked about this yesterday. He said, I have to see what percentage of market they have. None of them are particularly great friends of mine, which I feel like Larry Ellison and Jared Kushner would disagree.
Well, either way, it does highlight how we are seeing a new era for deals and deal making, both in public and private markets. A real question of how much the Fed is going to continue to fuel this with not only a rate cut tomorrow, but also signaling potentially a slew of additional rate cuts early next year. What we are seeing right now in markets is a lack of real direction, trying to rebound just a touch, with the S&P up about 0.1%. You do see yields essentially flat at 4.16 on the 10-year. The sell-off in long-end yields across the world has been notable and has really tempered some of that risk appetite and really somnolent when it comes to the currency markets, that dollar weakness that really has hit pause, as well as crude, which really has been hovering around this. Crude's been sort of a boring place right now because ultimately it's a supply-demand story that has more to do with OPEC than it does the consumer. Coming up this hour, don't miss this, Sarah Hunt of Alpine Sachs & Woods, as AI continues leading markets higher. Eswar Prasad of the Brookings Institute as the White House shifts its stance on selling NVIDIA chips to China. And Sam Zeef of JP Morgan Private Bank saying rate cut bets may be too aggressive. We begin this hour with stocks holding steady. Sarah Hunt of Alpine Sachs & Woods sees AI as a major market driver, writing, we expect this to continue as we look forward to 2026 and also expect some volatility around the ever-moving sentiment on who wins and loses in the AI sandbox. Sarah joins us now for more. Sarah, good morning.
Good morning.
So let's start with the moving sandbox that is who is allowed to sell what to who. And this idea of NVIDIA potentially being able to sell H200 chips to China. Is that a game changer for you, given the fact that it rearranges some of our notion of what national security means?
I think there's been so much back and forth on this, and my recollection is that the H200 chip was one that was actually developed specifically to be exported, as opposed to some of the other chips that were not supposed to be exported. So I think that there's been a hugely moving amount of sentiment. I think that there is an argument to be made on both sides, one for security and one also for you want the paradigm to be the technology that we are exporting as opposed to letting people develop technology, especially after the DeepSeek scare and some of the other things that have gone on in the AI world. I can understand why that makes some sense, but there's arguments on both sides, and at the moment, we'll see how much traction that gets when that's allowed.
It's come at a time of great competition, and I think that this is really important to the broader AI story. There are competitors, which is why it might be dangerous not to have a competitive edge and get people addicted to your chip. How much are we seeing a game-changing landscape when it comes into 2026 with Eddie Ardeni saying every company is a tech company? Those are going to be the big winners, not necessarily the rank and file that have benefited the most year to date.
Excuse me. Well, I think that that's part of the whole switch that people are looking for, which is we've been building out the infrastructure. We knew the companies that were making the infrastructure. Now we're looking for use cases. What are those use cases? Who's going to benefit the most by them? Who's going to end up having this be margin accretive as opposed to margin detrimental? And I think that that's where he's not wrong to say everybody's a tech company, because everyone's looking at how to incorporate this into their process and what to use it for, how to make things better, at the same time trying to trip over themselves and say, but we're not going to fire everybody, because that's also a concern on the labor side.
So who's doing it right now? Who's getting ahead of this and actually implementing AI in a way that you think it's worth buying some of those companies or some industries?
Well, I think that there's some enormous potential in places like healthcare. There's some companies that are specifically looking to take some of those wide-ranging numbers of candidates and narrow them down before you get into the lab, so that you have a much better shot on goal for some of the areas where people are looking for research on the biotech side. I think you're finally starting to see the biotech index pick its head up a little bit after it's been, the healthcare side hasn't been doing as well as some of the other areas. I think that's a place where the data and consolidating some of that data can be very, very helpful. But there are plenty of other places for that too. Like if you think about things like insurance and all sorts of things that use big, huge data sets, how can I use that information to sort of narrow down what might be the best outcome in a lot of different things. And I think that there are ways to do that. I mean, for us as well, you can get a lot of transcripts read, you can get a lot of things done and put it through. You don't necessarily have to believe everything it spits out, but it definitely gives you places to start that it took you hours to get to before.
How much do you need to see that story develop in 2026, potentially to quell any concerns, or the market to quell any concerns about an AI bubble?
I think it's a big deal to have that happen in 2026. Those use cases become more and more important because you can talk about the ubiquity and how we're going to use things, but the spend has been enormous, and to some degree, some of these companies don't have the revenue to back up that spend. Some of the companies are using their balance sheets. Some of them are going to be taking out debt. This is going to be a big switch. It's a paradigm shift between companies that were all cash generative to companies that are now using that cash, companies that were asset light to all of a sudden having assets. I mean, you can make that argument with Netflix and Warner Brothers as well, right? That was not an asset firm. So I think that there is a lot going on into next year, which is why I think we're positive, but I think there may be some volatility. So there are some places where you want to be a little bit careful.
It sounds like you agree with the Goldman Sachs client survey that came out on some level, where they started talking about optimism, particularly in the light of some Fed rate cuts, accommodation from both fiscal and monetary policymakers, but also highlighting high valuations in the AI trade. So even though they are optimistic, seeing a year-end target of 7,000 to 7,500, not necessarily the 8,100 of John Stoltzfus. Do you kind of line up with that, the idea of modest gains that are choppy through the year with a slight churn when it comes to leadership?
I think we've had such a change since the financial crisis, and we always look to history and we say, well, there's going to be a mean reversion, or you can't have this many things happen. These things don't follow these things. I think that it's right now, the companies that are continuing to increase their revenues, regardless of their valuations, people are willing to pay for still because they see a real path for that. I think that as you start to see things round out, that's going to help on the earnings front. If you start to see any kind of degradation in earnings, I would be much less optimistic. And I think that part of what people are building on for next year is some of the things that you mentioned on the fiscal front, but also in general, they're looking at an economy that they think is going to be doing fairly well. And if there's any change in that, or if you start to see earnings or margins have a problem, I think it's a much bigger issue than it would be at the moment that we see.
That's one side of the story, the idea that the stock market is seeing growth and optimism. The bond market is seeing enough weakness for the Fed to be aggressively cutting, and it seems like there is a sense of something has to give here. These two markets are not trading in tandem. Right now, we're seeing the bond market lose a little bit of footing with long-end yields rising. Do you think that they're sussing out the strength in stocks, or do you think that this is something else that has to do with global phenomena that are really lifting yields?
I think the trickiest thing for central banks is that the global indebtedness has expanded so much versus where it was pre-financial crisis, that when bond yields start to move around, it becomes much trickier to figure out why are they moving in the direction that they're moving. And we've seen the decoupling of yields and stocks on more than one occasion over the last several years. So a lot of those relationships, historic relationships, are not holding because of a lot of factors that we can't quite figure out how to take into account. So it's hard to answer that. I think the concern is indebtedness. The concern is everyone's got to refinance a lot on the government side, forget the private side. And I think some of that is making it trickier to figure out exactly from a directional standpoint which way yields are, what the yields are telling us, I guess.
Also, is it part of it what's going on in places like Japan?
Absolutely. Because there is something that for years you had a fairly quiet, fairly consistent carry trade that everybody was looking at and everybody was sort of using. And then all of a sudden you see the yields in Japan go from a very consistent, almost zero, to not so, to much higher. And that has been a change. And I think under the surface, there's been a lot of money flow that accompanies that. But that's also one of those things that it's one of the many variables. It's hard to look at that specifically and say this happened because that happened. But it definitely is part of the concern about where to go with yields, right?
What's your highest conviction trade heading into 2026?
We think that there is going to be a catch-up on small cap. We think that some of the areas that have not benefited as well, you had 2 years of you had 2 years of bad earnings in small cap, and everybody kept saying this is going to be their year, this is going to be their year. I think some of that, you're lapping such bad performance that you can see an earnings jump, and people like to see those earnings jumps. You have to be profitable. We look at companies where we want to see the cash flow, we want to see the ability to either buy back your own stock, which in small cap is harder, but if you start to see dividends getting paid, if you start to see that expansion of cash flow, we are very balance sheet sensitive right now. We run a dividend product and a capital return product. We're very balance sheet sensitive because there's a lot going on with cash.
Small caps that we've seen actually really gain favor over the past couple of weeks. Sarah Hunt of Alpine Saxon Woods will be sticking with us. Right now, let's get you an update on stories elsewhere this morning. Here is your Bloomberg Brief with Yahaira Anand. Yahaira.
Hi, Lisa. Google is being investigated by the European Union over whether it has abused its dominance by using its own AI tools to squeeze out competition. The Commission saying it will look at whether the firm has distorted competition by imposing unfair terms on content creators and giving its own AI model an advantage over its rivals. Meanwhile, 2 men are being detained by the DOJ for allegedly attempting to smuggle at least $160 million worth of NVIDIA AI chips to China. The department alleges the men operated a network that replaced NVIDIA labels from H100 and H200 AI chips with the fictional Sanqian brand before shipping them. A third suspect has already pleaded guilty. And Jimmy Kimmel is back for at least 1 more year under a new deal with ABC. Sources telling us here at Bloomberg that Jimmy Kimmel Live will continue until at least May 2027. We're told the host and Disney agreed on an extension months ago, but delayed announcing their plans out of respect for axed fellow late-night host Stephen Colbert. That's your Bloomberg Brief. Lisa?
Thank you so much, Yahira. Up next, Paramount versus Netflix.
I know the companies very well. I know what they're doing. We have to see the Netflix percentage of market, Paramount, the percentage of market. I mean, none of them are particularly great friends of mine.
Even his son-in-law? We'll talk about that. Bloomberg's Tyler Kendall joins us next. This is Bloomberg Surveillance. Making money isn't about drowning in emotions. It's about understanding what's actually happening. Markets are the best way to glean signal from noise, and that is what we try to do every morning. This is Bloomberg Surveillance.
I'm David Weston. Join me each week on Wall Street Week for stories of capitalism from business, markets, economics, tech, and climate. We go on the road for a look at what lies behind the headlines of today and what will likely be the headlines tomorrow.
We need more transparency.
Oil and gas is still important.
They said every citizen should be investing in the market.
Accelerate progress in all fields of science.
Watch Wall Street Week right here on Bloomberg. More than what you need to know, it's what you need to think about.
Asia is at the forefront of some of the world's biggest stories.
And we're here, where the action starts in Sydney.
And in Tokyo, get ahead as the global trading day begins.
The Asia Trade, weekdays only on Bloomberg.
Really trying to get that Santa Claus rally underway. Yesterday, we snapped it. We snapped that positive mood. 4 days of winning streak that did come to an end today. Just a little tepid lift to futures as the session grows older. Meanwhile, in the yield space, watch this because this has been really driving a lot of the risk sentiment. Yields up yet again in the 10-year, 4.17% when you round it up as you see yields climb to some of the highest levels that we've seen since the end of September. A real question about the state of the economy, given that we are operating somewhat in a fog. Today, we do get the JOLTS job openings data, as well as the quits rate. That, to me, is going to be very key. Tomorrow, we get ECI, the employment component index, the employment cost index, as well as, of course, that Fed rate decision, and Jerome Powell coming out with his statement with some sort of forecasts. Jobless claims on Thursday. Before that, Oracle. A real question here about whether people are getting an accurate read right now in the economy.
It's going to be a huge question because, as Andrew Hollenhorst just published, preparing for a few months of weird data. We're not even going to get October, November PPI data until January of a new year, which is why today and tomorrow's Fed meeting is so important. Likely they're going to cut, but what do they signal for 2026, given the fact that the data is just frankly weird given the government shutdown?
Yeah, how do they see the inflationary pressures versus some of the job losses that we have seen? Meanwhile, in the deal space, all eyes on the boardroom drama under surveillance this morning, Paramount versus Netflix.
I know the companies very well, I know what they're doing, but I have to see what percentage of market they have. We have to see the Netflix percentage of market, Paramount, the percentage of market. I mean, none of them are particularly great friends of mine. You know, I want to do what's right.
Here's the latest. Paramount Skydance launching a hostile takeover bid for Warner Brothers at $30 a share in cash, valuing the company at more than $108 billion. That offer coming just days after Warner Brothers agreed to a deal with Netflix. Bloomberg's Tyler Kendall joins us now for more. Tyler, how much does the White House really hold the keys to who wins this deal?
Yeah, hey, Lisa. Well, each deal's potential to pass regulatory clearance here in Washington and with the Trump administration is going to be a big factor, as President Trump himself has said that he will be directly involved in any decision. But as you just heard, the president also maintained yesterday that he's not close with either company, Netflix or Paramount. This despite, of course, Paramount's bid being championed by the Ellison family, which, of course, has close ties to this White House and includes equity backers like the president's son-in-law, Jared Kushner's private equity firm. The president did maintain yesterday that he has not spoken to Kushner about the proposal. Now, Paramount's bid is notable, not just, of course, for the proximity of the players to the White House, but also just the scope that we're talking about here. It includes sovereign wealth funds from Saudi Arabia and Qatar. Now, our reporting indicates Paramount has really been lobbying officials here in Washington. There was reporting that the CEO, David Ellison, did meet face-to-face with President Trump at the Kennedy Center honors over the weekend as they try to pitch investors that they have the clearer path when it comes to passing regulatory muster. And they're arguing, of course, that Netflix would harm competition when they're talking to officials. But Lisa, we can't forget that it was a Bloomberg News scoop that Netflix CEO Ted Sarandos met with President Trump in recent weeks at the White House, where he made the case that Netflix competition isn't only in the streaming space. I will point out that at that time, people familiar tell us that Sarandos left that meeting with the feeling that he wouldn't face immediate opposition from the White House.
Tyler, one of these bids includes the news division. One of them doesn't. I'm wondering whether the news division, potentially a tie-up between Warner Brothers, ABC, and CBS, the question of David Ellison winning this versus Netflix, whether that could potentially be a problem for the president, given some of his pushback on the media landscape.
Right, exactly. And you heard, Lisa, in that move, in that clip that you played, President Trump talking about how the media has been portraying this, often saying that he himself is going to take a look at the players and at the factors here. But particularly when we're seeing this reporting around what could happen to the future of CNN and how Paramount could address that, since we know that it's a top concern for President Trump, that really might play into the picture here. But at the end of the day, we have to keep in mind that, of course, whatever happens here, there's going to be that regulatory scrutiny. Typically, we are expecting that this is going to fall to the Department of Justice. They're the ones that typically oversee media mergers, and that could take anywhere from 10 months for an investigation to wrap and then ultimately decide whether or not to sue to block a deal. So there is so many factors here that we have to weigh, and it's going to take a while to shake out.
Tyler Kendall of Bloomberg, thank you so much for that. Sarah Hunt of Alpine Saxon Woods is still with us. Sarah, I am curious about the backdrop for this. Debt markets wide open, happy to finance it. Banks willing to put up a $59 billion bridge loan, one of the biggest ever, as Netflix does go forward in this deal. Does the mood of markets seem to be shifting to a very different kind of LBO-esque 2006, 2007 kind of feel versus where they were to start 2025?
I think there's definitely been a pickup in mergers and acquisitions, and I think that to some extent, the fact that the IPO market has been so quiet is one of the things that's got everybody jumping on M&A as opposed to some of the other aspects of capital markets on the equity side. So I think there's definitely, between the fact that there is plenty of money looking for a home and plenty of people looking for transactions, I think that you've definitely seen a step up in the last several months.
What does it say if this is not a one-off, that this is now becoming a fight when it comes specifically about the assets for Warner Brothers?
Well, I think, I mean, you've had an industry that has been so disintermediated by the internet, and you have, I mean, even thinking about the news division, right? How many news channels did there become over a period of time? How much of an audience does everybody have anymore? It's not the way we were. We still think of it. I mean, certainly those of us of a certain age, of a major three networks and everything else. It's been a very different situation. And between that and what has happened with streaming and taking things out of the theater, I think there's a lot of different issues to play with on the regulatory front. And I don't, it's going to be tough to make all those decisions. But I think that you have some real issues potentially with both of these.
What does it say about Netflix shareholders given where the stock price is? It doesn't seem that they like this idea and this idea of bringing on more assets. To your point earlier, that these were companies in the tech space that were cash heavy, asset light.
I think that is one of the head scratchers about the change in strategy from an outside perspective, looking in and saying, look, you've got this fantastic streaming service. If you're Netflix, you've got an enormous amount. You're generating an enormous amount of cash, which for several years they weren't, right? So they were penalized when they weren't generating cash, and they were paying all this money for content because people were trying to figure out how that was going to work. Well, they've got that to work very well, and now all of a sudden this is a change again, and I'm not sure how people are going to feel about that. I think that's one of the things that we have as a concern for next year, which is the returns on the cash that most of these companies have been getting for a long time has been fantastic. They're now putting it in a bunch of assets that may not have the same return profile. That is a paradigm shift that the market is going to have to come to grips with, especially given the valuations.
Would you rather invest on the debt side or on the equity side, given the fact that there is this change?
It's an interesting question. I mean, we're mostly equity people. We do some fixed income work, but we're mostly equity people. I think that depending on how levered you are, yes, I'd want to be looking at the debt versus the equity. But I think that right now, I mean, what this would do to Netflix isn't driving it into crazy levered territory, and it looks like what they're trying to do with Paramount Skydance is raise more equity than debt, because that's already an indebted situation. So it depends a little bit on what the entire capital structure looks like and what you think the cash flows are going to be after that. You know, there are arguments for both, but it sort of depends on what you're looking for.
Apollo's Jim Zelter was on earlier, just the past couple of weeks, and he said people are expecting disruption in business models, but aren't pricing in how exponential some of the revaluations can be, that things can go to zero, right? I'm thinking of Xerox, I'm thinking of Kodak, I'm thinking of other companies that just overnight become obsolete. You see, for example, a real question, existential question around some of the movie theater operators, right, in the wake of a potential shifting in business model. How do you avoid those potholes of potential businesses that suddenly overnight just become worth nothing?
Well, I think that this is one of the reasons that we like to follow things like cash flow as opposed to just earnings, because you start to see companies not be able to generate cash as things start to get worse. They may be putting up earnings for a variety of different reasons, but you want to look at that and make sure that you really are still seeing a business model that is viable regardless of what is going on. I think this goes to the networks again. This is one of those issues where you had these big cash generative networks, and then all of a sudden they paid up these massive amounts of money for sports and everything else. And then you're wondering, like, is the advertising really coming in strongly enough to support all of that? And I'm not sure the answer to that is yes. And I think that if you follow that trajectory, that gives you some insight into what's going on in the future.
Sarah Hunt, thank you so much for being with us. Sarah Hunt of Alpine Saxon Woods. So you don't believe, Emery, that this actually is someone, President Trump, who has not talked to his son-in-law or potentially even one of his best friends?
Well, he's talking to everyone involved. And your question to Tyler about what it means for the news division, Wall Street Journal overnight had this story about how there was a December meeting. David Ellison offered assurances to Trump about changes at CNN. This is according to the Wall Street Journal reporting. And it said Trump has told people close to him that he wants new ownership of CNN as well as changes to CNN programming. That can also cast a cloud of a ton of controversy around this deal if Paramount ends up winning over in the bidding war.
This deal is going to be full of controversy. Also, the idea of U.S. banks versus Middle East money, a whole host of other questions that we'll continue to be asking. Coming up next, we'll be talking about NVIDIA. Eswar Prasad of the Brookings Institute as the White House reverses its stance on selling NVIDIA chips to China. Plus, Danny Berger with your morning movers. AutoZone shares falling as first quarter comp sales missed estimates. From New York, this is Bloomberg Surveillance.
to Bloomberg Business Week Daily.
We got to talk crypto.
From the magazine that helps global leaders stay ahead.
What's the conversation around your company?
Bringing you insight on the people, companies, and trends shaping today's complex economy.
Planning very big things.
The new level of premium.
Plus global business, finance, and tech news as it happens.
The floodgates of innovation are going to open up.
You can't fake passion. You either are or you aren't.
Bloomberg Business Week Daily, only on Bloomberg.
Middle East and Africa, vibrant resources and high-yield investment opportunities abound. Join me on Horizons Middle East and Africa for the stories, newsmakers, and insight from this exciting region. Now weekdays, only on Bloomberg.
U.S. jobs numbers are released. Bloomberg has the report under surveillance with crucial data and expert analysis at terminal speed. Nobody covers Jobs Day like Bloomberg.
Morning, this is Bloomberg Daybreak Europe. I'm Tom McKenzie in London. These are the stories that set your agenda.
Taking you from the U.S. market's close to the overnight session in Asia. We'll walk you through what you need to know to kickstart Europe's trading day. Live from our European headquarters, we bring you the day's top market-moving stories, unmatched expert analysis, and on-the-ground reporting from across the continent. Tune in to Daybreak Europe, only on Bloomberg Television. Context changes everything.
The big question for today is, can bond markets sustain some sort of rally after 2 straight days of losses, with yields rising to the highest levels going back to September? Take a look at the stock market. You are seeing really range-bound, hovering between gains and losses, with the S&P futures up about 0.1%. It really does hinge on 2s, 10s, and 30s, whether we do see any kind of bid. Earlier this morning, we did see a bid into the long end. We continue to see that just marginally after that 2-day sell-off that really did send yields much higher. 2-year yields getting a little bit higher, as well as people pull back some of the expectations. This is heading into that 2-day meeting with the Federal Reserve, where they're widely expected to cut rates. Key question, how much can they possibly cut next year, given the fact that everyone's expecting a rebound in the U.S. consumer? 2 hours away from the cash open, here are your morning movers with Danny Berger. Danny.
Hey, Lisa, earlier this morning, we got an update from CVS at their Investor Day, and it is one where their earnings outlook that beat expectations. Their revenue didn't, but I guess the earnings was enough to lift things higher. They also gave outlooks through 2028. Their planned Vital Knowledge analysts say that it does imply that their expectations are ahead of the streets. They also talked about a new consumer platform that was, of course, AI-enabled. Shares up just under 3% this morning. Elsewhere, I talked about this yesterday, CoreWeave issuing more debt in the form of convertible bonds. It was $2 billion. Their shares fell 2.3% after that news. This morning, they announced that they're actually upping the size. It's going to be $2.25 billion. So it's the same reaction as yesterday. Shares fall this morning by 1.6% in the pre-market. Finally, we got some earnings from AutoZone just moments ago. Those earnings also missing expectations. It's again this concern about the consumer, big ticket purchases. So what does that mean for different parts and supplies for their cars? The CEO also talked about the fact they're going to aggressively open stores. They're hoping to capture more of the market share. Those shares down about 1.7%, Lisa.
Thank you so much, Danny. Just picking up on what you talked about, Danny, with CoreWeave. Really interesting to see CoreWeave continuing that slide. This convertible share sale is really highlighting how much convertible bond sale is highlighting how much they need to raise money to finance some of what they're doing for OpenAI. Again, this all comes back to Sam Altman and his shadow over this market.
Well, this is why people are concerned about an AI bubble, because the circular transactions between these companies, it's why you have basically the plug of an outlet into an outlet bank. It is just absolutely circular. And until they start showing more profit and showing that actually how AI is working, not just the basics of what we have now with ChatGPT, but across sectors, this is going to be a huge story for 2026.
A real question here about dilution. The financing further strengthens CoreWeave's balance sheet while lowering its cost of capital as the company scales its AI cloud platform to meet unprecedented demand. We'll pick up on that in a bit. On our radar this morning, Paramount launching a hostile takeover bid for Warner Brothers Discovery. The bid is being supported by a more than $40 billion equity commitment from investors, including Saudi Arabia's Public Investment Fund and Jared Kushner's Affinity Partners. Watch this space in terms of which poses a bigger conflict of interest, potentially a bridge loan from some of the banks, or potentially a cohort that includes President Trump's son-in-law and some of the Middle Eastern allies.
This is going to be incredibly complicated. Warner Brothers has 10 days. December 22nd, they have to give as the final date to Paramount, and then Netflix will have 4 days. So this could drag on. It's definitely going to drag on into 2026. But the biggest question right now is not just who has a better deal and for what assets, it's who can actually get regulatory approval. For Netflix, a huge question is going to be about market share when it comes to streaming. And then for Paramount, I think a big question is going to be about all these characters are involved. You have 3 sovereign wealth funds out of the United States, also Affinity Partners, which is the private equity firm of the President of the United States' son-in-law.
Meanwhile, in the other geopolitical news, President Trump threatening an additional 5% tariff on Mexico over a water dispute. The president also warning of new levies on Canadian fertilizer and Indian rice. The move's coming as the Supreme Court considers the legality of the president's sweeping global tariffs, and President Trump saying in a recent political interview that he's interested in possibly lowering tariffs in order for cost of living concerns. We will get into that as well. President Trump, meanwhile, granting NVIDIA permission to sell its H200 chips to China in exchange for a 25% surcharge. The decision allowing NVIDIA to potentially regain business from a key global market and is considered to a win in its efforts to curb export control. Bloomberg's Mandeep Singh joins us now for more. Mandeep, how unexpected was this, given the fact that NVIDIA wrote off any sales to China in its latest earnings release?
I mean, look, I think we have been going back and forth in terms of NVIDIA's ability to sell to Chinese customers. And in this case, I think this is a newer sort of variation of that H20 that they were allowed to sell in the region in the past. And it's not the latest Blackwell chip. So from that perspective, clearly, they are still managing to sell an older version of the chip. But the Chinese market, as Jensen has highlighted, is huge. I mean, he himself has said it's a $50 billion opportunity. And just to put it in context, we're like the hyperscalers will make up almost $160 billion in revenue for NVIDIA next year when there will be over a $300 billion base. So there are 3 big hyperscalers in the China's region. And so if they're able to sell up to $50 billion, that will be huge in terms of what it means for NVIDIA's top line growth. And that's why they're keen to, sell anything they can when it comes to the China market.
When it comes to the share price this morning, though, isn't it reacting to the fact that they don't think they're going to be able to sell that much? In the Financial Times this morning, talking about buyers are going to need to go through a lengthy approval process, showing why they can't use homegrown champion chips and they have to use NVIDIA.
Yeah, look, and that's where the back and forth that has been there in the past when they were able to sell H20s and then they had to completely, take it out of their guide. There is that, security aspect that continues to come into play in terms of what are the Chinese LLMs currently using? What are they training their models on? And so it's not a done deal, but from an NVIDIA perspective, I mean, there is no doubt that it will be a positive if they are able to sell to the Chinese market because they have to find big hyperscalers as new customers. They already have all the ones outside of China. The question is, that's where all the LLM companies are in China, and they want to be able to sell to them. So it'll be interesting to see if they're able to follow through and, sell in scale, which is what they want to do.
Mandeep Singh of Bloomberg, thank you so much for being with us. Turning to the trade war between the U.S. and China, China's top leaders signaling they are on alert for a potential flare-up as they draw up economic plans for next year. Joining us now to discuss, Eswar Prasad, Senior Fellow at the Brookings Institute. Eswar, thank you so much for being with us. I want to start with the trade war in the context of this recent move by the United States for NVIDIA to be allowed to sell its H200 chips into China. Do we have a sense of where buying those chips fits into China's plans as they try to turn more inward and rely on domestic champions?
So we are looking at competition in one area which is going to be the most intense between the US and China, which is technology. The Chinese government has been very keen on upgrading its manufacturing sector, moving up the value-added chain and trying to dominate the high technology sectors, solar panels, electric vehicles, and now AI. For the US, it's a very dicey strategy right now. On the one hand, you don't want to lose access to the Chinese market or deny China some of these chips, because that means that it gives China much more of an incentive to move forward with its domestic innovation strategy. But at the same time, providing these chips to China does make it a lot easier for them to move forward in terms of that innovation. And of course, the Trump team seems to be betting that this is going to help NVIDIA gain significant market share there. Whether that's going to be a durable increase in market share, whether NVIDIA can hold on when China competes with all the state resources behind it, I think it's a key question. But in the short term, NVIDIA's revenues are certainly going to take a big positive bounce. And there are going to be some revenues coming in for the U.S. government, but I'm not quite sure that this is going to serve the long-term U.S. national security or economic interests very well.
As far, I'm wondering, the Belt and Road, the digital Belt and Road that we've heard Jensen Huang talk about, that China would create a system of dependence on some of its technologies and goods in Southeast Asia. How far has China gotten in creating that type of ecosystem where domestic economies nearby really rely on China, both technologically as well as beyond that?
So in terms of trade and finance, China has certainly made a lot of progress through the Belt and Road and other initiatives. And technology is what they're coming from. At the moment, I think there is still a sense that China is able to not innovate fundamentally, but take existing innovations, many of which come out of the US, and commercialize them and scale them up in a way that is, clearly world-beating. And that is the advantage that is certainly very relevant in terms of increasing the scope of its technological, influence within Asia. And that is happening. It is happening a little slowly. And the fact that the U.S. is somewhat receding from the region, and many countries in the region feel that they cannot disengage from China because they don't have an alternative, trustworthy partner, is certainly helping China in this process.
Eswar, when it comes to China's relationship with Europe, especially now given Emmanuel Macron was just there, he's talking about how it's unstable. Do you see China going to have to not just dump more in Europe, but have to invest more in Europe because the walls have gone up and it's been so complicated with the United States?
The walls are going up for Chinese exports, and they're going to go up more because the reality is that China has now a very, very unbalanced growth model, with most of the growth coming from the supply side of the economy, which in normal times is not a bad thing, but domestic demand is not keeping up. And with every passing day, every passing quarter, there is more capacity in China that needs to be exported. The U.S. has put up walls, at least to direct Chinese exports to the U.S. So Europe and other countries that need exports themselves to bolster their economies are going to face the brunt. And China is very cognizant of this issue. It's the reliance on exports to power its own growth, but also the fact that walls are going up to its exports around the world. So it is trying to befriend these countries by essentially investing in those countries. And this again poses an existential risk, in my view, for some of the companies in these countries, especially in the high technology sectors, because they could get swallowed up by these Chinese investments and essentially find it very difficult to compete against Chinese firms operating on their own soil. But that's the direction the Chinese are taking, and at the moment, very few countries are able to resist.
A lot of times the United States will say that they are pushing other countries to do this, to not exactly combat, but have this competition with China. But what kind of message is the U.S. sending at the same time when they're basically showing that they want to put trade and economic concerns higher than national security concerns, with President Trump allowing NVIDIA to sell the H200 into Beijing?
Yes, some of the policymakers I've spoken to, you do point to what they see as U.S. hypocrisy in the sense of trying to put up barriers to Chinese imports, trying to limit exports and trying to get them, that is, other countries to do the same, while at the same time the U.S. seems very, very willing to trade off many issues that the U.S. claims should be very important, including national security considerations, for short-term economic gain. And this NVIDIA decision is a prime example of that. So certainly the message that the rest of the world is hearing from the U.S. is one of great inconsistency and some degree of short-termism, rather than really viewing the long-term economic and national security of the interests as being the prime drivers of U.S. policy.
Eswar, over the past couple of years, you and I have talked about a real question of how much the U.S. will lose some of its dominance globally as a result of some of these shifts and concerns that you talk about. We haven't really seen it. You have seen some sell-offs arbitrarily in the dollar, sort of momentarily, not arbitrarily, and a real bid up in the price of gold. But have you seen a sustained shift away from the U.S. financial system by some of the trade partners of the UR?
In short, no. I think the reality is that the U.S. remains a dominant economy and dominant financial market in the world. In terms of final consumption demand, it's still the most important. And relatively speaking, in terms of its financial market depth, size, and its institutional framework, which is certainly being eroded as we speak. But overall, this package is going to be very difficult for any country to beat. And despite all the concerns about U.S. government debt, about the U.S. institutional framework, including the central bank independence and so on, what we have seen is foreign investors have continued to buy significant amounts of U.S. treasuries and other U.S. financial assets, and this includes foreign central banks. Certainly foreign central banks and everybody around the world is trying to diversify away from the dollar. They're doing so at the margin, but really there isn't much of an alternative to the U.S., and we see that in investor behavior very clearly.
Eswar Prasad of the Brookings Institution, thank you so much for being with us this morning. Wonderful insight. Just as Eswar is talking, JP Morgan puts this outlook out, where as they say they expect emerging market equities to outperform developed market in 2026. So maybe not shifting away from the U.S., but bright spots elsewhere as well.
Especially when you look at places in Asia, especially China, when it comes to the fact that just this week they basically had a former NVIDIA executive launch an AI company. They are putting everything they can into these homegrown champions.
Yeah, talking about how a second year of outperformance from emerging markets comes after years and years of underperformance. Right now, let's get you an update on stories elsewhere this morning. Here is your Bloomberg Brief with Yahira Anand. Yahira.
Hi, Lisa. We're seeing CVS shares rising 3% in the pre-market. The healthcare company raised its full-year profit forecast and said earnings would rise in 2026. It's a sign of hope as it navigates a turbulent retail environment, plus government scrutiny across the healthcare industry from vaccines to insurance. Meanwhile, Michael Burry says he holds sizable positions in Fannie Mae and Freddie Mac common stock and believes a relisting is, quote, nearly upon us. Burry became bullish on the companies after President Trump's election and says regulators must ease capital requirements and scale back the government's claim on the companies for an IPO to occur. And the Los Angeles Chargers continued their push for the playoffs after defeating the Philadelphia Eagles to wrap up Week 14 of the NFL season. Eagles quarterback Jalen Hurts struggled, committing 5 turnovers, including a game-ending interception, as the Eagles dropped their 3rd straight game. That's your Bloomberg Brief. Lisa?
Thank you so much, Yahira. Up next, preparing for the Fed's decision.
I wouldn't be surprised if we see 3 cuts, so starting probably this week was the first, and then 2 more into next year. The U.S. is a bit in a weaker spot.
Sam Zeef of JP Morgan Private Bank joins next. This is Bloomberg Surveillance. Good morning.
In case you missed it, on Bloomberg Crypto.
There's a debate going on right now in D.C. that I think folks need to start paying more attention to, and that is the yield. And the question really is, who is going to keep the yield? Who makes money off stablecoins? Well, right now, in the case of some of the large stablecoin issuers, there's a yield that on those deposits So when there's a dollar, for example, deposited in a bank account, there's interest paid on that dollar. And so who's capturing that yield? And I think one of the really interesting things about the Genius Act is that it bans so-called yield-bearing stablecoins from giving that yield directly back to consumers. Now, that's not true everywhere. And I think if consumers have a choice, why would a consumer want an institution to keep that yield? Or would there be sharing of that yield? So right now, one of the debates going on is, will rewards be allowed? And I think these are really important questions.
Don't miss Bloomberg Crypto live Tuesdays.
Right, okay, ready?
David, what initially sparked your interest in this topic of longevity?
15 years ago, I turned 60, and I began to wonder how much longer I'm likely to live and what I could do to extend my life. On longevity, I talked with the leading experts in science and medicine to educate people about how they might be able to change their conduct so that they can live a happier and healthier life. I'm David Rubenstein. Join me on a 4-part journey as I explore the great quest for longevity. Only on Bloomberg.
Key investors, top executives, global innovators. Join me for in-depth conversations with the biggest newsmakers on the day's top stories. Insight with Haslinda Amin, only on Bloomberg.
Bringing you up-to-the-minute geopolitical news whenever and wherever it happens. I'm Stephen Engel at Japan's Akasaka Palace in Tokyo, and this is Bloomberg.
Right now, we're looking at markets, looking ahead to the Fed meeting, and a question of just how much the Fed will signal they are going to cut next year. A bit of an optimistic tone in equity futures. Bonds just fluctuating here after a couple days of a sell-off that left yields at the highest levels going back to September, under surveillance this morning, preparing for the Fed's decision.
I wouldn't be surprised if we see 3 cuts, so starting probably this week with the first, and then 2 more into next year if you look at a 12-month time horizon. I think that could be justified because although there is fiscal spending, yes, and increasing, but I would say at this point in time, the U.S. is a bit in a weaker spot. Inflation remains a topic, so we don't see inflation to substantially come down.
Here's the latest. Markets eyeing the Fed's dot plot as a divided central bank is expected to cut interest rates by a quarter point tomorrow. Sam Zeef of J.P. Morgan Private Bank writing, markets may be too aggressive in pricing the number of cuts. We anticipate the Federal Reserve will continue lowering interest rates with a total of 50 basis point cuts by the end of 2026, which seems to be consensus right now. Sam joins us now. Thank you so much for being here. I want to just start with what we've seen over the past couple of weeks in bond yields, particularly on the longer end. Why do you think there has been such a huge increase over the past couple of weeks?
Absolutely. I mean, it really does seem like it started after Halloween, after the Fed's meeting. So I think there's a 2-pronged thing that's happened here. Where one, the Fed did become a little bit more hawkish after its last meeting, signaling that the bar to further cuts is going to be higher, and we can talk about how that looks in 2026. And the other is that global sovereign bond yields are highly correlated. And we've seen sell-offs not only in Japan, but also in the UK around the budget. And so I think that's really been kind of infecting the long end of the U.S. bond market at the same time.
Is this bond vigilantes coming back and saying deficits are too high, or is this an issue of true inflation that people see as being persistent and sticky around the world?
I think it's an acknowledgement that central banks are getting to the end of their cutting cycles. The Fed might be the last one to get there, but if you look at basically money market curves across most developed market economies, outside maybe the U.S. and the U.K., they're all upward sloping now. All of these central banks have normalized rates. They're all near neutral, and the market is basically saying, look, there's no moves coming soon, but if there is going to be another move, because growth looks okay going into 2026, it's probably higher, not lower. And that's what we're seeing reflected in these curves.
It seems like markets have kind of come along with what you believe for next year. Have we fully priced in the scenario that we'll only cut by 50 basis points in 2026 based on the yield move that we've seen over the past couple of weeks?
I'd say that they're still a little bit more priced than we're expecting. I see the terminal rate priced at a little closer to 3%. We think that they really only get down to 3.25 to 3.5, not massive differences, but a bit. It's really about the labor market, right? The U.S. labor market is soft right now, relatively weak, you might even say. Our view is that as you move through 2026, it looks stable, resilient, even improves as it goes along, and that's what's going to determine the Fed cutting path. I think that's what we're going to hear from them this week, that, hey, they're going to cut this week. From here, it's going to take further weakness in the labor market to get them to move a lot more, and that's not something we expect. That's something that investors have to really make a big call on for 2026.
How do you think about all of this playing out to the fact that we are going to have a changing at the guard at the Federal Reserve, and Jay Powell's a lame duck, and everyone's just waiting for the next Trump nominee?
Yeah, I'd make two observations about it. One, and we have to remember this is a committee. So a new chair can come in and they could be hawkish or dovish, but in general, they've got to convince the entire committee how to move. And if you look at everyone across the committee, we can read all of their speeches. They're all pretty academic. They're all pretty much just interpreting the data. And I'd also make the observation that that seems to be how the market is interpreting this. There aren't huge changes in market pricing for before May to go. And there aren't huge changes. You know, a terminal rate priced into the market around 3% is, I think, very consistent, maybe a little bit more dovish than our economic expectations, but very consistent with overall consensus economic expectations. If there was some huge pricing in the market about concerns about how the Fed outlook was going to evolve, you'd expect that to be much more dovish than anyone's kind of central economic scenario. And I would argue that's not the case. Really, it's all about the labor market and the growth outlook.
Why do you think then bond investors told Treasury they were concerned about a Kevin Hassett chairman?
Well, I'd look at betting market odds, and that's how we've done it, which basically we've looked on days where betting market odds have shifted in terms of who it's likely the next chair is going to be, and then looked at market reactions around those changing betting market odds. And we don't see a huge relationship between that in any direction. And so I would really argue that it's really about how the economic outlook evolves. And we can talk about all of these things all day long, but when we look at what's driving market pricing across the curve, across FX markets, across markets in general, we think it's the economic fundamentals.
If you think the Fed is not going to cut as much next year as people expect, do you expect dollar strengthening, not dollar weakening, as so many people seem to believe?
Yeah, we really don't. Maybe that's where we're out of consensus. We really don't see the dollar set up for the same type of year as it had in 2026. The real driver for the dollar's weakness in 2025 has been that economic convergence between the U.S. and the rest of the world. Growth convergence, interest rate convergence. And in 2026, as the labor market stabilizes, we just don't think you're going to get any more of that economic convergence, really. So unless the economy ends up much weaker than we expect, we think the dollar is at least stable, and that's how we're investing, around a stable dollar. And the risks are that if the economy accelerates more than we expect, you could absolutely get a stronger dollar.
Sam Zeef, thank you so much for being here. Really appreciate it. Sam Zeef of JP Morgan Private Bank. As the market does expect, yes, a 95% chance that the Fed will cut tomorrow, but heading into 2026, the likelihood that there will only be 2 rate cuts, that's down from 3 just a couple of weeks ago.
And potentially hearing from him, you just have to ignore all the noise coming out of Washington. It all comes down to economic conditions and the labor market, which is why actually next week's non-farm payrolls are going to be so important, because they're coming after the Fed meets, and we're going to get some real clear-cut data on what is going on in this labor market.
Yeah, nothing's really been too clear-cut. We did get some NFIB small business optimism that did come in just a touch higher earlier this morning. We do get job openings and the quits rate coming out at 10 a.m. Eastern. Coming up, we get Michelle Weaver of Morgan Stanley joining us here in studio, Bloomberg's Jennifer Rhee and Jonathan Pingle of UBS, as we look ahead to that Fed decision, as we look ahead to boardroom drama with the media space very much front and focused, and as we look forward to the AI trade, as so many people discuss the bubble word and whether we've overused it heading into 2026. This is Bloomberg Surveillance.
Here is understanding. These digital assets have the ability to change the payment landscape of the world, and we need to be ready. We, the regulators, the world needs to be ready for a new wave of technology.
Stablecoins are almost entirely used in the mechanisms of trading in cryptocurrencies. What we saw is the opportunity for digital assets broadly, stablecoins in particular, to be used as a medium of exchange outside of the crypto world, what is today the fiat currency world. At some point, I think these digital asset wallets will be big enough and people will be comfortable enough using them. I think we'll have a flip from conventional payment mechanisms into stablecoin-based mechanisms.
Does that mean banks such as yourselves issuing stablecoin?
We could. We are issuing Hong Kong dollar stablecoins today. We're in a sandbox for tokenized bank deposits in Hong Kong. We're effectively issuing tokens related to trade finance in Singapore. So it's all on the table, but we're always going to tie it back to what our clients want and need, because if we don't get that one right, the rest doesn't matter.
The market capitalization of both type of instruments, crypto and digital assets, are both very low. Stablecoins today have $20 billion of flows a day. It's less than 1% of the flows of the payment system in the world. But because they have the ability to be very helpful in use cases, particularly in retail to begin with, but then potentially on the wholesale side, I think we will see a lot more of them.
It's the world's second largest economy with a growing influence in global affairs. Bloomberg The China Show brings you the unmatched expertise you need to keep track of breaking news, in-depth market analysis, and the most influential newsmakers in and around China.
We need to do more to engage the market more. We're risk on. I think we caught a little sweet spot.
Massive savings right now.
It's already a different game.
Bloomberg The China Show. Weekdays around the world, right here on Bloomberg. Context changes everything.
We have two crises, two essential crises, and for both it's now or never: democracy and climate, and they are absolutely interlinked. And we have to solve them together. We're losing the democratic infrastructure and norms to deal with the climate, and we're losing the climate stability that is essential for a democracy. We have to solve them together. We've never faced a threat like this to our democracy at a time when it's a perfect storm, at a time when we're being told by climate scientists, some of you may be in this room, that we have to cut our emissions, fossil fuel emissions, in half in 5 years now. You know, when I started to realize what was happening, it was 12 years, and we haven't done it.
Technology is embedded in every aspect of our lives.
And laying the foundation for the future.
From finance to defense, AI to entertainment.
And from the road to the stars. Bloomberg brings you the latest stories of the people and companies pushing the tech sector to new frontiers.
And the politics that shape global tech markets.
I'm Caroline Hyde in New York.
And I'm Ed Ludlow in San Francisco.
Watch Bloomberg Tech every weekday.
Only on Bloomberg Television.
Join me each week on Wall Street Week for stories of capitalism from business, markets, economics, tech, and climate. More than what you need to know, it's what you need to think about.
The direction of travel, things look great right now.
We're entering this phase of AI application.
AI is not a bubble. I think it's still a boom and a structural change, and that's why we are constructive for next year.
AI is certainly going to change the world. But who are going to be the winners in that?
You can look at either side of the coin on so much of the data that's out here, and you could either be bullish or bearish.
This is Bloomberg Surveillance with Jonathan Farrow, Lisa Abramowitz, and Anne-Marie Hordern.
Good morning. Welcome back to Bloomberg Surveillance, kicking off a Fed meeting with high expectations for rate cuts, with focus now turning to the state of the economy. Some jobs data on deck with jolts later this morning. Meanwhile, new details emerging in the boardroom battle between Netflix and Paramount as they wage war over the purchase of Warner Brothers Discovery, and a question about big tech as President Trump opens the door to high-tech chip sales to China, the national security concerns going from access to potentially losing out in the race.
And China has responded. Basically, according to the Financial Times, they're going to look piece by piece, deciding maybe which firms can get access to this chip. And does it even matter? Because China might shrug it off, even if they're allowed to buy these H200s, like they did with the H20. But I think the signal is clear. The Trump administration is putting trade and economic concerns over national security concerns, which in this sector is definitely a pivot.
And right now, people are looking to the artificial intelligence melt up that really drove 2025, potentially changing in 2026. We saw that in the Goldman Sachs survey. We saw that from Ed Yardeni coming out and saying that he does see a potential underweighting of big tech as warranted, as everyone is a tech company. And that really is what we heard from Sarah Hunt earlier this morning and the outperformance that we've seen of late in the Russell 2000.
And she's talking about how all these tech companies had a lot of capital and now they have a lot of assets and they have a lot to show for when it comes. In 2026, when everyone continuously says to us they want to see that broadening out in AI, not where the use cases are and which industries are actually adapting. And if they don't see the use cases and the adaptation of AI, then what is all this money for? Another key thing for 2026 is going to be the gap between the electricity need and energy needed for these data centers, and if this mismatch can that narrow.
And right now, people are looking at what the Federal Reserve's response is going to be to all of these dynamics. That meeting in Washington, D.C. kicking off. It will end tomorrow with a press conference with Jerome Powell. Meanwhile, in markets right now, really quiet, range-bound, ahead of that decision, ahead of a slew of deals that we talked about earlier with Warner Brothers being bid up by both Netflix and Paramount. Yields, watch this space. We saw a huge rise in 10-year yields over the past 2 weeks. Right now, near the highest levels going back to the end of September. Do we maintain that type of level after tomorrow's Fed meeting, given the fact that the market right now is still expecting at least 2 rate cuts next year? Coming up today, we have the jobs opening data, as well as, of course, the data tomorrow of the employment cost index ahead of that Fed meeting. Coming up this hour, Michelle Weaver of Morgan Stanley with stocks searching for gains, Jennifer Rhee of Bloomberg Intelligence on the possible antitrust concerns surrounding a deal for Warner Brothers, and Jonathan Pingle of UBS previewing the December FOMC meeting. We'll begin this hour with stocks flat ahead of the latest Fed decision. The team at Morgan Stanley expecting a cut tomorrow, followed by 2 more next year. Michelle Weaver of Morgan Stanley writing, this is a bullish setup for stocks that are looking ahead towards accelerating earnings revisions and Fed cuts based on lagging moderate labor market weakness. Michelle joins us now. Michelle, thank you so much for being with us.
Thank you.
It seems to all be predicated on the idea that 2 rate cuts comes with strong growth.
Yes.
What gives you confidence that we are going to get strong growth despite some of the weakening that we've seen in recent labor market metrics?
Yeah, so we think that we've seen in the alternative data more softness in the fall. So I think when we get the official numbers next week, we are going to see more softness, but that we're not going to get one of those non-linear, really concerning type rises in unemployment data. We think the setup is really constructive into next year for a broadening in earnings. If I think about the past couple of years, it's all been about the large cap stocks. It's all been about those who are exposed to the AI trade. We've seen a lot more weakness under the surface for the Russell 3000 over the past couple of years. Earnings growth has been flat to negative for most of those stocks. We finally saw that turnaround last quarter with those names growing 8%. So we are starting to see a more constructive setup for that broadening. And I think that combined with a Fed that is easing, but without a really concerning spike in unemployment is a great setup for stocks into next year.
Is it as simple as saying that some of these smaller companies are deploying some of these AI tools to be more efficient and preserve some of their margins, and that's the reason why you might see an outperformance?
I think AI is certainly part of that story. When we think about AI deployment, next year I think is really going to be the year of the AI adopter. It's taken companies, a couple of years to work with the technology, to set up the guardrails, to retrain their employees, to really get AI deployed. Our tech team has a great CIO survey. They think that by the end of this year, 60% of companies will have at least one AI product live in the field, and then that will rise to 80% by the end of next year. So we are finally starting to see this wave of adoption flow through the market.
Can you see that wave of adoption without layoffs?
I think you can. I think around the margin, you may see some companies do a little bit of layoffs, but it's largely going to be an incremental story. I think a lot of the messaging I've heard from CEOs on earnings calls is we're going to keep headcount flat, but we're going to be able to see more growth. We're going to be able to do more with the same number of employees thanks to AI.
Do you think that AI can also continue if the energy demand isn't quite there? So are able to meet that demand?
Yeah, it's absolutely a tricky setup around the power world. Our team has a great model where we take our semiconductor analyst chip sales forecasts, say what's the power needed for that and how much power are we going to need in the US. Through 2028, we're forecasting a 47 gigawatt shortfall in power just through the traditional grid interconnect power. For scale, that's around 10x the power consumed by New York City, so that's a huge shortfall. But there are a lot of innovative type of solutions that can apply to this. So
we're 10 New York cities short.
Yes.
Wow.
But through things like natural gas turbines, those are behind the meter. Those are apart from the grid interconnect process. And then Bitcoin site conversions, I think, are really interesting. So some of these companies have essentially realized that the power that they're sitting on is more valuable than some of the underlying business. We think there's around 20 gigawatts there, so there's a lot of power to be had there. And then nuclear is the last one that's a little bit more politically challenging, but we may see some nuclear for that problem.
Bitcoin conversion sites, are you saying that people who previously mined Bitcoin aren't necessarily seeing the gains there, and so they're transforming that into a fuel essentially for artificial intelligence? Is this the sort of not the death of the Bitcoin trade, but really the shifting in terms of where the enthusiasms go that has broader market implications?
Yeah, so I wouldn't say it's the death of the Bitcoin trade by any means, but there were some Bitcoin miners who'd amassed a ton of energy to be able to do Bitcoin mining. And they essentially saw, we're sitting on a gold rush here. We have so much power, these hyperscalers need power, they're willing to pay a huge premium for it, let's just sell off the power.
That's a fascinating trend. Meanwhile, we've been talking a lot about deals and how much deals have been taking place both in the AI and the tech space, but as well as the media space and beyond. I'm just wondering how that plays into some of your forecasts. Is that a positive thing? Or is that sort of a catalyst for winners and losers that really will differentiate the winners and losers within the investing space in 2026?
Yeah, it's a very, very positive thing for us. We think that you're going to continue to see pretty strong M&A and capital markets activity into next year. I think a lot of the hesitation we saw this year was really around the public policy front. What's going to happen on tariffs? What's going to happen on the regulatory front? How quickly are we going to see deregulation? Where's tax going? I think now that we're going into next year with a little bit more clarity on that policy picture, I think you're going to continue to see some of that corporate risk-taking, a little more aggressiveness on the M&A front.
At a certain point, is the year of the adopter rather than the year of the AI tech innovator, does that disadvantage the United States over the rest of the world? As we see JP Morgan come out this morning and say they see the emerging equity market outperforming the developed market one for yet another year after years of underperformance.
Yeah, so I think that we're going to continue to see that adoption really ramp up, and that broader diffusion is what's going to really help the U.S. market. It's been so concentrated, the return story on the enabler side, that as we see that adopter story broaden out, that will be more constructive. On the enabler side, though, we did have the announcement, so that company will see some gains there. So there's a little bit more gains to be had in the enabler side, but I do think it's overall a constructive setup.
When it comes to the real economy, is the consumer holding up?
It's been really tricky for the consumer. We held our consumer conference last week in New York, and we had over 100 companies in attendance. We got a pretty good read on the consumer from that. I think one key takeaway there was the K economy is still very much in place. We're really still seeing that bifurcation between higher income consumers and lower income consumers. I think you're going to start to see that continue into next year, but that's really what companies were talking about.
Is that what makes the Fed a little bit more complicated next year?
Yeah, I think there's some complication there. I also want to bring this back to the energy story that we were talking about earlier. Affordability concerns are huge, and there's been a lot of discussion around is this demand for AI power starting to weigh on the consumer? So just bringing those two conversations together. And we found that in certain regions, that activity has really pressured consumer electricity bills. In the Mid-Atlantic, those bills have risen by about 18%, where data center activity is really concentrated.
Michelle Weaver of Morgan Stanley, thank you so much for being with us,
Thank you.
and have a wonderful holiday season. To me, this really is the key question, right? We don't have a sense of the consumer and exactly which way it's going to break, and kind of the optimism and level of it really depends on whether you see that ongoing strength.
And there's optimism right now because we just had a stellar Black Friday and Cyber Monday. You add inflation, though, does it look as rosy? And then to Michelle's point, this is why you saw the results in Virginia and the results in New Jersey. These are candidates who ran on affordability and specifically talked about electricity prices going up.
President Trump in Pennsylvania today talking about just that. Right now, let's get you an update on stories elsewhere this morning. Here is your Bloomberg Brief with Yahira Anand. Yahira.
Hi, Lisa. We're seeing CVS shares rising 2.3% in the pre-market. The healthcare company raised its full-year profit forecast and said earnings would rise in 2026. It's a sign of hope as it navigates a turbulent retail environment, plus government scrutiny across the healthcare industry, from vaccines to insurance. Meanwhile, Apple's chip boss is denying reports that he's leaving the company. Johnny Stroji telling staff in a memo, quote, "I love my team and I love my job at Apple and I don't plan on leaving anytime soon." Apple is undergoing its biggest personnel shakeup in decades, with senior executives and key engineers leaving the company. And Google is working to create 2 different categories of AI-powered smart glasses to compete with existing products from Meta. The company collaborating with Samsung, Warby Parker, and Gentle Monster in the hopes of creating a more refined product than its previous model, Google Glass. That's your Bloomberg Brief. Lisa?
Thank you so much, Yahira. Up next, the morning calls, plus Jennifer Rhee of Bloomberg Intelligence on the possible antitrust concerns surrounding a deal for Warner Brothers. That's next. This is Bloomberg Surveillance.
At a time when policy in Washington is driving Wall Street, we draw a distinction between the rhetoric and the action, bringing you market-moving guests and original reporting. This is Bloomberg Surveillance.
Know how the market day started.
Find out how it finishes.
Public markets to private markets.
From the micro to the macro.
Covering retail, entertainment, the business of sports.
The supply chains, trade policy, how it all is impacting the U.S. equity market as we drive to the closing bell at 4 p.m.
A holistic approach to covering financial markets.
If it matters to your life, we're covering it. I'm Katie Greifeld.
And I'm Romaine Bostic, and this is The Close.
Live every weekday.
Only on Bloomberg. Context changes everything.
Why do the biggest names in business choose Bloomberg Television?
That's a great question.
It's a very good question.
Interesting question. Good question. Great question. I so appreciate that question. You certainly ask interesting questions.
Bloomberg Television. Top experts, great questions.
To me, AI is for real. You have to invest a lot of money to do what this proposes to do, whether it's the data centers, whether it's all the ancillary software and the design changes to be made. But the companies that are doing it are very well positioned in terms of their balance sheet. And when they borrow money, it's probably because they rather keep the cash on the balance sheet and just use other people's money.
And perhaps because that money isn't too expensive. That was John Stoltzfus of Oppenheimer ahead of that Fed meeting that begins today, ends tomorrow with a press conference with Jerome Powell as he indicates what he sees in the year ahead. Good morning. We're seeing right now in markets a pretty quiet tone ahead of that meeting, really fluctuating between gains and losses throughout all of the big indices. We had seen Russell 2000 outperformance. Now we're about unchanged. In the bond space, it gets a little more interesting based on some of the moves that we've seen, particularly on the long end of the yield curve. 10-year yields now fluctuating between gains and losses in terms of yields, and we are seeing just inflecting a touch bit higher after a sell-off, leaving those near the highest levels going back to September. A number of investor meetings over the past couple of hours, including Wells Fargo. Wells Fargo CEO Charlie Scharf is speaking, and he's talking about the consumer, how he is seeing a strong level of consumer spending. Listen to this, wages outpacing inflation for the customer base of Wells Fargo. Not exactly screaming this distress that so many people are talking about.
No, it sounds rosy, it sounds optimistic. Even holiday spending, they're saying it's a touch higher year over year in the first weeks. This points to, especially what you said about wages outpacing inflation, that points to a better 2026 than right now a lot of people are talking about, especially this administration. The president's going to be in Pennsylvania today because affordability has been top of concern in polls and also in a lot of the rhetoric when you hear from retailers.
Yeah, and a key question for a lot of investors heading into 2026, do you believe in the reacceleration of the U.S. consumer? Time now for the morning calls. First up, TD Cowen raising its price target on Walmart to $136, expecting profit growth to outpace sales growth. Those shares up about 0.5%. Next up, Citi lowering its target on Nike to $70 ahead of next week's earnings, highlighting ongoing challenges in China. And finally, Goldman Sachs upgrading Viking to buy, setting a strong balance sheet and large cash reserve. Those shares up 1.8%. If you're wondering, where is Jonathan Farrow? Yes, he is with Little Pharaoh, but he's also on a Viking cruise, cruising around the world.
I highly doubt
Can
that.
you imagine that? You know, teaching him about the world, out there. Yeah, maybe next year. Turning to media, and not that. The bidding battle for Warner Brothers is setting up an antitrust test for the Trump administration. Republican Senator Mike Lee, chair of the Senate Judiciary Subcommittee on Antitrust, Competition Policy, and Consumer Rights, writing, "Buckle up for an intense antitrust hearing in the Senate." Jennifer Rhee of Bloomberg, much for being with us. So let's just start with what we understand about the regulatory backdrop of the Trump administration, given that a lot of people are talking about deregulation, a more favorable outlook on tie-ups and on business. Do you get that sense on the sign-off so far on deals that have happened?
I mean, absolutely. It's a really big difference from the Biden administration. And, you know, the interesting thing is that they kind of threw me for a loop, the new officials that were appointed by President Trump to oversee antitrust, because in the beginning, they were talking really tough. Hey, we have a lot more in common with the Biden administration than you would think, and we're going to be tough on mergers. We want to protect the American consumer. But so far, what we're seeing is they're just pushing them all through, sometimes with remedies, but for the most part, they're just not challenging these deals. And as you mentioned, when you first started to ask me that question, there's a lot more influence, I think, from the administration with respect to antitrust decisions, particularly when it comes to M&A, than there has been in the past.
I mean, the president said himself he'll be somewhat involved.
He did.
So when it comes to antitrust, can you walk us through who has a better case in front of the DOJ, Netflix or Paramount?
So my view is that Paramount has a better case. And it's kind of odd because actually when you think about it, Paramount has more horizontal overlaps with Warner Brothers than does Netflix. But at the end of the day, they're minimal. They're lower than the overlaps that Netflix has. So for instance, Paramount Plus in streaming is a lot smaller than Netflix. So when you put it together with HBO Max, those market shares are lower. The numbers, the concentration numbers the Department of Justice will look at to understand whether this could be anti-competitive are far lower. And then there's a box office overlap, but that overlap is also fairly small as well, even though there's been consolidation in that sector.
Do you think it matters to the DOJ about where the money is coming from? We're talking about 3 sovereign wealth funds in the Middle East, as well as the President of the United States' son-in-law's private equity firm.
It shouldn't matter. And it probably won't matter. Now, if there's a lot of non-U.S. money coming in, the Committee on Foreign Investment in the U.S. might take a look at the deal because they look at foreign investment in U.S. assets. But what I understand here is there would be no management control, there would be no voting shares, there would be no board seat, and so it's very likely that that's not really going to be a problem. Now, the Department of Justice shouldn't consider Jared Kushner, the money coming from Jared Kushner's equity fund, because they really should be just evaluating this based on the antitrust laws, and that is it. But it obviously could influence how President Trump sees it, and then that could result in pressure being put by the administration on the Department of Justice for a certain outcome.
You know, you could argue that actually Netflix has a better case when it comes to the antitrust battle because of the tie-up of the news organizations in particular, especially given some of the controversy of late with the administration hoping for a change in direction in different places. I mean, how does that factor in? The fact that Paramount would be bidding for CNN and for CBS, bringing them together potentially, whereas the Netflix deal would really separate the two.
Right. You bring up a great point that I actually should have mentioned before when I was talking about the overlaps. Not only do I think that overlap in news could be problematic, I think an overlap in a giant package of cable networks that the company would have could be problematic. But that kind of issue is really easily fixed. That's through divestiture. So in a normal situation, what I would expect here is the Department of Justice would probably ask Paramount, if it's the buyer, to divest CNN. But on the other hand, the administration might be more interested in CNN staying in the hands of Paramount, right? Because it's the Ellison's family, and the Ellisons are aligned with them. So in this situation, maybe that wouldn't happen, but I could see them asking the company to divest some of the cable networks, because when they have that big a bundle, it gives them a lot of leverage over distributors.
I wonder, if you take a step back, how difficult it is to really understand what a monopoly is at a time when industries are so profoundly changing. The idea that Netflix could argue that their big competitor is YouTube, not necessarily one of the other streaming networks, one of the Paramounts or the like. So how do you sort of think about what the competitive landscape is at a time where our attention is being split into different places?
That is actually a really, really good question, because that's what it's going to be all about. And that's actually what most merger arguments are all about. How do you define the market? How do you put your arms around or put your circle around the sphere of competition? Who's in and who isn't? Because that's what dictates market share, and that's what dictates market concentration. Netflix will absolutely argue that the market is broader, that it should include any kind of video, anything that's taking the attention of eyeballs where somebody's watching video, whether it be YouTube or TikTok or just standard old-fashioned television, right? But the way the Department of Justice looks at this, and they actually use really complicated econometric modeling to try to figure this out. They have economists on staff, and they look at it from a consumer substitutability perspective, right? They ask if a person subscribes to a service or product, they don't like the price, they don't like the quality, and they want to switch, what will they switch to? And anything that they might switch to gets included in that market. And when the consumer doesn't switch, and again, this is done through economic modeling, that defines your market. And I think there probably is a pretty good argument that at least for some class of consumers, they wouldn't view something like YouTube as a substitute for streaming video on demand.
Jennifer, what's the timeline? When do you think the DOJ would wrap this up? Once Warner Brothers chooses their partner?
Yeah, once we have a deal, once that deal's filed, I think you're looking at a year or more. These things take a long time. They do an investigation. They issue a big subpoena called a second request for information, asking for data and documents. Companies have to turn those over, which takes a long time. The Department of Justice has to digest it, and then they go in with the economists, and they make arguments in defense of their deal, and it really does tend to take about a year, sometimes up to 18 months.
Jennifer Rhee, wonderful to get your thoughts.
Thank
you so much for being with us. That's Bloomberg's Jennifer Rhee on the latest in the antitrust issues surrounding this case. Meanwhile, we are getting some weekly ADP employment data that does inflect the positive. Michael McKee of Bloomberg joining us now for more. Mike, what do we see?
Well, we see that ADP in the 4 weeks leading up to November 22nd, that the economy added, according to ADP, an average of 4,750 jobs, which is an improvement over the 13,000 or so that were lost the average week before. But the problem is we don't exactly know how to use this. The Fed's been using this data for quite some time, which helps them, in the absence of the non-farm payrolls numbers, at least get a sense of where the economy is. But when you have wide swings like we've seen in the last couple of weeks in terms of these 4-week averages, it's hard to know exactly where that leaves you for the end of the month. And we're going to have to wait until next week, unfortunately, a week from today, before we get the next payroll numbers from November, and we won't even get all of the October numbers. So make of it what you will. It's a little bit better news, but it doesn't necessarily tell us what we saw in the month of November.
Michael McKee, thank you so much. This would be the first positive read from this new ADP report after 4 straight weeks of negative reads. We also are seeing something about the small business front. This is something that ADP points out, saying that in general, smallest business establishments lost 120,000 jobs in November, while medium and large firms added 90,000 jobs, sort of speaking to that K-shaped market within corporate America.
At least, though, to Mike's point, this is direction of travel better based on what we had previously heard from ADP. So they are adding more jobs on this weekly basis. Does it move the needle for the Fed? I don't think so. The Fed is still somewhat in a fog. And as Mike says, we're really not going to get a little bit more of a clearer picture until next week.
Which is the reason why people are looking for potentially getting some information that is delayed from non-farm payrolls. Coming up, we'll talk about that and what the Fed will do with that with Jonathan Pingle of UBS with that December FOMC meeting kicking off today. Plus, Danny Berger with your morning movers. Another check on Paramount as the company goes all in on Warner Brothers. Those shares up 0.2% in markets more broadly. A real question of long-term bond yields and how much they've climbed over the past couple of of sessions. Do they continue that ascent as the global bond sell-off takes hold right now in markets fluctuating between gains and losses as people ratchet back some of their expectations for next year's Fed rate cuts? From New York, this is Bloomberg Surveillance.
It's the countdown to the market open as we bring you the first trades across Europe.
We'll debate the most important stories and what will drive the big investment decisions throughout the morning. I'm Guy Johnson.
I'm Kriti Gupta.
And I'm Anna Edwards. Join us every weekday morning for the opening trade, live at 7 a.m. here in London.
Only on Bloomberg. Context changes everything.
Astonishing day for US technology.
It's shaping the region's technology ecosystem.
Asia's biggest tech news and innovation.
Get your fixed income fix. Watch Bloomberg Real Yield around the world right here on Bloomberg. Context changes everything.
I'm David Weston. Join me each week on Wall Street Week for stories of capitalism from business, markets, economics, tech, and climate. We go on the road for a look at what lies behind the headlines of today and what will likely be the headlines tomorrow.
We need more transparency.
Oil and gas is still important.
They said every citizen should be investing in the market.
Accelerate progress in all fields of science.
Watch Wall Street Week right here on Bloomberg. More than what you need to know, it's what you need to think about.
Right now, you've got stocks fluctuating between gains and losses. The futures a little changed across the board. There had been the outperformance in the Russell 2000. Do we continue that heading into the Fed meeting? 2s, 10s, and 30s. So much depends on that long-term bond yield after the sell-off that we have seen. A question around the global influence versus the domestic one on the front end of the yield curve. You have seen a bit more of a skepticism in terms of how much the Fed can cut rates. 95% chance that they are going to cut in tomorrow's announcement. At the same time, next year, ratcheting back those expectations, a little bit of a bid coming in to the long end. 1 hour away from the cash open. Here are your morning movers with Danny Berger. Danny.
Hey, Lisa, it's the drama between Paramount, Skydance, Warner Brothers, and Netflix. You're looking at Paramount, Skydance. Those shares are up about 0.5%. They were up more than 1% in the pre-market trade just moments ago, but it does seem like the odds keep shifting around who will be buying Warner Brothers Discovery. The latest on Polymarket has them in the lead with this new bid, and we've learned about the backing. A lot of Middle Eastern sovereign wealth funds, Jared Kushner's Affinity, and the Ellison family. Meanwhile, some reconstitution for the S&P 500. We've learned that Ares is going to be added to it. It gets a lot of passive flow when companies get added to the S&P 500, so those shares up 7.7%. Kellanova, that will be kicked out. Finally, ending things with Home Depot. Around 6 a.m., we got an update from Home Depot on their investor day, saying that they expect for next year comparable same-store sales to be between 0 to 2%. That does not suggest that a recovery is on the way, and with that tepid forecast, shares are dropping by 2.6%, Lisa.
Thank you so much, Danny. Of course, they did give a rosier scenario, but said they haven't seen that rebound in the housing market just yet. Meanwhile, the FOMC's two-day meeting kicking off today. President Donald Trump issuing a test for the next Fed chair.
You're going to pick a new Fed chair soon. Is it a litmus test that the new chair lower interest rates immediately?
Yes. Well, this guy too should too, but I think he's a combination of not a smart person and doesn't like Trump.
Michael McKee, Bloomberg economics and policy correspondent, joins us now for more. And Mike, we are going to be talking about ad nauseum the race to be the next Fed chair. A question, though, about how much clout Jerome Powell still has in his meeting at the end of this year tomorrow.
Well, I think Powell still has enormous respect from members of the Open Market Committee, and even if we get dissents, it's not going to reflect necessarily on him, but it will reflect on the circumstances. The issue with the president's comment today is he's setting his Fed chair nominee up for sort of a walk-in-the-door failure, because the markets are going to look at the guy and say, at this point, we don't trust you because you're there to do something the president wants rather than what the economy tells you to do. That's been something that Kevin Hassett, who is the betting favorite, has tried to talk down, and here's the president seeming to undercut him a little bit.
Yeah, which is the reason why it's notable that yesterday when Kevin Hassett was speaking, he actually really diminished the idea of giving some sort of 6-month plan of how much he planned to cut in the first half of 2026 should he become Fed chair. There is a feeling that whoever becomes the head of the U.S. Central Bank has to build credibility in markets and on the Federal Reserve Committee.
Absolutely, and that's going to be a real test for anyone that President Trump nominates, because he's been so firm in criticizing the Fed and criticizing Jay Powell. We don't know whether Powell is going to stay on the Fed or not as a governor if he's not chair anymore. It's a bit of leverage that he has over the president. He has suggested to people that he might stay if he doesn't think the new Fed chair has credibility or could do damage to the Fed. So that's going to be a political question to watch going forward, along with the whole question of whether or not the president's going to be able to fire Lisa Cook, a decision that would probably come after Powell is gone. But if the president was able to do that and Powell decided to leave, then Donald Trump would have a lot of space to fill spots on the Federal Reserve Board.
Michael McKee, thank you so much, and we look forward to catching up with you throughout the day and tomorrow, certainly, as that Fed meeting concludes. We are hearing from Kevin Hassett yesterday. He did say that the Fed chair's job is to watch the data, to adjust and to explain what they're doing and why. He also went on to say that to say, I'm going to do this over the next 6 months would be irresponsible, even though people have talked about a 6-month plan for any Trump appointee.
If he is the front runner and he knows he's going to get the nod, he's setting himself up to gain more of that credibility, as you said, with his committee members. I'm not coming in here wanting to cut interest rates every single meeting. We have to look at the data, how the economy is digesting all of this, and then make decisions that make sense for both sides of their mandate.
Well, let's stick with the Fed's head of tomorrow's rate decision. Jonathan Pinkel of UBS writing, we expect a large majority of FOMC members to support a 25 basis point rate cut. Expect few changes to the dot plot and no change to median assumption of appropriate policy. Jonathan joins us now. Good morning, Jonathan. Thanks for being here.
Thanks for having me.
So let's just start with a question of what you expect to learn tomorrow if you don't think we're going to get any adjustments.
Well, I think we are going to get a certain amount of communications out of Chair Powell, assessment of the risks, how he's viewing the outlook, what kind of bar he might have in mind for future cuts. The market's been pretty, pretty anchored to sort of having the year-end target range kind of around 3% at the end of next year. I think a lot of that is the discussion you were just having on the next Fed chair. But I think for the remainder of Chair Powell's tenure, he still is balancing these mixed signals. I mean, you just heard the Home Depot news. He's got kind of weak residential, weak non-residential, kind of weak, soggy labor market. How does he balance that against the inflation? I think those are going to be important questions to assess as we go through the press conference tomorrow.
How different is it that we might see 4 dissents for the first time going back 30 years on the FOMC committee?
Well, it's not that unusual historically. I mean, if you look back and you think about sort of the Greenspan era, where Chairman Greenspan really, with a lot of manipulative skill, I would add, having watched him, really controlled the committee. And then you had, sort of the GFC, the Bernanke era, where Ben was just the extraordinarily correct scholarly choice for the moment. And then you had, the pandemic and the inflation. So it was sort of an era where, there were sort of a lot of all hands on deck moments. So I'm not surprised we haven't seen a lot of dissents lately. But if you look historically, dissents are really the norm. It's unanimity is kind of the exception. I also think Chair Powell's, I'd bet he gets fewer than 4 dissents. And I mean, and you were talking about the clout earlier. What kind of clout does he have at this point? I think it's more earned respect. I mean, he's the one who's been pounding the pavement up on Capitol Hill. He's the one who is being, tweeted about. He's too late. Do you know what I mean? Like, I think he's really done a lot to incorporate the views of his committee. I think at the end of his tenure, he's just kind of earned some deference at this point.
As an institution, though, actually, don't dissents show the credibility that this is a deliberative body and it's not, we're just going to all line up where the chair is, at least for the future, if you are concerned about potentially someone that is very close to the President of the United States?
Sure. I mean, dissents are super healthy, but you also don't even need the dissents, right? I mean, we can hear Beth Hammack, even though she's not a voter, she's not going to dissent, but she disagrees with this policy. So you certainly do have that kind of open debate, and that's something that's certainly I think going to play out and remain a feature for the next FOMC as well next year.
So when you look into next year and the next FOMC, how many cuts do you have baked in for next year, and does it matter who the Fed chair is?
I have 2.
For the cuts.
And yes, it does. Yes, it does, I think, matter who the Fed chair is. I mean, we're all talking about Kevin Hassett. I mean, I've known Kevin for a long time. And Kevin actually has, in terms of his ability to build credibility, he's got, I think, kind of 3 key features that would make him sort of an effective Fed chair. One is his academic publication record's pretty impressive. If you think about the peer-reviewed journals he's published in, he has incredibly well-cited papers. Second, he was on the board staff and is an incredibly astute data expert of himself with knowledge of a lot of that staff and how they use the data. And third, he's really, Kevin's nice. I mean, he's really collegial, right? I mean, I think that will go over well in terms of trying to work with his colleagues. But I also think that combination is going to help him win debates at the table.
So we talk often about Fed policy as being rate cuts. But when we talk to equity strategists for 2026, they talk about the use of the balance sheet. They talk about quantitative easing in another name. And we hear that from Morgan Stanley. We hear that from Bank of America. We hear that from BlackRock, the sort of monetization of the debt that already is transpiring with respect to a focus on T-bills and the potential purchases disproportionately on the balance sheet. How much are you looking for that type of activity in the background, regardless of potentially a tempered view of how many rate cuts this Fed can make?
Yeah, I know. I'm expecting them to start outright expanding their securities holdings in January. And a lot of that is, though, I think, if you look at the level of reserve balances and what's happening in repo, it does look like it's starting to get a little tight. So I do think that they are going to have what they would call a reserve management purchase program. Regular purchases of T-bills, I think they probably start around $40 billion a month, but I think that's probably going to have to get up to 60 by the end of the year. Really just because they've got other liabilities that are rising over time. You clearly seem to be sort of in this ample reserve regime where you're putting upward pressure on the effective funds rate. I mean, the spread to IORBs narrowed steadily over the last month and a half. So I do think they're at a point they need to actually start adding liquidity instead of draining.
Which is what a lot of people are mentioning, and they say that the sell-off that we saw in big tech was largely driven by the withdrawal of Fed liquidity reaching that tipping point of reserves. I'm just wondering how much is this a technical issue in the markets, and how much is this outright asset buying and monetization of the debt?
So there is an element of monetization of the debt. I'm skeptical at how much that's driving high-frequency equity market moves. I mean, it is the case that if you got more volatility in repo markets and higher repo rates, you're going to have higher costs for funding leveraged positions in equity markets. But, I think what's happening in the background of the Fed balance sheet is they've kind of gone too far. They need to reverse it. But I don't really think this is going to be some sort of flood of additional liquidity. I think they are going to try to temper how much they are actually adding. And I think the risk is they probably err on adding too little.
Okay, so if that's the case, I guess, how do you game out the idea that we might see Fed rate cuts in addition to fiscal stimulus, in addition to a reaccelerating U.S. consumer at a time where inflation has still been relatively sticky? Do you see this as creating a problem for the 10-year and a Federal Reserve that might be motivated to try to cap some of those yields?
I don't think it's going to be that much of a problem for the 10-year, mainly just because we are getting some good news on the forward inflation indicators, right? I mean, if we look at the composition of inflation right now, we're seeing sort of core goods, ex-used cars sort of turn up. You can see the tariffs slowly passing through. But the forward indicators that we're getting on things like the slowing in rents have actually really gone the Fed's way. We've got among the higher estimates of inflation on the street. But by the second half of next year, we're still back to 2.5% or below on annualized run rate. So, the Fed's sort of got some tailwinds here on inflation. The Fed credibility, we'll see how much they try to push rates lower, but I do think that you'll start to hear a much more credible case about the supply side, and in a way that I think it'll alleviate at least some investors' concerns over whether this is really going to be sort of a FOMC that runs amok.
So you don't agree with the hawks about the concerns about inflation, but how do you view the labor market next year?
Well, I'm sympathetic to the hawks argument. I mean, they haven't hit their target in 5 years, right? It's going to be going on 6. Right? Yeah. At some point, it's going to look bad if inflation does stay sticky. But I do think they face a problem with the labor market. I mean, you've had residential investment contracting, structures investment, government spending and investment, even without the shutdown, has been unusually weak for the U.S. And consumer spending's been mixed, right? I mean, upper income's doing well, but we're seeing other parts that aren't. So the labor market is weak for a reason, and if the labor market turns into more obvious contraction, you really could have households pull back in earnest. So, thinking about sort of Chair Powell's risk management framework, the potential cost to the economy of, an unemployment rate that doesn't stop going up, I can see why he wanted to kind of address, there wasn't a whole lot of reason to slow the labor market when it's already weakening too much. And there's not a lot the funds rate's going to do to stop the cost push inflation of tariffs. So I do think his calculus makes a little bit of sense.
Jonathan Bingle, wonderful to see you. Wonderful to have you in studio, and hopefully we'll see you soon. Jonathan Bingle of UBS joining us here. Right now, let's get you an update on stories elsewhere. Here is your Bloomberg Brief, Yahira Anand. Yahira.
Hi, Lisa. Paramount Skydance launching a hostile takeover bid for Warner Brothers. The move coming just days after the company agreed to a deal with Netflix. The offer stands at $30 a share in cash, compared with Netflix's cash and stock bid of just under $28 per share. President Donald Trump, whose son-in-law Jared Kushner is participating in the Paramount bid, is downplaying his involvement, saying he's not close to Paramount nor Netflix. Meanwhile, President Trump granted NVIDIA permission to ship its H200 AI chip to China in exchange for a 25% cut of the sales. The move means the world's most valuable company could regain billions of dollars in lost business. The president says that the sales would only go to, quote, approved customers, and that chip makers such as Intel and AMD would also be eligible. And PepsiCo announcing a series of operational changes backed by activist investor Elliott Management. The moves include cutting nearly 20% of its U.S. product lineup, investing in more affordable products, and planning layoffs in North America. Elliott says the plan will drive greater revenue and profit growth. That's your Bloomberg Brief. Lisa.
Thank you so much, Yahaira. Up next, setting you up for the day ahead. Plus, Bloomberg's Ed Ludlow as the White House reverses its stance on selling NVIDIA chips to China. You see NVIDIA shares and AMD shares rising in response. This is Bloomberg Surveillance.
The key issue right now for us in the diamond space is the declared divestment of Anglo from GBS. And as you know, Anglo holds 85% stake in GBS. Botswana, the government of the Republic of Botswana holds 15. We are resolute now, and we've communicated a firm intention to increase our stake in GBS to a controlling stake. We have lined up a number of potential collaborators with us, if I may put it that way. We have targeted funders, we have parties, we have the Oman Sovereign Wealth Fund, we have others who are willing and ready.
Tune in to Bloomberg Business Week Daily.
We got to talk crypto.
From the magazine that helps global leaders stay ahead.
What's the conversation around your company?
Bringing you insight on the people, companies, and trends shaping today's complex economy.
Planning very big things.
A new level of premium.
Plus global business, finance, and tech news as it happens.
The floodgates of innovation are going to open up.
You can't fake passion. You either are or you aren't.
Bloomberg Business Week Daily, only on Bloomberg. From the world of politics to the world of business, Joe Matthew and Kaylee Lines deliver news, insight, and analysis live 2 times a day, every trading day. Balance of Power at 1 and 5 Eastern, only on Bloomberg.
Bringing you up to the minute geopolitical news whenever and wherever it happens. I'm Lizzie Burden outside Windsor Castle, England, and this is Bloomberg.
There's been so much back and forth on this, and my recollection is that the H200 chip was one that was actually developed specifically to be exported as opposed to some of the other chips. I think that there is an argument to be made on both sides, one for security and one also for you want the paradigm to be the technology that we are exporting as opposed to letting people develop technology.
That was Sarah Hunt of Alpine Saxon Woods on NVIDIA exporting H200 chips to China after President Trump reversed his stance on it. You did see NVIDIA shares and AMD shares rising in pre-market trading as a result of that. Intel also potentially included, although not necessarily participating as much based on just what their export models could be. S&P futures fading throughout the morning, had been up almost 0.1%, now lower by less than 10 basis points, so not a significant decline. Nonetheless, really a focus on what we get from JOLTS job openings later this morning and what that means for the Federal Reserve. 10-year yields a little bit lower by about 2 basis points after that ADP data came out, 4.1468%. Meanwhile, what we are focused on right now, counting down to the opening bell, your trading diary for the week ahead, those 10 a.m. Eastern October JOLTS data. Tomorrow at 2 p.m. Eastern, we get the FOMC rate decision, followed by Fed Chair Jay Powell's press conference, employment cost index before that, plus earnings from Oracle after the closing bell. Thursday, another round of jobless claims, as well as earnings from Broadcom, as well as Costco, a real question about how they're lining up with the tariffs. Friday, we finished the week hearing from Fed Presidents Anna Paulson, Beth Hammack, and Austin Goolsbee. Turning back to one of our top stories, President Trump allowing NVIDIA to sell its H200 chips to China. Bloomberg's Ed Ludlow joins us from San Francisco with more. Ed, how much of a reversal is this in Silicon Valley, given the fact that it seems like there is a shift in the approach to national security?
As a point of export control policy, a big shift. And, you know, I think even Bloomberg Economics published a note on it, which I enjoyed reading because the H200 is a piece of technology at the center of export control policy. The soundbite that you played from your last guest is interesting. What is the H200? It is many times more powerful than the H20, which was specifically designed as a deprecated chip for the Chinese market, right? And this is a debate the three of us have discussed this week and many weeks prior, that the position of NVIDIA and Jensen Huang has been, it won't work to export a deprecated chip to China. They won't accept it. The H200 is a cutting-edge chip. It is one generation removed from Blackwell that's available to technology companies in America, but it's highly performant. And so it does mark this shift in the spectrum of China hawkishness. We've gone from a position where loads of people in the president's orbit are okay with exporting a deprecated chip to now being okay with exporting a more powerful chip. But of course, across the political divide, there are many national security concerns, and the ball's now in China's court because we don't really know if China even wants it.
Right, that's a big question. Does China even want it? The Financial Times has some reporting that potentially they're going to have a review process and some firms may get access to it if they can show the reasons why they need this instead of using a Chinese company's chip. But Ed, if NVIDIA is able to sell a lot of these H200s into China, or China really opens up the door, what kind of money are we talking about for the bottom line?
Yeah, look at the trading of NVIDIA shares in the immediate aftermath of the president's Truth Social post through to this morning, and momentum was lost very quickly. The baseline assumption for NVIDIA right now is zero revenue from China within this fiscal year and in next fiscal year. But of course, when this news hit, the analysts quickly remodeled to work out how much revenue is possible in China. Jensen Huang has said that this is a $50 billion market opportunity. But the issue is the degree to which they can work with China on that. You know, you're right, the reporting is using domestic chips that are massively supply constrained before using the H200. So again, NVIDIA's baseline assumption is zero revenue from China, although they'd love it. And now the analysts between them have a very wide range of estimates of what's realistic in the fiscal 27 year.
All this is in exchange for a 25% tariff. But Ed, I remember in the summer, there was that 15% that was supposed to go to the U.S. government. Has the U.S. government seen a dime of that?
No, and it's interesting. You will remember in August, I spoke to NVIDIA's CFO, Colette Kress, who is a classic CFO, a very experienced CFO, and she made the point that they are an American public company. They are bound by SEC regulations and by the Sarbanes-Oxley Act, and there is nothing codified or in existence in the legislature that provides for a mechanism where a company can issue a surcharge to the United States government, in this case of 25%. So my basic working understanding is that, of course, this is a discussion that's taken place between the president and Jensen Huang, but we need to see some specifics from the relevant regulatory agencies and government bodies on how it would work in practice. There are going to be loads of compliance and finance teams watching surveillance right now going, oh, I was thinking that as well, I think, because that's the basics of how a public company works in this country.
Ed Ludlow, thank you so much, as always, for the insights in this developing story, with a real focus on big tech and how much it can continue to drive the economy. Right now, our focus is very much going to shift to what we get from JOLTS job openings data. We did get this ADP report report earlier this morning. As Mike was saying, hard to know what to do. It's a new series of data. Nonetheless, this really stands out to me, the focus on small businesses, with ADP and coming out and saying that last week's ADP National Employment Report showed that small business establishments lost 120,000 jobs in November, and medium and large firms added 90,000. This is a tale of two corporate sizes, and this is what we hear across the board.
Well, this is what Neela, who is at ADP and our Bloomberg contributor, said to us last week. She was concerned about what is going on in the small business space, not these big executives. And Gene Soroka, who's running the Port of LA, was talking about how it's these big retailers that are able to mitigate all the supply chain disruptions, all the concerns around tariffs. It's the small businesses. Those are the ones that are having a lot of issues when it comes to margins, and potentially that's why they're laying people off.
And that's the reason why the Fed is having a hard time getting their hands around this, because on one hand, you are seeing big companies do just fine. You aren't necessarily seeing the price increases, but you are seeing job losses in some key areas. We do get that Fed meeting kicking off today, finishing tomorrow with the press conference, widely expected to be a 25 basis point rate cut at tomorrow's meeting. The look ahead could be really interesting. Kevin Hassett in the front seat in terms of who's going to be the next Fed chair. In his interview yesterday, really talking about how he isn't going to give some sort of sense of how many rate cuts he's going to give. He really is going to be data dependent.
Right, but that's the one question the President of the United States is going to ask. And we know this because this is what happened in his first term. Are you going to cut interest rates? That's all he wants to know. Kevin Hassett might be able to say, I'm going to cut them at the next meeting. At least that's where my vote would be. But I can't tell you where I'm going 6, 12 months' time. He's clearly trying to build credibility for potentially his future colleagues.
Right now, we're looking at markets that are trying to discover some sort of Santa rally. Coming up tomorrow, Julian Emmanuel of Evercore ISI, Erica Najarian of UBS, Chris Harvey of CIBC, and Chevron CEO Mike Wirth with huge demands on the energy sector. This was Bloomberg Surveillance. Good morning.
Morning, this is Bloomberg Daybreak Europe. I'm Tom McKenzie in London. These are the stories that set your agenda.
Taking you from the U.S. market's close to the overnight session in Asia, we'll walk you through what you need to know to kickstart Europe's trading day. Live from our European headquarters, we bring you the day's top market-moving stories, unmatched expert analysis, and on-the-ground reporting from across the continent. Tune in to Daybreak Europe, only on Bloomberg Television. Context changes everything.
We are in such an incredibly exciting moment with AI. It is really the most profound technology of our lifetimes, and I think it has the potential to help us rethink literally everything. The potential for economic impact, societal benefit is honestly boundless. When we think about the economic impact for Europe in particular, it's around a 1.2 trillion euro estimate of the productivity growth that can be unlocked. This platform shift that we are living through, I think, is going to create untold amounts of value for the world, but also for the businesses and for economies, which is why I'm incredibly optimistic in this moment for Europe, but also for the whole world.
How do you think about job losses or safety for some of the AI tools?
You know, I hear the anxiety and I understand the anxiety about jobs. I think that we are certainly going to live through a massive transition about how people learn to work alongside these tools. I mean, the reality is I do think there'll be some number of jobs that are displaced. I think it is a smaller number maybe than some anticipate. We estimate it's around 7%. And I think what's important is that we have programs that help those 7% transition into new fields of work. I think what is more likely is that most of us are going to learn to work alongside these tools. So we estimate about 2/3 of us. If you think about the tasks you do in your daily life, when you look at every industry, there are administrative tasks that are happening everywhere, and that's what AI is most helpful in improving.
I'm Alex Rodriguez.
And I'm Jason Kelly.
And we're back with another season of The Deal.
With athletes and entrepreneurs who are changing the game on and off the field. Jerry Jones.
Some good-looking trophies.
1 and 1 is 3 in sports, not 2. And it's because that 3 is imagination. That 3 is putting yourself in a way, having yourself hit the home run.
Erica Ayers-Badon.
I'm a high-energy board member. I'm very passionate. I have a lot of opinions.
Robin Arzón.
I want to light fires in people's lives, and that is still one of my core mandates for all of my businesses.
Justin Tuck.
I tell all of my friends that play in leagues now, make these relationships now while you're hot. Don't wait till you're like your 12th year in and you're just hanging on.
Stay tuned. You won't want to miss it.
bringing you up-to-the-minute geoeconomic news whenever and wherever it happens. I'm Vonnie Quinn in Sao Paulo, Brazil, and this is Bloomberg.
Welcome to Tuesday. Wonderful. I was thinking we could have a rebound today, but it doesn't look like it, judging by futures. 30 minutes until the start of the cash trade. I'm Matt Miller.
I think you were trying for like a turnaround Tuesday thing. We're not there.
Yes, I was.
I'm Danny Berger. Bloomberg Open Interest starts right now.
Coming up, what could be really just a minor win for NVIDIA. The company gets permission from President Trump to sell some of its chips in China, but China doesn't want them.
Meanwhile, there's Apple. It's become this anti-AI stock. A lack of AI spending for the company turns into a feature, not a bug.
And a new twist in the Warner Brothers drama, Paramount launches a hostile takeover bid backed by banks, billionaires, and Saudi Arabia.
Yeah, I was going to say Middle Eastern sovereign wealth funds that are doubling the amount that the Ellison family is putting in. One of the stocks that I'm watching, you mentioned it, it's NVIDIA. And Matt, you probably put it well. We're going to talk to Caroline Hyde about this in a moment. It's a win, but how big of a win if China is pushing back on H200s being able to be sold into the country?
Again.
So NVIDIA is only up 0.5%. It was up higher. It was a 25% revenue that the Trump administration was insisting on taking via tariffs. But this maybe would give NVIDIA a new revenue stream, but I mean, probably not if
China has now warned on at least 3 occasions in the last year it does not want domestic companies buying these chips.
Correct.
All right, Home Depot issued a cautious preliminary guidance for next year, expecting comparable sales growth of only 2%. The housing outlook really weighing on earnings. Toll also didn't help yesterday when the luxury home builder gave a disappointing outlook.
Yeah, we're going to get into all those stories, Matt. Let's start with NVIDIA. And for that, as I mentioned, we're joined by Bloomberg Tech co-host Caroline Hyde. Caroline, is Matt's caution warranted, the fact that maybe this isn't as big of a win for NVIDIA as it seems on the surface?
I mean, he himself, Jensen Huang, has said at the moment there is 0% revenue coming from China, and as it seems, he cannot get them to purchase his chips, even if he's allowed to do so. There are so many ifs around this, because remember, when the H20s got sign-off, alongside some AMD chips as well, with a 15% cut going to the government, that was never signed into law. So it never occurred. The CFO told Bloomberg at the time that until it's signed off, they're unable to do this, and they're unable to send the 15% to the government. Will this get legal sign-off?
15%?
Now it's 25%.
25%.
Now, it was 15% for the H20s. H200 is going to be 25%. But then, as you say, is China going to buy any of this? Because this isn't the latest, greatest Blackwell. This isn't pushing towards Vera Rubin. This is based on Grace Hopper. This is based on last year's offering. And for that, that's like sort of telling the Chinese to go suck eggs. Overall, they are frustrated that they want access to the best kind of semiconductors. I'm speaking to people in the industry who are saying we are assessing how much prowess China has with its own use of chips they've already had access to, with their own Camericon and others that are building at Huawei, and what they've been able to do to basically line up all those chips and get the interoperability and be able to ensure that they can train their own large language models. Many think that we are not thinking that they are as good as they actually really are underneath the hood here.
So does China have enough homegrown chip makers? Does it have enough domestic producers to be able to do what it would otherwise need NVIDIA chips to do?
Not yet. And I think that is why you're hearing the government still have to push back, as we heard with the H20s, on their own businesses. Now, Alibaba and all the big tech giants would like access, even to the H20s, even if they aren't as sophisticated, because they just have so much insatiable demand. And so H200s are 10x what the capabilities of an H20 was, even if they are based on the previous Grace Hopper architecture. And so, yes, I think businesses would like to spend the money, but at the moment they're really being asked to focus in on their domestic offerings.
Yeah, if I were in China and the Chinese government advised me not to do something, I probably wouldn't do it. Caroline Hyde, thanks very much. Caroline Hyde, co-host Bloomberg Tech, that kicks off at 11. They'll be talking a lot more, you can bet, about this. Let's get to Home Depot. It delivered muted expectations for 2026. Another sign the housing market is not expected to rebound in the short term. Here with us is Bloomberg Equities reporter Matthew Griffin, and this is just one more piece of bad news for the U.S. housing market.
Yes, Matt, this outlook from Home Depot, comparable sales up only as much as 2% next year, really not what investors were hoping for. I mean, you think back, just a few weeks ago, Home Depot cut their profit outlook for this year. Zoom out a little bit, maybe some puts and takes on the data, but the big picture here, mortgage rates for the 30-year still above 6%, housing prices really high, consumers facing high prices elsewhere, under a lot of pressure. That's weighed on Home Depot's stock this year, down 10% through yesterday, weighed on home builders. And again, this outlook showing investors maybe that these headwinds could be here to stay through next year. Few glimmers of hope yet.
Even the luxury housing is having an issue. Toll Brothers yesterday reporting their earnings. Their median house, I think, is what, like $1 million? What does it say if they're also giving an outlook that disappointed?
Yes. At a basic level, it shows that no one is immune. The real thing that investors are latching onto with Toll Brothers is their outlook for deliveries next year, which fell short of expectations. That stock down more than 5% in the pre-market. I think investors will be looking for whether weakness among luxury consumers continues. Luxury consumers have been strong spenders this year, propping up not just Toll Brothers stock, but the broader American economy. We are, of course, sifting through every earnings report and piece of economic data, looking for information on the health of the consumer. And I think investors are going to be laser focused in the days and weeks to come on whether this is an anomaly, weakness with one company, maybe a cautious outlook that there could be some upside to, or whether this is the start of a trend of weakness here.
And we'll get another read with JOLTS data later today. Matt, thank you so much. That's Bloomberg's Matthew Griffin. From housing to something you might find in your pantry, Campbell stock is up pre-market after beating EPS estimates in the company's first quarter. It also announced that it would be buying a 49% stake in Rouse producer La Regina for $286 million. Key, it is it says Campbell's Soup there, but it is just Campbell's now, right? I guess something about the data being fed in.
Campbell's, it's officially rebranded to Drop the Soup.
Right, so it's just Campbell's.
Because they make other stuff.
They do, indeed. Joining us now is Bloomberg consumer reporter Red Brown. So for this company that makes other stuff besides soup, what did we get from them?
Yeah, I think we got another kind of picture of the theme that's come up in earnings quite a bit of this K-shaped economy, right? So they talk about things where is things like SpaghettiOs are showing weakness. People aren't buying as many SpaghettiOs, but Rouse, which is this kind of like higher end tomato sauce, is doing well. That is kind of offsetting and pasta,
delicious
right?
Pasta.
And it is good stuff, right? So it is showing how the people at the top end of the K are doing quite well, are still shopping, offsetting some of those losses that they've had elsewhere in the business.
It's had a tough year. Campbell's is down 30% year to date. If you look over the last 5 years, it hasn't done much better. What's the problem with this company? Is it just the U.S. consumer? Because I thought these were sort of staples. These are things that you have to buy pretty much.
Yeah, no, I think it's probably some like structural issues with the company. They are kind of working through a pretty significant cost-saving program. So I usually think that kind of speaks to the fact that the company is trying to take some costs out of the business. Earnings, they did beat on earnings, but it is falling as well. So there is, some issues there, and maybe how the business is running. I'm seeing earnings fell around 13-14%. So yeah, definitely still trying to like work through some more business aspects of the company, but I think when you have also the consumers pulling back in certain areas, that doesn't help as well.
Isn't there sometimes in this environment, though, when there is stress, that you get less people spending at restaurants and more spending at grocery stores? Are you seeing that at all, or is this Campbell show just like overall it's softness and people just aren't buying name brands?
No, that actually did come up in the commentary from the management, that they are seeing people shopping at grocery stores, eating in-house more. That is helping the business somewhat, but the word they use, and I think it's kind of it's a good description of how people are, is intentional. People are being intentional with what they're buying. So yeah, you maybe not buying the SpaghettiOs, the pre-made thing. Maybe you are cooking more, like you're buying more raw ingredients to make something that's can stretch throughout the week, things like that. We're seeing a lot of different kind of consumer behaviors in this way to save just at the margin.
All right, Red, thanks very much for joining us on this. Red Brown talking to us about the Campbell's Company. Check on futures right now. You can see that we are down even after we dropped a little bit yesterday. So right now, futures off 1/10% on the S&P, double that on the NASDAQ. Let's get a look at some of the individual movers on our radar, and activist investor Starboard has reportedly built a 5% stake in Clearwater Analytics. It wants the software firm to conduct a strategic review.
Meanwhile, Ares is climbing. It will be replacing Kellanova in the S&P 500. By the way, just a programming note, we're going to be speaking to the co-head of real estate for Ares in the next hour. That's Julie Solomon.
CVS issued 2026 revenue guidance that's below Wall Street's expectations as it navigates a turbulent retail environment and government scrutiny across the healthcare industry. You can see it hasn't hurt CVS shares, gaining almost 3%.
And even though all of their items are in like deodorant jail and shampoo jail, and I hate it. I just want to buy my stuff without unlocking it.
Come to Westchester, Annie Berger.
That's a great
idea.
idea.
The metropolitan area.
You're so right. It's much more convenient to drive all the way to Westchester versus like ordering on Amazon. Will do. All right, coming up on the show, a billionaire, Middle East sovereign wealth funds, and the president's son-in-law. It's the backers of Paramount's hostile bid for Warner Brothers Discovery. We have the details coming up next. You're watching Bloomberg TV.
Technology is embedded in every aspect of our lives.
And laying the foundation for the future.
From finance to defense, AI to entertainment.
And from the road to the stars. Bloomberg brings you the latest stories of the people and companies pushing the tech sector to new frontiers.
And the politics that shape global tech markets.
I'm Caroline Hyde in New York.
And I'm Ed Ludlow in San Francisco.
Watch Bloomberg Tech every weekday.
Only on Bloomberg Television.
The phone is, what's great about it is it's a well-developed gaming ecosystem, right? So, folks know to find games there, but it's also a highly competitive gaming ecosystem. So it's developed, this gives you both that upside and the downside. But what's exciting is that now we are moving beyond the phone to the TV. So I mentioned like one of the big gaming areas we're going after. One of the big gaming areas we're going after now is social gaming experiences that will show up on your TV. So we are now announcing, we're going to announce here actually, that we're going to have these social party games that you can play on your TV with your phone as the controller. And it's things like, recognizable games like Boggle, you got Pictionary, we've got a Lego party game. We, basically are going to like unleash this with a bunch of creators, and they're going to go figure out stuff that we didn't even imagine that they can do with that interactivity.
Join me each week on Wall Street Week for stories of capitalism from business, markets, economics, tech, and climate. More than what you need to know, it's what you need to think about.
From the world of politics to the world of business, Joe Matthew and Kaylee Lines deliver news, insight, and analysis live 2 times a day, every trading day. Balance of Power at 1 and 5 Eastern, only on Bloomberg.
Let's get now to high interest. Look what's making headlines around the world. President Trump told Politico that Russia holds the upper hand in its war with Ukraine, citing Moscow's size and territorial gains. The president pressed Ukraine to start accepting things, and he criticized the ineffectiveness of European leaders, saying they, quote, talk too much and don't produce. Trump's comments come as the U.S. intensifies its efforts to forge a ceasefire between Russia and Ukraine. A lot of talk and not a lot of production there either. Traders around the world are suddenly rethinking the path for interest rates. Markets now expect almost no more cuts from the European Central Bank, and Australia and Japan may even hike rates again. In the U.S., expectations for future cuts are also fading. A single hawkish comment from an ECB official kicked off the shift as investors brace for tighter policy and wait for the Fed's decision tomorrow. And the famed Big Short investor Michael Burry says he's taken sizable positions in Fannie Mae and Freddie Mac and believes their long-delayed return to public markets is close. In a detailed blog post, he argues regulators need to ease capital rules and reduce the government's claim on the firms. He warns their common shares are, quote, worthless without those changes. Danny?
To another top story this morning, Matt, the Warner Brothers saga, and we now have the names behind Paramount's hostile takeover bid, and they're notable for as much as their size as well as their proximity to the president. Paramount's bid is backed by nearly $41 billion in commitments from investors that include Saudi Arabia's PIF, the Qatar Investment Authority, and Jared Kushner's Affinity Partners. Joining us now is Bloomberg Tech's Ed Ludlow. And then, Ed, when you kind of group them together, the Middle East sovereign wealth funds are committing $24 billion. Right. That is literally double the amount that the Ellisons are committing to this. Matt rightly pointed out to me that they don't necessarily get board seats, but that feels like a huge influence coming from these Middle Eastern sovereign wealth funds.
The headline is that the deal's packaged as an Ellison family-backed deal, but you're completely right. Across Saudi's Public Investment Fund and then the entities from Qatar Investment Authority and Abu Dhabi, that's the largest chunk of equity. And then you have the structure of Larry Ellison and Jared Kushner through his private equity firm, Affinity. But in reading the regulatory filings, you know, the Ellison part of it, particularly the Larry Ellison part of it, is backstop. It's guarantees on the equity portion, which, you know, in the simplest way of summarizing it, is done against Larry Ellison's personal balance sheet, right? His net wealth, which of course is, you know, a big chunk in Oracle stock and through other investments.
It's interesting that the president's son-in-law is so involved in this. He's done, obviously, a huge deal with the Saudis already in the takeover of EA Sports. Doesn't this look as though there are many people close to President Trump or who would like to, you know, have the blessing of President Trump on other issues, putting in a lot of money towards the purchase of an asset that controls CNN?
There are a number of players, Jared Kushner included, who are in close proximity to the administration and the president. The president in the last 24 hours has discussed both bids, and while, you know, the precursor of the Paramount Skydance $30 a share cash bid was him acknowledging the antitrust considerations, the president's now essentially saying that he will have some oversight of the process as well.
Ed, the other thing I think that sticks out is some of the overlap is specifically with the Ellisons to the American TikTok bid too. What does it mean, or how should we view what the Ellisons are specifically doing with media, and media that is very core either when it comes to brands or usage in the case of TikTok and what they're trying to build?
Yeah, the TikTok piece of it is interesting and difficult to understand. Like, the big picture of Bloomberg screen time coverage is that broadly across the media and entertainment industry, the biggest threat to a combined Netflix Warner Brothers Discovery or a combined Warner Brothers Discovery Paramount Skydance is YouTube, because they actually have a large market share, particularly in the United States, in the battle for eyeballs. But again, time spent is probably the metric by which the market now measures the success of these platforms, and TikTok is a factor. Remember that within the structure of the TikTok deals, there are both technology safeguards and split ownership models, which we've reported on, right? We broke the story on how that split is with both foreign investors and the Ellison family and other family offices as well.
I keep going back to a couple of things. Yesterday, Michael Wolff of Activate told us that the creative community is more in favor of the Paramount deal. And it reminds me of Lucas Shaw's interview with David Ellison, in which he repeatedly expressed his main goal being to make good movies, that he and his sister Megan have grown up, you know, on Hollywood and want to create content that's not sort of AI-driven sequel slop. Is it true that, you know, the West Coast is more behind the Ellison deal? Because they do also want to fire a lot of people, right?
I thought you guys were going to ask me about the debt package, and we get to talk about the future of Hollywood instead. I mean, the way that a lot of the media industry analysts look at this is HBO Max has a ginormous library of content that nobody watches. So Netflix and Warner Brothers Discovery combining HBO Max with the Netflix algorithm would put into the real world, it would put in front of consumers a valuable library of content. Both companies, Netflix and Paramount Skydance, are actually arguing that they have the better outcome and bid from an antitrust perspective, although clearly Netflix, from a sort of broad streaming standpoint, would take a bigger market share, which is what the president's talking about. Paramount Skydance, remember, the main technical difference is that its bid is for the whole enchilada. All of Paramount, all of Warner Brothers Discovery, including the cable networks, while Netflix only wants the studios and streaming platform with the plan to spin off and divest the legacy cable assets. I'm not answering your question, which is what does Hollywood and the West Coast want? They, again, I think would look to Netflix, the algorithmic benefit of what the platform on Netflix offers, if it was combined with the studio and existing library that Warner Brothers Discovery has. That is at least the answer that we've been getting on Bloomberg Tech from the media and entertainment specialists that we've had on.
Right, but I mean, movie theaters across the country, I think, rooting for Paramount, right? Because the idea that Netflix is going to let something play in the cinema is unlikely.
Because very quickly, Netflix's track record is to have a preference of releasing high-caliber content on the platform first with very limited theatrical release. And in Lucas's detailed reporting through this saga, we aren't sure where Netflix really stands on that in their proposal in the bid. And, you know, I'm sure that that is a question that the watchdogs will ask over the course of time.
We could spend a lot more time talking about this, and I'm sure you will on Bloomberg Tech. Kicks off at 11 with Ed Ludlow and Caroline Hyde. From AI to infrastructure stocks, Citi's Scott Kroner shares some of his top picks for 2026. We're going to get to them next. This is Open Interest.
I'm David Weston. Join me each week on Wall Street Week for stories of capitalism from business, markets, economics, tech, and climate. We go on the road for a look at what lies behind the headlines of today and what will likely be the headlines tomorrow.
We need more transparency. Oil and gas is still important.
They said every citizen should be investing in the market.
Accelerate progress in all fields of science.
Watch Wall Street Week right here on Bloomberg. More than what you need to know, it's what you need to think about.
Bringing you up-to-the-minute news whenever and wherever it happens. I'm Haslinda Amin in Bangkok. This is Bloomberg. Key investors, top executives, global innovators. Join me for in-depth conversations with the biggest newsmakers on the day's top stories. Insight with Haslinda Amin, only on Bloomberg.
The Middle East and Africa regions are home to some of the biggest deals and fastest growth in the world. Vibrant resources and high-yield investment opportunities abound. I'm Jumana Versace. Join me on Bloomberg Horizon's Middle East and Africa for the stories, newsmakers, and insights shaping the decisions of traders across this exciting region.
You had heightened levels of volatility.
There's still room to maneuver.
Reduce the opportunities.
It allows you to increase significantly your net income.
Every trading day, only on Bloomberg.
Making money isn't about drowning in emotions. It's about understanding what's actually happening. Markets are the best way to glean signal from noise, and that is what we try to do every morning. This is Bloomberg Surveillance.
Since 23, and many people deny it, has been a broadening of the rally, with other sectors sharing the stage with information technology and communication services. Any company that wants to keep a competitive edge needs AI. Any company that wants to gain a competitive edge needs AI. Any company that just wants to maintain a good premise as a value company to attract and maintain investor loyalty needs AI.
Oppenheimer's John Stolfus defending his 8100 call for the S&P 500 next year. Joining us now is Scott Kroner, Citi U.S. equity strategist and managing director. Scott, the bulls have come out for 2026, not just him. HSBC's Max Kettner writing this morning that he would be max bullish, max overweight going into 2026. Do you share the same enthusiasm for the new year?
Yeah, so I do. We haven't published our full year targets yet for 2026, so we're still in print for only mid-year. But what I would say, the narrative that we've been building recently does kind of play into this. We've been on this broadening theme for some time. Essentially, the argument here is that as we go into 2026, we think the fundamental broadening across different sectors within the S&P is going to be an important part of the playbook that's going to be in addition to the AI tailwinds that we're seeing in tech, okay? So essentially, as you think about next year, we're arguing a couple of things, Danny. One is that this Mag 7 Elite 8 construct becomes more idiosyncratic. We've seen that behavior already this year. But what that is offset with is more of a cyclical rotation going into next year on the heels of further Fed rate cuts, ongoing economic growth improvement into next year, and a little bit lessening of the policy consternation that we've been facing. So all told, we think the setup here is pretty constructive going into 2026, and that includes going down cap into U.S. small mid cap as well.
Into small cap as well. We were talking about the fact that the Fed is getting maybe a little bit more hawkish. Does that worry you?
No, I mean, the way this is setting up, Matt, is if you, I get it. The S&P valuation construct is a constant source of conversation. But if you step back and look at it, this is really interesting. The large cap growth part of U.S. equities is the only part where you've seen earnings expectations rise through the year to where we're looking at stronger earnings growth now than we started the year. Everything else, including down cap, is a different setup. And here's where it gets really interesting. You can buy the S&P 600, for an example, at a nearly 10 multiple turn discount to the S&P with a growth convergence dynamic that suggests, per consensus estimates, that earnings growth in the small cap space is going to be approach that of large cap next year.
Scott, we'll get more into that. We got to get to the break so we can get to the market open. We'll continue the conversation. Scott Kronert of Citi, your opening bell is next.
When I visited Fernandez at IMAX's headquarters outside Toronto, we went to the facility where IMAX designs and maintains its cameras. The latest next-gen equipment was out with directors on filmed for IMAX sets, but there was still plenty of cool gear on view.
As the head of the finance department, do you look at all the things in this room and think, this costs that amount of money, this costs that amount of money?
Thankfully, no, I don't. When I think about cameras in general and what we, when we first, I'll give you a really prime example, the film cameras. When you thought about it, okay, are we building 2? Are we building 4? Are you building 8, right? And that's where I start to think about, well, what makes the most sense from a return perspective? Because yes, Nolan wants the cameras, but how many other filmmakers out there use the film cameras? The lens that I look at it through is essentially, how many do we build and in what way? Because the one thing is we are going to invest to build it right and to build it for longevity. But do you need 10 of them? No. Building 4, that was the right number. And do we potentially want to build a couple more? Maybe a couple more, but I don't think we need 10 because they won't always be in use all the time.
I imagine that at different points you need to tell people no. What's that process like for you?
Oh yeah, it's a key role in the CFO position. It is a word that most people are used to, and yet they still think you're not going to say it.
Why do the biggest names in business choose Bloomberg Television?
That's a great question.
It's a very good question.
Interesting question.
Good question.
Great question.
I so appreciate that question.
You certainly ask interesting questions.
Bloomberg Television. Top experts, great questions.
Bringing you up-to-the-minute geopolitical news whenever and wherever it happens. I'm Stephen Engel at Japan's Akasaka Palace in Tokyo, and this is Bloomberg.
We are moments away from the start of trading. This is Bloomberg Open Interest. I'm Matt Miller. There's not a lot going on in futures. You can see we're pretty much unchanged here on the S&P futures. NASDAQ down 0.2%. We do have some pretty interesting bell ringers for you today. Starting over at the New York Stock Exchange, Jack Mallers, surrounded by a bunch of dudes wearing hoodies. He, of course, of Strike fame, ringing the bell for 21. His grandfather was the chairman of the board of the Chicago Board Options Trade, so of CBOT, which is pretty cool. And his dad was one of the biggest broker dealers in Chicago. I've interviewed him. Very interesting dude. Over at Walmart, incredibly interesting. I don't know who it is, but one of these people, maybe both of these people, are fleet drivers who have put in 3 million miles on the road, just chasing that long white line, accident-free. So Walmart has a couple of fleet drivers ringing the bell.
I didn't know that was humanly possible to drive 3 million miles.
Yeah, that's pretty impressive, right?
It is really impressive. Also ironic because they're at the NASDAQ being like, we're at a tech company. So one day are the robots just going to be driving?
Yes, exactly. Eventually they'll be replaced by AVs.
Yeah,
right?
I don't think we'll be celebrating their like accident-free drives too. Okay, speaking of tech, I'm looking at NVIDIA. It's turned around from the gains we saw pre-market to now losses down 1/3%. President Trump said, NVIDIA, congrats. You can export your H200 chips to China. We'll take a $25 surcharge off the back of that. But to be clear, it's now weaker this morning. Matt, China, the surprise of all surprise, the FT reporting that China is saying, we're not necessarily going to just allow you to start buying this chip. You have to go through all of these different allowances. We have to give you approval. And China, of course, hasn't been so generous with allowing companies to buy American-made chips.
Right, and let's not forget that the Trump administration wants a 25% cut of these sales. Maybe China is also going to want to put its hand in the pot. Home Depot issued a cautious preliminary guidance for next year, expecting comp sales to grow just 2%. The housing outlook is weighing on earnings as high interest rates keep more Americans on the sidelines. And we also got disappointing earnings out of Toll Brothers, which is surprising because they make what are deemed luxury homes, and we thought that part of the market should be doing well, but also weak guidance from Toll. Let's get back right now to Scott Cronert. He's Citi's U.S. equity strategist and managing director. And you know, this kind of flies in the face of all the bullishness. The U.S. housing market has long been a problem, and it doesn't seem like even rate cuts from the Fed are going to help that much because over the last year, they've cut 75 basis points, and the U.S. 10-year is only down like 10 basis points. How do you expect the 10-year to be priced in 12 months' time, Scott?
Well, I think the way we're thinking about this, Matt, is that, you know, in our view, the Fed's path to policy neutral is the path that we're on right now. And getting to that point and lessening some of the restrictiveness is an important element of this. Now,
do you think the Fed is restrictive right now, that this is a restrictive rate for the U.S. economy?
They've been pretty clear on this. Now, the discussion on terms of where Fed neutral is open-ended, but many will say it's in that 3.5% range. So the starting point here is you need to get the Fed down to neutral. I think the consumption data, you know, would tell you that there's still a concern regarding the labor backdrop and aggregate spending that in our opinion, the Fed needs to respond to. So you've got the path lower for Fed funds rates. Now, the other side of this is inflation and the term premium you're going to place out to the 10-year. And there, we're of the view that inflation is in a fairly manageable position right now. So, you know, where the 10-year ends the year, obviously, is going to be probably around these current levels, 4.1 or so. But the path lower still is going to be tied to inflation and Fed funds. we think, generally speaking, you continue to see the rate complex move lower, which again speaks to and sets up for a cyclical rotation as we go into next year.
Speaking of cyclical rotation, Scott, commodities have been doing so well. The Bloomberg Commodity Index trading around a 2023 high. You could say it's maybe the economy, expectations of an uptake. Maybe it's the new economy with demand for different infrastructure. How are you viewing that, and how does that translate into some of the stocks that you like heading into 2026?
Yeah, so there's a big discussion out here in terms of what the drivers are of sort of the macro tailwinds that we're dealing with right now, and how much of that is a pull from the AI infrastructure build out. And I think that debate will be ongoing next year, but suffice it to say, we have had that as a tailwind. We think it, again, broadens down other paths as we go into next year, all of which sets up, we think, pretty constructively for this ongoing broadening thesis. So you step back and look at the way we've been positioning. Yeah, we've been overweight tech all year with a focus really on the semiconductor space and software as well. But within that, we've also been pushing out the cyclical path, whether it's financials. And so we're fairly keen on the banks here still, despite very strong performance this year. And then within the more traditional cyclicals, we've gotten more constructive on cap goods. And, we've been using names like Rockwell and Quanta Services on our rec list for over a year now. And then even down the consumer path where, again, lower rates as a catalyst here and a still fairly healthy high-end consumer has kept us very constructive on some of your larger cap names, such as Walmart, which you highlighted a few minutes ago.
You mentioned Rockwell. I see in your note that you guys have spent time with company management there. What did you take away from those meetings?
Rockwell conceptually is a pretty straightforward play here in terms of the automation backdrop. But, what really investors are looking for is signs that the shorter-term order uptake is in pretty good shape, and that's what we're starting to pick up here. So you get a company that you go back 2 or 3 years ago was really struggling to keep up with the rest of the industrial sector. The short-term order pattern picks up, and boom, the stock has been much better so far this year. So, I think what investors are looking for in this industrial space is a tie to the AI infrastructure build-out, which has been a real point of differentiation within that component of industrials. But then also, are you beginning to see a more broadening in terms of the economic underpinnings that can further drive the fundamentals from here? It seems like it's falling in place.
Well, Scott, that's like you mentioned Walmart, too. Another one of these companies that people are pointing to is saying they're making great strides in their technology offering and how they're using AI. Emblematic of that, Matt was showing them ringing the bell at the NASDAQ. They've relisted onto the NASDAQ to say, hey, we're a tech company now. Scott, especially for a company like Walmart and any other of these staples, discretionary, really consumer companies trying to brand themselves as tech companies, how do you distinguish what is AI theater and what's real and what's a buy case?
Really good question. I'm not sure how much time we have to go into this, but this is an important thesis, right? So essentially, we think one of the storylines for next year is that we see a broadening away from the AI enablers and creators of this year and last year to AI users next year. So you begin to switch away from the discussion around the hyperscalers as an example towards the users of the technology that are improving their operations. And there's going to be a plethora of companies, every S&P company, if it doesn't have an AI strategy by now, it will. And if you don't, you got investors questioning what's going on. My point here is that the opportunity structurally for U.S. equities is that you see more companies deploying AI in a way that lessens their historic earnings volatility. And as you do that, you can pay a higher current multiple for that and a higher terminal value. It's one of the reasons why I think Walmart trades more expensively than does NVIDIA, which is showing much stronger earnings growth right now. So this notion of deploying technology to better improve even a traditionally low-margin business like Walmart's is really, really critical to the way the large-cap U.S. equity landscape is unfolding. I think it's going to be an ongoing important storyline for next year.
Yeah, it's so interesting. Scott, thank you for joining us. We're looking forward to continuing those conversations into the new year. Scott Croner of Citi. A check on your equity market now. We are little changed in today's session. I mean, okay, we're unchanged. Even though breadth is good, it kind of feels like days where we're up, breadth is really bad. And if we're unchanged or to the downside, breadth is good to the upside. Go figure. Apple doing pretty well in today's session, adding the most points to the S&P 500. Exxon, those shares are up 2.1%. They gave an updated cash flow estimate for 2026, and that exceeded expectations. CVS also in your winners, too. They also gave expectations for next year. That beat what the street had expected. Going over to the downside, Meta Platforms, they're not doing so well, down 1.3%. NVIDIA, we've talked about this all morning. Are they going to be able to sell H200 chips into China? Trump says yes. China says not so fast. Microsoft, Broadcom, AutoZone also down. AutoZone had earnings which disappointed, down 5.6%. Looking at the sectors this morning, most of them are into the red despite, or into the green rather, despite an index that is little change. I pointed out Exxon. That's why you have energy at the top. Utilities also at the top. Again, commodities in general have done really, really well. At the bottom of the screen, you can see communication services is down there. I pointed out Meta was one of the big losers. So again, you have kind of safety plays, I guess, at the top. Energy, utilities, healthcare, that's really the only things that are lifting up the market this morning.
Yeah, a little bit of a defensive rally here.
Yeah.
Coming up, NVIDIA gains approval to sell its H200 chips in China, but will that help earnings? Will they get any past Chinese regulators? We'll talk about this with Mandeep Singh next. This is Bloomberg Open Interest.
Climate change is going down right now. It's going down. And we've tried everything to shame people and blame people and put them in their place and tell them that they're doing things wrong and that they're killing everybody. But if we keep telling them that, then we are going to kill everybody. So we got to figure this out. And we're not going to do it by blaming people who are just trying to wake up and make ends meet every day, especially when a lot of those people have the same connection to nature and the environment that we all share here. I hike and I ski and I love the environment just as much as anybody else, but so does somebody who works in an oil field. The Cabela's shopper and the REI shopper want the same things. They want clean air and they want clean water and they want to be able to recreate outdoors. So until we figure out how to get on the same page, we will continue to lose. We cannot afford to lose anymore. We need to build a winning coalition of people across the political spectrum, or we will never create the solutions that we need.
It's the world's second largest economy with a growing influence in global affairs. Bloomberg The China Show brings you the unmatched expertise you need to keep track of breaking news, in-depth market analysis, and the most influential newsmakers in and around China.
We need to do more to engage the market more. We're risk on. I think we caught a little sweet spot.
Massive savings right now.
It's already a different game.
Bloomberg The China Show. Weekdays around the world, right here on Bloomberg. Context changes everything. U.S. jobs numbers are released. Bloomberg has the report under surveillance with crucial data and expert analysis at terminal speed. Nobody covers Jobs Day like Bloomberg.
Astonishing day for U.S. technology.
It's shaping the region's technology ecosystem.
Asia's biggest tech news and innovation.
Know how the market day started.
Find out how it finishes.
Public markets to private markets.
From the micro to the macro.
Covering retail, entertainment, the business of sports.
The supply chains, trade policy, how it all is impacting the U.S. equity market as we drive to the closing bell at 4 p.m.
A holistic approach to covering financial markets.
If it matters to your life, we're covering it. I'm Katie Greifeld.
And I'm Romaine Bostic, and this is The Close.
Live every weekday.
Only on Bloomberg. Context changes everything.
A look at the top calls this morning, the analyst action we're watching. First up, RBC upgrading Colgate Palm Olive. The firm says that the stock is now beaten down enough that expectations are realistic and it can consistently meet or beat forecasts through 2026. Growth looks more achievable even in a tough macro backdrop. Those shares up 2.3%. Next up, Goldman Sachs downgrades Norwegian Cruise Line, warning that its heavy and fast-growing Caribbean capacity could outstrip demand and pressure 2026 expectations. That makes the risk-reward less attractive. Shares down 1.7%. Finally, Barclays opens coverage on 34 healthcare names. They lean bullish on drug distributors like Teva and Hims and Hers. The analysts also arguing that earnings still have room to beat despite rich valuations. Goldman also says that specialty pharma is shifting towards newer, faster-growing products. Matt.
Colgate Palmolive, by the way, does use palm oil.
I know.
In some of its products.
How often in life, well, you probably say never in life very often, but like palm olive just doesn't, it's not there at the front of my mouth, you know? Oil is.
It's a tough one. For some reason, a lot of people have a tough time with that. All right, let's turn to tech now. President Trump is giving NVIDIA permission to sell H200 AI chips to China in exchange for a 25%, I guess we'll call it a surcharge. Joining us now is Mandeep Singh, Bloomberg Intelligence Global Head of Technology Research. So this is interesting on a number of different levels. The export tax, I think, is where we should start. Is there any historic precedent for this kind of export tax?
Not that comes to mind, especially with technology companies. And look, in this case, I think they have had a lot of back and forth in terms of selling NVIDIA's chips to China. In one case, the U.S. government didn't want to sell it. Then the Chinese government stopped, the sales. So that's why you see such a muted reaction. But there is no doubt when you look at the numbers, I mean, even if it's less than a $50 billion market in terms of selling to China, for a company like NVIDIA, it's huge. I mean, we're talking about maybe a 10 percentage point lift to their growth rate for next year if they're able to sell to China. And the reason I still feel companies over there want to buy NVIDIA chips is because when it comes to training the LLMs, NVIDIA still has a monopoly. Every provider, I mean, TPUs was the first time that Alphabet actually used their own chips for training. But other than Alphabet, everyone that we know of uses NVIDIA for training. So that's where I feel like even though the Chinese government may say no, they would still want their companies have access to NVIDIA chips just for training, even if they may use their own chips for inferencing.
Yeah, but is Jensen Huang really going to change his expectations for China sales to anything other than zero, even with this?
No, and they're prudent in being conservative because you don't want to, raise expectations and then having to cut it back. So he wants to beat and raise, and I get that. But look, you have to think about NVIDIA's customers as the LLM companies. The companies that are at the forefront of training these LLMs, at the forefront of scaling laws, because that's what drives the bulk of the compute. If we are talking about building gigawatt clusters, those are the customers NVIDIA wants to sell to, not to smaller enterprises. That's not going to move the needle for a company like NVIDIA, which is going to do $330 billion in revenue next year. So you want to find those large hyperscalers, and they are your model training companies. 3 of them are in China. So they want to be able to sell them their chips, the newest versions of that, or the one version behind the US current version that they're selling, and be able to do that on a recurring basis. And that's why that market is so lucrative.
So the Chinese government, even though they've repeatedly warned domestic companies not to buy these chips, you think they still want their big LLMs to train on them? There's really very few competitors for that purpose. Are they charging significant tariffs on the import of these chips? Are they taking kickbacks from this? How's that working?
Not that we know of in terms of NVIDIA having to pay anything to sell to that market. I mean, obviously these chips are not their latest Blackwell chips, so I assume they're going to price it slightly lower than the latest Blackwell chip. Also, you have to remember, NVIDIA is selling systems. They're not selling individual chips.
This is the Grace Hopper thing.
They actually are building clusters of 100,000 chips that are connected through their own networking gear. So when those chips are getting smuggled to China through some other means, they're not able to sell networking business. Whereas if H200 is allowed, NVIDIA will be able to sell their networking gear as well, because at the end of the day, the way you do training is to build a cluster of 100,000 chips that are interconnected, and you are using that to manage a workload and, you know, split it across those 100,000 chips. That's how you do training. And that's where, you know, smuggling those chips is not a good solution.
But the smuggling thing, like, also introduces this confusion, because the Justice Department, the most recent story I think you're referring to, detains 2 men of Chinese nationality, saying that you threaten our national security by bringing and smuggling in H200 chips. But those are the exact chips that the Trump administration just said that he'd allow China to buy. So, like, is it a national security threat or not to have these chips?
Or does our national security have a price? 25%.
I mean, clearly, national security-wise, I think we have had a lot of back and forth, and that is the biggest concern, because at the end of these day, these models are very powerful, and, you know, we're learning more and more about possible cyber attacks, state-sponsored attacks using these LLM capabilities. So there is that element that the more frontier model you have as a country, then there is a lot that you can do with it, and that's the national security concern that keeps coming back, even though, you know, we have had a few approvals in terms of selling these chips to China. Those concerns are not going away anytime soon.
Well, let's not talk around Danny's point, right?
Yeah.
On the one hand, the Department of Justice is saying these H200 chips, if the Chinese get a hold of them, that represents a national security problem. On the other hand, the Trump administration is saying we're willing to let the Chinese have these H200 chips if they pay a 25% surcharge.
Yeah, well, we don't know what those 2 people were importing in addition to that. Like, yes, that's what's been reported, but there could be a lot more to the way they're going about it. And as I said, you know, when you are selling a clustered, you know, big cluster of NVIDIA chips, these are big systems. You know, you almost have to forklift them, you know, to install an NVIDIA training cluster. So what are you doing with small chips? Like, you don't know the end use of that, and that's where the bigger concern is, as opposed to a big giant training cluster that NVIDIA is selling to a customer in China.
Yeah, I was going to say, I mean, who knows the validity of this, but the Justice Department is saying they would use it against American interests. Mandeep, we're going to have to leave it there. Always so great to get you on. Mandeep Singh of Bloomberg Intelligence. Coming up on the show, Pepsi slims down. We discuss Elliott's role in the coming layoffs and plans to cut its product lineup by 20%. That's after the break on Bloomberg Open Interest.
By the way, Mandeep.
Bringing you up-to-the-minute political news whenever and wherever it happens. I'm Tyler Kendall in Washington, and this is Bloomberg.
What is going to be the consequence for U.S. markets?
We are basically deep in the European earnings season.
Take a look at how we're faring when it comes to Asian markets.
To Bloomberg Business Week Daily.
We got to talk crypto.
From the magazine that helps global leaders stay ahead.
What's the conversation around your company?
Bringing you insight on the people, companies, and trends shaping today's complex economy.
Planning very big things.
A new level of premium.
Plus global business, finance, and tech news as it happens.
The floodgates of innovation are going to open up.
You can't fake passion. You either are or you aren't.
Bloomberg Business Week Daily, only on Bloomberg. It's a multi-trillion-dollar industry. We'll show you what's happening in ETFs like no one else. ETF IQ, only on Bloomberg.
This is Bloomberg Open Interest. Quick check on what's going on in stocks on this Tuesday morning. Not a lot. The S&P 500 actually up now 0.1%, and as Danny points out, the breadth is good. The NASDAQ is down 0.2%. NVIDIA, I guess, is a weight here. You can see that NVIDIA has turned red now, down 0.7%, even with the presidential allowance to sell some of its chips to China. Intel actually gaining 0.2%. Obviously, it's a much smaller company, so it doesn't cancel out the drag that is NVIDIA. Netflix right now is completely unchanged, whereas Paramount Skydance is down about 2%. These moves don't really tell us much of anything, but they're two companies that are in the news. And Campbell's Soup and Pepsi are in the news as well. Campbell's right now down 1%. Actually, it's just called the Campbell's Company. I'm going to have that changed. It's just called the Campbell's Company. And because they make a ton of other stuff, like potato chips and goldfish and SpaghettiOs, as Red Brown was pointing out, Pepsi is going to make less stuff, fewer things after an agreement that it reached, I guess.
SpaghettiOs is like basically soup. Anyway, I don't want to debate about this because we need to get to the Pepsi story, Matt. They reached an agreement with Elliott. They'll cut 20% of their product lineup, and Bloomberg's Crystal C covers activist investors and joins us this time from London. Crystal, is this Elliott getting what it wants in Pepsi?
So this is a sort of agreement. It's not exactly an agreement. So Elliott is getting some of what they want. The company announced that they're cutting the product line, the product offering. They're cutting workforce, and they're putting out more aggressive growth projection. They're now saying that it's going to be 2 to 4% instead of what analysts was estimating, which is 2.7%. Elliott is not getting a board seat, so they're only getting some of what they want. But the overall operational improvement is definitely something Elliott had been pushing for.
So what do we know about slimming down in terms of the product offering? What are we no longer going to be able to buy from PepsiCo?
So we don't know a lot about that yet. The detail is yet to come out. We are also hearing from the company that says they will be downsizing product line as well as prices. So I think it's definitely in response to more kind of constrained customer kind of spending in the U.S., where people are less willing to spend, especially on brand name products, and switching more towards white label. So there are going to be definitely some of the products that people love and consume that will be gone, and we'll see what kind of campaign can bring them back.
All right. Good prediction. Crystal C there covers deals for us at Bloomberg right now. She's out in London. Coming up in the next hour, Empower's Marta Norton says it is time to rebalance your portfolio. Plus, Ares partner Julie Solomon walks us through their new real estate management program for 2,000 properties worldwide. And we'll talk to Tanger CEO Stephen Yaloff.
game here is understanding. These digital assets have the ability to change the payment landscape of the world, and we need to be ready. We, the regulators, the world needs to be ready for a new wave of technology.
Stablecoins are almost entirely used in the mechanisms of trading cryptocurrencies. What we saw is the opportunity for digital assets broadly, stablecoins in particular, to be used as a medium of exchange outside of the crypto world, what is today the fiat currency world. At some point, I think these digital asset wallets will be big enough and people will be comfortable enough using them. I think we'll have a flip from conventional payment mechanisms into stablecoin-based mechanisms.
Does that mean banks such as yourselves issuing stablecoin?
We could. We are issuing Hong Kong dollar stablecoins today. We're in a sandbox for tokenized bank deposits in Hong Kong. We're effectively issuing tokens related to trade finance in Singapore. So it's all on the table, but we're always going to tie it back to what our clients want and need. Because if we don't get that one right, the rest doesn't matter.
The market capitalization of both type of instruments, crypto and digital assets, are both very low. Stablecoins today have $20 billion of flows a day. It's less than 1% of the flows of the payment system in the world. But because they have the ability to be very helpful in use cases, particularly in retail to begin with, but then potentially on the wholesale side, I think we will see a lot more of that.
Good morning. This is Bloomberg Surveillance.
Welcome back to the opening trade. Watch Bloomberg Tech. This is the Asia Trade.
This is Wall Street Week. Welcome to Balance of Power.
This is Bloomberg Television.
Bringing you the world's business and financial news whenever and wherever it happens. I'm Michael McKee at Mount Everest. And this is Bloomberg.
CBS News on the Hour, sponsored by Eggland's Best.
I'm Deborah Rodriguez. The Pacific Northwest is bracing for downpours. An atmospheric river is bringing precipitation and warnings. CBS meteorologist Rob Marciano.
Heavy rain coming in. We've got over a dozen rivers that are at flood stage, a major flood stage. Flash flood watches remain up here with this atmospheric river that's coming in. Another 5 to 10 inches of rainfall potentially here through the week.
There's another winter storm set to bash the Midwest. Just in from New York, a federal judge says the Justice Department can publicly release investigative materials from the sex trafficking case involving Jeffrey Epstein's longtime confidant, Ghislaine Maxwell. She is serving a 20-year prison sentence. There's a hearing in Florida today on the president's $10 billion defamation suit against a Rupert Murdoch publication over a birthday card featuring the curvy shape of a woman with a suggestive note allegedly sent to Epstein. Loyola Law's Lori Levinson.
The Wall Street Journal says that they can prove that indeed Trump did send that. It doesn't matter whether he drew it or he signed it. They said he sent it. And if that's true, it would not be libel or defamation.
The Fed is set to consider lowering the price of borrowing money again. CBS News business analyst Jill Schlesinger.
Today, the Federal Reserve begins its final policy meeting of the year, and expectations are that the Fed will reduce interest rates by 0.25 percentage point, and that would leave the Fed funds rate at a range of 3.5% to 3.7%.
Today marks 1 year since Luigi Mangione was arrested in the murder of United Healthcare CEO Brian Thompson. The suspect is back at court in New York now for a pretrial hearing on the evidence collected. CBS's Lilia Luciano.
Last night, prosecutors released photos showing the items in his backpack, including a 9mm handgun and silencer, as well as a red notebook, passport, and ID, and several handwritten notes. One of them described what appeared to be a map of Pittsburgh with possible escape routes. Another note read, "Keep momentum, FBI slower overnight."
Dr. Mehmet Oz, who heads Medicare and Medicaid services, offering tips on healthy holiday eating.
In an email to his 6,000 employees titled Crushing Cubicle Cravings, Oz asked them to practice portion control. He suggests using smaller plates when taking part in office cookie swaps and trying not to eat every cookie on the table. The former talk show host writes, "Don't double fist food and drink. Keep one hand free to shake hands with colleagues. Put your fork down between bites and savor each bite." A CMS spokesperson says the feedback to Oz's tips has been positive. Michael Wallace, CBS News.
This is CBS News. KISS lead singer Gene Simmons testifies on Capitol Hill today on legislation to force radio stations to pay artists to use their music.
The bipartisan bill is called the American Music Fairness Act, and during a stop in the White House briefing room last week, Simmons said it needs to be passed.
Because your favorite artists, Elvis Presley, Frank Sinatra, and quite a few others, were never paid a single cent when you heard their voices on the radio. Nothing.
He said artists must be properly compensated for their work, just like they are on other platforms like streaming services. Stacey Lynn, CBS News, Washington.
The longest reigning monarch in European history did not die of gangrene after all. Scientists who studied DNA from King Louis XIV's mummified heart have determined it was a chronic skin infection caused by fungi unheard of at the time that led to his demise in 1715. Deborah Rodriguez, CBS News.
This is Bloomberg Intelligence with Scarlett Fu and Paul Sweeney.
How do you think the Fed is looking at tariffs, the uncertainty of tariffs?
Let's take a look at the sectors and how they performed.
A lot of investors getting whipsawed every day by news events.
Breaking market headlines and corporate news from across the globe.
Could we see a market disruption, a market event?
Are people just too exuberant out there?
You see some so-called low-quality stocks driving this short-term rally.
Bloomberg Intelligence with Scarlett Fu and Paul Sweeney on Bloomberg Radio, YouTube, and Bloomberg Originals.
Good Tuesday morning from the Bloomberg Interactive Broker Studio in New York City to our worldwide audience. We're streaming live on YouTube as well. Scarlett Fu, Paul Sweeney. This is the Bloomberg Intelligence program. Coming up, we're going to check in with Caroline Hyde. She covers all the technology stuff over at Bloomberg Technology for Bloomberg Television. Get the latest. There's a lot of technology news out there, and Caroline can tell us kind of what's important and what we need to focus on. So that's coming up. We're also going to talk to James Abato, Managing Director and Head of Fundamental Strategies at Horizon Investments. Get his thoughts on these markets. Geeta Ranganathan, she is the media analyst for Bloomberg Intelligence. Boy, is she busy these days. This Warner Brothers Discovery deal, is Netflix going to buy it? Is Paramount Skydance going to buy it? Is somebody else going to come in? Looks like we've got a bidding war there, so we've got the latest reporting there from her research analysis. Ira Jersey, Bloomberg U.S. interest rate strategist. He's going to preview kind of what we're going to hear from the Fed tomorrow and kind of where the rates may be going in 2026. So a lot coming up in the next couple of hours. Scarlett Fu and Paul Sweeney with you for the next 2 hours. Right now, let's go to Lisa Mateo and get a Bloomberg Business Flash. Lisa.
You have it. And the Bloomberg Business Flash brought to you by Interactive Brokers. Trade over 10,000 U.S. stocks and ETFs, U.S. equity index options, U.S. treasuries, and more on your timetable. Learn more at ibkr.com/around-the-clock. We have some more data out, rounding out economic releases before the Fed announcement. JOLTS job openings for October. The expectation was for 7.12 million. Came in, tick higher, 7.67 million. JOLTS quit level for October. The forecast was for 3.15 million. Came in lower at 2.94 million. Okay, so all that said, we still have stocks mixed. So we have the S&P 500 up about 0.1%, 8 points. The Dow up 0.2%, 117 points. And the NASDAQ, that's down about 0.1% or 23 points. We go over to the yield space, the 2-year, 3.60%. That's up 2 basis points. The yield on the 10-year, 4.18%, and that's up 1 basis point. The Bloomberg Dollar Spot Index strengthening by about 0.1%. Over to company news. President Trump granted NVIDIA permission to ship its H200 AI chips to China. That was in exchange for a 25% surcharge. But now you have the Financial Times reporting that China, well, they're set to limit access to those chips because it's pushing for self-sufficiency. The shares right now, NVIDIA shares are down about 0.3%. The contest for Warner Brothers Discovery, Paul mentioned it, intensifying. Paramount Skydance launching this hostile takeover bid. It comes just days after Warner Brothers agreed to that deal with Netflix. So we'll check in with their shares. Paramount right now down about 2.5%. Warner Brothers Discovery up more than 1%. And Netflix, their shares are little change. And finally, Google, they've been hit by an EU investigation. That's over suspicions the company is abusing its market power and its rollout of artificial intelligence. And that comes just days after Meta was targeted for a similar probe. Right now, Google shares, they're down about 0.3%. For on-demand news 24 hours a day, subscribe to Bloomberg News Now. Wherever you get your podcasts, I'm Lisa Mateo. That is your Bloomberg Business Flash. Scarlett and Paul.
All right, Lisa, thank you so much. We appreciate that. Scarlett Fu and Paul Sweeney live with you here in our Bloomberg Interactive Broker Studio in New York City, streaming live on YouTube. Head over to youtube.com, search Bloomberg Podcast. That's where you'll find us. Market Drivers today brought to you by Commonwealth, supporting more than 2,000 independent financial advisors with a 2-to-1 advisor-to-staff ratio.
Small firm attentiveness, big advisor impact. Go to commonwealth.com to learn about their consultative support and technology. Let's take a look at some of the stocks on the move today. I'm Paul Sweeney alongside Scarlett Fu. We're joined by Christina Aquino. Christine, what are you looking at?
We're going to take a look at Warner Brothers, Paul.
Okay, bring it.
Deal of the year, right?
Yeah, it's a big one.
Yeah, exactly. And those shares up today. So ticker WBD shares are up 1.4% at the moment. So the latest development here, of course, we know that Paramount has launched a hostile takeover, launching a $30 per share offer for Warner Brothers Discovery and all of Warner Brothers Discovery, including its debt, which is kind of the crucial difference between its offer and Netflix's offer. And so the Paramount deal is interesting, though, because, of course, it's being helmed by CEO David Ellison, who has touted his family's good relations with the president. And, of course, the president's own son-in-law, Jared Kushner, is also participating in the bid, though the president has said that he has not discussed the topic with his son-in-law. Anyway, the details are that, again, Paramount is in the mix. Netflix then has an option to match Paramount's offer if Warner Brothers determines that the other offer is superior, according to filings. And all this will probably get an answer to in the next 10 business days, which is when Warner Brothers said it will respond to Paramount's deal.
All right, my head is spinning, and once upon a time, people would call that conflict of interest, but it's 2025, so I don't know that we call that anything.
It's just business, Scarlett.
It's just business. All right, what's second on your list?
Let's take a look at CVS. So those shares also doing well today. So ticker CVS shares are up nearly 3%. And it's holding an investor day today. It already gave us some pretty optimistic guidance, raising the full-year profit forecast and saying that earnings will rise in 2026. The company is now looking at adjusted earnings of as much as $7.20 per share versus the $7.17 that analysts were expecting. So Bloomberg Intelligence weighing on this, they're saying that the headlines do meet the mark in terms of the near and long-term financial implications. The only thing is that the framework is missing a little bit of detail. That's what they're kind of saying. It's a lot less detailed on a segment basis compared to their last release in 2023. But at the very least, there were no surprises from this investor day.
Last one, Home Depot.
Taking a look at Home Depot, those shares also in the green. So ticker HD, shares up nearly 1% at the moment, even though the company did give initial guidance for next year that was slightly below street expectations, both in terms of their top and bottom line metrics, although it did reaffirm its guidance for the current year, which is set to end in February 1st, 2026. So they're looking at total sales growth of 3%. That said, for the following year, their comparable sales growth estimate looking at approximately flat to 2%, and the estimates previously were plus 2.1%. A JP Morgan analyst weighing in saying that the event is on path to creating a proper reset of investor expectations following a guide down in the third quarter.
All right, good stuff. Thank you so much. Christina Aquino, Managing Editor for Markets Live here at Bloomberg News. And for more conversations like this, subscribe to our Stock Movers Reports. Listen for 5-minute audio reports on the biggest winners and losers in the stock market. Subscribe to Stock Movers on Apple Podcasts, Spotify, or anywhere you listen. So Christine mentioned that President Trump has now opened the door to NVIDIA selling some of its high-end chips to China.
Yeah, I'm not sure. I kind of can't follow the policies. Some days the door's open, some days it's closed.
Yeah, and it could always move in the other direction. That's the other risk, right? Let's bring in Bloomberg Tech co-host Caroline Hyde to tell us a little bit more. So on B-Tech, I'm sure you're going to be talking all about this. But Caroline, what does it mean that NVIDIA can now sell these H200 chips to China? Because that is not the most advanced chips, is it?
It's not. It's based on Grace Hopper architecture, which isn't the Blackwell that we're currently in. It isn't the Vera Rubin that we're looking towards. It's the previous year's iterations. It is 10x superior to the H20s that, remember, cast your mind back, had also been deemed okay to ship from the United States to China if a 15% cut was given to the US government. But that was never signed into law. They were never able to execute on that. And most importantly, China doesn't want them. And I think this is the key. The Financial Times is reporting that basically already China's looking at putting curbs, licenses, basically limiting the ability for certain companies to access the H200s, even if NVIDIA is allowed to ship them. And I think this is what everyone's got to currently digest. I'm hearing time and time again from some of the most powerful people in the technology space that we are underestimating how sophisticated China is at using the NVIDIA chips, the small amount they already have, and some of those homegrown ones.
Typically, how is this trade policy negotiated? Who typically says, U.S. tech company, you can sell this into China or to other markets, or you can't? Because it just seems like it's now at the whim of the president and his X account or Truth Social account setting trade policies. How is it typically done?
Well, isn't it interesting that just last week, Jensen Huang was meeting with the president, but was meeting with some of the leaders over in Congress. Most crucially, he was with the Senate Banking Committee, because it's the Banking Committee, oddly, that tends to be in charge of export restrictions. And so it was that group of leaders, but many are frustrated. And I was just at the Reagan Defense Forum, National Defense Forum this weekend, and there is hand-wringing going on from Congress that they're being cut out of a lot of these discussions. Really, they should have ownership of how much trade should be allowed. But at the moment, these are coming through executive orders, and we know that the president likes to cut a deal.
Yeah.
NVIDIA Jensen Huang likes to cut a deal. They have a very personal relationship. And most broadly, NVIDIA and Jensen want access to China. They think there's something like a $50 billion total addressable market they're being forced to have to put down at the moment. He has 0% revenue coming from that country. But you've got this tussle at the top of the China hawks who are worried from a national security perspective if you allow technology to go from the US into China. But on the flip side, Jensen Huang would say, they're just going to build it themselves and we're forcing them to speed up that by limiting my technology. Let our stack own that of China's big large language model development.
So you had mentioned that China didn't want to buy the H20 chips. Does China want to buy the H200 chips?
I think if you asked, what the reporting shows is that if you turn to an Alibaba or a Tencent or a Baidu, they are limited by the amount of GPUs they have access to. So I think more is more from their perspective. And yes, the H200s build on the H20s, but longer term, the government wants to focus on domestic supply here. That's why you're seeing Cambricon do so well, why you're seeing Huawei do well, why you're hearing Baidu wants to spin off its chip manufacturing, why we just had that superb entrance to the market just of the Moores technology company that has shot up more than 400%.
Wow.
They do want to make it homegrown.
Great story on the Bloomberg terminal today. Apple shares have soared 35% since the end of June as the market scrutiny of AI development spending has made the company's lack of an AI strategy a strength.
So do nothing and benefit?
I don't know, but I mean, Apple, we always say about Apple, they don't have to be first. And typically they are not first, but when they do come into the market, they do it really well.
It's a thought out approach.
And that, people, you know, the Apple bulls have been saying, don't worry, don't worry, don't worry. They're going to be fine. There's 2 billion Apple devices out there. They'll be fine. I don't know.
Yeah, and meanwhile, goodbye to the guy who was in charge of AI policy over at Apple because of that botched Apple Intelligence rollout. People have been frustrated that Apple seems to be a slow player to adoption, but longer term, most in the generative AI space are thinking that we are going to be using this from a consumer perspective from our edge devices. Therefore, compute is going to change in the way in which you know it. Your models are going to change in the way in which you know it. And eventually, we will be running our ChatGPT or our Gemini or whatever model you like on your device. Eventually, that means you'll need an Android or an Apple, or maybe some future AI device that hasn't yet been created and is probably being developed in the minds of the great leaders right now. But we'll have to see how Apple continues to basically do the benefit of not having got a load of debt and not having spent an awful lot of money on the build out, because at the moment, I think investors are just still grappling with the sheer scale of capital expenditure that's going into this and wondering whether there's going to be a real upside. Can Apple get the upside without making the infrastructure investment?
So Apple's a standout in contrast to the other hyperscalers and how much, or the hyperscalers, I should say, in terms of how much they're investing in AI. But what does this mean for Apple, the company overall, as it kind of slows down its approach and takes a more considered approach, if you want to put it generously, to AI? There's a lot of question marks.
I know there's, and maybe just, again, the Apple story, which people have got comfortable with, is they don't have to be first. They just have to be the best. They've shown that in the past. Maybe they'll show it again here in AI. We'll see. Caroline Hyde, thank you so much. We appreciate it. BTech co-anchor. Check out her work with Ed Ludlow on Bloomberg Television. They got the tech world covered. Soup to nuts. This is Bloomberg. Good morning.
markets, headlines, and breaking news 24 hours a day at Bloomberg.com, Bloomberg Television, and the Bloomberg Business app. This is a Bloomberg Business Flash.
From the Bloomberg Interactive Broker Studio, I'm Lisa Mateo. The S&P 500 right now, little change, and that's after the benchmark stopped a 4-day rally yesterday. Goldman clients, well, they've grown a bit more cautious on AI U.S. stocks, expecting the S&P to end 2026 between 7,000 and 7,500. Let's go to the S&P 500. Like we said, little change, up 5 points. The level, 6,852. The Dow up 0.2%, 123 points, and the Nasdaq falling 0.1% or 33 points. The 2-year yield, 3.60%. That's up 2 basis points. The yield on the 10-year, 4.17%, and that is little change. Over to commodities, we have COMEX gold up 0.3%, $4,232 an ounce. Brent crude, $62 a barrel. WTI crude, about $58 a barrel. The Bloomberg Dollar Spot Index is little change. To earnings we go. Campbell's, it reported first quarter adjusted EPS at topped estimates. Shares were higher. Now they're taking a turn. They're down about 2.5%. AutoZone reported a miss on comparable sales for the first quarter. Its shares are falling down more than 4%. And now we'll look into the housing market. For that, we get a cautious outlook from Toll Brothers. The luxury home builder, it beat estimates for quarterly orders, but the thing is, it provided this full-year guidance for 2026 that fell below expectations, so its shares are down nearly 2.5%. And finally, Home Depot, they offered a cautious preliminary guidance for next year. It also gave projections for total sales growth that were below estimates. Its shares were lower, now getting a bit of a lift, up about 0.5%. For on-demand news 24 hours a day, subscribe to Bloomberg News Now. Wherever you get your podcasts, I'm Lisa Mateo. That is your Bloomberg Business Flash. Scarlett and Paul.
All right, Lisa Mateo, thank you so much. We appreciate it. So the jobs, the JOLTS job openings, they didn't publish that, did they? I'm looking at the eco screen. I have no JOLTS job openings, but I got the jobs quits rate.
Well, job openings, it looks like it was 7.658.
Okay, my screen's just not showing it.
Yeah,
okay.
Maybe refresh it a bit, but
Okay.
a lot of
There
stuff
we go.
came out all at once.
Okay, here it is. So the jobs openings much higher than expected. Got you there. Okay, so there you go. So we'll keep an eye on that. That's a number. Remember that back in the pandemic, I think it was like, 12, 13.
I know, it's a far cry from what it was back then.
Exactly, crazy. That's what are we doing here in 2026, folks. Let's put 2025 in the books for all intents and purposes here. The question now is, what do we do for next year? What's the next act here? James Abate, he's the managing director and head of fundamental strategies at Horizon Investments. James, again, the S&P 500 up 15-ish, the NASDAQ up 20-ish, high single-digit returns in fixed income. So 2025 for most folks was a really, really good year. Now we got to look to 2026. How are you kind of framing that out?
Yeah, it's been literally 3 very good years and very steady years for markets across the board after a very difficult 2022. But, where we see the best symmetrical or asymmetrical opportunities in the stock market now are probably in early recovery cyclical value stocks. I think the financials, the materials, the industrial sectors, as well as even smaller companies. Let's not forget, we've been in a global manufacturing slowdown recession since 2022. And we're starting to see early signs of cyclical recovery. You're seeing in manufacturing, transportation. I think some of the positive indicators from surveys, as well as the company earnings we've seen, have been quite positive. And if the Fed, will embrace a further easing of financial conditions to spur cyclical growth and support debt-laden sectors like housing and manufacturing, I think we're, going to be in a good opportunity for those areas of the market. I think also, very, very importantly, at the same time that we're witnessing this emerging cyclical recovery, we have, a bottom-up dynamic of really restructuring and capacity curtailments, whether it's packaging, chemicals, construction, and other areas of the market akin to what we observed back in 2009, coming out of the banking crisis and recession. So, when you look at regional banks, paper and packaging, timber, certain chemicals, analog semiconductors, we see like this coiled operating leverage to explode higher on any semblance of cyclical growth. And I think you'll see a rotation or pro-cyclical rotation into those areas of the market and away from perhaps the defensives and the Mag 7.
I get the the want to rotate into some of these beaten up names that have, been looking for some kind of catalyst for the upside for a while. But rotating out of Mag 7 is a lot to ask for. How do you want to be exposed to those Mag 7 names? I mean, we were just talking earlier about how Apple is not quite the same as a Meta or a Microsoft because it's been really late on AI. And as a result, it doesn't have the CapEx issues and people are seeing it as a different kind of tech company.
Yeah, I think you're finally starting to see differentiation among the Mag 7, whether it's Meta falling off because people don't believe the efficacy of their investments or have been as powerful as perhaps Alphabet's have been. You start to see now AMD and Broadcom and even Alphabet going after those 70% gross margin targets that NVIDIA has and everybody else covets. So I think you see in 2026, a differentiation amongst the leadership within the Magnificent Seven. And we continue to feel like the best opportunity to take advantage of what we continue to feel is a very positive environment for infrastructure build out into AI domestically is to play actually the raw infrastructure players. Whether it's the industrial companies that are helping to put together this, as well as utilities, energy, transportation. Those are areas where you can find much more attractive valuations and still benefit from this multi-year build-out for AI investments over the next few years.
James, thanks very much. Appreciate getting a few minutes of your time. James Abate, Managing Director and Head of Fundamental Strategies at Horizon Investments. Well, the M&A trade certainly of the week, certainly of the quarter, probably the year. At least it's getting really interesting here. Warner Brothers Discovery, we got an old-fashioned kind of fight over this company. Netflix on one side and Paramount Skydance on the other. Lots of billionaires, lots of Mideast money, lots of debt being thrown around here. So let's get the latest here. Geetha Ranganathan joins us. She is the media analyst for Bloomberg Intelligence. Geetha, when you talk to institutional investors out there, particularly the shareholders of Warner Brothers Discover, is there a preferred buyer out there between these two?
Really hard to say, Paul, at the moment. Netflix deal, obviously, I think it means a total valuation. So it's only for the streaming and studio assets, but I think it implies a slightly higher valuation than the $30 all-cash bid that Paramount is offering. We think that with the Netflix bid, Warner Brothers Discovery will be worth around $31 to $32 a share. But you could argue on the flip side that the Paramount deal actually offers you, first of all, it's a full cash bid. So there's a lot more certainty there. There is also potentially more regulatory certainty, and they are promising that the speed to close the transaction will be actually faster than a Netflix deal. So it's really kind of going to come down to, do investors value the certainty that is offered by Paramount? It's also for the full company. With the Netflix deal, you still kind of have a little bit of uncertainty because you don't know where the TV networks business, Discovery Global, the stuff is going to trade ultimately. So they really have to kind of weigh all pros and cons, but it's a very, very difficult decision.
Would it be an easier decision if Paramount Skydance raised its bid even more beyond that $30 a share offer? Because there were regulatory filings, according to Bloomberg reporting, that show Paramount Skydance bankers told Warner Brothers bankers that $30 a share is not their best and final offer.
Yeah, I think that's exactly right, Scarlett, and that is pretty much David Ellison leaving the door open for Paramount to raise that bid a little bit. We've run some math. We think that Paramount can easily support a bid of up to about $35 per share for Warner Brothers Discovery, just given the synergies that they could potentially extract from this transaction. So they themselves have outlined about $6 billion in synergies in the case of a potential deal. Remember, this is for all of Warner Brothers Discovery, so there's obviously a lot more savings that can be gotten out, just given that the TV networks are also involved here. So I absolutely think that, yes, the decision will become much, much easier if they do raise their price. But I think $30 itself is pretty attractive. It depends on, the investor standpoint, and do they want the money right now? A bird in hand is better than two in the bush kind of situation.
What's the timetable for Warner Brothers to respond here to this Paramount deal and maybe even to the original Netflix deal?
So Warner Brothers Discovery has 10 days to respond starting yesterday. The tender offer itself, the $30 all-cash tender offer, expires on January 8th. So, you know, they have to obviously act quickly, but right now the way that the tender works is any Warner Brothers Discovery shareholder can obviously tender their shareholding. And I think that what Paramount is looking for is really to kind of build a position here. So obviously, if they get 51% of those outstanding shares, they've pretty much won the war here.
Geetha, why does Paramount Skydance want the old school cable networks, the TNT, CNN, Discovery channels that Netflix doesn't want?
So Netflix is a pure streamer. They have absolutely, I mean, this is the business that they disrupted, Scarlett. They disrupted the original TV model. They have absolutely no exposure there. They're a pure play streaming business, and they really are looking to both beef their current streaming service as well as to get access to a studio, get access to all of that IP that Warner Brothers offers. You know, you think of some of the most beloved franchises across the world, including DC Comics or Friends or Sopranos or what have you. That's really what they're looking for. Paramount, on the other hand, has a business that is very, very complementary, very similar to Warner Brothers Discovery because it has exposure to the TV networks. It also has a studio, and it also has a streaming platform. However, all of the Paramount Networks businesses are somewhat subscale. And getting, Warner Brothers really kind of transforms the business from a financial perspective, from a strategic perspective.
Geetha, some are suggesting that Warner Brothers Discover represents a must-have for Paramount, but a nice-to-have for Netflix. Do you agree with that?
I do absolutely agree with that. I mean, investors have kind of really been scratching their head, Paul, about why Netflix wants to go after a business that it disrupted in the first place. I mean, we've come here full circle, Paul. You might remember that Jeff Bewkes back in the day had referred to Netflix as the Albanian army. And here you have the Albanian army basically going back and buying Warner. It makes no sense to some, while others obviously argue that they're really buying content. But at the same time, it also suggests something about Netflix. Does this mean that their engagement is actually slowing? Is this an offensive move for Netflix? Is it a defensive move? I mean, a lot of questions still remain unanswered. For Paramount, of course, I mean, they really have no path forward here unless they scale up. Just given the amount of legacy exposure that they have, it is a must-have. There is no doubt about it.
All right, very good. Geetha Ranganathan, she is the media analyst for Bloomberg Intelligence, getting the latest there. I was listening to a call from Jason Bazinet, the media analyst at Citi, and he said, they really do need it. He thinks they need the content. He says, where Netflix does, because where they're driving subscriber growth has been in international markets. So take, for his example was, they create a show in Polish for the Polish market. Does great, drive subscriber growth there. But that's it. That show doesn't play in Brazil. And so their cost of programming on a per subscriber basis is too high.
Yeah.
And so if you buy this content from Warner Brothers, you can monetize that over the globe.
Yeah, people just want to watch Friends over and over and over again.
Exactly. And he says that would bring down their cost of programming relative to their peers. And that is one long-term strategic value that he feels like the Street may not be fully understanding at this stage, because this Netflix story has been a good story. So we'll see how it plays out. This is Bloomberg.
markets, headlines, and breaking news 24 hours a day at Bloomberg.com, Bloomberg Television, and the Bloomberg Business app. This is a Bloomberg Business Flash.
From the Bloomberg Interactive Broker Studio, I'm Lisa Mateo. We've got little movement in stocks. This is after more eco data was released before the Fed makes that final decision on interest rates this week. There were 7.67 million job openings in October. Estimates were for 7.12 million. Money markets holding steady, seeing a little more than 2 cuts in 2026 after a likely 25 basis point reduction tomorrow. We shall see. Let's go to S&P 500. Little change, up about 4 points. The level, though, 6,850. The Dow up 0.1%. 84 points. We have the NASDAQ, little change, down about 10. The 2-year yield, 3.60%. That's up 2 basis points. The yield on the 10-year, 4.18%, and that's up about 1 basis point. To currencies, the Bloomberg Dollar Spot Index is little change. The Japanese yen weakening by 0.5% at 156.80 against the dollar. Over to Bitcoin, it's up about nearly 0.5% at just above 91,000. Over to company news, we're starting with PepsiCo. They're saying they're going to lower some food prices, reduce costs, including layoffs, while cutting the number of individual products by 20% across its U.S. businesses. It's part of this agreement with activist investor Elliott Investment Management. PepsiCo shares are down about 0.5%. Ford and Renault, they're teaming up to make affordable EVs in Europe, as both coming under a lot of rising pressure from Chinese manufacturers. First vehicle expected to reach showrooms early 2028. And we take you from cars to planes. The FAA says Airbus A320 operators, they have to do extra checks of door fasteners to check for possible cracks. Shares are down more than 1% in Paris. And finally, CVS shares are up about 3% after the company raised its full-year profit forecast and said earnings would rise in 2026. For on-demand news 24 hours a day, subscribe to Bloomberg News Now, wherever you get your podcasts. I'm Lisa Mateo. That is a Bloomberg Business Flash. Scarlett and Paul.
All right, Scarlett Fu, thank you. Lisa Mateo, thank you very much.
You were looking at me.
I'm
when
looking
you,
at you.
Yeah, I got it.
I got Matt Miller bugging me here on IB. I got all kinds of things going on there.
He's supposed to be on air. What is he bugging me for?
I don't know. Lisa Mateo, thank you. That's great. We got Scarlett Fu. We got Paul Sweeney. We're here. Bloomberg Interactive Broker Studio. We're doing that thing again. We're streaming on the YouTube thing, so you can go there and find us there. All right, here are the functions I'm going to be using tomorrow on Fed Day. I got Fed Go, gives me kind of all the data I need all on one screen. Got WIRP, W-I-R-P, kind of tells you what the market's thinking about rate cuts going forward. And then I've got DOTS Go, dots, kind of plots out where the FOMC folks are with the dots in their forecast. So those 3 functions, I should be in pretty good shape. Ira Jersey, he's got it all in his head. He's the chief U.S. interest rate strategist for Bloomberg Intelligence. Ira, what are you going to be looking for tomorrow?
So I actually think it's the last thing you mentioned, Paul. It's the dots and then the rest of the summary of economic projections. So where do these members of the Federal Reserve see the economy going? Where do they see unemployment and the like? You know, you mentioned the JOLTS numbers that we got barely half an hour ago, and they were certainly better than expected, but they still don't point to necessarily significant hiring, but there's also not a lot of firing going on either. So you kind of have a treading water for the job market. And does the Fed see that being a little bit weaker? And if so, does that mean that they're going to cut more than maybe the dot plot currently shows? So I think that's going to be more market moving tomorrow than the actual rate cut, which, as you mentioned, is basically fully priced.
Basically fully priced. And this idea that the Fed has been on this rate cut campaign since September 2024, albeit with a big pause in between, we've still seen bond yields higher even as the Fed has been cutting rates. And I'm curious to get your take on why you think that's been happening.
Well, I think the long end is higher because the economy is not terrible, right? Like what the Fed's trying to do, and at least my read of it is they're trying to balance the economy out. Where yes, the economy's okay, so then some people say, well, then why are they cutting interest rates? Well, they're cutting interest rates because they're worried that the economy might slow if they don't cut interest rates, right? So it's one of these chicken and egg things where they're trying to get in front of economic weakness. So the long end of the curve is going to be more reflective of the overall economy and in the kind of the medium term. So when you think about 10-year yields, why are they at 4.15%? Well, they're there because the market sees the Fed cutting to 3%, and that's what's priced, right? Another 2 rate cuts after tomorrow, and then eventually the Federal Reserve starting to increase interest rates. So the 10-year yield, 4% plus or minus a few basis points, is about fair value given that potential outcome for the economy. If the market's wrong, I suspect that it's wrong and the economy is going to be somewhat weaker, and that means, yes, maybe 10 years can get down below 4% once again on a more sustained basis. But I think that would require a repricing of the Fed expectations for maybe another 100 basis points of cuts next year, not only the 50 that are currently priced.
Again, I'm looking at Fed Go here, everything you need to know about the Fed and kind of how it does its job. And I say I've got a couple of functions I rely upon. There's like 25 functions on this Fed Go page for help people kind of figure it all out. I know 2, which is pretty representative of my knowledge.
But it's the 2 that you use, so it's all good.
It's the 2 that I use, yeah. So we'll figure it out. Ira, listening to people like you, you've educated me that now I know the Fed's got a dual mandate, price stability, full employment. Are either one of those taking precedence these days, or is it still pretty even, do you think?
Good question.
Well, the reason that they cut in September was they did switch to a more employment-focused worry here, right? So yes, they have this dual mandate, but one of those mandates usually takes precedence over the other if the situation demands it in their mind. So, I think that they think that the inflation is going to continue to come down over time, that tariffs aren't as big of a deal in the overall economy, and we agree with that. We've done a lot of work on, exactly how much imports should affect, and the tariffs on these imports should actually affect headline prices, and it's not as much as people think, mainly because most of consumption in the U.S. is actually service-based. So while some of these service-based companies might import some goods or equipment or materials that they need to do their jobs for the consumer, automobile fleets and things like that, they're not going to be able to pass through 100% of those tariffs. So there's a profitability story, there's a hiring story involved with tariffs and everything else. So I suspect that you'll see inflation kind of hovering around, maybe not quite at their 2% target, but somewhere closer to 2.5% on the PCE deflator. But that's fine for the Fed. They just don't want to see it climbing. They basically made a mistake, I think, in the way that they've been communicating their 2% target. Why do we have a hard 2% target? If we're at 2.5% and we'll be at 2.5% forever, the market and the economy will learn to live with that. It's not a big deal.
Maybe they should change it to just 2-ish. Real specific. Ira, there was a Bloomberg News report today that mentioned Christina Hooper, the chief market strategist at Man Group.
You know her.
Yeah, the biggest publicly traded hedge fund group, saying that the Fed may need to turn to QE to lower long-term rates if markets start to question the independence of the next Fed chair. And she cites the trust moment in the UK in 2022 as an example. I know the US and the UK are 2 very different markets, but what do you think of that prognostication?
Well, I think if you really had long-term bond yields start to rise significantly, because that would probably because the market thinks that the Fed cut rates too much and that there was going to be an inflationary impulse. I think the bigger thing, the Liz Truss type moment was more fiscal, right? So that has more to do with what are deficits, are there going to be a lot of long-term bond yields, more long-term bonds being issued. So I don't think that the Fed is going to do QE. Now, they are going to do these reserve management purchases, which some people are going to call QE. They're not. I need the next 5 minutes to explain why. But at the end of the day, they are going to be expanding their balance sheet. But they're going to do that by buying T-bills, not by buying 30-year bonds, right? So they want to buy T-bills because they only own about 5% of their portfolio right now is in T-bills. They want their Treasury portfolio to look like the market, and the market has 23% of Treasuries outstanding are T-bills. So they have to buy a whole lot of T-bills to get up to what the current outstanding Treasury market is. So when they do these reserve management purchases, which we think will start sometime toward the middle of next year, they're going to be buying T-bills more than likely. Plus, they're already buying a lot of T-bills with the runoff of their mortgage portfolio as they reinvest and try to keep their balance sheet more or less constant at the moment.
Ira, thanks so much. Appreciate it. Ira Jersey, Chief U.S. Interest Rate Strategist for Bloomberg Intelligence. Red headline crossing the Bloomberg terminal here. Spot silver tops record $60 an ounce as traders bet on lower rates. You know that silver has more than doubled this year? It's up 107% year to date.
Industrial metal and precious metal.
It's unbelievable. I mean, gold up 60%, 60%. Silver up 107%. How about that? This is Bloomberg. Good morning.
This is Bloomberg Intelligence with Scarlett Fu and Paul Sweeney on Bloomberg Radio.
This is Bloomberg Intelligence with Paul Sweeney and Scarlett Fu. We're streaming live on YouTube, and we were just reminiscing about how much we loved Campbell's soup when we were younger.
Yes.
It was like the first thing I learned how to make on my own. I mean, after I understood that you had to open up the can.
Yes.
But, you know.
And that was the hardest part.
It was, yeah, because can openers were a lot different back then. In any case, we want to talk about Campbell's because the stock is down about 4% right now after the company came out with its fiscal first quarter earnings. Both the top line and the bottom line beat analyst estimates, but the direction of travel for revenue and profit is still lower. Let's bring in Diana Rosera Pena. She is Bloomberg Intelligence consumer staples analyst on the latest on Campbell's and, of course, the packaged foods industry overall. So Campbell's has two businesses, the snacks business and the meals and beverages portfolio. How are the two businesses doing, Diana?
Well, there are puts and takes on both of them. You know, for meals and beverages, there's some headwinds on ready-to-serve soup, whereas broth and condensed soup, which is usually used in cooking, is improving. You know, you have V8, which is not really, it's a brand that is not really doing that well.
I love V8.
You do well.
To me, that's like my healthy eating for the day. When I drink the little one in the morning.
So when you're on a plane, you'll get a V8 and you're like,
Sure,
I'm good.
I'm good.
And
I'm good.
that's
No need
your
to work
veggies.
out. No need to go to the gym. I'm good.
Exactly. So, but it's still facing some headwinds for snacks. It's in kind of, I found it odd because there seems to be a bifurcation of the consumer trends here. You have salty snacks being, challenged by people trying to eat healthier, reducing their sodium, but then you have cookies outperforming. So I guess it's the salad with the fries.
All right.
Which I love, by the way.
Yes.
Yeah, absolutely. Campbell's agreed to take a 49% stake in La Regina. What is La Regina? What's Campbell's trying to do here?
Yeah, so that is the supplier for Rao's,
Nice.
which they bought it a year or so ago. And that it makes it kind of like have a little bit more control on the supply side. There has been some headwinds on this brand because tomatoes are being exported or imported to the United States, so they have to face some tariffs. So, with this, they're trying to not only offset tariffs, but have a little bit more on the supply chain, have a little bit more control on that.
Here's my Rao's story. I mean, for people who aren't in New York City, it's a very famous restaurant in New York. It's very difficult to get a table there, to get a reservation. On my 30 years of Wall Street, I've asked people to take me, who I know go there, to take me. I haven't gone once.
Really?
Yeah, I mean, it is impossible. Like, I never ask people to take me out on their great golf course. I just wait for the invite to come. But for Rao's, I've actively tried to get.
And haven't gotten
struck
any.
out. That's
So
how
anyone
tough
who
it
has
is.
an invite into Rao's, let Paul Sweeney know.
Exactly.
I did actually get to eat there. We ordered takeout during the pandemic when they were doing takeout. Yeah, so that was my one time I got to eat Rao's.
Very good.
But Diana, I want to ask you about, of course, the controversy that surrounded Campbell's just last month. There was an executive, he was the vice president of the IT department, who talked about how the company's products are being made for poor people, and had some disparaging remarks about some of the employees, the Indian employees. Is that something that's going to cast a pall over Campbell's? I mean, do you see any long-term effects from that?
Well, usually they did not address that during the call, but I think it might be a short-term headwind if there's any boycott happening. I don't necessarily think that there's going to be one. It's just one executive, and the company went ahead and kind of tried to put on record that they're not necessarily agreeing with what he said. So I don't necessarily see that as a significant headwind for the company.
Packaged goods companies, I kind of think of them kind of a GDP top-line growth story at best. What's the 2026 outlook for your companies? What are investors looking for?
So for 2026, they're hoping that there's some light at the end of the tunnel in terms of volume growth. Again, it might be a second half of the year story because comps get a lot easier going forward. But, profitability seems to be a little bit more difficult because they have tariffs. They have to contend. Costs still are a little bit higher, specifically on the employee side. And there's also marketing that they have to do because they want to spur growth. And pricing is not necessarily the only lever that they have to.
But I think about Campbell's and other packaged foods companies and how much competition they must face from private label products. I go to the supermarket, I'm going to get the chicken broth that's cheapest, and it's usually the one sold by the supermarket and not Campbell's or anyone else's. So and for private label, you don't need to do any marketing.
Exactly.
So how do they counter that?
Well, more marketing.
More marketing.
They're trying to
Really?
work with the retailers to position themselves in the best part of the shelf to be able to
Feels like a losing
move their
battle.
product. Yeah, well, obviously retailers have to contend with increasing their private label penetration and at the same time have a good relationship with this national brand. So they're not necessarily want them to go against these products. So they're trying to. There's some negotiations happening, and usually when I speak to retailers, because I do cover Canadian retailers, they mentioned that they tried to expand their private label into white spaces, not necessarily served by national brands. So you might see some condensed soup private label, it's not as intricate or as better quality than probably Campbell's.
All right, I shop at the ShopRite, Belmar, New Jersey. The store brand there is awesome. So and it's a great store, by the way. Great lighting, great
See,
people.
there you go. Paul
so
Sweeney,
that's kind of,
customer
the
number
people
one.
are awesome there. That's a key thing. Lots of good staff there. Diana Rosetta Pena, Consumer Staples Analyst for Bloomberg Intelligence. For our listeners in the U.S., a reminder, you can listen to us via satellite radio on Sirius XM Channel 121. Access the world's only global audio business network, coast to coast, 24 hours a day. Bloomberg Radio on Sirius XM Channel 121 is presented by Golden Crest Metals. Stay tuned for the latest market news and industry research. The next hour of Bloomberg Intelligence starts right now.
This is Bloomberg Intelligence with Scarlett Fu and Paul Sweeney.
How do you think the Fed is looking at tariffs, the uncertainty of tariffs?
Let's take a look at the sectors and how they performed.
A lot of investors getting whipsawed every day by news events.
Breaking market headlines and corporate news from across the globe.
Could we see a market disruption, a market event?
Are people just too exuberant out there?
You see some so-called low-quality stocks driving this short-term rally.
Bloomberg Intelligence with Scarlett Fu and Paul Sweeney on Bloomberg Radio, YouTube, and Bloomberg Originals.
Good Tuesday morning, and by the way, it's the first day of the FOMC gathering. We'll get the decision tomorrow at 2 p.m. A lot happening here at the Bloomberg Interactive Brokers Studio in Midtown Manhattan. We've got a full hour ahead for you. We're going to start with Jonathan Palmer. He's the Senior Equity Research Analyst at Bloomberg Intelligence, talking about CVS forecasts. It's a 2026 revenue outlook that does miss the average analyst estimate. Vincent Piazza is our Senior Equity Research Analyst on oil and gas. He's going to talk to us about Exxon boosting its long-term cash flow forecast 2030, and it's on a combination of cost cuts and more productivity out of its existing assets. After that, Jeffrey Cleveland, the chief economist at Payton & Rygel, will be discussing his outlook for the U.S. economy. And Laura Martin, this is a conversation Paul Sweeney has been looking forward to all week. She's a senior analyst at Needham & Company, and she's going to give us her take on Warner Brothers Discovery. She says Netflix is better off on its own.
She is, and there's some folks out there that think that that the Netflix story is good as it's great the way it is right now. Don't muddy it up.
Yeah,
so.
don't bring in some legacy assets.
Right.
All right, we're going to get into all of that in a little bit. But for now, let's go to Charlie Pellet for our Bloomberg Business Flash.
Hi, thank you very much, Scarlett Fu. Right now, we got Netflix shares. They are trading lower, down by about 0.8%. Warner Brothers Discovery continues to advance, up now by about 1.3%. If we're talking those two, cannot ignore Paramount Skydance, retreating today, down by 3.1%. Bottom line here, stocks struggling to make headway, but we are higher ahead of the Fed decision tomorrow, 2 o'clock Wall Street time, when it all comes down. 30 minutes later, yes, we got the press conference, the news conference from Fed Chair Jay Powell on Bloomberg Radio and Television. Equities, though, right now higher. S&P up 12 at 68.58. That is a gain of 0.2%. Your Dow Industrials up 135, up 0.3. NASDAQ up by 0.2%. And the Bloomberg Mag 7 index climbing by 0.3%. The 10-year at 4.17%, with the 2-year currently yielding 3.60%. Gold at 42.16 the ounce. It is up 0.6%. Silver right now 60.44. Right now silver up by 4%. West Texas Intermediate crude down 0.8%, 58.38 a barrel. And Bitcoin now up 2%, 93,243 on Bitcoin. David Bahnsen is Chief Investment Officer at the Bahnsen Group, and on Bloomberg Surveillance this morning, he told us he likes artificial intelligence, but cautions you got to be selective.
This AI story is a real story. It's very compelling. It's going to be a transformative revolution in American economic life, but that doesn't mean that everybody is playing it in an investably sensible way. Valuations, the just sort of euphoria concerns me, and I want people to be careful.
David Bahnsen of the Bahnsen Group. Now, speaking of AI, number of companies making news this morning. Microsoft pledging to invest $17.5 billion on AI and cloud computing in India. Alphabet's Google has been hit by an EU investigation over fears it may have abused its dominance by using its own AI tools to squeeze out competition. And Wells Fargo CEO Charlie Scharf says artificial intelligence poses a significant opportunity to to improve efficiencies and has the potential to influence companies' headcount decisions. Again, recapping here, U.S. equities, they are advancing. S&P up 10, up by about 0.1%. Bitcoin up 1.9%. Silver, do not want to ignore the move there, up by 3.9%. For on-demand news, 24 hours a day, subscribe to Bloomberg News Now wherever you get your podcast. I'm Charlie Pellet, and that is a Bloomberg Business Flash.
All right, Charlie Pellet, thank you so much. We appreciate the market turning higher. Let's take a look at some of the stocks on the move today. I'm Paul Sweeney alongside Scarlett Fu. We're joined by Bloomberg's Denitsa Sakova. Denitsa, what are you looking at?
Let's start with CVS. CVS is up about 3% after the company raised its full-year profit forecast and said earnings would rise in 2026. The numbers are pretty strong. Adjusted earnings would be as much as $7.20. This is higher than what the street was expecting. The company also said it expects a profit this year of about $6.60. This is a 5-cent increase from its previous forecast. Overall, the outlook suggests that CVS is navigating a pretty tough environment very well. The company is actually up more than 70% year to date. It has a new CEO that came in October 2024, so we're seeing quite a turnaround there. Of course, the pressures are still there. Health insurance plans are facing greater government scrutiny. Drug benefit managers are changing their business practices, so there are so many things that the company had to struggle this year, but very strong day today and off to ending a pretty strong 2025.
All right, we're going to talk to Jonathan Palmer, the Bloomberg Intelligence analyst, in just a moment. Get the lowdown there. What's next?
Let's look at Pepsi. The company is actually down about 1% today. The ticker is PEP. It's coming off that agreement with activist Elliott Investment Manager. So two big changes. They're reducing their lineup by 20%, lowering prices, and then there are also some language about them pairing its workforce. Pepsi has been down this year. There are so many trends that the company is in the middle of. There is softening consumer demand, rising costs, tariff, shaking investor confidence. So there are many different forces weighing on the company. Even this move to cut costs is not helping. It's part of an early agreement with Elliott, which we remember, it's built up a $5 billion stake earlier in this year. It's been working on all those changes, but so far we're not seeing a very optimistic reaction. Pepsi has been trying to go into more fiber, protein, healthy drinks. Obviously, consumers have been turning to more healthier options, and Pepsi has been trying to catch up. But so far, the stock has been struggling this year.
Yeah, we see it lower at the moment. All right, last one.
Quick index effect. ARIS Management surged as much as 9.4% on the news of it's going to be included in the S&P 500. Ticker is ARES. The stock is up about 8% now. The company will replace Kellanova, which owns Pringles, Cheez-It, and all that. Interesting analysis from Bloomberg Intelligence. ARIS addition to the S&P will boost the passive ownership toward high teens. Currently, it's 15%. We all know this is very important, and clearly investors are excited about the increased passive ownership. ARIS is really big. It has a market capitalization of $54 billion. There are very few companies with that size that are not part of the S&P 500, but clearly the company is joining now. And there is a big gap between other private equity and private credit managers, and ARIS is definitely jumping higher on the news and almost turning positive so far this year.
All right, Denitsa, thanks so much. Appreciate that. Denitsa Sakova, she covers all the equity markets for Bloomberg News. For more conversations like this, subscribe to our Stock Movers Reports. Listen for 5-minute audio reports on the biggest winners and losers in the stock market. Subscribe to Stock Movers on Apple's podcast, Spotify, or anywhere else you listen. Again, here's another name I missed. CVS Health Corp. Who cares about this? Stock's up 76% year to date. Again, where was Jonathan Palmer when I needed him? Jonathan Palmer, senior healthcare analyst for Bloomberg Intelligence, joining us here via Zoom. Jonathan, I know this company just had an investor day. They just reported some pretty solid numbers. Just remind everybody what CVS Healthcare Corporation is and kind of what's been driving the stock higher.
Sure, Paul. So actually, their investor day is ongoing as we speak. Traditionally, people think of CVS as this pharmacy, but about let's see, I guess it's 8 years ago now, they bought Aetna to go into insurance, and they have kind of three legs to the stool. They have the retail pharmacy, they have an insurer, Aetna, and they have what's called a PBM, which is Caremark. And so the stock really didn't meet expectations for the first couple of years after that Aetna transaction. And there's been a load of pressure in their Medicare Advantage business. They're a big player there with other folks like Humana and United Healthcare. And that led to a changing of the guard. So last year, the CEO that was there, Karen Lynch, resigned or was pushed out, depending on how you want to look at it. And executive by the name of David Joyner, who ran the PBM for a number of years, took over, came back to the company, and has kind of hit the 1 year mark in this turnaround story. And so what's happened is the company really saw a lot of headwinds in that Medicare business, did a total reset of expectations, and now has slowly been building back trust that they can, return that business to profitability and grow it again over the next few years. And you see the stock's up a few points today on that message.
So is the idea of a vertically integrated healthcare giant that CVS is, and for a while was trying to convince investors is a good bet, is that a good business model, or is CVS just lucky in being able to turn things around at the moment?
Well, I think it's a combination of a couple things. They were clearly following their peer United Healthcare, who's a vertically integrated entity. And we saw their other big competitor, Cigna, follow suit with some vertical integration, marrying an insurer and a PBM together. But what we've seen with CVS is that, they had this vision of this vertically integrated enterprise, and it never really came to fruition. And there was the struggles around retail, there were struggles in pharmacy and the PBM, but a lot of those headwinds have now actually cleared, and we're seeing an improvement, across the board in how the company's kind of delivering operating profit. And it looks like the worst is cleared, so to speak, for the company.
There was talk a while ago of a potential breakup of CVS. You talked about the three legs of the stool, maybe breaking up that business overall. Is that still on the table at all?
Well, I don't think there's a high probability of that happening. I mean, once these businesses are put together, it's kind of hard to break them back apart again. I think we were thinking that maybe they would spin out their retail pharmacy. I mean, that's been under pressure for, the better part of a decade, with Amazon coming in and a lot of the shifts to online ordering, which have really impacted how consumers buy products outside of the pharmacy, the retail products, the shampoo, razor blades, those sorts of things, candy, whatever it might be. As we sit here today listening to the CEO and his message on where they're going from here, they really see that pharmacy as a cornerstone asset for them going forward. So I think they're all in again, if you will, on this vertically integrated strategy.
All right, Jonathan, thank you so much on that. Jonathan Palmer, he's a senior healthcare analyst for Bloomberg Intelligence, talking about some of those healthcare stocks there in CVS Health having their investor day today. Investors like what they hear. They put out some decent numbers, so stock moving higher today. Interesting story out in the energy space today. Exxon's out there. They're saying they're boosting their 2030 cash flow forecast, I guess, on the Permian Basin, Guyana, and liquefied natural gas. Looking at the stock, ExxonMobil's up about 3 percentage points today, up about 11% year to date. And I got WTI crude oil at $58 a barrel. I know they'd like it to be higher. How do I know that? Because I watch Landman, and they tell me. They tell me all about the oil and gas business.
They're using that as the benchmark.
So I'm an expert on all things oil and gas, thanks to Landman.
Thanks to Billy
But the
Bob
real
Thornton.
expert is Vince Piazza, Bloomberg Intelligence. He covers these big oil companies. Talk to us, Vince, about Exxon. What's the story there? And talk to us about kind of their growth outlook.
You must really be the expert because you stole all my thunder.
See?
Repeat after me, man. It's Permian, Guyana, and LNG. When we think about Exxon, or when we think about the integrateds, we think about these entities with vast value chain businesses across the globe. But for Exxon, over the next, call it 5 years or so, the story is going to be about the upstream components, and specifically the Permian Basin, Guyana, and LNG. Those three projects, those three critical projects are going to account for roughly 65% of their production. through 2030. But the most important piece, Paul, is the Permian Basin. Of the 5.5 million barrels a day that they're going to pump out by 2030, roughly 2.5 is going to come from the Permian Basin. So the Permian remains a critical asset for them, and that critical asset was acquired via the Pioneer acquisition, which they continue to generate sizable synergies from. They upped the estimates on the efficiencies and productivity there. They also picked up other assets over the years, but the Permian Basin has slowly become a critical asset for them. And we know Guyana has been in the conversation for some time now.
Right.
That is probably their second most important piece outside of the Permian, but the Permian is going to be that one asset that continues to generate significant cash flow for them to maintain that financial flexibility.
So Vince, what we know about the Permian Basin and Guyana is that they're both profitable at under $35 a barrel. Paul was talking about what price line? 60?
I like 75.
Okay, 75. But in any case, $35 a barrel means there's a lot of room for upside there. And a lot of what ExxonMobil is able to do is because of technology advancements in the Permian Basin, it's been able to be more productive. What is that technology advancement?
The technology advancement has been what we've talked about for several years now, and that is doing more with less. We first established the unconventional drilling in the Barnett Shale, and that was exported to other basins. The Permian has been around for over a century, and we continue to deploy these unconventional fracking technologies to produce more from those same basins, from those same layers. Think of it as a layer cake, cutting through those layers and going horizontal and gaining the extra molecules from that same base of land mass. And I think that is critical. Again, the Permian has been around for over 100 years and continue to find ways to extract more. That's why concentration, this idea that we've talked about, concentrating in specific basins is so important to us. So it's concentration versus diversification. Concentration wins out. That's why Guyana is so important. That's why you saw Exxon and Chevron battling it out over the Hess asset. So those three pieces, the Permian, Guyana, and the LNG component, which just launched as well, are going to be the keys for that growth, aside from everything else. The downstream business continues to have its challenges. Obviously, the chemicals business is what it is. The upstream business is going to be the main driver of the Exxon story through 2030. And what that also offers is an opportunity for inorganic growth as well. I don't really think they're done. They generate significant free cash flow. Right. They're going to buy back stock, $20 billion a year. That's fine. But there's also opportunities to continue to consolidate within the broader U.S.
Okay. All right, Vince, great overview there. Vince Piazza, Senior Equity Research Analyst. He covers all the oil and gas companies for Bloomberg Intelligence. I tell you, watching Landman, again, I'm into season 2. Two things I've learned about working in the oil patch. A, it is really hard work. Those people down there, it is crazy hard work. And
like work your fingers to the bone hard work.
Yeah, and like lifting stuff and chains and I don't know, hard work. And two, it's very dangerous. I mean, wow. I mean,
did Billy Bob Thornton almost die?
Well, a lot of people have died on the show.
Okay, yeah, I didn't know this.
I mean, anytime you're working around oil and gas, that stuff tends to blow up, I guess.
Right.
So you got to be really careful. And the gas, there's some toxic gases. I don't know.
Do they talk about cost savings? Because that's a big theme for Exxon, at least.
They tangentially talk about we're more disciplined than in the old days where if we, oil hits $80, we drill, baby, drill, and then it would knock down the prices. Mike McGlone tells us the cure for higher prices is higher prices. So there you go. I'm learning all about the oil and gas business. S&P up 16 points and Dow up 160. We'll have more coming up. This is Bloomberg.
markets, headlines, and breaking news 24 hours a day at Bloomberg.com, Bloomberg Television, and the Bloomberg Business app. This is a Bloomberg Business Flash.
It's 11:21 on Wall Street. We check the markets all day long here at Bloomberg, and this Bloomberg Business Flash is brought to you by Golden Crest Metals. Inflation, tariffs, and volatility have some investors turning to gold for stability. To get a free gold and silver info guide and learn how to add metals to your IRA or 401k tax and penalty free, go to goldencrestmetals.com/guide, goldencrestmetals.com/guide. Stocks higher right now. The Dow, the S&P, NASDAQ, all advancing ahead of the Fed's interest rate decision tomorrow. It is the final decision of 2025. It drops at 2 p.m. Wall Street time. We'll have Jay Powell's news conference and Michael McKee's question beginning at 2:30 Wall Street time. The Dow, the S&P, NASDAQ higher. S&P up 17, up by about 0.2%. We've got the Dow now up 170, up by 0.3%. NASDAQ up 27. That is a gain of 0.1%. The 10-year at 4.17%, with the 2-year 3.60%. Gold now higher by $20 the ounce, $42.11, up 0.5%. Silver surging 3.4% at $60.13 the ounce. West Texas Intermediate crude $58.24 a barrel, down 1.1%, and Bitcoin up 2.3%, 93,480 on Bitcoin. Briefly, a new way to use Uber. Uber Technologies introducing a way for some people to use its ride-hailing service without the company's signature app. The rideshare giant plans to install physical kiosks at places like airports, starting with LaGuardia in New York. Uber right now down 2.3%. Rival Lyft, also based in San Francisco, down 0.9%. For on-demand news 24 hours a day, subscribe to Bloomberg News Now wherever you get your podcasts. I'm Charlie Pellet. That is a Bloomberg Business Flash.
Thank you so much, Charlie Pellet. This is Bloomberg Intelligence. Paul Sweeney and Scarlett Fu live from the Bloomberg Interactive Brokers studio. And we did get some economic data this morning on day one of the Fed's meeting. We learned that U.S. job openings rose to a 5-month high, but layoffs are also higher as well. Jeffrey Cleveland is chief economist over at Payton and Regal. Regal. Okay, sorry. Regal, as in Regal Beagle. To give us his outlook for the U.S. economy. Jeffrey, excuse me. I knew that, but I just needed to be reminded. We had characterized, or I shouldn't say we, Fed Chair Jay Powell had characterized the economy as a low hire, low fire type of economy. What does today's data show about that perception? Is that the case?
Well, the JOLTS report is not our favorite report. You know, it's pretty volatile, notoriously so, and it comes out with a lag. So I think, you know, those caveats apply here. But I think I would note that layoffs, have picked up in the September and the October data. 1.85 million now. So it's probably the highest reading since 2023, I think, if I'm looking at the chart correctly. So we might be seeing, you know, that story is eroding. We were in a low hire. Now maybe the layoffs are picking up. I mean, that's one of the takeaways from this morning.
Jeffrey, what do you think the Fed is focusing more on? The labor market, inflation, or they kind of got both balls in the air there?
Well, both are problematic, you know, trying to get a sense for where things are at. But I do think, you know, people are still too probably fixated on the inflation story. We think that is a rear view mirror issue. And, you know, when we look at the drivers of inflation, we're optimistic that in 2026, inflation will move lower. So core inflation, it really has been stuck around 3% this year. That's true. But we think it can get back closer to 2%. By the end of next year. So, you know, Paul, we'll still have inflation. Sometimes people yell at me. They tell me that I'm saying that there'll be no inflation. No, there will be inflation, but we're optimistic that we can be around 2%, which is the Fed's target. And if that's true, then that's great news for the Fed. They can focus more on the downside risks to the labor market, which I think are present.
Jeffrey, when you look at all the data that's been coming out, we've been getting a lot of data recently because the government is back to business and there was a lot of stuff that was put on hold during the shutdown. Is any of it helpful at this point, even if it's stale? Does it tell you anything that you didn't already know?
We've had a lot of data that's still come out even in the shutdown, and I do think when you look at all of it, you take it all in, it shows that the labor market has weakened, on the margin. So a weaker labor market. We're now at 4.4% on the unemployment rate, which is where the FOMC median policymaker thought we would be next year at the end of 2026. So I think the labor market is weaker. That's pretty clear from the data. In terms of where markets are going to go next year, is probably the data that's coming out right now is not that important. So September or October data. What we have to do is almost a creative thinking exercise and think about what could play out in 2026. And we do think lower inflation might be the key, maybe surprise, the key story that a lot of people just aren't paying attention to yet.
DOTS, dots go, one of my faves. We're going to get some dots tomorrow, Jeffrey. What are you looking for?
Well, there's so much happening. There's so many interesting things. I mean, first and foremost, where's the median dot for 2026? Where do policymakers think that the Fed funds rate will be at the end of next year? But I also think we like to look at, we call it the neutral dot, would be the longer term dot. The median has been around 3% for a while. It doesn't take much, though, for that dot, Paul, to creep up. I think you really need one person to move from a 3% neutral or below a little bit higher. And then the long-term neutral rate could creep up. Why does that matter? You might be thinking, well, who cares? For bond people, for ourselves, it matters because it suggests that the current setting, the Fed funds rate is not as restrictive if your neutral rate is a little bit higher. So, that's something that I think the bond market will key in on tomorrow.
All right, Jeffrey, thank you so much. Jeffrey Cleveland is chief economist at Payton & Regal to discuss his U.S. economy outlook and, of course, give us a preview of what he expects from the Federal Reserve, which is meeting today, and will conclude with its 2 p.m. announcement and 2:30 p.m. press conference, which should be very interesting.
Yep.
Reading the body language of
Mike
Jay
McKee would be down there.
Yes, and of course, we'll bring you live coverage here on Bloomberg Radio and Bloomberg Television and available on our streaming platforms. All right, let's move on here and talk a little bit about Home Depot. Home Depot, of course, did come out with the earnings a while ago, but they are giving a bigger long-term outlook here for its business. It's an investor day kind of outlook. And for that, we have Matthew Griffin. He's a Bloomberg stocks reporter to just talk us through some of the issues that Home Depot has faced. Because at the last earnings report, Home Depot made clear that the expected rebound in demand that it was looking for had not yet materialized. Is the tone changing here from Home Depot?
Well, Scarlett, I would say the tone really hasn't changed in a meaningful way. Everyone's trying to make sense of the economic moment that we're in. I mean, you were just talking about economic data that we got this morning that had some puts and takes in it when you look at job openings versus layoffs. And I would say that, like pretty much any economically sensitive company right now, Home Depot is facing some puts and takes as well. So they gave an outlook for comparable sales next year. Their preliminary view is they'll be flat to up 2%. That's lower than what Wall Street was looking for, but then they also gave this market recovery scenario where there's a bit more of a rebound in the U.S. housing market, more demand for home improvement, and in that scenario, comparable sales would beat estimates at up 4% to 5%. You zoom out and you've got a picture where mortgage rates have come down, but consumers are still under pressure, housing prices are still high, and so are rates, historically. And so you've got the consumer trying to muddle through, companies trying to make sense of it, and investors trying to make sense of it. You've got the stock down a little bit pre-market and now just about flat on the day.
470,000 employees at Home Depot. That is amazing. But I don't think I could get a job there because I really don't know a hammer from a screwdriver.
Okay, so back up a little bit because Paul's goal is to become a greeter at Walmart down the road.
Yes.
Like that's his dream job.
That's the final career path.
Final destination for Paul Sweeney.
So what are they saying about just the consumer behavior these days? I mean, interest rates are still high. Are people still working on their homes? The professional versus the private. What's going on with their core customer?
Yes. So we can actually look back to a few weeks ago when they reported earnings and actually cut their profit outlook for this year. What we saw then was a continuation of trends at the company, which is you have flagging demand for some of the bigger ticket home remodels. Again, because there's pressure on consumers, people are not taking on big projects that require financing. At the same time, they are shifting maybe into projects like gardening, smaller projects. So it's not that people don't want to do anything, it's that people are maybe doing the home remodeling equivalent of trading down here, which is a trend that we've seen in other corners of the economy. For example, Walmart's business holding up. You know, if you want that greeter job, it might be open for you because consumers are trading down. That's good for Walmart's business. It's good for a segment of Home Depot's business, but not enough to support the overall outlook so far. And if you look at the slides from their analyst day today, they see pressures continuing, including high home prices, and that's weighing on consumers here.
Yeah, the affordability crisis
Yep.
strikes again. So, Matthew, I'm looking at Lowe's shares, which are, of course, a competitor to Home Depot, down at the moment as Home Depot's basically unchanged. Do we presume that these same headwinds that are dogging Home Depot are the same that kind of are clouding the outlook for Lowe's, or does Lowe's have a different approach?
Interestingly, you know, they both serve similar corners of the market, home improvement. So far, it does seem like Lowe's has fared a little bit better this year, at least with how investors have viewed the way they've been managing through their shares, currently down about 2% on the year compared to down 10% for Home Depot. If you look at that reaction today, it's possible investors are thinking there could be some of the same headwinds in their future. But again, it does seem like they've gotten a little bit more of a pass so far.
How about tariffs here? What are the companies saying about tariffs and their ability to deal with them?
So far, the companies in their commentary have really focused on the state of the consumer rather than directly talking, or at least talking constantly about tariffs. I would say, though, that Home Depot did call out high building material costs as a reason that consumers are deferring home improvement projects. So, you know, you do think about tariffs on lumber, things like that. That doesn't help that side of the equation.
Matthew Griffin, graduate of Duke University. When did you graduate?
2022. Go Blue Devils.
Nice. Now, we are greatly outnumbered here in Bloomberg News. I mean, tons of Carolina people here, and there's a couple of reasons for it, I think. One, they have a really good journalism school.
There you go.
Okay. Two, Peter from Greenwich is a big Carolina, and I think there's something to do there, and that's just an internal call there. But we're doing our best to kind of.
What are you doing to recruit more Dukies over here?
I hired a bunch of BI back in the day.
Okay, so you played your part.
They loved me. Yeah, so I go back down there. They know that I can hire. I can't give the big money, but I can hire people, and that's even more valuable. So that's how I roll down there. Matthew Griffin, thanks so much. Appreciate it.
Thanks for
Matthew
having me.
Griffin, stocks reporter for Bloomberg News. Home Depot putting up some numbers. Looking at Home Depot versus Lowe's over the last 5 years for their stock prices. The S&P over the last 5 years is up 15% per year. Lowe's up 10%. And Home Depot up 8%.
I always felt Lowe's was friendlier for me as a female consumer.
Yeah, I just get overwhelmed when I go in there. There's so much stuff.
Lowe's or Home Depot? Or
Both of them. Both of them. There's just so much stuff, and like, gee, I need some lumber, I guess. This is Bloomberg.
markets, headlines, and breaking news 24 hours a day at Bloomberg.com, Bloomberg Television, and the Bloomberg Business app. This is a Bloomberg Business Flash.
It's 11:40 on Wall Street. We do check markets all day long here at Bloomberg. We have got the Dow, the S&P, NASDAQ. They're all advancing right now. All of this ahead of the Fed decision tomorrow, 2 o'clock Wall Street time. When it comes down, we got J. Powell's news conference at 2:30 Wall Street time here on Bloomberg Radio. Stocks higher. S&P right now up 13, up 0.2%. Dow Industrials up 134, up by 0.3. NASDAQ right now up by 0.1%. 10-year at 4.17%, with the 2-year currently yielding 3.60%. Gold is up $26 the ounce, 42.16, up 0.6%. Cannot ignore the surge in silver today, up 3.9%, 60.44 for an ounce of the silver metal. West Texas Intermediate crude oil down 1.1%, 58.20 a barrel on WTI, and Bitcoin right now up 2.9%. at 94,000 even right now on Bitcoin. Wall Street's looking ahead to tomorrow's Fed decision with the debate, jobs versus inflation. Jeffrey Cleveland is chief economist at Payden & Regal, and he was a guest moments ago right here on Bloomberg Intelligence.
People are still too probably fixated on the inflation story. We think that is a rear view mirror issue. And, when we look at the drivers of inflation, we're optimistic that in 2026, inflation will move lower. So core inflation, it really has been stuck around 3% this year. That's true. But we think it can get back closer to 2% by the end of next year.
Jeffrey Cleveland of Payden & Regal. Home Depot offering cautious preliminary guidance for next year, a sign that the home improvement retailer does not anticipate the housing market to rebound in the short term. Company expects comparable sales growth to be in a range of flat to up 2% for the year, below the average of estimates compiled by Bloomberg. Recapping, the Dow, the S&P, NASDAQ all higher. S&P up 12, up by 0.2%. I'm Charlie Pellet. That is a Bloomberg Business Flash.
All right, Charlie Pellet, thank you so much. We appreciate that. Scarlet Fu, Paul Sweeney. We're live here in our Bloomberg Interactive Broker Studio, and we're streaming live on YouTube as well. Boy, one of the big stories here over the last couple of weeks has been Warner Brothers Discovery putting itself up for sale. And there's not one bit of news. We've got Netflix, of course, and then Paramount is still very, very much in here. So we've got an old-fashioned kind of bidding war here. Our next guest, one of the most highly respected media analysts on Wall Street for a long time. And I think the value that I really find from her research consistently over the years is she is not afraid to be out of consensus here. And I think she's got a non-consensus call here that even if you don't agree with it, it makes analysts. Laura Martin Company. As it relates to Netflix, do you think they should even pursue this deal here?
Yeah, so we published a note this morning saying no, that the big Warner Brothers would create cultural problems at Netflix. Netflix has about 14,000 employees, and Warner Brothers is about 35,000, some of which they wouldn't. It would be about twice as many employees from, let's call it the world, the 50-year-old studio, who really is averse to taking risks, and they really do things the old-fashioned way and siloed, competitive, internally fighting culture, and that isn't Netflix. This disruptor, everybody on the same page, move fast, iterate if you get it wrong. And I just feel like the culture that Warner Brothers is would be an anchor to Netflix at a time when generative AI technology risks are collapsing timeframes into weeks with the changes. So we think the next disruption created by generative AI requires really fast reaction times, which Netflix has the fastest in media, and it would really slow their reaction times if they suddenly brought on twice as many employees that were stuck in the 50-year-old business model of the Hollywood studio.
And you quantified the drag that this would have on Netflix. What does that look like?
I think what we're saying is that the $83 billion purchase price that they would pay to buy Warner Brothers would add another, that cash would be at risk of not returning its capital because they would bring all these cultural problems and envelop the entire consolidated $400 billion entity.
Laura, so as it relates to Gen AI, is that a friend or a foe to Hollywood, to the media companies?
Yeah, so to date, Paul, what isn't different about Gen AI is it's being used as tools by humans. In which case, it's not different than the web. It's not different than our smartphones, our Apple phones, our flashlights and communication devices and map. They replace Thomas guides, so they're utility. So far, Gen AI technology has been a tool or a utility for human beings. I think the vision of Sam Altman at OpenAI, Elon Musk, Mark Zuckerberg over at Meta, is to have, and certainly, of course, of NVIDIA, is to achieve what's called superintelligence, where machines train machines, in which case it replaces people at some level. It does better thinking, faster, it's less emotional. So if that comes true, and they're saying that's 10 years out, that's superintelligence, it would actually replace humans. But near term, it's just like the other three technological disruptions you and I have seen, where it makes our life better. It's a tool for humans to do faster, better, safer work.
So, Laura, you make the case that Netflix doesn't need to buy Warner Brothers Discovery. It would be adding an anchor, and it would drag it down because it's this disruptor. What about Paramount Skydance? Doesn't that argument also apply, or does it not?
It does, but the distinction I would make is Netflix is large enough to go it alone, and with generative AI collapsing timeframes, their culture is really well suited to the technological, the future of the next 5 years. P-Sky is subscale. It probably can't survive without bulking up, and it doesn't really have time to build in a generative AI world, because it's just too small and change is happening too fast. So it needs to bulk up and buy in something. We think they could get it closed in 6 months because we think the senior Ellison is good friends with Donald Trump and he would have it sail through regulatory. So it would happen faster, there'd be less uncertainty, and it would allow P-Sky to survive. So I think they have to take the technological risk because they must have scale, or they're gonna die. So they might die because I'm right about the culture problem and the anchor problem, but they're going to die if they don't buy something anyway. So it gives them a better chance to survive, I think, to buy Warner.
And Laura, you've followed Netflix since its inception here. This is a company and a management team and a board that's been pretty adamant. They'd rather build from within than buy. What do you think has changed here? Because this is a huge turnaround for this company strategic wise.
Paul, I really wanted to write a note that says dogma is bad. I mean, they said they'd never do advertising. Now they do advertising. They said we'll never do live sports. And now they broadcast NFL games on Christmas Day. And then they said, well, we don't like the Hollywood, we don't like the theatrical window, and we don't want to release any films in the theatrical window unless talent, like directors, force us because they want Academy Award consideration, which is a requirement to get an Academy Award. You have to have been released in theaters. So that is really hurting them. Those words are really hurting them with the talent community. So when they say we will never do something, please take that with a grain of salt because they often reverse themselves completely 180 degrees. And it's really, those words about the theatrical window are really hurting the feedback loops with talent, like big talent, like Jim Cameron and Scorsese, like all these people that really are big talent. They all want a theatrical window. And Netflix, they're scared to death that if Netflix bought Warner's, the theatrical window over 5 years would go to zero.
All right, Laura, great stuff. Thank you for making some time available. I know this is going to be a very busy time with this deal going on here. Laura Martin, senior analyst. She covers the media industry and really the confluence of media and technology. She's been on top of that for a long time at Needham & Company. So we'll see what happens. I mean, it seems like both of these companies really
They're both very, very determined. She mentioned theatrical releases. I just watched Jay Kelly, which is a Netflix release. Of course, it did get released on the big screens first, and then it was released on streaming, and maybe like, an Oscar contender for George Clooney.
Okay. Very good. I mean, there's a ton of stuff out there. Netflix feels the need that they need even more. They need to own a studio.
They want respect in the Hollywood industry.
I guess. Whereas they started off saying, "No, we really don't care about that. We're based up here in San Francisco. You're down there in LA." So we'll see how that plays out. We'll be on top of it for sure. This is Bloomberg.
This is Bloomberg Intelligence with Scarlett Fu and Paul Sweeney on Bloomberg Radio.
All right, Scarlett Fu, Paul Sweeney, live here in our Bloomberg Interactive Brokers studio. We're streaming live on YouTube as well. The Fed meets tomorrow. That'll certainly be a key thing. One of the things the Fed really takes into account is how's the consumer doing out there as it relates to employment, as it relates to inflation. One of the areas that we like to look at is the restaurant business. Are they spending money on restaurants? More money, less money, different places within the restaurant ecosystem? And so the expert we turn to is Michael Halen. He's a senior research analyst covering the restaurant and food service business for Bloomberg Intelligence. Mike, talk to us about how the current environment is out there in the restaurant business and maybe what your 2026 outlook looks like.
Sure. You know, it hasn't been an easy year for restaurants. I mean, sales are up about, same-store sales are up about 1%. But obviously there's been pretty significant margin pressure here in the second half. Beef is one that, you know, everyone's complaining about. Prices will be up about 15% here in the fourth quarter. You know, we just got November data. November data was weaker than it had been in October. It wasn't really a surprise to anyone. We're lapping a very strong post-election spending from last year. Also, the government shutdown of the first couple weeks of the month impact the results. I think what stood out to us the most was that the longer term, the 2-year same-store sales trend actually accelerated, showed some strength, and we think that bodes really well for December and then into next year. I think there's going to be a little bit of a flip. So this year, casual dining were the outperformers. Part of that was just a better supply and demand dynamic. Also, they were comping over a very, very weak 2024. We think 2026 is going to be a year where quick service starts to claw back some of that market share that they lost to casual dining this year. You know, some of the names we cover, like McDonald's, Restaurant Brands, which owns Burger King, Popeyes, and Tim Hortons, Yum Brands. We think they're all set up for a really, a nice first half here as they lap some weak comps. Consumers get some tax relief, and oil prices are down pretty significantly year over year, and we think those are all gonna help consumer pocketbooks.
What's the story on beef prices here? I know they've been high. Folks tell us that the cattle herd's not going to get back to a more normalized level till maybe 2027, and so a lot of the companies you deal with, that's probably got to be a hit to their margin.
Yeah, for sure. You know, what's interesting in the steakhouses, they tend to do just fine because they're able to kind of mitigate some of the cost pressures better than the grocery store can, by using different cuts of beef or whatever it may be. And so their sales tend to hold up pretty good in these times of inflation. Obviously, there is going to be some margin pressure there. Shake Shack is another one's going to feel it because they own and operate their stores, unlike some of those quick service names, and so they have to foot the bill for the higher beef costs, right? But high prices tend to cure high prices, and so what we expect is that this quarter there was a lot of switching where customers in restaurants and the grocery stores opted for poultry, seafood, whatever it might be, different proteins to kind of help mitigate their restaurant and grocery expenses.
So I know you've told us in the past, Mike, the McDonald's model, which is just one of franchising. Is that, that just seems like such a great model. What are the risks to that model that investors have to be aware of as they kind of pencil out their earnings?
Yeah, so for McDonald's and some of these quick service chains that I named, there's not as too much risk in that model, right? Yep. The risk is that your franchisees start running poor stores because you're not directly controlling the operations. There's a risk that the franchisees kind of go off the reservation and charge, $20 some odd for a Big Mac meal in Connecticut and bring in some bad headlines, right? So there is some risk with that franchisee relationship, and that's why having a strong franchisee relationship is so important in this sector. I think there's bigger risk franchising full service chains because they're a lot more complicated. They require a lot more employees to run. The employees have to be trained up for table service, and it's there's a lot more work and more dangerous work to be done in the back of house, in the kitchens, and so I would say there's more risks to that full service business. But we love franchisees, man, and it's easy to project earnings and cash flow. It's an asset light model. They usually take all that cash they generated and pour it back into dividends and stock buybacks. It's a really nice model.
Can't let you go, Mike, without getting the Cracker Barrel update. 30 seconds left here. Stock's up today, but they're still down a year to date.
Yeah, so earnings are coming in tonight, and it's expected to be pretty bad. So their quarter ended October 31st. So it was impacted by the logo controversy and all that came with it.
Yep.
It was impacted by the government shutdown. Sales are probably going to drop mid-single digits. What investors really want to hear about is there any inflection post-government shutdown, right? That's what we want to see, some improvement here in the last few weeks.
All right, Mike, very good. Appreciate it. Michael Halen, Senior Restaurant and Food Service Analyst, Bloomberg Intelligence, joining us there. Again, Cracker Barrel, I'm a big fan. I like the Country Boy breakfast with that country ham as my meat alternative. Pretty good stuff there. Loosen the belt and sit right down. That's how we roll there. Bloomberg is now in your dashboard with Apple CarPlay and Android Auto. Want access to every Bloomberg podcast, live audio feeds, and headlines at the click of a button. We'll just download the latest version of the Bloomberg Business app now. Looking at the marketplace, a little bit of green on the screen here. The S&P's up 15 points. That's about 0.25%. The Dow's up 110 points. And the NASDAQ's up 46 points. That's about 0.2%. 1%. So a little bit of a lift here. Again, market discounting and waiting for those results out of the Fed. Tomorrow, as it relates to interest rates, we'll have full coverage of that there. That begins at 1:30 p.m. Wall Street time. Bloomberg special edition of Bloomberg Surveillance. Tom Keene and the team will walk you through the Fed decision tomorrow. This is Bloomberg Good Morning.
This is CBS News on the Hour, sponsored by Steel.
I'm Steve Kathan. President Trump heads out to Pennsylvania to push his economic agenda a day after proposing a $12 billion aid package for farmers. Iowa farmer Steve Swenka is encouraged.
Anything the Trump administration can do right now to kind of get us through this time of year will be invaluable.
CBS's Natalie Brand says the push comes as polls indicate the economy is a big concern.
77% surveyed said that the president is not spending enough time on it. So that could explain why he is going to hit the road, go to a key battleground state, specifically a key, very competitive congressional district in northeastern Pennsylvania to talk about the economy. The Republican state party there says that the focus will be on inflation and bringing down prices.
On the weather map, there's deep cold in the east, more snow in parts of the upper Midwest, and in the Pacific Northwest, heavy rain could spark flooding.
I had 3 children. Maybe I need a boat.
That man lives near the Smohomish River, which is expected to crest twice this week.
We will just have to be cautious.
But that business owner says she can't afford to shut down. Along the Puyallup River, this woman says the fire department told her.
We probably should leave, so we did.
Take those precautionary steps right now. Residents are warned not to wait until it's too late. Allison Keyes, CBS News.
The Supreme Court's hearing arguments today on whether to further roll back campaign finance limitations. CBS News legal contributor Jessica Levinson.
What we're hearing in the arguments is whether or not these limits are needed enough because they would prevent either corruption, the appearance of corruption, or circumventing other limits that do those two things.
A new ruling gives the Justice Department the go-ahead to release grand jury transcripts and other material from Ghislaine Maxwell's sex trafficking case. CBS's Scott McFarland.
A federal judge in Manhattan wasn't wholly surprising, but nevertheless, it does allow the Department of Justice to do something it typically can't do, to unseal what a grand jury looked at when making a charging decision. This is the grand jury that looked into Ghislaine Maxwell, Jeffrey Epstein's co-conspirator in the trafficking of young women and girls.
A federal judge has allowed a Tufts University student from Turkey to resume research and teaching while she deals with having her visa revoked by the Trump administration, leading to 6 weeks of detention. And checking Wall Street, right now the Dow is up 100 points, the NASDAQ is up 40 points, and the S&P is up 14. This is CBS News. A woman who made her name around the home is thinking about the future.
Martha Stewart knows exactly what she wants to happen after she dies.
I'm going to be composted.
The 84-year-old tells the 50 Plus and Unfiltered podcast she wants to be buried just like her horses.
We dig a giant hole really deep in one of my fields. We have a pet cemetery. And the horse is wrapped in a clean white linen sheet and very carefully dropped down into this giant, lovely grave. I want to go there.
She says she's not worried about potential legal issues.
It's not going to hurt anybody. It's my property.
Stewart says coffins and waste aren't for her. Deborah Rodriguez, CBS News.
A nativity scene labeled ICE was here at Dedham, Massachusetts church has led to calls for its removal. The church's priest says he wants to meet with the Archbishop of Boston about it before doing anything. I'm Steve Kathan, CBS News.
Live from Washington, D.C., this is Balance of Power with Joe Matthew.
The Trump show goes back on the road. Welcome to the Tuesday edition of Balance of Power as President Trump heads for Pennsylvania to talk about what else? Affordability. We'll consider the optics and the argument when we talk to Bloomberg's Wendy Benjaminson just ahead. The president's farm bailout is making waves here in Washington. We'll get reaction from Steve Ellis, who runs Taxpayers from Common Sense. We'll hear from Republican strategist Ashley Davis. And as Senate Republicans circle the wagons on health care premiums, we've got a big vote coming up. We'll get into it with our panel. Bloomberg Politics contributors Rick Davis and Jeannie Shanzano, all coming up this hour after we check on Wall Street. Let's get his read on the markets. Charlie Pellet is back today at World Headquarters in New York. Charlie?
Hi, thank you very much, Joe Matthew. Great to be back. And we have got the Dow, the S&P, NASDAQ. They are all advancing. Stocks are pushing higher ahead of the Fed decision tomorrow. And, of course, Jay Powell's news conference at 2:30 Wall Street time. So right to the numbers, we got stocks making advances with the S&P up 18 now at 68.64, up by about 0.3%. A lot of green there with the Dow now up also by 0.3%. NASDAQ as well up 0.3%. And the Bloomberg Mag 7 index up by 0.4%. 10-year ahead of the Fed, 4.16%, with the 2-year 3.59%. Gold is up 0.6%, but a substantial move higher today for silver, up 4%, 60.44 for an ounce of silver, while West Texas Intermediate crude is down 1.1%, 58.24 a barrel, and Bitcoin up 3.5%, 94,000 now, 540 on Bitcoin. Nvidia shares today, they are trading lower right now. We do have Nvidia stock down a day after President Trump granted NVIDIA permission to ship its H200 AI chip to China in exchange for a 25% surcharge, watering down years of new U.S. national security safeguards. Sarah Hunt is Chief Market Strategist at Alpine Woods Capital Investors, and she was a guest this morning on Bloomberg Surveillance.
I think that there's been a hugely moving amount of sentiment. I think that there is an argument to be made on both sides, one for security and one also for you want the paradigm to be the technology that we are exporting as opposed to letting people develop technology, especially after the DeepSeek scare and some of the other things that have gone on in the AI world. I can understand why that makes some sense, but there's arguments on both sides, and at the moment, we'll see how much traction that gets when that's allowed.
Sarah Hunt of Alpine Woods Capital Investors. NVIDIA shares down 0.4% among other chip names. Advanced Micro Devices up 0.7%. Intel up by 0.1%. Again, recapping here, equities are advancing with the S&P up 60, now up by 0.2%. And for on-demand news, 24 hours a day, subscribe to Bloomberg News Now wherever you get your podcast. Back we go to Washington once again. Your host, here he is, Joe Matthew.
All right, Charlie, good to see you. Welcome back. Charlie Pellet's back. What else do you want? He'll have more on the markets in about 15 minutes here. We do this, of course, throughout the day on Balance of Power as we connect the dots between Washington and Wall Street. The voice of Wall Street and the New York subway, Charlie Pellet, will have much more coming up in a short period of time as we consider the news on both ends of Pennsylvania Avenue. We will touch both today and even reach so far as the state of Pennsylvania. This is all going to sound really familiar to you. It's our deja vu episode here on Bloomberg Radio, streaming live on YouTube. Search Bloomberg Business News Live. Unless you got the YouTube TV, this is what all the kids do now, just flip to Bloomberg Originals and you can just watch the whole thing right there. If you're driving around on your way to Grandma's, we're at Channel 121 on your satellite radio. Affordability is the story, and, well, that's the case every day around here, right? Doesn't matter who the president is. Not that Donald Trump prefers this conversation. He has, in many cases, called it a Democrat con job and a hoax. But this is the spirit in which he is going to Pennsylvania today to talk about this issue of, yes, affordability. 6 o'clock this evening, he'll talk about his plan to cut costs, and he was asked about this whole issue in a long-form, sit-down interview with Politico that's making waves today. Here's what he said.
I do want to talk about the economy, sir, here at home, and I wonder what grade you would give
A+.
plus. A+.
Yeah, A++++++, the word affordability. I inherited a mess. I inherited a total mess. Prices were at an all-time high when I came in. Prices are coming down substantially.
That was 5 pluses, right, James? Producer James got 5 A+++++, which is pretty good. I wonder what that means in terms of data and your ability to afford the same bag of groceries that you were buying when he came into office. Wendy Benjaminson covers all of this for a living and helps to steer our coverage in Washington, D.C., Bloomberg senior editor. The issue of affordability, it's just like the good old days with Joe Biden.
Yeah.
May as well go to Pennsylvania. How do we write this script? This is unbelievable.
Well, it very much is deja vu all over again, in that we have another president telling Americans that everything is fine when Americans can see with their own eyes and their own wallets that it is not fine. And for Christmas, I would like a U.S. president, I don't care if he's a Republican or a Democrat, to say, I know prices are high and I'm trying to fix it.
Yeah.
They just won't say that. And Trump is falling into exactly the same trap that Biden fell into, which is to keep saying, but I've done this, but I've done that, but I've done this. And Americans are saying, okay, but prices are still high.
Yeah.
Or, as Scott Besson said the other day, just be patient. In 2026, things will be better.
Right.
Well, if they want to have a Republican Congress at the end of next year, things better get better before November.
Because voters don't have a lot of patience.
They're not feeling it right now.
But you point out, it's interesting, that was Donald Trump's line at one point. Remember, short-term pain, long-term gain, give us a chance, I just got here.
Right.
That would still work today, right? 10 months in, or no?
Well, it doesn't see it. We saw in the elections recently that it is not working, where Democrats have now accepted the affordability mandate. They've focused on that, which was a big move for them from losing years of just saying, we think Trump is an awful person. That clearly wasn't a winning message. So they did find one, which is things are too expensive and we're going to fix them. And, it is showing cracks in Trump's armor on that one.
You wonder if there's a disconnect as well with the billionaire class and the people that Donald Trump's on the phone with and talking to on a regular basis. You know, when they started this interview, when Dasha started this at Politico, she asked with a question about Americans buying Christmas presents and budgeting, and Trump said, don't be dramatic. Remember the line as well about you might not get $50 this year, maybe you get 2.
Yeah.
Well, that might actually be the case, Wendy.
Exactly. Plus, he's also, when he's asked about this, he'll often point to the stock market. But the stock market's going up. Well, most people aren't investing in the stock market. I mean, they may have a 401k, but they're not paying attention to it. But most people don't have 401ks. Most people don't play the stock market. And to them, that means nothing, but it means a lot to the people who go to Mar-a-Lago dinners.
Sure.
And that's where they're making money. And the thing is that what it's showing is that there are really 2 economies right now. There is the one that the wealthy are enjoying and the one that the rest of America is enjoying, and the rest of America is going to vote on how that turns out for them.
So you're speaking as someone who's well-versed in the economy. You edit our stories that involve a lot of economic data and so forth. Let's just talk about politics and optics. Joe Biden couldn't close the deal on this argument. Donald Trump is very persuasive on the stump. We're going to have a Trump-style rally, I suspect, is what we ought to call this tonight, right?
Right.
And when he gets on the road, he tends to do better in polling, at least with his base. What's this going to look like if we start doing these on the regular?
Well, it could go two ways.
Yeah.
It could go the way that Chief of Staff Susie Wiles really wants it to go, and I think in some interview, and I'm sorry, I don't remember who it was with, said, I haven't told him yet, but he's going to be doing a lot of these, and we're going to campaign like it's 2024.
Who wants to tell
The
him?
fact that she hasn't told him that yet, and then, of course, it was a joke because she said it in an interview that he clearly read. But, so the White House staff really, really wants him to do this, and they really want him to stop saying it's a hoax. But when he feels in a corner, this is a president who will then lash out and be very defensive. And so if he feels like he's being dragged kicking and screaming to the podium in the Poconos tonight, he's going to say, look, it's the Democrats who did this to you. It wasn't me. It was, I inherited this mess. This is a con job. If he goes out with that message, Susie Wiles is going to need a stiff drink tonight. If he goes out and says, I get it, we're working on it, and I just gave this bailout to farmers, which is not a fix, it's a Band-Aid. But, then he might do better. But he's going to have to find that bit of humility and go out and say he's working on it.
He tends to point to gas prices.
And eggs.
Well, he got the eggs down. Yes,
Yeah,
that's
he
right.
did.
Not hearing about the eggs as much anymore. But also these deals to bring pharmaceutical prices down.
Right.
That resonates with some people, but in the throes of healthcare premiums going up, we're about to hit this cliff, that might not matter. Is he going back on the road because his surrogates, his lieutenants, Scott Bessent, Howard Lutnick, the folks, Kevin Hassett, they're on TV every day, Wendy, that they're simply not effective?
It could be. It could be. I mean, he is by far the most effective communicator of his administration.
And he knows that.
And he is, whether you like him or not, he is definitely an effective communicator.
Absolutely.
And so I think what Wiles and others are really hoping for is that, people aren't glued to their TVs when Kevin Hassett speaks. I'm sorry. He's a brilliant economist, but, But when Trump goes out there, people will listen. So he should hone his message if he wants to.
If you're trading bonds, I guess you're listening to Kevin Hassett.
Exactly.
Does he do this, the swing states? Where do you go after Pennsylvania?
Well, he is going, as someone mentioned on the show a few minutes ago, he is going to a very competitive district, and that'll help the Republican member there, supposedly, or it could hurt them. But he's not going to go to Democratic areas.
Okay.
At the end of the presidential campaign, he went to Madison Square Garden, and that didn't go all that well. So I think he's going to stay out of Democratic areas and go to these competitive swing districts or the states that are redistricting to try to gain more Republican seats. So that would be the strategy if they decide to do that.
It is an awfully familiar playbook.
It is.
When we look back to the Biden administration. But you've also got a president who's earlier in the cycle here beginning this argument, and a tax code that's just now taking effect, questions about tariffs. Will he still need to be making this argument at this time next year?
I think he will, because the things he's doing, like I said, the farm aid he mentioned yesterday, there's a good story on the terminal that has farmers saying, yeah, that's going to help get us through this season, but if this tariff chaos continues and China doesn't buy enough soybeans and Argentina is still flooding the market with beef, then, this isn't going to help us in the long run. And, sometimes there's tariffs, sometimes there's not. He reduces them, then he puts them back on. And businesses are just having a hard time making ends meet.
And the cycle continues.
And the cycle.
There's so much noise around here. It's sure great to have Wendy Benjaminson help guide us through the news that actually matters. Bloomberg senior editor, Wendy, thank you, as always. We're going to spend more time on this farmer bailout and the idea of America without an income tax. Yeah, when we talk to Steve Ellis at Taxpayers for Common Sense, next on Bloomberg.
It's 12:21 on Wall Street. We do check markets all day long here at Bloomberg. We are looking at an up Tuesday here for the Dow, the S&P, NASDAQ, all advancing. Fed meeting underway. Decision drops 2 o'clock tomorrow, Wall Street time. So ahead of the Fed decision, S&P up 10 right now, up 0.2%. The Dow up 0.1%. NASDAQ Composite Index up 0.2. 10-year 4.16%. Gold is higher by $18 the ounce, up 0.4%. A surge for silver up 3.6%. Bitcoin right now up by 2.8%. 93,918 on Bitcoin. For on-demand news 24 hours a day, subscribe to Bloomberg News Now wherever you get your podcast. I'm Charlie Pellet. Balance of Power continues now. Once again, your host, here he is, Joe Matthew.
All right, Charlie, many thanks to you. He'll have more on the markets coming up in about 20 minutes' time here on Balance of Power, live from World Headquarters in New York. It's good to have Charlie back as we talk politics here in Washington. All these stories converge eventually, particularly in the conversation we're about to have with Steve Ellis at Taxpayers for Common Sense. I'm assuming that Steve's head exploded when he heard the president talking at the cabinet meeting a couple of days back. Remember, this was a couple of hours long conversation, and we went through a lot of topics, and everyone was really focused that day on what we all now call the double tap strike on the Venezuelan boat, September 2nd. That was the talker, right? Pete Hegseth sitting right next to President Trump. But as I say, a lot of different things were said over the course of 2 hours, some of them striking, including this idea. And the president's gone here before. Imagine if the whole country was Florida. I stole that from Cece in New York. A world with no income tax, in America with no income tax, thanks to proceeds from the tariffs. Here's Donald Trump in the cabinet room. Listen.
So we're going to be making a dividend to the people, and additionally, we're going to be able to reduce debt. And as time goes by over the next 2, 3, 4 years, those numbers are going to go up. And I believe that at some point in the not too distant future, you won't even have income tax to pay, because the money we're taking in is so great, it's so enormous, that you're not going to have income tax to pay.
Wow. So Steve Ellis can retire. You know, he founded Taxpayers for Common Sense many years ago. He's still the president, still on the job every day in Washington. And I don't know, Steve, welcome back to Bloomberg. He says 2, 3, 4 years. Imagine a world with no income tax. Is that what you're preparing for?
Certainly not, Joe. I mean, there's no remote possibility that we could raise enough tariff revenue without totally crashing the economy to get to the $2.66 trillion that the income tax raised in 2025.
That's a good number, okay? A little perspective from Steve. $2.66 trillion. It's unclear how much money has been gathered from tariffs. Steve, we can get abstract on this real quick because the question is still being asked, who pays tariffs? And I realize that that might be a bit of a moving target. But as more retailers and more manufacturers suggest that they're going to have to start passing along tariffs in the next couple of months, in the next year, aren't we already taxing the consumer? Are we just moving the tax in that world?
Well, absolutely. So Joe, so far this year, we raised $230 billion in tariffs. So a far cry from that $2.6 trillion I was just talking about. And certainly Costco, who is trying to sue to get the tariff revenue back, certainly thinks that it's costing them and their consumers.
Okay. So this doesn't sound like 2, 3, 4 years be enough time, or ever for that matter. When you consider the impact of tariffs, Steve, and people must ask you about this at every cocktail party in Washington. There are a lot of holiday parties going on right now. Who is paying the tariffs? The administration would tell you that it's mainly the exporting countries, and to a lesser extent, the importers who are swallowing some of this cost, and then maybe a smaller share going to consumers. Do you have a breakdown on that?
There isn't really a breakdown because it's every importer making their own decisions. But at some point, it's got to give because they have to make a profit or they're going to stop importing that particular good. And those prices are going to go up for consumers. And so certainly it gets passed along, and it is effectively a tax on all our consumers. And it's a very inefficient tax as well And so this is something where if you could actually really raise tariffs to the level that President Trump is talking about to eliminate the federal income tax, it would be far beyond what we saw in the 1930s, and it would crash the economy.
So enter the idea of a farmer bailout. You can't really talk about tariffs without mentioning this. $12 billion. President put pen to paper yesterday on this in the form of an EO. The farmers, according to the analysts at Bloomberg Intelligence, say they want trade, not aid. What do you think?
Certainly, they're in the business to grow products. They don't want to just get handouts of cash. And so they want to be able to export these commodities, the soybeans, the cotton, these particular commodities. And a major export market was China, who, guess what, we slapped with a whole bunch of tariffs, and then they reciprocal tariffs on us. And so it's not just hurting China, it's hurting our farmers. Plus, China's going to Brazil to buy these soybeans. So essentially, they're managing this much better. And so then we're trying to dole out cash. And we saw this exact same movie before, Joe. We saw it in the first Trump administration where they doled out cash from the Secretary of Agriculture's slush fund.
It sounds to me like more will be needed. Do you see another bailout like this next year?
Well, unfortunately, Joe, we've seen a series of agriculture bailouts over time, and certainly we seem to hand out money, hand over fist to agriculture and agriculture businesses and through crop insurance and a whole variety of sort of safety net programs. But this is a self-inflicted wound. This is something where the administration's policies are harming farmers, and to try to assuage them, to try to keep them in his tent, they're just helicoptering cash over farmland.
Well, Steve, it's good to have you back. He's the president of Taxpayers for Common Sense. Steve Ellis with us live on Bloomberg as we add the voice of Republican strategist Ashley Davis, of course, partner at S3 Group and a regular presence in our conversation here every day on Balance of Power. Ashley, it's great to have you. What does Congress think about the farmer bailout? We talked to a lot of members last evening, for instance, from Kansas, with a lot of constituents who are counting on this. Is $12 billion enough, and does Congress like the fact that we're helicoptering this money, as Steve Ellis just put it?
I think you'll have, first of all, hi, Joe, nice to see you as always, but I think that you'll have both sides of the argument here. I mean, if you look at how this is being paid for, the $12 billion subsidies, it's going to be paid for by the tariff revenue, so there's not going to be any budget issues as in the past in regards to subsidies or tax credits or anything else that the farmers have received over the years. So the budget hawks, the people that want to get rid of the deficit, especially on the right, the more consumers, and the left as well, will be happy that this isn't any type of new appropriations money, so to speak. But just as your last guest said, as Steve said, is these subsidies have been happening, or the bailouts have been happening in different forms to the farmers as long as I've been in Washington, which is almost 25 years. I do think that obviously the farmers are the bread and butter of our country. We want to make sure to support them. But I don't think that adding them to the year-over-year budgets are the way to do it as well. I actually personally like that this comes from tariff money. This is kind of a bridge, so to speak, hopefully to get us back on track. But I don't know if I do agree that this is just because of the tariffs that this is happening, because, for again, 20, 25 years that I've been here, there's always been issues around the different funding that our farmers need. So there's a bigger problem than just our tariffs.
Sure enough. I mean, it has a lot to do with China and soybeans and uncertainty when it comes to imports, right? But you're suggesting it goes deeper than that.
Well, yeah, but yes. Obviously, times have changed. A lot of our country was built on the farming industry. A lot of our exports were the farming industry, exactly. Not just China, but other places throughout the world. It's just, it's just the natural times of change that have changed the industry. However, I don't think there's anybody on the Republican side and the Democrat side, no matter if it's Biden or President Trump, would ever want our farmers to go under. So I think that everyone does do their best way of supporting them. Talk to Chuck Grassley, obviously, every day. Talk to the Kansas senators. That is the number one issue for them. And even in Kentucky or Virginia in regards to tobacco, I mean, there's all types of farmers, not just food. So, but we either have to support them through subsidies, we need to support them through one-time payments, but it can't continue to eat at our bottom line of the deficit, in my opinion.
And Jerry Moran from Kansas was with us just last evening talking about it. If you're with us on YouTube, just a reminder, Cece's got the best farm footage in the business. Big vote Thursday. Ashley, I've been dying to ask you about this because nobody's closer tied to the Senate than you. What are you hearing? There's going to be a Democratic healthcare proposal that gets a vote. Do we know what it will include? Have we settled on something? And will Republicans have an answer? Because I know there are about 45 plans that they're looking at right now.
Well, I was just going to say, if I knew, I would probably have a lot of money right now. But I do think, there's a big lunch happening shortly with Senate Republicans to try to decide a path forward. I don't think that there's not going to be an alternative from the Republicans that will be presented to the 3-year extension that the Democrats will get a vote on Thursday. It's obviously Republicans are not going to support that. I don't think anyone's going to be surprised about that. But we have all different, we have a new bill with the Cassidy bill that was coming out today, and Crapo. So those are 2 committee chairs that have jurisdiction. We have the Marino-Collins bill that also has different. So I'm assuming it's going to be some combination or well, let's just put that aside. We also have the House that has like Brian Fitzpatrick, the moderate bills that are trying to, I mean, people are trying very hard to come to some solution. The issue, I'm not a big believer that this needs to happen by the end of the year. I think the deadline's more January 30th. But I think Republicans, at least in the Senate this week, need to show something. And getting around one answer is going to be very difficult over the next 48 hours. Yeah.
Well, you remember the talking points. We're going to get into this with our panel coming up around the government shutdown. Speaker Johnson, pretty much every Republican said, no, you're conflating 2 unrelated issues. Funding is a now issue. Healthcare is something we get to figure out at the end of the year. Democrats said, no, this is Capitol Hill, and we'll never get it done unless we start now. Ashley, were Democrats right?
All of these deadlines are a little bit fungible, as you know. I mean, I think that obviously the subsidiaries expire at the end of the year, but I do really think that we can backtrack in regards to paying from some of them probably through the first quarter of next year. The problem is you need a cliff, is exactly what Democrats are saying. But we meaning Republicans, were never going to move off of the shutdown connection to the subsidies. It just wasn't something that politically was going to work. But there is going to be something significant that has to happen in the next 3 months.
All right. You got it from Ashley Davis. It's great to see Ashley. She'll be back on the late edition of Balance of Power, partner at S3 Group, Republican strategist. Great to see you. Our panel, as I mentioned, up next, Jeannie Shanzano and Rick Davis with us as we tackle the healthcare debate, only here on Bloomberg.
It's 12:40 on Wall Street. We do check markets all day long here at Bloomberg. Move lower now for the Dow Jones Industrial Average since our last update. Right now, looking at the Dow, Merck, J.P. Morgan Chase leading the index lower. Right now, we've got the Dow down 82, drop there of 0.2%. The sell-off happening in the past couple of minutes. S&P 500 index up 5. That is a gain of about 0.1%. But the NASDAQ Composite Index holding on to a gain of 48 points, up now by about 0.2%. The 10-year currently yielding 4.17% ahead of tomorrow's Fed decision. The 2-year 3.60%. Gold is up 0.4%, 42.08 the ounce. Silver surging 3.6%, 60.24 the ounce. And West Texas Intermediate crude oil down 1.2%, 58.18 a barrel on WTI. Bitcoin at 93,793. Bitcoin up now by 2.7%. Markets, meanwhile, are looking to Washington as we head into the new year. Jonathan Pingle is chief U.S. economist at UBS Securities, and he was a guest this morning on Bloomberg Surveillance.
When we're constructing our forecast, I would, under most circumstances, continue to have the economy slow here. But it's really hard ahead of the fiscal stimulus we think we're going to get from the One Big Beautiful Bill Act next year. I mean, we're going to have a bumper tax refund season that's going to be spread across the income distribution. It's a little hard to get overly bearish knowing I'm going to get sort of this slug of $50 billion in additional refund checks.
Jonathan Pingle of UBS interviewed this morning on Surveillance. Uber introducing a way for some people to use its ride-hailing service without the company's signature app. The rideshare giant plans to install physical kiosks at places like airports, starting with LaGuardia in New York. The idea, you walk up to a human, they'll help you order an Uber. Recapping, stocks higher. S&P right now up 5, up 0.1%, but we are seeing the Dow Industrials down 0.1%. For on-demand news, 24 hours a day, subscribe to Bloomberg News now wherever you get your podcast. Back, we go to Washington. Once again, here's your host, Joe Matthew.
All right, Charlie. Many thanks, Charlie Pellet. We'll have much more on the market at the top of the hour, 1 p.m. Eastern Time, as we welcome our global television audience to the conversation today on Balance of Power. We've got big doings on Capitol Hill, at least later this week, and we're still waiting to see exactly what form legislation to address the expiration of health care subsidies, the Obamacare subsidies, might take. Democrats have a very different approach to this than many Republicans. And of course, while President Trump doesn't want anything to do with any of this, he says just send the money directly to people, let them buy their own. So yeah, we're still chewing on Obamacare. This is the same debate that led to the government shutdown. And the Thursday promised vote by John Thune is what brought Democrats back to the table to vote for the CR to reopen. So we're still experiencing the fallout here of the longest shutdown in government history, knowing that millions of Americans have already received notices saying that their premiums are going up. Donald Trump, in this long-ranging interview with Politico, was asked about this. Here's what he said.
Will you tell Congress to extend those Obamacare subsidies while you work out another deal?
I don't know. I'm going to have to say, I'd like to get better health care. I'd like to have people buy their own health care, get much better health care. And what I want to do, very simple, I want to give the money to the people, not to the insurance companies.
So right now, people
give the money to the people. But of course, then the people would give it to the insurance companies, right? We're trying to figure this out with the help of our panel. Bloomberg Politics contributors Rick Davis and Jeannie Shanzano are with us. Rick is, of course, partner at Stone Court Capital, our Republican strategist. Jeannie, our Democratic analyst and democracy visiting fellow at Harvard Kennedy School's Ash Center. Rick, you've been knocking around the healthcare debate for a long time. Everybody remembers the thumbs down from your former boss, John McCain, and it's something 15 years in the making. Republicans haven't really gotten their arms around in terms of a replacement or a realistic set of reforms. What's about to happen this week? Will Republicans decide on a plan, or do they just let this go by?
Yeah, you point out it's incredibly difficult for Republicans to do anything that looks like they are enshrining ACA. And when John McCain went down to the well of the Senate, when skinny reform was on the vote and put his thumb down, representing the vote that killed that reform, he was the lone guy who could make that happen. There are no lone guys anymore in the United States Senate. There's no one there who's actually going to want to take the hard trek down to saying, oh, we should have ACA subsidies. And so the fact that, you know, in the Susan Collins bill in the Senate, they actually have some of those subsidies to be done, reformed, but actually continued, is an act of political courage. Can that pass? Probably not.
Jeannie, yesterday you were suggesting that a Democratic plan cannot pass the Senate. Do we know exactly what that plan is? Is this a 3-year extension? What are you voting on Thursday?
Yeah, that's what it looks like, is the 3-year extension. And by the way, Joe, you cut off the best part of that interview when she said, Dasha Burns, when Dasha Burns started raising Christmas gifts and Donald Trump was like, don't be dramatic. Not substantive, but a lot of fun. The Democrats, it looks like it's going to be the 3-year extension. It doesn't have much hope to move through, although, you know, on what Rick mentioned in terms of what we're seeing out of Susan Collins and Bernie Moreno, I think it's really important to note that Bernie Moreno is no sort of moderate Republican. This is a young MAGA conservative, and it is notable that he is joining forces with Susan Collins, and they are putting forward this idea. And again, it doesn't have the votes either, but it just shows you how the concern has rippled through the Republican side if the Republicans don't take a vote, or if they do take a vote and have nothing to meet Democrats with. I mean, there is a lot of fear on the Republican side as to what this all is going to mean if they can't get something through. And we heard the president say yesterday in that interview, you know, these sort of very sort of vague ideas. You've got 2 weeks to go. If you're not going to convince GOP members now, it's done. So it doesn't look like we are anywhere closer today than we were a month or 2 ago.
I'm compelled by what's happening in the House here, Rick. I don't know your thoughts on this, but it's actually bipartisan. Brian Fitzpatrick leading the effort, Don Bacon, Bresnahan, Malliotakis, the R's. You've got Jared Golden, Tom Suozzi, Don Davis, and Glusenkamp Perez, the D's, here from a lot of different areas of the country. A 2-year extension, crackdown on pharmacy benefit managers. Isn't this the kind of thing that could pass?
I really think it's the kind of thing that should pass the House of Representatives. It's kind of an example of the gang of in the Senate in the old days, right? You get, 5 Republicans, 5 Democrats. They craft a bipartisan plan and then dare everybody else to vote against it. And it really echoes what Jeannie was saying. Republicans are in a bit of a panic. We don't have a singular proposal, right? All the talk we've had for almost a decade of opposing ACA has not yet resulted in a Republican plan to replace it. You know, you remember repeal and replace? Yes. Well, we've been talking about that for a decade, and we haven't figured out what to replace it with. And so the fact that we're now posed with this challenge, and there is a real deadline at the end of this year that will have a really negative impact if it's missed, with individuals, 20 million people, maybe 40, who are going to have extremely high premiums, is what's got Republicans really willing to walk the plank now. So, look, this is a classic case where the House could actually lead the Senate. If they could pass that kind of a bipartisan measure, then there'll be the onus on the Senate Republicans to come together with a number of, all they need is a half a dozen Democrats to pass a bill.
Did Republicans make a mistake by not engaging Democrats when the shutdown began on the issue of health care?
It's hard to talk tactics at this point because it was all fused with this shutdown politics. And the worst thing was combining health care and shutdown. They really should have been divorced and we wouldn't be in this mess. Both would have been dealt with on their own. And now we're right back in the same pot. And so I think the lesson for history is don't put too much on the plate when you have a looming government shutdown, because it really makes everything else harder, not easier.
Yeah, but do you think if the government had not shut down, Jeannie, that Republicans would have engaged Democrats, that we might not be having this conversation right now on health care specifically?
No, and you know why? It's something you and Rick were just talking about. It's the fact that we are 15 plus years on and they have never been comfortable with this issue. And what's astonishing is not just that we're almost 2 decades in and they have no answer on health care, but that the answer that the Republicans had is Obamacare. That was Mitt Romney's bill. That is what passed. And so they have been flummoxed ever since Barack Obama adopted that as his own and it was pushed through, and they've never had a coherent answer since. to your earlier point about deja vu all over again, which is where we are. And the danger for Republicans is very real here, but it's also a danger for all of us. The millions of people who are going to be paying more in healthcare, the fact that if we don't get a vote before the end of the year, it increases the chances we could see another government shutdown. And also, what about the president's one big beautiful bill? They were trying to do those refunds. Now, if people are paying more for healthcare, all of that is a wash. So this is a big mess for Congress, and I think it underscores what we've been seeing in this Congress. There is very little leadership. The bill you're just talking about in the House with this bipartisan group, this is a rank and file bill that they may have to put forward on a discharge petition. Where is the leadership in the House and where is the leadership in the Senate? They've got to come forward. But of course, their leader is Donald Trump, and we heard he's really nowhere on this either last night.
I actually thought of you when I heard this discharge petition idea. Is this really where we are?
It could be.
We're going to bring major healthcare reform.
I think it's like everything else, right? Sanctions in Ukraine, discharge petition.
Yeah. Jeffrey Epstein.
Yeah, but I would remind Jeannie, we're still waiting for the Democratic alternative that was supposed to be presented like a long time ago, and now we're down to like a vote tomorrow and no one's seen the paper. So it's leadership on both parties, right? They have sort of abdicated their will on trying to formulate the plans that they could inform and sell and then vote on. And none of that's happening. And thank goodness for the rank and file in both the Senate and the House, because they see their job is not done yet until this is fixed, and they're trying to fix it.
Jeannie, new polling on this matter comes from Morning Consult. It's a pool of about 2,200 people for what it's worth. Registered voters, 58% say Congress should extend the subsidies. 24% say let them expire. You know, there are a lot of folks out there, a lot of political analysts and people here in the political class in Washington who think Democrats don't want there to be a solution. Because if we go over the cliff, you take back the House. What would you say to them?
I think that strategically, that is a real concern. We all hope that that is not the fact, but politically, this has been a helpful issue for Democrats for decades, and it continues to be. You look at that poll, and those numbers are pretty startling. There's no really good answers here because, of course, the subsidies themselves never made much sense either. But now your back is up against the wall. They probably should be extended. But let's not forget, my view has always been if Republicans or Democrats rather really believe in these subsidies, they should never be temporary. You should tell us the cost. We should pay for them, and they should not be a temporary fix. But that's how our government has been working for a long time on both sides. So now our back is up against the wall. We probably need an extension and then hope they figure it out long term. But it's Congress, so there's not a lot of hope in that.
Revolutionary idea. What do you think of this language we're hearing from Donald Trump? Just send, it sounds good to some people, just send people the money, but then they're just going to go give it to the insurance company with less leverage, wouldn't they?
Yeah, it's tricky, right? Because, sure, you want to give people the power to control their own fate, and that's a little bit of the bill that is making its way through the Senate by Cassidy. Yes. Give $1,000 to people under the age of 49 and let them go buy the bronze plan, make them eligible for the bronze plan and the ACA and catastrophic, and they can go pick up $1,000 worth of insurance somewhere else. The problem is HCA accounts do not allow you to use that money to buy insurance. That was the whole idea of an HCA, is that you use it not to buy insurance, to actually go and pay for health care directly. A lot of people don't want the hassle of doing that. They want an insurance plan that covers everything. And so that's part of the problem in the debate that's happening right now in the Senate is how do we just make it easier? We've created a plan that is so confusing to people that they'll never figure out the solution is a good one if we give it to them.
So, Jeannie, just a remaining moment. What would happen under Donald Trump's proposal? You send everybody money so that they can go to the insurance company. Don't the premiums go up in that case anyway because they don't have the benefit of economies of scale?
I think so, and I also see our future, Joe, and we would be on the phone, I guess, individually battling with insurance companies. It's the worst case scenario. I don't see it as a solution. So, please, God, no. I think Rick is right when he says that people really want a plan that allows them to get health care and not have to be battling with insurance companies individually in this way.
Yeah. So I think we're still chewing on this. Rick Davis and Jeannie Shanzano, our great panel, will be back in our second hour as we welcome our global television audience to the conversation. I hope you'll stay with us as well here on Bloomberg Radio, on satellite radio channel 121, streaming live on YouTube. We'll get an update on this from the latest at the White House on Bloomberg.
From Washington, D.C., this is Balance of Power with Joe Matthew.
The president leaves the bubble to talk affordability. Welcome to the Tuesday edition as Trump heads for Pennsylvania later to make the case for his economic plans. We'll get the latest on the agenda from Bloomberg Washington correspondent Tyler Kendall with insights later from Republican Senator Pete Ricketts as we consider affordability in health care as well, an important vote coming up on Thursday in the U.S. Senate. As the president gives Volodymyr Zelensky days to respond to a peace proposal, we'll discuss the hope and the effort to find peace in Ukraine when we talk to Slovenia's Minister of Foreign Affairs Tanya Fayon. Analysis from our political panel this hour, Rick Davis and Jeannie Shanzano. And it's all after a look at Wall Street. Let's get up to date here on the markets. Latest on the Tuesday trade with Charlie Pellet in New York. Hey, Charlie.
Well, hello there, Joe Matthew. We're looking at a decline right now for the Dow Jones Industrial Average. The S&P 500 index is holding on to a gain, while NASDAQ remains higher. The NASDAQ Composite Index up 54, up by about 0.2%. S&P up 6. That is a gain of 0.1%. Dow Industrials now down by 0.2%. The Bloomberg Mag 7 Index up 0.7%. 10-year at 4.16%. The 2-year currently yielding 3.59%. Traders holding off from making big bets ahead of the Fed's final interest rate decision of 2025. All of that 2 p.m. tomorrow, Wall Street time. Right now, we have got gold up $12 the ounce, up 0.3%, 42.03. Silver up 3.5%, 60.21 the ounce. West Texas Intermediate crude down 1.2%, 58.17 a barrel. And Bitcoin is up 2.9%, 93,978 on Bitcoin. As I mentioned, a decline for the Dow. J.P. Morgan Chase shares certainly weighing on the industrials. J.P. Morgan Chase down 2.9% right now after Marianne Lake, CEO of Consumer and Community Banking, said the bank sees full year 2026 expenses at $105 billion. Now, her remarks came at a Goldman Sachs conference. Recapping, the Dow lower right now, down 81 on the Dow, drop there of 0.2%. The S&P and NASDAQ, they both remain higher. Right now, the S&P up 0.1%, NASDAQ higher by 0.2%. For on-demand news 24 hours a day, subscribe to Bloomberg News now wherever you get your podcast. And back we go to Washington. Once again, your host, Joe Matthew.
Okay, Charlie, we thank you, and we'll have more on the Tuesday trade with Charlie Pellet just about 20 minutes from now here on Balance of Power. Thank you for joining us on the Tuesday edition on Bloomberg TV and radio, streaming live now on YouTube as well, and on Bloomberg Originals. If you're in the car, find us on Sirius XM channel 121. As the president prepares to leave the bubble, yes, a little bit later on today, he's got a couple hours still, they'll gas up the jet, and the president will fly to Pennsylvania. This may sound familiar, to talk affordability. It's almost like we're back in the Biden administration at this moment, as the administration tries to frame its economic plans in a way that not everyone seems to be feeling or is borne out in the data. President Trump sat for an extended interview with Politico and was asked by Dasha Burns about the issue. Here's how that went.
I do want to talk about the economy, sir, here at home, and I wonder what grade you would give your economy. A plus.
Yeah, A plus, 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 plus. The word affordability. I inherited a mess. I inherited a total mess. Prices were at an all-time high when I came in. Prices are coming down substantially.
To our count, that was 5 pluses as the president rates his economy at the end of year one. Now on his way to Mount Pocono, Pennsylvania, he'll be speaking after the bell to a crowd of supporters. And of course, we've seen the president outperform on the stump, and he tends to do better in polling when he is out in front of people. So it's on now. This is going to be the beginning of a bit of a roadshow, and that's where we start our conversation with Bloomberg Washington correspondent Tyler Kendall's with me here at the desk in our Washington bureau. Tyler, this is straight out of the Biden playbook, even going back to knock around near his old hometown in Pennsylvania.
Right, exactly. And this idea that officials have to thread the needle between saying that the economy is doing well when polling and data is showing us that Americans don't feel that way. And there's 2 statistics that I pulled for our conversation today that I think put it into context. One is our Harris poll conducted for Bloomberg News back in October that found that 55% of employed Americans are concerned that they're going to lose their job. And then pair that with the most recent consumer sentiment reading, which is improving. Friday's numbers from the University of Michigan showing that it rose for the first time in 5 months. It's still hovering near those record lows. So we know that the White House really wants to try to recapture this narrative when it comes to higher prices, any signs of a slowing labor market. And this marks the first big domestic policy speech that we've seen from President Trump since November, when Republicans really were handed that slew of election losses over the issue of affordability, which is now front and center of these conversations.
And it's an issue that the president likes to call a Democrat con job or a Democrat hoax. Even the term affordability, he says, is something that was invented by Democratic operatives. So are you hearing anything from the White House on the contents of this speech and what type of rhetoric we're going to hear tonight?
So we did get sort of a preview from the White House press secretary, Caroline Leavitt, in an interview earlier today, and we're really expecting President Trump to actually tout some of the more recent policies. I mean, we've spoken so many times on this program about all of the different policies we've seen come out in really just the past few weeks, right? Over the weekend, President Trump signing that executive order directing the Department of Justice and Federal Trade Commission to look into alleged price gouging and unfair trade practices, also reminiscent of the last administration in a bid to try to bring down grocery prices, look into the food supply chain. Other things such as the recent relief we've seen for American farmers. We played the sound from the Politico interview where President Trump did mention those exemptions for some agricultural tariff products. He didn't rule out additional carve-outs, but then it will be interesting to see how he frames some of the things that haven't quite come to fruition, such as his idea for tariff rebate revenue checks, which is something that we know that he's really put.
Is that real, Tyler, or are we just talking about it?
Well, we know that it's something that very likely is going to need Congress's approval, right? Power of the purse. We've heard some administration officials. I was in an event last month with the Deputy White House Chief of Staff who said that they would look into potentially a way to do this without Congress, but that seems to be a little bit of a stretch at the moment. But I'll bring up Congress, Joe, because as you've been following, of course, the affordability issue that could really come to a head for this president as we head into the end of the year is going to be health care. And at the moment, that is squarely on Capitol Hill's shoulders, and we haven't really seen Republicans coalesce around a plan for those expiring Affordable Care Act premium tax
Coming to a head or a cliff, as Democrats would tell you. The president continuing his refrain in this interview, just send the money to people, let them go to the insurance companies. But there's no evidence that that would help to lower premiums, is there?
Right. So it seems like President Trump is coalescing around a plan that we've really said that we had our eyes on for a while here. Likely from Senator Bill Cassidy, Republican from Louisiana, leads the HELP committee. He wants to see more money going into health savings accounts. This would be a bid to encourage Americans to try to get into plans that have lower premiums but higher deductibles, with the idea that if they have more money in their HSAs, then they can afford higher out-of-pocket costs. But as you're saying, we really have to see how this actually threads the needle to lower prices for Americans down the line. And really, the deadline is coming up in a matter of days that millions of Americans could see their costs spike related to healthcare if at least an extension doesn't get done. So Republicans could potentially hammer out a different sort of deal. Again, in that Politico interview, President Trump didn't rule out an extension on these ACA tax credits, but it's very clear that he wants to see a different plan.
Yeah, so it's interesting to see Bill Cassidy teaming up with Mike Crapo here, Finance Committee Chair, because John Thune needs to pick something, right? They're going to vote on Thursday on a Democratic plan. The question is, will there be a Republican answer?
Right, and he seemed to lend his support to this idea. I mean, as you're mentioning, this is the vote that Democrats wanted to see. This is how we reopened the government. We're going to get deja vu all over again. Back. But it doesn't really feel like there's any sense that that plan, it's a 3-year so-called clean extension. They're not going to put into effect any sort of structural changes like income caps or anti-fraud provisions that Republicans want to see, that's really going to ultimately get over the finish line. So then that leaves with the ball really in Republicans' courts on what's going to happen. Though worth mentioning, there are some Republicans we have our eyes on, like Josh Hawley, hasn't said that he would support the Democrats' plan, but says that he wants to support something. It's not a good look for Republicans. He says if they don't put something a little bit more concrete on the table.
Tyler, thank you so much. Reporting here in Washington, our Washington correspondent, Bloomberg's Tyler Kendall, with the latest from the White House and from Capitol Hill, both ends of Pennsylvania Avenue, trying to manage this healthcare issue as we speak, not to mention what is happening in Ukraine and throughout Europe right now. President Trump has been speaking quite a bit about this recently, with a new security plan and a new peace proposal for Ukraine. We find the headline on the terminal. Before we spend some time with the foreign minister of Slovenia, Trump gives Zelensky days to respond to a peace proposal. This is the plan that has been hashed out with Steve Witkoff, Jared Kushner, and to a lesser extent, the Secretary of State Marco Rubio over the past couple of weeks. Trump's envoys, according to the Financial Times, have given Zelensky only days to respond to a proposed peace deal. The president saying just on Sunday evening at the Kennedy Center that he was disappointed President Zelensky hadn't even read the proposal yet, because there are great concerns that this proposal favors Russia and would force Ukraine to give up part of its sovereign territory. Bigger questions about President Trump's view of our allies in Europe? He was asked about this in his sit-down interview with Politico. Listen.
I think they're weak, but I also think that they want to be so politically correct. I think they don't know what to do. Europe doesn't know what to do. They don't know what to do on trade either. I mean, I look at a lot of the trade, situation that's going on over there. It's a little bit dangerous.
That's where we start our conversation with the Minister of Foreign and European Affairs, the Republic of Slovenia. Tanya Fajon with us live from World Headquarters in New York. Minister, welcome to Bloomberg TV and Radio. It's great to have you with us as part of our conversation. We'll start broadly here in the President's remarks about Europe. Is he missing something that you wish he knew?
First, thank you for inviting me. We just held a very good discussion in the Security Council on Ukraine, which was at points quite emotional. And rightly so. We are observing the fourth year of brutal Russian aggression in Ukraine with a lot of civilian deaths, a lot of children deaths, destroyed energy infrastructure, and severe violations of international law and the UN Charter. So everyone, including Ukrainians, wants to see just and lasting peace. And everyone in the Security Council, 14 countries, are permanently calling for an immediate and unconditional ceasefire. So I think it is very clear. That is Russia. We want to see peace, and we want to see just and lasting peace. That means that the peace is also acceptable for Ukraine.
Yeah. Well, we should note, and I appreciate your answer, that Slovenia currently holds the presidency at the UN Security Council. So your views are important here. Do you worry that this plan on the table now favors Russia and would hurt Ukraine and therefore the rest of Europe?
I mean, the negotiations are ongoing, and I, of course, commend the U.S. administration, Trump, and everyone involved, because it is good that there is a time also for diplomacy, for searching for political solution instead of a military one. Of course, first is, as I said before, immediate and urgent ceasefire needed, and then meaningful negotiations. Ukraine has to be at the table. Europe has to be at the table. We are discussing about strong security guarantees for the countries. That something like similar wouldn't happen again in the future. And it's also about accountability. It is a brutal war that is ongoing. We see really horrible acts. I was traveling myself not long ago in Ukraine, in several parts of the country. When you see young people, children being amputated without legs, without arms, I mean, these are wars victims. So we do have to all do more, and I encourage the diplomacy to work, and I encourage all sides to be equally engaged, especially Ukraine, because Ukraine is deciding about its own future. We speak about territorial sovereignty and integrity. No one by force can change the internationally recognized borders.
You know, when you consider the idea of this peace plan being accepted within days, the FT is reporting that that timeline is keying off President Trump's hope to have a peace deal in place, a deal agreed to by Christmas. Minister, is that possible?
I mean, I wish to see that it is possible. I think we all wish to see a just and lasting peace for Ukraine and a peace agreement. But this is a question mostly for those that are sitting at the table. I speak mostly here about President Zelensky. He's speaking about the state and about the future of his state. That's why I say it's very important that everyone is at the table, that the dialogue is ongoing, but still, as long as there are bombings every day, I don't see it's a good way to find meaningful negotiations. So yes, I do commend the efforts of Trump and administration, because we start talking, and Europeans, but it is clear how these talks should be conducted, meaningful way and based on an international law and a UN Charter.
Minister Fajon, President Trump sat for an extended interview with Politico and was asked about these negotiations. I'd like you to hear what he said, and we'll have you respond. Listen.
Which country right now is in the stronger negotiating position?
Well, there can be no question about it. It's Russia. It's a much bigger country.
Zelensky rejects this deal.
Yeah.
Like, is there a timeline? Is there a point at which you say, okay?
Well, he's going to have to get on the ball and start accepting things. You know, when you're losing, because you're losing.
Do you think Ukraine has lost this war?
Well, they've lost territory long before I got here. They lost a whole strip of seafront, big seafront.
Minister Fayon, I'll ask you the same question. Do you believe Ukraine is losing this war?
I think Ukraine has high moral, and it's quite an inspiration to see people fighting for their own territory and the country. As I said before, no one, and I will repeat it, no one can by force simply take your land away. We had our own history in former Yugoslavia, and that is why I say it's all about territorial sovereignty and integrity. If there is meaningful negotiations after the ceasefire, it has to be respected and negotiated. So I do hope that the presidents, Putin, Zelensky, Trump, will sit down and find a solution that is acceptable for peace, for security, and for the future of Ukraine.
Well, you remind us, Europeans have long memories. And I wonder, even if we have a peace deal with signatures on the table and a security guarantee, does history suggest you can trust Vladimir Putin with a deal?
I mean, we are this year in 80th year of anniversary of United Nations. 80 years ago, our leaders committed to values of securing collective peace and security for our citizens around the world. I think this is a good moment to reflect ourselves, where is our responsibility, and maybe to recommit to these values. I think we live in times of this terrible geopolitical turbulence with too many armed conflicts in the world, and we need to protect civilians. And I think this is our really moral, if nothing else, responsibility.
If Volodymyr Zelensky gives up the Donbass, gives up territorial gains that Russia has made, Minister, in our remaining moment, what will that mean for the rest of Europe?
You don't expect that I will prejudge the negotiations and the end result. I think this is up to President Zelensky for the talks about what is acceptable and negotiable for Ukraine, that is clearly the victim of this war.
I'm really glad you could join us today, and I appreciate your coming to see us at our headquarters in New York, Minister. Thank you. Tanja Fajon, Minister of Foreign and European Affairs, the Republic of Slovenia, in a conversation you will not hear anywhere else today. Of course, on Bloomberg TV and radio, The Exception. I'm Joe Matthew in Washington with much to discuss here as we turn from the situation in Ukraine back to politics here at home. And our signature panel will be up next. The president sat for that extended interview and touched on a range of issues, including the healthcare debate here in Washington, geopolitics around the world, and prices here at home. With the president flying to Pennsylvania today to talk about affordability, we'll have more with Rick Davis and Jeannie Shanzano straight ahead on Bloomberg.
121 on Wall Street. We do check markets all day long here at Bloomberg. We have got the Dow lower, the S&P 500 erasing most of its earlier gains after a warning from J.P. Morgan Chase on the health of the consumer. Right now, the S&P is up 7, well off session highs, up by 0.1%, but the Dow down 94 right now, down 0.2%. JPM certainly weighing on the Dow. For Citigroup shares, right now, the NASDAQ Composite Index up 60 points. That is a gain there of 0.3%. And the Mag 7 Index up now by 0.6%. The 10-year, 4.17%, with the 2-year, 3.60%. Gold up $16 the ounce, higher now by 0.4%. Silver is up 3.8%. And West Texas Intermediate Crude down 1%, 58.27 a barrel on WTI. Bitcoin up 3%. Bitcoin back above 94,000, has been fluctuating 94,043 right now on Bitcoin. Luxury home builder Toll Brothers beat analyst estimates for quarterly orders while providing full-year guidance for 2026. It did fall below expectations. Toll Brothers shares down 0.6% among other home builders. Lennar down 2.1%. KB Home lower now by 0.4%. Again, recapping here, S&P 500 index up 6, up by about 0.1%. Balance of Power continues now. Back we go to Washington. Once again, your host, here is Joe Matthew.
All right, Charlie, many thanks. We'll have more on the markets with Charlie Pallett in just about 20 minutes' time here on Balance of Power. Thanks for spending part of your Tuesday with us on Bloomberg TV and radio. We're streaming live on YouTube and always on your satellite radio at channel 121. Big questions about what's going to happen as we make our way through the week, but we're actually asking questions about what will happen later today, even as the president leaves the White House for Pennsylvania. And this will likely sound familiar if you watched Joe Biden go through the affordability crisis and the heights of inflation in the last administration. It was typically Pennsylvania where he would travel, if not to Scranton itself in his hometown, to get down to kitchen table issues and talk about, yes, affordability. A term and a concept the president likes to call a Democrat con job. So squaring these two ideas could be interesting when he stands before thousands later on, making his way to Mount Pocono after a Christmas party at the vice president's residence. The president was asked just yesterday about this idea of affordability as a hoax or a con job when he sat down to talk about a farmer bailout in the cabinet room at the White House. Listen.
You can call it affordability or anything you want, but the Democrats caused the affordability problem. I think the prices are going to be going down already. I mean, the prices are way down. We brought prices way down from what it was. We inherited high prices. Inflation is essentially gone. We have it normalized, and it'll go down even a little bit further.
But of course, the data we talk about on the regular, at least when the government is open, would not confirm that prices are down. In fact, flat in some cases and even higher in others. The president likes to reach toward gas prices, which have been trending lower, and some of the deals that he's made when it comes, for instance, to pharmaceutical prices, but people haven't felt those yet. And we could be in a world where healthcare premiums are about to skyrocket, at least if something isn't solved on Capitol Hill. So let's assemble our political panel for more on affordability and how the president is going to approach this today. What is the strategy that could work that maybe Joe Biden did not enjoy? Rick Davis and Jeannie Shanzano, as you can see, are with us. Bloomberg Politics contributors. Rick is our Republican strategist partner at Stone Court Capital, and Jeannie is Democracy Visiting Fellow at the Harvard Kennedy School Ash Center. Great to have both of you with us. Rick, this is a tough order for President Trump. President Biden was never able to close this deal. What should be the approach today as he tells people that they may not be feeling what he is seeing?
Well, Biden, who did oversee one of the largest inflation spikes in our nation's history, was running for re-election. We didn't realize that he wouldn't make it all the way, but at the time, he was trying to be empathetic. He was trying to show the kinder, gentler Joe, Uncle Joe's side. I feel your pain kind of approach, and that was a disaster because at the same time, he too was vaunting all the positive things his administration was doing to bring these prices down, and consumers weren't buying it, right? Nobody bought that line. Donald Trump is not running for re-election, so he has more options on the table. A little truth to power might be a good approach. A forecast for how we're going to deal with it methodically over the course of the next 2 years. But then that takes away his optionality, and Donald Trump loves optionality above everything else. He loves to be able to turn on a dime. What's working today, if it's not working, we'll try something else tomorrow. So honestly, he talks about this is a great economy. It's an A economy, A++++. And I think, this is one strategist talking, that if he goes into this conversation in Pennsylvania and tries to convince people that they aren't feeling good enough because the economy's so great, that's going to backfire on him.
How about just give me a minute, Jeannie? A little bit of honesty. You know, we've got a big plan. He likes to say, I inherited a mess. So give me a minute. Short-term pain, like he said, with the tariffs, long-term gain. Do people buy that?
Well, that's what J.D. Vance has been trying to say. That's what Scott Bessent has been trying to say. They are following the directives coming out of the politics arm of the White House. But of course, they are much better at staying on message than Donald Trump, who famously does not want to listen to people who tell him that he's got to say, give us more time. The politics strategy folks are also telling him, stop blaming Joe Biden, start contrasting your plans with those of Democrats in Congress. He's not interested in that. So it's going to be very curious today to see how he threads this needle, because of course, he wants to say what he said in that interview to Dasha Burns yesterday, which is that I get an A+++++. And of course, the problem for the president is we don't grade ourselves. You know, it would be nice in life if we were grading ourselves, but that's not the way this works. Somebody else grades us. And in this case, it's the American voter. And, you know, Rick's right. He's not running again, but you know who are? All of his Republican counterparts that are running in Congress. And if he loses this House in the midterm, he has a very long 2 years left on his term when the Democrats will be using oversight powers to investigate him. So he's got an awful lot at stake here, and he's got to get this messaging right today.
You know, Jeannie's a professor at Iona University. I bet she's a hard grader. Remember the daily interviews? They're just grinding through these interviews with Jared Bernstein, Ian Deese, the Biden economic team. They talked about shrinkflation. Right, they brought the meat packers into the White House to talk about gouging. They talked about supply chain. Will we hear specifics like that from this administration? Because it didn't work, obviously.
Yeah, I don't think so. I mean, Donald Trump is the ultimate promoter, right? And you don't promote the negative. I mean, like, go to where he is. He wakes up every morning and says, this is great. I mean, like, you know, and even though he does things like attack his allies and things like that, it's because other things are happening that are even better than having allies. And so I doubt if he's going to go after sectors, unless there's something specific he's trying to get from that sector that he's trying to do. And remember, Jimmy Carter, who I'm old enough to sadly remember the high cost of power, and he said, put on a sweater and turn down your thermostats. Well, that went over well.
Yeah, right.
And so there's no evidence that having this sort of serious conversation with consumers is any more effective than, you know, being the grand promoter and saying everything's fine. So I just think he's going to be who he is, right? Whether we like it or not, Donald Trump is the cheerleader in chief of the United States of America and our economy. And more, he's even realizing it's his economy. So if it's bad, it's Biden. If it's good, it's me. Sure. A year from now, it'll be all me because it'll all be good.
Yeah, well, it's tough to get out of the bubble sometimes when you're the president, Jeannie. He's going to be standing in front of throngs of supporters, right? They're probably waiting in line right now. He'll hear the cheering and the USA chants. He'll probably figure that this is working out pretty well, won't he?
Yeah, and that's the problem, right? And we saw it with Biden. We're seeing it with Trump. Incumbency is a benefit, but it's also a drawback. You are in the bubble of the White House. In this case, he hasn't spent a lot of time on the road. It's one of the very few excursions he's taken out on the road because his numbers on the economy are dropping so fast, and it's such a problem for him. And yeah, people will be waiting out in the cold and they will be cheering for him, but nothing changes the numbers or how people are feeling. And that's the problem he has to contend with. And there's no easy way to contend with it, except to say, I've got a plan, and if you hold on and wait, it's going to be coming. But that's not what people want to hear. And of course, that means he's going to go out there and probably bolster what he's done and blame the problems on Joe Biden, which, by the way, is just what he's been doing. The only difference here is he's going to do it in Macomb County. And, you know, this is a county that matters. And I think it's a sign how concerned he is about the midterm, that this is one of the counties that straddles two districts, two of the few in the country that are up for grabs in the midterms. And he is desperate to hold on to the House as we go into the midterm.
Would you send the boss to Pennsylvania, and where should he go from here if this is the road show?
You know, I'm not sure I would go to Pennsylvania.
That's your point. He's not running for
as
re-election.
Pennsylvania goes, so does the country. But he's not on a ballot.
Yeah.
And he's inviting a week's worth of response from Josh Shapiro, who is running for president.
Yeah.
And it's almost like handing a Democrat a gift bag from this administration.
Yeah.
So I think I would find a much more benign state with a Republican governor.
Mm-hmm.
Everyone's got the same problems. There's nothing unique about Pennsylvania, only its zip codes nearby.
Sure.
And I think that would be a more effective tool, because then he has a governor who's going to go around that state for a week and talk about how right he is, not how wrong he is.
Interesting. And as you're filling out that map in the strategy meeting, Rick, are you adding frontline Republicans who could be at risk in certain districts? Are you trying to target midterm races while you're trying to deliver your own message?
Yeah, I mean, look, this is obviously a very skilled political operation around Donald Trump. They've done things that nobody else thought they could accomplish. But I have not seen the gang tackling on administration priorities the way previous administrations have done it. You know, there was a real lack of interest in selling the one big beautiful bill. His signature legislative achievement, arguably for the rest of his term, and nobody went out and really sold it other than the vice president, who it was like an afterthought. And Republicans today grumble about that because they have to go back to their districts and defend it. Right. And they didn't get any high cover from cabinet members or from the president himself. And so I'm not surprised that this is a lone wolf effort. I mean, where's the entire cabinet push out to all these other states, all these other businesses? What events are going to be held in Washington while he's in Pennsylvania, echoing the same message? None.
So what do you make of that, Jeannie? Is it because Donald Trump, in our remaining moment, is the only one who can sell it?
He is the best salesperson they have, obviously. He's one of the best in the country on both sides of the aisle. But the reality is people have been out. Members of his cabinet are on the air all the time. They are not necessarily going throughout the country. But the problem is they don't have a lot of good news to sell. We are facing a crisis in healthcare. They've got no answer for that. We are facing, you know, a really coming off the heels of a really bad election season for them. Consumers are angry. They're facing Christmas. So, you know, it's got to be Trump that's out there. There's not a lot else they have to offer, and he's got to trumpet this.
Well, we'll see how many dolls we can afford this Christmas. Jeannie Shanzano and Rick Davis, the best we have. Many thanks to our panel. Coming up, our conversation with Senator Pete Ricketts, the Republican from Nebraska, weighing in on all the issues we're talking about today, only on Bloomberg.
It's 1:40 on Wall Street. We do check markets all day long here at Bloomberg. We have got the Dow Industrials trading lower right now. The S&P, NASDAQ both holding on to gains barely on the S&P right now. Little changed up under 0.1%. The S&P 500 wiping out most of its earlier gains after a warning from JP Chase on the health of the consumer. JPM shares down 4.7% right now. Again, the Dow trading lower by 154, down 0.3%. JP Chase weighing on the Dow. S&P up 3, little change there, up under 0.1%, while the NASDAQ Composite Index is up 55 on NASDAQ. That is a gain of 0.2%. The 10-year ahead of the Fed decision tomorrow, 2 o'clock Wall Street time. The 10-year 4.18%, with a 2-year currently yielding 3.60%. Gold right now up $15 the ounce, 42.06 on the precious metal, up by 0.4%. Silver, though, outperforming, up 3.9%, 60.42 for the ounce on silver. West Texas Intermediate crude down 1.1%, 58.20 for a barrel of WTI, and Bitcoin now up 2.9%, 93,985 as it moves right around the $94,000 level. PepsiCo reached an agreement with activist investor Elliott Investment Management to reduce its U.S. product lineup by 20% and lower prices, while the company also pairs its workforce. PepsiCo shares down 1% today. Rival Coca-Cola down by 0.5%. Recapping, S&P higher by 2 right now, up just about 0.1%. JP Chase down 4.6%. The 10-year 4.17%, and Bitcoin up 2.9%, 93,959 on Bitcoin. Balance of Power continues right now, and back we go to Washington. Once again, your host, here he is, Joe Matthew.
All right, Charlie, we thank you, sir. Charlie Pellet will be back top of the hour, 2 p.m. Eastern time with his read on the Tuesday trade. Thank you for spending part of your day with us here on Balance of Power. We're live in Washington, covering both ends of Pennsylvania Avenue, and they do collide on this issue of health care as the president prepares to head off to Pennsylvania to talk about affordability. You chose a very smart time to join us because an important lunch directed by the Senate Republican leadership has just wrapped up, and we might be able to start answering some of the questions that we've been asking in our conversation earlier with Rick Davis, Jeannie Shanzano, even earlier with Ashley Davis. Republicans' answer to the Democratic proposal on health care reform. This came up last evening in Donald Trump's conversation on Politico. He held an extended interview in which the issue of extending the enhanced Obamacare subsidies came up. Dasha Burns asked him about this. Listen.
Will you tell Congress to extend those Obamacare subsidies while you work out another deal?
I'm going to have to say, I'd like to get better health care. I'd like to have people buy their own health care, get much better health care. And what I want to do, very simple, I want to give the money to the people, not to the insurance companies.
Just one of the ideas floated in this lunch meeting, I can only assume, on whether to hold a vote on a Republican-drafted alternative to whatever Democrats are going to put forth in the promised vote on Thursday. And what we understand is Democrats will seek a 3-year extension to these COVID-era subsidies. A man who was in the room, this is why I say you picked a real smart time to join us on Balance of Power, because a man who was in the room is with us now. Senator Pete Ricketts, Republican from Nebraska, live on Capitol Hill. Senator, it's great to see you. Are you any closer to answering these questions about what a Republican answer might look like?
Thank you very much for having me on. And indeed, Republicans are going to put forward our own plan with regard to how we fix this broken system. Obamacare has been a disaster for the last nearly 20 years. It's failed to deliver on its promises. You can't keep your doctor. Prices just kept going up and up and up. And we know that there's solutions out there. I agree entirely with what the president was saying, is give the money to the people and not to insurance companies. In fact, in the bill that we just passed earlier with regard to reconciliation, we changed it so you could put HSAs with bronze level plans to be able to give money directly to people as opposed to giving it to insurance companies. We know there's a variety of other things that will work as well, like allowing people to buy insurance across state lines, association healthcare plans, creating high-risk pools for people who've got pre-existing conditions to take care of them. So I think there's a number of things that we can do to be able to offer the American people that will actually help start bringing the cost down instead of this failed system that, again, the Democrats very cynically, passed these, Biden, Obamacare, pandemic subsidies, these bonuses, and they're about to expire, but they were really meant to buck up a system that was failing. And so just throwing more money at a system, and to your point about Democrats just want to extend the same system that we already know is rife with fraud and corruption, that's wasting, millions and millions of dollars. This is not what we want for the American people. We want to try and find solutions.
Well, it was noteworthy that Senate Majority Leader John Thune last night decided to back the plan put forth by Bill Cassidy and Mike Crapo, Senator. It doesn't sound like the caucus has arrived at a plan. Is that fair to say?
Actually, I had to leave the lunch before to get to this interview, so I don't know what the final outcome was. But we were discussing, as you point out, this very idea of what we want to put forward. And I think that putting forward our ideas with regard to how we actually address healthcare, I know as coming from a Nebraska senator, I want to deliver for Nebraskans. We want to be able to show that we have got a plan that will help Nebraskans' healthcare costs actually go down, not continue to go up the way it has under Obamacare. I think most Nebraskans know that Obamacare has been a failure. So we as Republicans want to show, here are some of the ideas that can actually make a difference versus continue to support the same old Democrat system that we know has failed and, frankly, is rife with corruption and fraud.
I almost feel like I should apologize for pulling you out of that meeting, Senator. That's pretty important stuff. Do you have confidence that there will be a solution? We hear about what's going to happen with subsidies and premiums rising 2, 3, and 4-fold if we go over the so-called cliff. Will there be a solution before the end of the month?
One of the things I think it's important to note is that when the Democrats put these Obamacare, COVID bonuses out, they took the caps off who could get them. So we're providing these to people at much higher income levels. What we really want to do is focus on helping people who are at the lower income levels with regard to that. I absolutely believe there's a solution out there. We do need Democrats' help on this, right? We need to get to 60 votes to be able to pass anything with regard to how we're going to reform health care. So I certainly encourage Democrats to look at how we can find common ground and solutions on bringing the health care costs down for people who we really need to be helping. And really, for those folks at the higher income levels, let's look for solutions that involve them actually maybe getting private health care or other solutions. But really, as a government, we should be trying to help the people who are at the lower income level.
I want to ask you about chips and national security, Senator, with your position on the Foreign Relations Committee. You're up with an important bill here, and it's something that's very important to our listeners and our viewers on Bloomberg, having just spent 24 hours talking about NVIDIA potentially selling H200 chips to China. Of course, we'll see if China allows that to happen. But you've got a SAFE Act you're co-sponsoring with Chris Coons that would essentially codify the export controls, as I understand it, where they are now. It would cement them in place. Does your bill compete with this idea of selling H200s to China?
So our bill, the Safe Chips Act, is designed to make sure that we don't sell our high-end AI chips to China. And I really think it just supplements what the administration is trying to do. It does give the Commerce Secretary the ability to adjust the standards 30 months down the road. If the administration gives licenses on the chips like the H200, it doesn't revoke any licenses the administration gives out, but it does really set a bar to slow down the number of chips that would be going to Communist China. We need to remember that Communist China only produced about 570,000 of these chips last year compared to us and our allies producing like 20 million. They need us. We need to slow this down. We don't want a world where China is dominating AI. I know for my state and Nebraskans, I was, as governor, the first governor to ban TikTok, for example, on our state devices. Nebraskans understand the risks that Communist China poses. We don't want a world where it's Communist China's authoritarian values dominating AI. We want to be able to be the ones that are setting that. And so we want to keep our competitive lead. And that's what our Safe Chip Act really is designed to do, is to be able to help America keep our AI chip lead.
So are you cool with selling H200s to China, Senator, or are we playing with fire here?
I think it's dangerous and risky to give China high-end AI chips. I'd certainly encourage the administration to think about the risks that they're taking when they do this. I don't know what the advisors are advising the president on this with regard to that, but I think there is a risk here that, you know, China and other industries has taken our technology, copied the intellectual property, and then kicked our companies out. They've done this in all these industries, and Xi Jinping specifically has said that he doesn't want to be dependent on the United States at all for any of these AI chips, and they've invested billions and billions of dollars in trying to get away from us. So we should really take him at his word and not help him actually get the technology and the know-how and the chips, frankly, for the compute power to be able to catch up with us in this AI race. It's important we continue to have a dominant position. And again, that's what our Safe Chips Act does, is really helps us as a country, delivers for us that national security.
Have you heard from Jensen Huang about this? His whole message has been the only way to win the AI race is to get the entire world on the American stack. If that's the case, does the H200 represent that, or are you drawing the line, for instance, at the Blackwell chip? That's the one that China cannot get.
Well, again, I think that we should slow down any high-end AI chips from going to communist China. And frankly, I think that just, again, I think that helps us actually supplement what we want to do with regard to dominating the AI tech stack with American technology outside of communist China. So remember, Xi Jinping, the dictator of communist China, wants to make sure that he's got his own chips and his own technology, and we should have a dominant lead on him, and that's actually how we will win the race in the rest of the world, to make sure they're using the AI stack with our technology, making sure they're using our AI models, you know, using our applications. That's what we want. And so again, keeping that commanding lead will help us make sure that we've got the ability to deliver that American AI technology stack to the rest of the world.
Yeah. Is the White House behind this, Senator? That would help a lot. I'm curious if you have the votes. If Donald Trump says go for it, that would help, wouldn't it?
Well, Senator Coons and I just introduced this bill last week. As you can see, it's a bipartisan bill. We've got not only Senator Coons on it, but Senator Shaheen and Senator Kim from the Democrat side, Senator Cotton and Senator McCormick on my side. So we are just starting right now to socialize this idea with my colleagues. We're going to continue to work on how can we make sure we limit the number of AI chips, especially these high-end ones, right, that are going to communist China, so that we can continue to have our lead. So we're going to continue to work with our colleagues here, and of course we'll work with our colleagues in the House and the White House as well to be able to get that done.
Really interesting moment that we're in with regard to Ukraine, Senator, and I know that the NDAA, the National Defense Authorization Act, includes, I believe, $400 million to support efforts in Ukraine through intelligence, through military, and so forth. Is that the way to end this war, is to continue supporting Ukraine?
Dictator Putin is only going to end this war when he thinks he's losing it. And so we've got to get to the point where he believes he's got more to gain through a peace than continuing this war. That means we need to continue to support Ukraine to make sure they've got a strong battlefield defense. Intelligence is obviously part of how we can do that. We also need to make sure we're ramping up the sanctions on them. And frankly, helping drive down the price of oil, such as the administration and President Trump have done, really helps us do that. That helps keep us safer when we've got a dictator like Putin who believes that he's under more pressure. So we should continue to do that. And again, that's how we deliver national security for our country, is to make sure that we got dictators in check. And so making sure that Ukraine is successful in pushing back on Putin is one of the ways that we can help make our own country stronger.
Well, in our remaining moment, Senator, do you support the peace plan that's being formulated, what you've heard about that so far? Do you think it rewards the man you just called Dictator Putin?
Well, we all want to see the fighting in Ukraine stop. And what we need to do is make sure that we have Ukraine in a strong position to resist aggression in the future. So making sure that they've got the weapons they need, they've got the army they need to be able to defend themselves, that they've got the support from Europe, and that they've got appropriate security guarantees are all the things that we're going to need to have to get to a final peace agreement. We don't want to have something where Putin can just years later, or even just the next year, decide he's rebuilt enough to attack Ukraine again. So it's got to be something that actually has Ukraine in a strong position to be able to resist aggression in the future, because frankly, again, Putin's a dictator, he's going to continue to come after Ukraine. Russia has done this for centuries. This is not something new that Russia has done just in the last, couple of years. So we're going to have to make sure that Ukraine's in a strong position going forward.
Well, Senator, I appreciate your time. You've been very generous, and it's good to compare notes on a series of topics today. Pete Ricketts, the Republican from Nebraska, with us live from Capitol Hill. Senator, thank you. We'll meet you back here on the late edition of Balance of Power that starts at 5 p.m. Eastern. We'll spend some time with Democratic Senator Tina Smith of Minnesota. Stay with us on Bloomberg.
This is Bloomberg Business Week Daily, reporting from the magazine that helps global leaders stay ahead, with insight on the people, companies, and trends shaping today's complex economy, plus global business, finance, and tech news as it happens. Bloomberg Business Week Daily with Carol Masser and Tim Stenivek, live on Bloomberg Radio, television, YouTube, and Bloomberg Originals.
All right, everybody. Yes, indeed. We're across Bloomberg platform. What's going on here? Is there a party or something?
There is a
Fed
party. There's a
going
Fed party. Michael McKenzie and Stuart Paul. You get these guys into the studio.
I know.
And we just start partying.
It's like the kegs come out, the Fed talk.
Speaking
no,
of
it
parties,
doesn't. The kegs do
Matt
not come
Miller.
out.
was in here yesterday with you.
He did okay,
I got to
right?
catch some of the show.
You know what he said?
What did he say?
He's like, if that Stenovic dude isn't here, just call me.
Oh, I thought he was going to say, hey, that's a hard show. You guys do a lot of work.
He does, yeah, but you know what? He comes to play.
Oh, I know. You sounded great.
Yeah, he did pretty.
Not too great, though.
But we missed you.
Okay, well, I'm glad to be back.
We're glad to have you back. All right, and especially as we are counting down to the Fed. We know the Fed kicked off that 2-day policy setting meeting. Stocks a little changed, kind of bouncing around a little bit. U.S. yields we've seen moved higher. So we're going to get into that, kind of what's to come maybe in 2026. We've actually got a Fed policy and rate strategy session.
Yeah, we're going to have Michael McKenzie join us in just a minute. Also, StartupPal of Bloomberg Economics. He's here as well. Also, we're going to be speaking with the head of multi-asset solutions at Van Eck in just a few minutes about the market implications of everything happening right now, including the policy meeting.
Curious what he has to say about maybe might be his favorite asset class right now. Hey, also we get a read on the economy with Lauren Hochfelder back with us, co-CEO of Morgan Stanley Real Estate Investing. Curious what she is seeing. I looked at a lot of REIT performance, not so great, but certainly rates play into this. So we'll talk with her in just a moment.
All right, and get out the whiteboard, Carol.
Okay.
Because we're going to dive into the financial web behind the hostile bid for Warner Brothers Discovery and what the bidding reveals when it comes to the fledgling cable networks.
There are some incredible deep dives that our Bloomberg News team has done into this. All right, we're going to get to it in just a moment. First up, though, let's get a look at that trade as we await for that Fed decision tomorrow. On it all, Charlie Pell.
Hi, thank you very much. Warner Brothers Discovery, by the way, trading higher again today, up another 2.7%. The Dow lower, the S&P, NASDAQ 100 index trading mixed right now, right to the numbers here with the S&P 500 index up 4. Little change now, up under 0.1%. Dow Industrials down 121. A drop there of 0.2%. The NASDAQ Composite Index up 53 for NASDAQ, a gain of 0.2%. And the Mag 7 Index up 0.5%. Your 10-year at 4.18% with a 2-year 3.60%. Gold is up $19 the ounce, 42.09. The precious metal now up 0.5%. Major move though for silver. Right now we are looking at silver pushing higher by 4.1%. Brent crude down 0.9%, 61.94 a barrel, and Bitcoin at 93,870. Bitcoin up by 2.8%. Lots of AI news on this Tuesday. Microsoft pledging to invest $17.5 billion on AI and cloud computing in India. Alphabet's Google has been hit by a European investigation over fears it may have abused its dominance by using its own AI tools to squeeze out competition. And Wells Fargo CEO Charlie Scharf says AI poses a significant opportunity to improve efficiencies and has the potential to influence companies' headcount decisions. Recapping, S&P 500 index, little changed, up 3 right now, up by under 0.1%. The 10-year ahead of the Fed decision tomorrow, 4.18%. And right now we've got Bitcoin up 2.7%, 93,790 on Bitcoin. I'm Charlie Pellet. That is a Bloomberg Business Flash.
Hey, thanks for that update, Charlie. Appreciate it. As you were doing the news there, some breaking news coming in. The redhead crossing the Bloomberg terminal. The Food and Drug Administration is investigating whether COVID-19 vaccines cause deaths in adults as part of a safety review that's broader than was previously known. The investigation is being conducted across different divisions of the FDA. It earlier appeared to just be focused on children. Numerous studies have shown that COVID vaccines are safe. A spokesperson said, quote, the FDA is doing a thorough investigation across multiple age groups of deaths potentially related to COVID vaccines. Once again, that's a spokesperson in a statement to Bloomberg on Tuesday.
All right. Helps if I push the button. A lot of papers here because I was looking at all of my stuff on the Fed, the eco outlook, and also the bond market. Hey, we do know the Fed has kicked off its 2-day meeting, policy setting meeting today. 24 hours from now, we will have had that Fed decision, and we'll be awaiting commentary from Jay Powell, chair of the Fed. A quarter point cut, widely anticipated, expected, largely priced in according to many. But what's next is probably even more important, especially for a Fed that's undergoing changes with more likely to come in the new year. So let's get to it. And I'm curious about how informed the Fed is making their last decision of 2025. With us is Bloomberg Economics U.S. and Canada economist StartupPal right here in studio, along with Bloomberg News rates reporter Michael McKenzie. Stuart, I want to start with you. How informed is the Fed in making this last decision of 2025, considering the lack of data still kind of trickling its way through because of the government shutdown?
Look, I think that the Fed is actually very well informed. We have so much alternative data that if you were really depending on a single jobs report number, you just fundamentally don't understand the economy. I think that I give the Fed enough credit to, and the Fed staff enough credit to think that they have some reasonably strong understanding of underlying economic activity. I think that what's going to be most difficult right now, though, is communicating about the economy when they don't have a lot of the key indicators that we use as common reference points, things like the unemployment rate through October and things like CPI through October. If you're going to say that you're data dependent, but you don't have those specific reference points, it becomes a little bit more difficult. But when we look at the broad swath of economic data, we're looking at dozens of alternative labor market indicators. We're looking at dozens of inflation indicators, and so is the Fed.
Okay, Stuart mentioned some of the indicators that we're looking at if we don't have all of the official indicators that we would typically see and that the Fed would typically see, Michael McKenzie, ahead of a policy meeting. When you look at all of the data for jobs, for inflation, what do you see?
It's definitely softening, and I think what's problematic about the meeting tomorrow is that the data that the Fed needs doesn't get released until next week. You're going to get November jobs, November CPI. And so the bond market right now has sort of pushed yields up to kind of the highest levels we've seen since late September for both the 10-year and even the 2-year. And they've actually made January, they've sort of taken out the expectations of another cut in January, and they're pretty low expectations for a cut even in March next year. So the idea in the bond market is that the risk is that the Fed could be pretty hawkish. Powell could keep things open-ended, which he's likely to do. And we'll get a cut tomorrow, but the trade is January still going to be a pause, and we'll get an idea of whether January is a pause or is actually in play when we get the data next week.
What's trickiest for the Fed right now? I look at that dual mandate, right, in terms of full employment, price stability. Which one, Stuart, right now is more difficult or presenting more of a challenge for the U.S. Central Bank?
Well, getting inflation back down to the 2% target is the most difficult.
We've been trying for how long now? Like, it's a while.
Yeah, I mean, look, COVID preceded the major inflation push, and inflation peaked at 9%. It's just been a long slog since inflation peaked. And so getting back to the 2% inflation target is the more difficult thing right now. But of course, policymakers are more focused on the labor market. So as much as getting back to the target is the more difficult thing right now, all eyes are on the labor market.
What about the Treasury market and Treasury traders? I feel like the bigger thing, even though we talk so much about the equity market here, I mean, watching what has happened in yields, right? We're above 4%. For a while, I felt like we were talking that 4% was the high, and nope, we're going up there.
What the bond market is telling us a couple of interesting things. If you look at what's happened this year, yields are actually lower across all maturities for this year. And if you dig into the entrails of the bond market and you look at what are real yields, the yields, adjusted for inflation, they're actually lower too. And that's a proxy for growth expectations. So the bond market is kind of leaning in the direction that labor is weakening. We're in a slow hire, slow fire mode. But bond traders in the back of their minds know that in the past cycles, that's usually tips over into a rapider pace or faster pace of job losses. So the other interesting thing here is that for all the angst about inflation and when is it going to arrive from tariffs or from some other source, inflation expectations, which the Fed used to really lean upon, have remained remarkably stable, and they're steady, and they're actually signaling that over time the Fed will get back towards 2%. So I think what you've got then in turn is you've got some people in the bond market who are listening to some of the more hawkish members in the Fed Reserve, such as Beth Hammack, and saying, wow, they're really worried about inflation. And then they're listening to Christopher Waller, who comes from the sort of point of view that says the Fed should be more preemptive and get ahead of any risk to the economy and cut rates towards what is called neutral, which of course is a theoretical level that neither stimulates or slows the economy. And of course, the bond market thinks neutral's around 3.25. The Fed at the last summary of economic projections put the longer term dot in the dot plot at 3. So that'll be something that people will be watching tomorrow, whether there's any shift in that longer term dot. Because that's the debate. is the Fed going to get to neutral? Is the Fed actually going to have to go beyond neutral, or can the Fed stop before it gets to neutral? And that's what's going to really determine how we open up the beginning of 2026 and proceed. And then you throw into the mix the potential for a new Fed chair who comes in, and who knows?
Well, okay, so that's exactly where I want to go with Stuart. The who knows part of this. And the idea that, let's say we do in the next few weeks here, that a new Fed chair has been chosen. We don't know what the fate of Jay Powell will be after his term ends. We don't know if he'll stay. We don't know if he'll go. But what does it mean for the last policy meetings where he is chairman?
I think that beyond who's the next Fed chair, the thing that's going to be most interesting is that there are going to be such divergent views on the Fed. You're going to have this new slate of regional bank presidents who are coming in, and they're far more hawkish. So even if you do have a very dovish voice taking a governorship and becoming the next presumed chairman, somebody like Kevin Hassett being announced, confirmed, sworn in, it's going to be difficult for even that dovish potential chairman to build a large enough coalition to deliver really quick cuts. And I think that as long as Chairman Powell is sitting in that role, even if there is somebody who's like a shadow chairman, somebody like Hassett in that governorship spot waiting to take the chairmanship in May, even if you have something like that, Chairman Powell, I think, is going to want to tap the brakes quite a bit in the first half of next year because of his expectation that the next chairman is going to at least try to build a coalition to deliver cuts. It's going to be hard, but I think that Powell is going to want to keep his foot on the brakes a little bit.
15 seconds each. The thing you're watching out from Jay Powell, just quickly, Michael, tomorrow.
I think what everyone's going to be watching is when he talks about the unemployment rate.
Okay. And what?
Because we got very close to 4.5%, and that seems to be a line in the sand for the bond market.
How about for you, Stu?
I think that's probably right. I think that anything about the balance of risks in the labor market tilting toward something like accelerating firing would be really interesting.
All right. We are teed up. Guys, thank you so much. Really appreciate it. Of course, Bloomberg Economics, U.S. and Canada economist Stuart Paul, along with our Bloomberg News rates reporter, Michael McKenzie. We're going to stay on the macro. We're going to now talk about the trade in multi-assets.
And the head of multi-asset solutions at Van Eck Funds, David Schassler, joins us. Van Eck has approximately $162 billion in assets under management. David joins us right here in New York City. The Fed decision, the commentary, in your view, what's going to affect the financial market trade the most?
We are thematic investors, so I'm going to talk big picture, and then we can kind of narrow it down. So you've got three things happen, right? So think about it this way. You've got three basically mega themes crashing together at the same time, right? First one is clearly disruptive innovation. Yes, we're talking about AI, robotics, everything that, right? But in addition, you've got old world assets building new world, right? None of that happens without infrastructure development, raw assets, real assets. We're in a stealth bull market in real assets. And then third, we're in the debasement era, you know, and that's going to lead to more liquidity. Now we're talking about, I know you guys were talking before this about rate cuts, another 25 basis points, all moving towards and validating the thesis of the debasement era where liquidity is going to get easier out of necessity. So that's where we think we're going, and it completely changes the landscape from an asset allocation perspective.
Okay, so what are you, I just talked to our team and asked them, Michael McKenzie, Stuart Paul, who watch, too early to even think about that, considering Jay Powell is likely to leave the Fed next year when his term is up, and we get some new individuals on the U.S. Central Bank.
Yeah, so listen, Jay Powell, the attack of the central bank, their independence, him getting replaced, all that's happening, right? Who's he going to get replaced with? All that's happening, right? Now, the key is what's going to happen in the markets. AI, let's kind of go back to that because that's what's clearly going to drive markets. That's where the growth is, right? That's the focus. I think about AI in three phases, so that's how we frame it up. The first was the build. That's clearly where we spent the last 2 years, where anything attached to AI, billions of dollars in spend, all that was benefited. That's where the scarcity was. That's where the compute was. That's where the energy was. Then we moved to phase two. Investors are looking at it and saying, well, how do we get paid back? You know, you spend billions of dollars. Well, how do we get ours? And that's when we start asking questions like that, there's going to be a disconnect between hype and expectations and the reality. Make no mistake about it. we're of the camp that AI is going to over deliver and that it's not underhyped long term. But there's going to be a mismatch, and that mismatch is going to cause volatility.
Well, what is the
volatility?
I just want to jump in because the over delivering on AI, I think the concern that a lot of people have is what's the fundamental change that it makes to our economy? The idea that workers should be very worried about their jobs, because that's the promise that AI has, an increase in productivity, because this technology can do what human beings do. How do you look at that and the effect of that on the economy and the markets?
I think about it a little bit differently. So there's no doubt that there's going to be replacement, and the next few years are going to be particularly bizarre and uncomfortable for many, because where AI can replace, it's already replacing. So you see that in new college graduates. Anybody doing repetitive tasks where they're putting their head down and they're pushing computer keys, be concerned, think about expanding your skill set. At the end of the day, AI, which think about it as the brain, is going to combine with the body, which is robotics, to drive massive innovation, massive productivity gains, ultimately massive growth across the entire labor force. That's the setup. So you end up in a period of an abundance where you get better lives, higher quality of lives, longer lives, all that coming eventually. But the idea is really simple, is that human beings engage with this technology, as we have with every previous technological advancement as it relates to general purpose technologies, to make things better.
Well,
and that's the core assumption here.
So, David, the Mag 7, the Bloomberg Mag 7 total return index up 25% year to date, dropped more than 8% from late October to November 20th, and it's down about 2% since late October. The group has been definitely bouncing around as people question some of the spend by those hyperscalers that make up many of the names within the Mag 7. Is big tech, in your view, a buy, sell, or hold at this point?
It's a hold. And there's going to be more compelling opportunities as volatility is introduced, as people question the spend and the productivity payout. So in a very short period of time, unfortunately, I would say sell, but the reality is I would hold and buy into dips, because we're not entering this overexposed from our side. And that's the key, is not being overexposed. This technology cycle has long legs.
Yeah.
It's going to touch lots of things. It's going to require lots of old world assets. There's a stealth bull market going on in real assets right now as well. Natural resource equities are up more than the Qs this year.
Yeah.
People aren't talking about that.
Well, that's
how are we going to pay for this?
Well, 30 seconds. You have a favorite asset class. I mean, gold has soared this year. Bitcoin has bounced around. That's kind of the two extremes when you think about kind of the investment environment, with a lot of stuff, including private markets and everything, in the middle of that. So, favorite asset, just got about 25 seconds.
Bitcoin's a top performer by the end of the year, down 30%, mismatched off the Qs by about 50% this year, followed by gold. Gold will hit $5,000, we think, sometime in 2026. By weakness in technology, we're in a long-term innovation cycle.
Cool stuff.
All
Fun
right,
to
we got
have
some
you.
calls. There it is. We'll have you back.
We will in 2026. David Schassler, head of multi-asset solutions over at Van Eck Funds, joining us. That was some cool stuff.
It was. Hey, just real quick, an update on that story. The FDA probes if COVID shots might be linked to deaths of adults. We did see shares of Pfizer and Moderna briefly move lower, but back to now where they were before this report. This is Bloomberg.
It's 2:21 on Wall Street. We do check markets all day long here at Bloomberg. We have got the Dow lower, the S&P, NASDAQ. They are both holding on to gains. S&P 500 erasing most of its earlier advance after a warning from J.P. Morgan Chase on the health of the American consumer. J.P. Morgan Chase shares, they are trading lower today, down now by just about 4.3%. Bottom line here, S&P holding on to a gain of 3 points, up by about 0.1%. Certainly, though, JPM weighing on the Dow. JP Morgan Chase, as I mentioned, lower. Dow Industrials down now by 0.3%, down 141 points. NASDAQ up 52. It is advancing now by about 0.2%. Our Mag 7 index, the Bloomberg Mag 7 index, up by 0.5%. 10-year at 4.18% ahead of tomorrow's Fed decision. The 2-year currently yielding 3.61%. Gold up 0.4, 42.08 the ounce. West Texas Intermediate crude down 1.1% right now, 58.21 a barrel. Cannot ignore the move in silver today. The metal up 4.2%, 60.62 for an ounce of silver. And Bitcoin up 2.9%, 93,940 now on Bitcoin. BioNTech, Moderna, and Pfizer falling as the FDA examines COVID deaths. Right now, BioNTech shares down by 1.1%. Pfizer trading lower by about 0.9%. And briefly, CVS Health is raising its full-year profit forecast and says earnings will rise in 2026. CVS right now up by about 3%. And for on-demand news, 24 hours a day, subscribe to Bloomberg News Now wherever you get your podcasts. I'm Charlie Pellet. That is a Bloomberg Business Flash.
All right, Charlie, thank you so much. Carol Master along with Tim Stanovic live here at Bloomberg headquarters in New York City. Well, a double dose of kind of the saga and the bidding in the media space continues. We're, of course, talking about Warner Brothers Discovery, the battle for that. It brings us to a story on while Netflix and Paramount Skydance vie for President Trump's blessings in their competing bids for Warner Brothers Discovery. Investors have an irony, Tim, to consider.
The valuation of faltering cable TV networks, we're talking CNN, TNT, and Discovery, among the TV industry's least coveted properties, at least today. It's much of what separates Paramount's hostile takeover bid from Netflix's friendly offer. So here to dig deeper into this is Bloomberg News media reporter Hannah Miller. She joins us here in the studio. I just want to start with the basics here and remind everybody, even though I know they listened and watched yesterday
yes,
on Bloomberg Business Week Daily, the Netflix offer and the Paramount offer, they're not apples to apples because Paramount's offer includes the cable networks. Just give us the details there.
Yeah, that's totally correct. So they're different numbers and they're different assets. You know, Paramount wants the whole company. They want all of Warner Brothers Discovery, including those cable channels like CNN.
Which would mean CNN would live alongside CBS, which would be this bizarro world that has never existed before but could exist in the future.
Exactly. Netflix, they just want streaming in studios.
Which makes sense because they don't have those assets right now, so it would be really outside of their core competency to bring in, live TV.
That's right. Yeah, and if Netflix takes it, we'll see the spinoff of Discovery Global. Those would be those cable networks.
Okay, so then it raises the question of what ends up happening to those spinoffs and how are they valued?
Yeah, so that's the huge question here that, shareholders, the board, that's what they're looking at and weighing these two offers. They're trying to determine which one is superior. And the value of those cable networks, that's a key factor in that. And, Paramount is arguing that those cable networks are low, maybe around $1 per share. And, the lower that they want it, the sweeter their deal looks.
Yeah, exactly. I think we're kicking around $4 billion with our own internal Bloomberg intelligence folks. Having said that, I think, Hannah, you want to take a step back, go back 10 years, 20 years. Who would have thunk, right, that the cable industry would be facing such troubles or declining audiences? But here we are. I mean, viewers have a lot of options.
It's true, yeah, and it's very interesting to see this consolidation play out. You would maybe see two news organizations living alongside each other. These struggling cable networks housed under one entity if Paramount gets it. So it'll be very interesting to see how this plays out.
Although you think about NBC or something, right? They moved into a business news channel. They have MSNBC or used to have MSNBC, not anymore. But I'm saying the idea of Paramount having kind of a traditional network and then another cable network, some have thought, they have some digital, I think, offerings, but it doesn't necessarily not crazy.
Yeah, I mean, and I think we have to remember here that, the most valuable IP is that movie and studio stuff. We know Paramount is leaning
Feeding
really
the beast,
hard.
the content beast.
Yes, and David Ellison really wants to build out that Paramount Plus streaming service.
But I think Carol brings up a really good point, and that's when this is what she was flicking at, this idea that, even traditional media companies that have long had these storied cable assets, they're now trying to figure out what the future of those are. So you have, CNBC and the company or the network formerly known as MSNBC, now MS Now, being spun off into this separate publicly traded entity that Comcast has ownership of called Versant. And, they're trying to figure out, okay, how are we going to value that?
Yeah, and it'll be interesting to see, Versant is supposed to start trading in the new year. And that value, I mean, who knows? We'll see if that could play into what's happening with these negotiations.
Good point.
But it's just incredible, right? Content changes, how we get it, and what's coveted and what maybe not so much. Hannah, thanks so much. Really glad we could cover that aspect of the story. Bloomberg News media reporter Hannah Miller. We're going to stay on the battle, though, for Warner Brothers Discovery to a fantastically written deep dive into the hostile takeover bid for the company by Paramount Skydance that is backed by banks, billionaires, and sovereign wealth funds with the goal of torpedoing the deal that Netflix has put out there. So let's get to what is one of the most read stories on the Bloomberg. Sally Bakewell, I can't speak right now. I'm just going to point. Sally's here. She's Bloomberg News America's finance team leader. She's here in studio. The financing that's going in to make this happening, it's quite a list, and there's been some jockeying and maneuvering to kind of get the backing. Walk us through what's been going on behind the scenes.
There sure has been some jockeying and maneuvering, but what we have landed on now is a $54 billion bridge loan, which is coming from Bank of America, Citigroup, and Apollo, who are taking about $18 billion of that each. And there is also a big equity component of about $40.7 billion. Now, there are lots of interesting things to this. First of all, the whole of that equity is guaranteed by Larry Ellison, essentially, who is the Oracle founder, friend of Trump, and father of CEO David Ellison. Now, it's guaranteed by Ellison and by Redbird Capital Partners, and providing the actual equity are this host of names from the Gulf region, including Saudi Arabia's Public Investment Fund, the Qatar Investment Authority, and an Abu Dhabi relatively new company called Limad, as well as Jared Kushner's Affinity Partners. So you have this dash of tech wealth. You have this longtime ally of Trump in Larry Ellison as well. You have a spot of family with Jared Kushner, and then you have some Middle East money. And of course, Trump has, fostered some really close ties with the region. So the financing is notable because of the proximity a lot of it has to the president.
This is also a media question, but you brought this up on the call, Carol, when Rupert Murdoch wanted to buy Fox News, and the regulatory environment that he had to deal with as a foreigner who was owning a news asset or a broadcasting asset. Maybe it wasn't Fox News per se. Maybe it was the Fox Broadcasting Network. I want to make sure I get that right. And I'm wondering, Sally, and I mean, Hannah, feel free to jump in here too. If there's any sort of question about where this money comes from when it is with regard to owning these assets. Like, we've had cable assets that have had Middle Eastern money before, and news assets in the U.S. that have had Middle Eastern money before, but would that mean that CNN could potentially be owned by sovereign wealth funds, or partially, rather?
Yeah, and talking about this with folks in the industry, there is this sensitivity around the fact that this is a major news organization at play, that it could be money coming in from abroad. That's definitely something that shareholders are thinking about in looking at these deals.
Go ahead, Sally.
Well, this is the interesting thing about the financing, and some of the tweaking and the reworking of the financing stemmed from this foreign investor component. So they're originally in a proposal that was submitted on December 1st. So that was an earlier proposal. The most recent one was submitted December the 4th. A Chinese company, Tencent, was listed as providing $1 billion of equity. That is no more. And also in the most recent proposal, one of the points that was emphasized was how these Middle East funds they are foregoing governance rights. So they won't have board seats and so on. Apparently, there were no concerns expressed about that element, but I think the company is trying to ward off potential concerns emerging down the line.
What about the president's son-in-law, though? How much of a position is that? I mean, it's hard without getting political, but
Didn't the
hard to
president say yesterday he hadn't talked to him about it, and Jared Kushner is busy working on peace in Gaza?
Yes.
Yeah.
Okay, I just want to make sure.
Yeah, but I mean, okay. How much of that investment, how will he have a board seat? Like, I'm just curious, do we know how much we know about around that particular part of the investment?
I think the idea is that he will also forego his governance rights, i.e. not having a board seat. That is what the proposal said. And it's a kind of interesting playbook that's being developed here with Jared Kushner, because his affinity partners was also part of the consortium that agreed to buy Electronic Arts in September. And apparently he actually brokered the initial connection between the video game maker and the Saudi Arabia PIF, Public Investment Fund, and actually acted as a central figure in the talk. So it seems like he is a sort of pivotal figure in some of these deals.
I see all the names in here, and I hear them coming from you, and I think to myself, this is a very complicated deal involving a lot of advisors and a lot of bankers. But is it a complicated deal, or is it a deal of this size would typically have this many moving parts? The debt side, the equity part, and on the equity part, the multiple geographies and the multiple entities?
I think that's a really good question, because what we're trying to now look into is this $54 billion debt package, because the loan, this $54 billion bridge loan, is going to be guaranteed by Paramount's assets. Now, that's apparently quite weird in the market for a loan like this, a bridge loan like this. And a bridge loan is one of these things that you get, and then you bring in other banks to spread the risk. And once the acquisition is announced, after time, the loan is placed in a sort of more permanent form of financing, like bonds. And so what we're trying to figure out now, well, the fact that it's backed by Paramount's assets is an effort to get investment grade ratings, as far as we can understand, because Paramount currently does not quite have an investment grade rating. So there's just interesting elements to how this financing is being put together that are definitely a bit striking and a bit unusual, and we're trying to dig into that more.
So more to be known.
Yes.
More to be known. Yeah, I just think it's kind of fascinating. Either of you can weigh in. Is this it, or are we anticipating higher offers or another round? And I'm just curious, Sally, what you guys are hearing.
Ooh, I think I might have to punt that one to Hannah.
Hannah, are you hearing anything?
We know that this may not be a final offer, and they've left that open. Paramount has left that open. Warner Brothers has 10 days to respond, 10 business days.
Okay, so we'll see what happens. We know Comcast is out, though, at least for the moment.
I mean, yes, we heard comments yesterday publicly at a conference.
I mean, I'm not a conspiracy theorist, Carol, but if
you
you're
play
Netflix,
one sometimes
if you're
on.
Netflix, like, you know, and you don't get the assets, you want the next bidder to pay as much as possible.
Yeah.
So it ends up costing them that much more.
Right, exactly. It just, there's twists and turns to this one, and I feel like we're not quite done yet. So I know this may go into the new year. Thank you both for helping us understand this as we go, because there's a lot there. Sally Bakewell and, of course, Hannah Miller, we really appreciate it. All right, folks, you are listening and watching Bloomberg Business Week Daily. More when we come back.
It's 2:40 on Wall Street. We do check markets all day long here at Bloomberg. We have got stocks and bonds wavering. Traders are awaiting the Fed decision tomorrow, 2 o'clock Wall Street time. That's when it drops. 30 minutes later, the press conference, the news conference on Bloomberg Television and Radio. Here's where we stand right now. Little change, as I mentioned, on the S&P, up just 1 point, 68.48 right now, up under 1/10%. The Dow Industrials down 120. JP Morgan Chase weighing on the Dow right now. We've got the industrials down 0.2%. The NASDAQ Composite Index up 45, up 0.2. The 10-year 4.18% with the 2-year yielding 3.60%. Gold is up $18 the ounce, 42.09, up 0.4%. A major move higher for silver, up 4.4% right now. Bitcoin up 2.9%, 93,946 on Bitcoin. Briefly, the U.S. Defense Department says it's chosen Alphabet's Gemini for a government system to deliver AI capability for its roughly 3 million civilian and military employees. Alphabet shares up 1.1%. I'm Charlie Pellet. That is a Bloomberg Business Flash.
All right, Charlie, thank you so much. Carol Masser, along with Tim Stanovic, live here on Bloomberg Business Week Daily. All right, folks, you got casinos coming to New York City, including one by New York Mets owner Steve Cohen. Also recently on the Bloomberg, you saw the Energy Department planning to unwind a Biden-era program that promoted zero-emissions buildings. And then when it comes to real estate globally, which is something we certainly focus on, a story on a duplex apartment selling, Tim, for a record price in Hong Kong, 113 million US, in the latest sign of the luxury property sector in the city is bouncing back. But if you talk about China, they still have a real estate problem.
Yeah, they do. That's fair to say. Real estate top of mind for us always, but especially today in our weekly discussion on women, money, and power, where we explore the shifts underway in the world of money and investing, and the role women are playing in influencing and investing in those shifts. Back with us is Lauren Hochfelder, co-CEO of Morgan Stanley Real Estate Investing, got about $54 billion in assets under management. She joins us here in the studio. Welcome back. How are you?
Thank you. Great to see you.
So it's been a couple months since we last spoke to you. If we go back to August, and a lot has happened since then. We've had 2 rate cuts, another one expected tomorrow. Over that time, how has the real estate landscape changed for you?
Yeah. So at this point, we're nearly 4 years into a real estate correction. Since August, I'd say real estate values have really been flatlining. But we look into 2026 and we feel like we're at an inflection point. We've been bouncing around this bottom for quite some time, but it feels like the conditions are on the ground. Sellers are more motivated. Buyers are more interested, right? Debt markets wide open. Lots of things lead us to believe that here we sit, real estate values down 25%. This could be the transition into a recovery period.
Lauren, why haven't people been buying? I mean, I was looking at REITs as a whole. They're down, they're up only about 2.5% as a group. Data center REITs, according to our index, down nearly 16% year to date. Office REITs down about 14% year to date. Malls are up about 4% year to date. I just looked at a few different things. But why is it still, as you say, there seems to be a lot of metrics out there that would be supportive of investors coming in, including depressed pricing. Yeah. Why aren't they?
So, look, I think if you went back 12 months ago, many of these things were true then, right, as we headed into 2025. But what happened is we headed into 2025, we were hit with Liberation Day, and that created a lot of dislocation in the capital markets and, frankly, a lot of dislocation in the occupier markets because leases tend to be pretty long-term decisions for CEOs, CFOs, et cetera. And what do big decision makers do when hit with a lot of uncertainty? What is my supply chain going to look like, et cetera? They pause. And so you saw a real pause in decision making, which hurt industrial real estate in particular. You saw rents trend down for the first time in a very long time.
You know, we use the term real estate like it's a monolith, but it's not. I mean, there are so many different sectors within real estate. And certainly there are areas of strength, like at least here in New York City, we know that Class A office buildings, right? If you don't have one of those, you're kind of out of luck. And also data centers to a certain extent in many parts of the countries. What am I leaving off that list? Like, what is the area of strength right now?
Sure. Well, look, to determine what type of real estate is going to perform, you have to look at what human beings need, what infrastructure supports our daily lives. And I'd say living generally, so residential broadly speaking, is necessity-based and it is undersupplied. So as a broad matter, it is a sector we like. But let's get more specific. Look at the population of the U.S., what do we know? We know
Aging,
it's aging.
yeah.
Yes. Senior housing is a really high conviction strategy for us. 2026.
Well, you're not the first person to sit in that chair and tell us that, senior housing is high conviction,
Yes.
which leads me to believe that there will be a lot of investment in senior housing. What's the delta between what we need and what we have right now?
Yeah, it is pretty dramatic. Well, let's look at essentially the 80-plus population is expected to grow by 50% over the next 5 years. So if we even keep penetration rates the same, meaning, we only have a small fraction of that senior population in senior housing, we are undersupply. We are building about half of what we need. We actually think there's a case to be made that penetration rates should increase because, look, it's not only that this is where so much of the population growth is, it's actually where so much of the wealth is concentrated. We know that, right? Over half of this country's wealth is concentrated in this age cohort. So actually, if you look across different residential categories, it tracks as among the most affordable because this is a cohort that, through the combination of home price appreciation, stock market appreciation, et cetera, can afford to pay for this.
Well, that's what I wanted to ask you. When I think about whether it's baby boomers and the whole population that's aging and will need maybe certain types of housing, how much can really afford it? I think we always assume that everybody's going to be able to pay the bill.
Yes.
Is there, I do wonder about the build out. Like, is it too much? Because not everybody will be able to afford it, and whether that means they live with kids or something else. I just wonder how much, because this has certainly been an investment play we've talked about for a long time.
Yeah, no, look, it's a profoundly important question, both financially and socially. And I'd say the short answer is, for private pay-oriented assisted living, broadly speaking, yes, it tracks as much more affordable. So for more traditional residential, it's paid for by current income, right? And we obviously are seeing some inflationary pressures, et cetera. Senior housing tends to be more paid for by savings, whether that's distribution, dividends off of your savings or actual drawdown of assets. So I sell my house and that gives me N number of years to afford senior housing. And the reality is, because you've seen home prices increase so dramatically over the last 30 years that many of these seniors have been in those same homes, they can actually afford it.
But is there an assumption of a number that you guys think about of the aging population that 50% of them will be able to afford some kind of senior housing? Is it 40%? I'm just curious, because I think we make an assumption that everybody's going to get old is going to be living in, kind of nice assisted living or something. And I don't think that's the case. And I'm just curious about that.
Yeah, no.
It goes back to the overbuild,
Yes, well, I think it's obviously there are different segments of senior housing, different price points. Obviously, the margins are a bit different, so there's a provision of services. But what I would say is, in a way, you have a natural hedge because there are healthcare provisions needed for this population. And in fact, often staying at home, even if you're living with your children, there is a cost to the healthcare provision there.
Right.
So I think what we're seeing is the adoption of technological innovation, among other things, to bring down the cost of this provision of services that can sometimes be done more efficiently in that format.
We could have an entire discussion on the economics of this. we're seeing it anecdotally. Colleagues who are leaving to actually spend time with their aging parents and take care of aging parents. This is going to hit. Leaving a job, Like,
because
this is going to hit.
taking their parents in.
Which comes with a financial opportunity cost.
Exactly. The elder millennials and Gen X really living through this as we speak.
It's unbelievable. Thank you for coming in.
Thank you so much.
Yeah, really interesting. We'll see what 2026 holds for all of us. Happy New Year.
To you as well.
Lauren Hochfelder, she's co-CEO of Morgan Stanley Real Estate Investing, joining us right here in studio. Hey, folks, just a quick update on the trade for you on this Tuesday. As you know, the Fed kicking off its two-day meeting. We've got stocks kind of little changed at this hour.
Yeah, doing nothing, the S&P 500.
Yeah, just down, not even 1 full point. Dow down about 121 points, 0.25% to the downside. And the NASDAQ 100, slight gain, up about 35 points, up about 0.1%.
Healthcare down about 0.5 percentage point. Industrials down 0.3%. Real estate down 0.3%. On the flip side, energy in the green, up 0.8%.